revenue was down 2.8% sequentially versus the estimates of 1.5%. EBIT margin is at 14.6% versus estimates of 13.7%. Now coming to Angel One, operationally it's a strong quarter reported by the company. Revenue has seen an uptick of 11% sequentially and PAT has seen a growth of 27% sequentially. Next up is ICICI Prudential AMC. It's a strong quarter that the company has reported. Revenue has seen a growth of 7%. PAT has seen a growth of 10%. This is boosted by an uptick of 52% sequentially in the other income of the company. HDB Financial, net profit up 36%, NII up 22% on a YoY basis. Waaree Renewables, the revenue has seen an uptick of 2.4 times. Margins stood at 18.6 versus 19.8, and the margins have been impacted due to higher raw material cost. Prestige Estates also came with its Q3 update. The pre-sales has seen an uptick of 39%, collection 40% on a YoY basis. Cipla is the next one. The manufacturing has been temporarily paused for the drug Lenoride, and the resupply is expected to resume in H1 FY27. Translane, on the back of order win of 527 crore. BHEL starts supply of underslug traction transformers of Vande Bharat sleepers. So all in all, we'll be watching out for all these stocks in today's trading session.
Upasana, thank you for that update there. And lastly, hop over to Sudarshan for cues from the FNO space. Sudarshan, belated birthday greetings to you. And well, what's the Nifty FNO setup indicating right now? Do we move beyond that 25,800 resistance band?
Thank you very much and very good morning. So the key question for today is, can Infosys provide the much needed push to the market that we have been waiting for the last few trading sessions? As far as the Nifty range is concerned, the range remains from 25,500 to 26,000. And for the last few days, one thing we have noticed is that Nifty is trying to hold, protect the downward levels of around 25,500 to 25,600. It has not gone below 25,450 on Thursday. It had hit, but it had not gone below that. As far as the FI flows are concerned, in the index future we have seen minor selling. In the stock futures we have seen minor buying. FI's long exposure remains around 8%. On the short side they remain heavily shorter and the exposure is 92%. On the call side, so in the last hour of trade, we had seen buying in the Infosys, and that time 25,800 call had become very active. So at one point, the premium was around 60, and suddenly it had seen a big surge, and at the close, it was around 80. So 25,800 remains very important resistance level for Nifty, and the second call option, which was active, was 25,600. On the put side, 25,600 and 25,300 were the focus ones. So support 25,560, first support, that's 100 DMA, resistance 25,960, that's 50 DMA. For Nifty Bank, first support will be 59,450, that's 20 DMA, and next support comes around 59,150, that's the 50 DMA resistance, 60,437. Two stocks remain in the bench, Sale and Samant Capital. Keep on some other stocks, Infosys, Rima will be talking the details, but this stock was seeing fresh longs, Astral was seeing fresh longs, and on the short side, Voltas has been seeing fresh shorts.
Oh, keep an eye out on Infosys, could potentially be the stock of the day as well. Sudarshan, thank you for that update. And speaking of the stocks, or stock of the day, Infosys will be reacting to its results. Rima is joining in with the fine print. Rima, morning.
Hi, good morning. Well, going by the Infosys ADR on Wednesday, where it was up nearly 10%, you get a sense of the kind of market reaction. Well, onto the numbers, a beat on the company's top line and a guidance upgrade. The company's top line went up by 0.6% versus estimates of a flat performance. The guidance for FY26 was not narrowed, it was raised. The guidance stood at 2 to 3%. It now stands at 3 to 3.5%. Margins came in line with estimates. On the back of the new Labour Code, there was a one-time impact on the company's margins and profitability. But adjusted EBIT margins came in at 21.2%. Onto the Labour Code impact, it was 1,289 crore. As a result of that, the reported margins were lower at 18.4% and the bottom line declined by 9.4%. The other two internals which were positive, one is deal win, substantially higher sequentially at $4.8 billion. This was boosted by the NHS deal. And secondly, the headcount addition was also strong over the last 2 quarters because that is seen as a proxy for demand. So headcount has gone up by nearly 11,000 plus employees in the last 2 quarters. Back to you.
Rima, thank you for that update. We'll keep an eye out on Infosys in today's session. Also listening to what the management had to say in their earnings call.
Growth guidance, we are just finishing the third quarter, so only 1 quarter is left. So this, we have had a lot of large deals in the previous few quarters. Plus, we had a very strong execution in this quarter. We've also seen, you asked a little bit about the industries. We've seen, for example, in financial services, and we've seen in energy, utilities, resources, services. We see that the way the deals have come, the way we have become AI partner of choice with our largest clients, we see a good outlook even as we look into the next financial year.
Now, big boy Reliance Industries is set to report its third quarter numbers later today. Sonal is here with all the earnings expectations. Sonal.
Expecting a steady quarter from Reliance Industries in quarter 3. Now, do remember, in the last 1 month, the stock is down around 6%. However, on 5th of Jan, it did hit a record high of 1611.8 rupees a share, and the stock is now trading at 27.2 times FY27 EPS. In terms of the consolidated picture, let's take a look at what the street is expecting. A 3% decline on revenue on a quarter-on-quarter basis, but EBITDA is expected to increase by 5% on a quarter-on-quarter basis to come at 48,134 crore rupees, leading to margin expansion as well. Margins expected to come at 19.45%. Profits accordingly will see an increase of 6.5% at quarter-on-quarter basis. What will lead to this growth for the company this time? The oil to chemicals business, because the refining margins have been very strong, specifically the Singapore GRMs, and that's why we'll see growth in the refining segment. However, weakness will be seen in oil and gas segment. And if we talk about the retail segment, where we will see marginal growth, it is expected to increase 3% on a YOY basis, 4% on a sequential basis. If we talk about their Geo business, which has been a growth driver, they will continue to benefit from higher ARPU and subscriber growth, and that is why 16% growth on a YOY basis and 2% on a sequential basis. What are we watching out for now in terms of commentary? Any clarity on announcements in the new energy business? Also, in terms of growth in retail store additions, so commentary there will be very important. And any pricing action in telecom are the key monitorables. Anything around IPO of their segments is something that Street will be watching out for.
Sonal, thank you for that update there on Reliance Industries. Take a short break. All the action from Wall Street on the other side. Welcome back. Now for Wall Street, benchmark indices ended higher on Thursday, rebounding after back-to-back losses after chip stocks and broader AI stocks led that recovery, along with the banking names as well. The Dow gained almost 300 points, supported by Morgan Stanley and Goldman Sachs. The S&P 500 also, and along with the Nasdaq, closed about 0.25% higher. Both of them also closing off the highs of the day. CNBC's Kate Rogers gets us a wrap of all the action on Wall Street.
U.S. markets were up across the major averages in Thursday's trading on the strength of chip stocks and the broader AI trade. The Dow up more than 0.5%, added 293 points. The S&P 500 was up 18 points, and the tech-heavy Nasdaq gained 58. The Commerce Department announced a trade agreement with Taiwan on Thursday. The deal includes a $250 billion investment by Taiwanese companies to build chips and factories in the U.S. The Taiwanese government is guaranteeing another $250 billion in credit for those companies. In return, Taiwan gets a reduction on current reciprocal tariffs from 20% down to 15% and a commitment of no reciprocal tariffs on a host of other goods. And Spotify announced Thursday it's raising subscription prices in the U.S. next month. The company says individual premium plans and student plans will increase by $1, while the two-person and family plans will increase $2 each to $18.99 a month and $21.99 a month, respectively. This is Spotify's third price hike in 4 years. Spotify reported strong earnings last quarter, but revenue and premium subscription guidance were below analyst expectations. That's what's happening here in the U.S. Back to you in Mumbai.
Kate Rogers, thank you for that update there. Now here's some reactions from Austin Goolsbee, the president and CEO of the Federal Reserve Bank of Chicago, on the latest jobless claims data and the broader labor market trends.
Look, I'm not surprised by these low numbers. I've been saying, as you know, for months, our labor market indicators coming out of the Chicago Fed suggest strongly that there's stability in the labor market, that it's not, it's cooling at a slow rate. The low hiring, low firing is not what the business cycle looks like. That characterizes a high uncertainty environment where everybody just kind of pulls back. High layoffs with low hiring, that's what the business cycle looks like. And you saw the unemployment rate tick down. You've seen the vacancy rate still remaining relatively modest, comparable to previous booms, and layoffs are low. You see that in unemployment claims, but you see that in the layoff rate and the other indicators. So I think there's still strength there.
Now, getting you the latest on Donald Trump-related developments, Vinny is joining in our special segment, Trump Watch. Vinny, good morning.
Hi, good morning, Urma. So starting with some of the key updates that have come in the last couple of days. Firstly, US President Donald Trump has formed a Gaza Board of Peace, a phase 2 element of a US-backed plan to end the war in Palestine territory. Now, Trump said that the members of the board will be announced shortly, and the body would oversee a Palestinian technocraft committee managing a post-war of the Gaza. Now, in a separate post on Truth Social, Trump also celebrated stellar financial data attributing U.S. economic highs, hundreds of billions in tariff revenue, no inflation, and no peak national security solely to the tariffs. Moving on to some developments with regards to Venezuela. President Trump has reported a productive call with Venezuela's interim President Rodriguez, and the two leaders said have discussed oil, minerals, trade and security as the U.S. aids stabilization of the country. Now, he also predicts a spectacular bilateral partnership restoring Venezuela's greatness going forward. Moving on, Trump reiterated U.S. national security needs a Greenland for the Golden Dome project, urging NATO's support to block Russia or China. He emphasized America's rebuilt military makes NATO effective only under United States control of the territory. And finally, in the last update that we have today, the United States has struck a deal with Taiwan, slashing tariffs on its goods to 15% from previously 20%. And this is as a part of an agreement that the Taiwanese chip and technology companies will invest at least $250 billion in production capacity in the United States, and the Taiwanese government will guarantee $250 billion in credit for these companies as well. Back to you, Urmas.
Vinny, thank you for that update from the White House. Take a short break. Cues from the commodities market on the other side. Stay tuned. Welcome back. Now, the Supreme Court has ruled that Tiger Global's sale of stake worth $1.6 billion in Flipkart to Walmart will be subject to capital gains tax. Now, the tax department is claiming dues of nearly 14,500 crore rupees. Remember, the share sale, which took place in 2018, was part of Walmart's $16 billion takeover of the Indian e-commerce firm. Now, Tiger Global claimed exemption from capital gains tax under the India-Mauritius tax treaty as it held stake in Flipkart via a Mauritius-based entity. However, the tax department has alleged that the company used the Mauritian entity to sidestep the tax dues. The Supreme Court, in its judgment, stated that the tax benefits are available only to genuine entities with commercial interest. And Manisha Gupta now joins in with all the updates from the commodities space. Manisha, good morning. There's a bit of a sell-off in oil as well as in some precious metals overnight.
Oh, well, it has been, yes. So Thursday did see some sell-off in various of these commodities. But when you look at Friday morning, we seem to be looking at some of these gains coming back. So you have gold prices holding around $4,600 an ounce. Silver is back above $91 an ounce. So even as US has reiterated that they will not be putting tariffs on the critical minerals, that is a bit of a ease that the metals perhaps have seen. Having said that, while you may not see an interest rate cut from US in this month, but the markets are putting in a probability of at least one rate cut in the first quarter of 2026, and that continues to be quite supportive. Copper prices hit all-time highs on Thursday night. We also have seen tin prices trading at an all-time highs on Friday morning right now. So money seems to be coming out of gold and crude in some sense, but it does seem to be moving into copper and tin because that are your all-time highs today, Friday morning.
Manisha, thank you for that update there. Getting you updates now from the elections in Maharashtra. Exit polls have projected a massive victory for the Mahayuti in the BMC polls, with the BJP Shiv Sena alliance set to cross the 130 seat mark in the state. In contrast, the Shiv Sena UBT MNS alliance is expected to lag far behind, with projections placing it at just over 60 seats. The Congress is likely to get around 20 seats. The counting of votes begins at 10 a.m. and the results will also be announced later in the day. We take a leave on this edition of Power Breakfast. Bazar Morning Call on the other side to set you up for the day's trade.
begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. A market holiday, Friday session that is today, and of course going into the weekend. A lot of politics, of course, here in Mumbai with the election and, of course, the results today. So it's going to be an interesting one. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, morning.
Hi, morning.
Hi, good morning. And still no decision from the Supreme Court on the US tariffs.
In the US, yeah, on the US.
Still no decision there, but lots of geopolitical headlines to navigate.
Yeah.
Lots of flashpoints, volatility seen across in various asset classes.
Yeah.
And I think we got a lot of cues, and it's going to be a very earnings-focused day today, particularly with regard to the Nifty. So we'll delve into that a little bit more.
Yeah, but, the geopolitics you spoke about, thankfully, seems to be, at least for now, calming down a little bit, right? And I think that's what we want to start with before we go any further. And of course, I mean, it may all turn out to be sort of... It may blow up yet, but the point is, so far as we begin this session, it looks like, at least over the last 2 days, the Iran-related geopolitics are seemingly calming down. Oil prices, that's the big headline, are down 6% in the last 2 days to 64. I mean, just under $64 a barrel. So they've seen a sharp spike up, and I'm talking about Brent here, and that is not a sort of trivial drop that we've seen. Now, and of course, this is the trajectory which most expected out there, that, with more supply out of Venezuela and, if something happens with Iran and more, but that's longer term, more oil from both these countries eventually. I mean, that's a longer term story. Near term, it would have meant disruption, etc. So prices spiked. And as the geopolitics around Iran starts to, settle down, you've seen a pullback as far as oil is concerned. Now, how do we know that, and why did markets take that, the understanding that maybe things are settling down? Because President Trump has said that the killing in Iran is stopping, and basically markets understood from it that at least for now there is no direct action from the United States in Iran. Although I must say, Fox News is reported late last night that U.S. military assets are still moving to the Middle East. So the buildup is still there. So can never say never, but at least for now, it looks like things, the market understanding has been that things are, a bit of diffusion is happening. And incredibly, I'm not going into too much detail, it looks like, Middle Eastern countries have prevailed upon President Trump not to get involved in a direct action to topple the regime in Iran. It'll kind of trigger a wave of instability in the region. Now, no Supreme Court ruling on U.S. tariffs. They were supposed to come on Tuesday night. And, we were supposed to react to it today, but nothing, once again, for the second straight time. The ruling will come, we just don't know when. And, of course, markets struggle to find direction on the back of it. Last 2-day change on the S&P, nothing very much, about a quarter percent down on the S&P. NASDAQ down about 0.75%. Banks in the US have reported stronger earnings, and we've got more lined up later today. So that's going to be something to watch. Jobless claims in terms of economic data, lowest since November. Empire Manufacturing and Philly Fed also beat expectations. So data out of the US is looking pretty solid. You look at earnings, you look at, the high-frequency economic data as well. Now, silver and other precious metals have also seen a bit of a retreat. So at one point, silver, day before yesterday, actually was down, late into the session, was down 7%. It recouped losses. But across the board, if you just look at things, 2-3% lower on silver, palladium, platinum, gold, that kind of thing. Trump, of course, there was another bit of news, right? Trump was supposed to, at least investigations were on, and there was some fear that Trump would impose a 50% kind of a tariff on critical minerals. Trump has said that he's not doing it. What he's considering to do is imposing a floor on some of these things, and that was taken better. But in any case, I mean, prices on the back of it have come off. U.S. markets are shut on Monday, although they're trading today, but on Monday they're shut. World Economic Forum in Davos, so I guess no time like this to understand from the top leaders who will gather in Davos in Switzerland to get an overall world view, and the CNBC TV 18 team, of course, will be there. Just to tie in the levels, Nifty still exactly at the 20 weekly moving average, which is what we've been putting out for the last several days now. So 25,642 is the 20 weekly moving average, and that is important. On the way up, I mean, if you're looking for trades, etc., the nearest is the 40-day exponential moving average, which is the 25,924 level. For the Nifty Bank, well, we are again here exactly at the 20-day, a very short-term but important pivotal moving average. That level is 59,448. There's lots of trading type calls, and and we'll get to all of that in just a bit. The oil drop, I think, was also important for specific names. OMCs, etc., should be in focus. We'll get to all of it in just a bit from now. But stock specific, I guess, more than a broad index kind of a call is what's at play. GIFT Nifty gives you a quick sense of how we're likely to start. I think we're about 70 odd points higher to begin this session. Nigel has walked across to the wall with a sense of how the position is looking like. Nigel, over to you.
Well, it'll be interesting to see whether or not we do get that 70-point bump up that the GIFT Nifty is suggesting, and if we can hold on to those levels. For today's trading session, with regard to results that came in the last 24 hours or so, results that are due today and results that are due tomorrow. Net, you have close to around 35% of the Nifty that will be reacting or will be in focus owing to its number. So it's going to be a result-focused day for the Nifty itself. What about the flows? Well, the FIs continue to remain sellers. The DIs, well, they are buying is offsetting that selling. But the FI sell number at more than 4,000 crores, a little bit of a worry. And remember, on index futures, they continue to remain net short. They added close to around 1,800 contracts on the short side. You have the positioning that is at around 92.4% or thereabouts. So they're aggressively net short. And in absolute terms, the FI net short positions at around 2 lakh. Well, 2 lakh contracts is for the first time we've seen all the way since the 24th of February 2025. So aggressively net short is what we are seeing them. And remember, there's been a change in the lot size as well. Moving to the client positioning, well, that they are net long. And normally we have seen that both of them have been moving to different directions. The PCR, that's at around 0.81. Remember, that had started the week at close to around 1.5. Then it did pull back. And now, in fact, it's holding at around 0.8. So just a few trading sessions ago, it went to that peak of around 1.5. Then, in fact, it did cool off to around 0.6. Currently, around that 0.81 or thereabouts. There are two strikes that are very active, and they'll give you a broad range. 25,700 call, very, very active. You did see that in Friday's trading session, in Tuesday's trading session as well. And the 25,600 put as well, good amount of open risk build up is what we had on both these two, which brings us to that broad 500-point range that I've been talking about. The recent low, well, comes in that vicinity of around 25,450, around 25,500. That's what the options data suggests as well in terms of a support, while resistance 20-50 DMA as well around that 26,000 odd mark. The index to track today will be the tech index because Infi could react positively, and that's close to around 30% of its weightage on the IT index itself. So if Infi does well, that's what's going to help the tech index to at least hold its own, and the Nifty Bank will have to continue to lead the way. But you have Infosys that will be reacting to its numbers. HDFC, ICICI Bank, they are due with their numbers tomorrow, while Reliance comes out with its set of numbers today. So put all these together and throw in there Tech Mahindra as well as Wipro, you have more than 35% of the index that will be in focus just on the back of results. So I'm going to keep an eye out on all these stocks. The stock that I'm looking at, though, is going to be Dalmia Bharat. Remember, the last 6 months, the stock corrected from around that 2,500 odd mark. It came down. Last few trading sessions, it's been doing quite well. Now, reports are indicating that both on demand as well as on pricing, things are actually recovering, which could bode well. So an underperforming sector, cement, could find its way in focus, at least in the near term.
Thank you very much for that. And interesting pre-positioning in the stock. So Reliance Industries ahead of numbers is down 7%. HDFC Bank, post the quarterly disappointment, is also down 6.5% on a year-to-date basis. But on the flip side, ICICI Bank has been the rank outperformer, up 5.5%. And Infosys ADR, up 10%, sets the tone, perhaps, for Tech Mahindra and Wipro as it reports numbers post-market hours today. So pre-positioning in the stocks is also quite stark and sharp this time around. Matt Orton, Chief Market Strategist at Raymond James Investment, is now joining in. Matt, thank you very much for joining in. As we said, there's still no decision from the US Supreme Court on tariffs. Does the lack of a ruling on tariff make it difficult for markets to have a clear direction, at least in India? Because amongst all, we seem to be more sensitive to what happens on the tariff front.
Hi, good morning, Rima. And I think the lack of certainty with respect to tariffs certainly impacts sentiment with respect to India. And I would say from a foreign investor sentiment perspective, it's particularly acute because you have other emerging markets like South Korea, Taiwan, China, where there's more visibility with respect to what's happening, and just more clouds that continue to come over India with respect to Iran, and still not having a result from the Supreme Court or a resolution to a trade deal in the first place. That being said, what I urge investors to look at, and this is with respect to India and really the rest of the world, is to avoid reacting too much to the headlines that are out there and really follow the fundamentals. We've been in a macro-driven market for the past couple of months, really since the last earnings season, and now we're finally getting corporate results around the world. And results so far have been pretty good. In the U.S., financials have been very, very strong. It's encouraging. Again, the share prices rallied into the earnings, which maybe led to a little bit of a letdown. But overall, investors should lean into names that have been a little bit weaker, but report really good numbers that are levered to strong fundamental growth drivers in the economy. And I think that sets you up well in 2026.
Matt, hi, morning. In terms of your conviction bets, what would those be? Anything new, Matt, in that sense? Because prices have fallen, and as prices fall, I mean, I guess more and more stuff comes into the investable zone. So tell us.
Yeah, no, it's a very good point, Prashant. So I like when names fall heading into earnings where there isn't really fundamentals driving it. You know, the reaction to HDFC, I think, is overstated. I'll be very curious. I'll be watching to see what the results are for both HDFC and ICICI. I would expect to see decent results. The key is going to be, margin enhancement, where the directionality is with respect to ROE, how we're mobilizing loans. If we get decent results and growth there, I think you could see a pop with respect to share price. But IT has been an area I've been keeping my eye on. We started this year talking about some of the green shoots in IT within India. Infosys has been interesting. You look at the strength, particularly around global asset management and financial services, having willingness to sign bigger contracts. So you're getting better visibility with respect to large deal flow. If you can see names like, Tech Mahindra, who also has decent exposure to IT around the world, report good numbers, I think that could be really, really interesting. And those could be more long-term turnaround stories where valuations look very attractive right now.
So Tech Mahindra over Infosys at the juncture, and Infosys ADR did very well. Are investors also sharing the optimism surrounding Indian IT? I mean, do we see a turnaround in stock prices from here on?
I think you can, assuming the rest of the results come in good. This group has been trading a little bit less correlated over the past year, which is encouraging. Again, it signals to me that fundamentals do matter. Obviously, Infosys is the giant in the room, but I think a name like Tech Mahindra, I like just the diversity of exposure and the significant room for margin expansion that the company has related to being able to sign bigger deals. I think Infosys is a name that is cheaper. It's underperformed. So from that perspective, I think it's interesting for maybe a value investor who might want to buy something more at a discount. But I think the premium asset that has the best chance for strong margin growth in 2026 into 2027 is going to be Tech Mahindra.
Okay, all right. Matt, a quick word on the geopolitical issues, because they have suddenly cropped up, and it appears most equity markets are just looking through that. Do you think investors are being a little too casual about it, and that can actually suddenly perk up and hurt sentiment big time?
It could. When you just take the whole geopolitical world right now, Nigel, there's increasing fracturing that's happening. And there's a lot of hotspots around the world. And so I don't think the market's necessarily whistling past the graveyard. It's just, I think the market's a little bit jaded to the news flow that continues to barrage investors on a daily basis with no resolution and nothing really happening on both the left or the right tail. And so what I encourage investors to do with this, and I've been very long across my portfolios really for the past year, has been playing offense and defense with defense companies. So I'm looking at companies that specialize in drones, autonomous warfare, the next phase of where governments are making investments and spending more money. You saw a Truth Social post from President Trump here talking about increasing the defense budget from $1 trillion to $1.5 trillion. You're seeing money being spent by European governments, more money being spent by governments in Asia around defense. And I think that is a very long-term, durable trend that's already impacting earnings. So if you want to hedge those sorts of risks, I would say look for premium assets across the defense complex. And I think that's a great complement to portfolios right now.
Any defense stocks in India?
India is a little bit tougher for defense stocks. So Hindustan Aeronautics was a name that I used to trade in. Right now, I just don't have as much visibility with respect to helicopter purchases, where exactly they're planning to have growth with selling outside of India as well to other Asian nations as you compete against China. So right now, my preferred areas to play defense rests both in the U.S., not on the contractor side, but on the more missile, rockets, and technology side, as well as some European defense companies as well. I think those are the assets that have the most potential to report strong earnings in the near term.
All right, Matt, thank you very much for joining in. Let me tell you the interactions that are lined up on the show today. So first up, coming up at 8:35, we've got PL Capital's Amnish Agarwal to discuss the stock fundamentals. At 9 a.m., we'll talk about IT and the tailwind that Infosys numbers could provide to the rest of the pack. Bhavin Shah of Samiksha Capital will join in. 9:20, Pankaj Murarka of Renaissance Investment Managers will be a market master for the day. 9:30, we'll get you a discussion around the oil uncertainty amid geopolitical tensions. And following that, we'll be chatting with the management of LTTS post their Q3 earnings at 9:40. And Vishal Goyal, the India financials analyst at UBS, will lay out the expectations from HDFC Bank, ICICI Bank as the banking earnings also begin. Towards the end of the show, we'll get you a discussion with the management of Union Bank of India after their Q3 numbers.
Well, time to take a quick break. We've got a lot of stock-specific action to track for you today. We'll get to that in just a bit in our special Top 10 segment. We'll look at Infosys, ICICI Prudential, Angel One, Godrej Properties, Prestige Estates, and Restaurant Brands Asia. All of them will be reacting to positive news flow, while you have HDFC Life, L&T Tech Services, HBD Financial Services, and Cipla that will be reacting to negative news flow.
Welcome back. You're watching Bazar Morning Call. It's a Friday morning and it's a sandwich session between two holidays, but lots of stocks on our radar this morning, many reacting to their numbers. So let's kickstart with the big one, and that is Infosys. Our entire research team is also standing by with CNBC TV 18's list of top stocks for the day. Everyone, good morning. Happy Friday to you all. But let me begin with Infosys because the ADR closed up 10.5% on Wednesday. On Thursday, it had a flattish finish. So don't look at this number. We are going to focus on the Wednesday's reaction, which is when the stock closed up with a gain of about 10%. What did the investors like in the numbers? One, Q3 revenue growth was a beat at 0.6% versus flat. FY23 guidance was raised. The earlier guidance was 2 to 3%. It now stands at 3 to 3.5%. So that was a positive. And thirdly, even on the deal front, the deal wins were very strong. $4.8 billion. Of that, 57% were net new. And in the management commentary, in the conference call, the company also said that the outlook is improving for financials and energy utilities. So they're saying FY27 will be better for financials versus FY26. And financials is the giant in terms of a segmental contribution. Brokerages on the back of this performance have also raised estimates. So CLSA says for this year, we're expecting 3.4% revenue growth versus 3.1% earlier. Even for next year, we've raised the growth target by 30 basis points to 6.3%. Jefferies has raised EPS estimates by 1%, and they expect the company to deliver 7.5% EPS CAGR. So good Q3 and some upgrades coming through on Infosys post the numbers. But LTTS has had no such luck. What the company has done is they've decided to recalibrate their business. So they've said that they will not be pursuing some low margin accounts. As a result of this, in Q3, there was a loss in revenue. Overall top line went down by 2.8% on a quarter-on-quarter basis versus estimates of a 1.5% work. But as a part of this business recalibration, the company is also pivoting towards higher margins because they're exiting from low margin businesses. So EBIT margin performance was strong, expanding by nearly 200 basis points on a sequential basis. The overall guidance now has come down. Earlier, they were talking about double-digit revenue growth. Now they're saying it will be mid-single digit. HSBC says that the company has got very good capabilities on the ER&D side, but now its growth potential versus peers appears to be on the weaker side. So green for Infosys, red for LTTS.
Got it. All right, Rima, thanks a lot for that. So we'll keep an eye on both those two tech names. But Yash joins in to tell us about HDFC Life. Morning, Yash.
Morning, Nigel. So for HDFC Life, I'm going with red simply because though the numbers have been in line what the expectations were, but the expectations themselves were very weak. So new business premium for the third quarter has come with a slight mix. Total AP, individual AP, VNB and margins have come slight ahead of what the street was anticipating. Now, I'll tell you why the numbers are weak, and the absolute numbers would tell you that. New business premium growing at just about 5%. Total AP growing at 11%, individual AP growing at 13%. But see the value that they've been able to derive. VNB just about 3% out of 11% growth in AP, and new business margins were down about 200 basis points on a year-on-year basis. So simply going with red on HDFC Life because the numbers are though in line with estimates, but the estimates themselves are very weak.
Okay, all right. That's HDFC Life. Thanks very much, Yash, for that. HDB Financial Services is the next one we want to focus on. Gaurav is here with details. Gaurav, morning.
Well, as going with red in HDB Financial, and the reason being that if you look at the numbers, they look fine actually, because net interest income that increased almost by 22%, PPOP increased by 23%, and in the profit that increased almost by 36% on a year-on-year basis. But what remained a key thing to watch out is that the credit cost, although now on a positive side, it has declined almost by 20 basis point on a sequential basis, and now it has reached 2.5% level. And at the same time, even if we look at net interest margins, we saw a 14 basis point of expansion in this quarter. But what remains actually a concern for street is that the credit cost still remains higher than 2% level that we have seen in the business so far. Apart from that, management also said that in the time going ahead, they will see 10 to 20 basis point of decline in credit cost. So that will still bring credit cost to 2.3 to 2.4%, which is still higher than its earlier estimates and earlier levels. Other than that, despite festive quarter, if you look at the loan book growth, that came in just at around 12.2%. In fact, the disbursements, they also increased just by 10% on a year-on-year basis. Now, this is considering the festive season and the GST cuts that we have seen. And apart from that, if you look at the management's guidance as well, they say that they want they aspire to grow 6 to 8% higher than the nominal GDP, but the current growth rate, it's still lower. Now, if you look at the valuation, it trades at 2.6 times price to book, which is still expensive for a company which is growing at around 12 to 13%, because the last quarter was also a slow quarter for HDB Financial. As a result, if you look at MK, they have also downgraded the stock to reduce. So all in all, decent set of numbers, but because of the lower growth and higher credit cost, which is still there, going with red on this stock today.
All right, Gaurav, thanks very much for that. That's HDB for you. Well, you want to talk about, Cipla, which is in focus, not in a good way. Ekta is here to tell us more. Ekta, morning.
Morning. Well, yes, it's a fresh setback for Cipla when it comes to lanreotide, which is basically their tumor drug, and they have 22% market share. It's one of their top 3 drugs in the US. Remember that it was in focus because its partner, Pharmathin, their Greek facility, had received 9 observations. So now the latest development is that the company has said that manufacturing has temporarily paused off the drug lanreotide to support remediation. And as of now, there could be a possible resumption or resupply, which is only expected in the first half of FY27. So earlier, the street was not sure about, what the impact could be. But as of now, we know that maybe FY27 earnings could be impacted. Remember that Cipla has 22% market share in lanreotide in the US. They recorded around $233 million in terms of US sales in Q2 FY26. And US sales were at a record high in FY25 at $934 million. That was mainly because of Revlimid generic, but lanreotide was one of the key contributors as well.
Well, big potential impact then going forward. Ekta, thank you very much for that. Sonal joins in to give us the latest on Godrej Properties and Prestige Estates. Sonal, hi, good morning.
Good morning, Rima. Well, we've been talking about the realty space for a while, but there's some good update coming in. For Godrej Properties, their pre-sales are up 55% on a YOY basis. Collections are down 29% on a sequential basis, but they're up 40% on a YOY basis. In the 9 months as well, their sales are up 25% and collections are up 19% to come at 12,000 crore rupees. For Prestige Estates, they have broken records this time. In quarter 3, pre-sales are up 39%, collections are up 40%, but in 9 months, they've already crossed FY25 sales. These are the highest ever sales that the company has recorded, even collections for that matter. So pre-sales, they have come in at 22,327 crore rupees. Collections have come in at 13,283 crore rupees. This is the quarterly update. Additionally, they have launched another project in Bengaluru itself, which has a gross development value of around 5,000 crore rupees. So going with green with both these names.
Right. Thanks very much, Sonal, for that. So that is, a bunch more names. Restaurant Brands Asia is the next one we're going to focus on. This is a confirmation of a story that Vivek put out earlier. Vivek, morning. Tell us more.
Well, good morning. That's right. So Restaurant Brands Asia, late last night has actually put up an exchange notification. They've said that there is now a board meet that has been scheduled on January 20th. This particular board meet is to consider various fundraising options, and the fundraising options that the company has spelled out include an equity issuance of shares. Along with that, they may also look at a private placement basis of preferential issue of shares, and this is amongst a whole host of other fundraising options that they may look at. Now, just to remind our viewers, on November 24th, we had reported that the large PE investor, which is Everstone Capital, had gone ahead and reinitiated efforts to exit their entire stake in Restaurant Brands Asia. We understand that a large family office of a listed entity, as well as a few other PE firms, were in the race. So it'll be interesting to see eventually who gets the maximum chunk as far as Everstone's stake in Restaurant Brands Asia is concerned. Now, the most important thing to watch out for is the fact that despite the fact that Everstone has less than 25% stake, given there will be a change in promoter, whether the open offer is triggered or not.
Okay, all right. Thanks a lot, Vivek. We'll keep an eye out on that particular name as well. Ria joins us to tell us about ICICI Pru AMC as well as Angel One. Morning, Ria.
Well, good morning, Nigel. Let's start off with Angel One first. This has been an operationally strong quarter for the company, beating estimates across the board. The revenue has gone up by roughly 11% to 1,335 crores, led by a 16% uptick in interest income sequentially, beating estimates by around 7%. The EBITDA is up around 26% with a margin expansion of 30%, led by operating leverage on a quarter-on-quarter basis. And the NPAT has also seen an increase of of roughly 27% sequentially to 269 crores, beating estimates by roughly 11%. On the operating front, the client funding book has gone up by 11% to 59,000 crores on a sequential basis. The average daily turnover has also gone up by 22.8% overall and 22.2% in the FNO segment. The average daily premium turnover has gone up by roughly 39%, and the market share has also been maintained in equity as well as FNO, although the commodity segment has seen a decrease of roughly 1,200 basis points to 53.1%. And apart from this, the company has also announced a stock split in the ratio of 1:10. Moving on to ICICI Prudential AMC, this is the first quarter of earnings for the company post its listing. This has been a strong quarter for the company, and this has seen faster quarterly average AUM growth versus the industry average of 5%. The revenue has gone up by roughly 7% sequentially, and even the EBITDA has seen an expansion of around 9% with margin expansion of 150 basis points. The net profit has also gone up by around 10% sequentially for the company to 917 crores, boosted by an uptick of around 52% on a quarter-on-quarter basis in other income to 109 crores, along with operating leverage. The mutual fund quarterly average AUM growth stands at roughly 6.1% on a sequential basis, and the equity quarterly average AUM growth stands at 7.3% for the company. Both of these stocks expected to open in the green today on the back of strong earnings.
Thank you very much for that. ICICI Pru AMC has had a good run since listing. The issue price was 2,165. As we speak, the stock is up 20% from that level at above 2,700. Here is a quick recap then of the top stocks. Stocks with positive news flow are Infosys, ICICI Prudential, Angel One, Godrej Properties, Prestige Estates and Restaurants Brand Asia, while stocks with negative news flow are HDFC Life, LTTS, that's L&T Technology Services, HDB Financial Services and Cipla. Well, moving on now to what's happening in the world of commodities. The big story and talking point is the sharp decline seen in crude prices overnight. Manisha, down nearly 4% as Trump has dialed back on military threats and intervention in Iran.
Well, absolutely. That is one sole reason that you have seen a profit taking coming for the crude oil prices. So from almost $66 a barrel, we are trading at around sub 63 at this point in time. Apart from that, it also is about the U.S. inventories, which have gained for a second straight week. Markets do believe that the U.S. production will peak sometime in 2026, and 14 million barrels per day is what we could be looking at on a per-day basis from U.S. Apart from that, it also has to do with a bit of a strength that has come back in the dollar index. That seems to be weighing on to the crude prices also. So while energy is down, there is some profit-taking that we've seen in gold and silver as well. With that geopolitical tension, especially from Iran, slightly easing off, seems to have led money out of precious metals. But that is the whole thing. The money seems to be going into base metal prices because copper is still trading at near all-time highs. You have tin trading at all-time highs. Aluminum now touching a new 3-year highs. So that really is how the money seems to be rotating right now. So the base metal prices have opened quite positive.
All right. Thanks very much, Manisha, for that. So that is what's happening as far as commodities go. We take a quick commercial break here. We're going to come back in just a bit from now. Amnish Agarwal, Director Institutional Equities at PL Capital, is going to be with us when we return. Stay tuned.
Welcome back. You're tuned in to Bazar Morning Call. You're on CNBC TV 18. Well, as promised, let's get in Amnish Agarwal, Director Institutional Research at PL Capital. Hi, Amnish. Thanks a lot for joining in. Well, the big stock really from the Nifty today is going to be Infosys. Been a bit of an underperformer, but the results looks pretty okay. What's your view on the numbers from your on?
You see, hi Nigel, IT stocks have not incrementally disappointed in this quarter. So there were very low expectations from IT when you can say the earnings season started, but incrementally there has been no disappointment, although the growth visibility has not considerably improved for the sector. But having said that, it seems to be forming like some sort of a base. Given that the valuations are corrected, there seems to be reasonable upside, but not a very, I would say, it's not something where the visibility is great, but because the valuations have corrected, there could be, you can say, some bit of, you can say, trading upside, which can come in many of these stocks.
Amish, do you look at restaurants, Brand Asia, the company which has the master franchisee for a Burger King, Popeyes, Tim Horton? Now, they're planning to hold a board meeting on the 20th to consider a fundraise. And earlier, our colleague, as Vivek was pointing out, there's also talk about Everstone, which has an 11-12% stake in the company, looking to exit. Tie these two pieces of news flow together and what it means for restaurants, Brand Asia.
The restaurants Brand Asia has actually gradually seen the stake coming off, both from the, you can say, restaurants brand.
There's a little. Okay, I think what we'll do is we're losing you there, Amnish. I mean, the audio is a little patchy. So we'll try and fix that and come back to you in just a bit from now. You know, the other story, right? I mean, this is not directly, it's not going to impact market today or anything of that sort, but this is definitely very, very important. The Supreme Court has ruled that Tiger Global's sale of stake worth $1.6 billion in Flipkart to Walmart, which happened many years ago, will be subject to capital gains tax here in India. The tax department is claiming dues of nearly 14,500 crores. This perhaps can open a Pandora's box for all transactions. I mean, if the IT department wants, it can go and look at all transactions before the treaty, the India-Mauritius treaty was amended before. That is in 2018. So pre-2018 investments perhaps can be reopened basis this Supreme Court judgment. So we spoke with Dinesh Karabar of Dhruva Advisors and Anuradha Dutt of DMD Advocates. And this is some perspective, and this is a story which we will continue to follow through the course of the day. Listen.
The principle of the judgments will apply to all the any treaty eligibility. So in every single case where you are claiming tax treaty benefits, merely because you produce a tax residence certificate, the tax authorities are not bound to agree with you that you are a tax resident, and they could ask you to prove your treaty eligibility. If the CBDT has come up with a circular to say that TRC is sufficient, where does the court come and say that no, it is not sufficient? And that is where the interesting conundrum is, because if that is what the government stand is, why would the government want an attorney general or whoever is representing the tax office to sit and argue before the Supreme Court that no, it is not sufficient? We are giving confusing signals to foreign investors. So it's one thing for us to sit and interpret what does the judgment say and what are the larger ramifications. I think even the more important ramification is what is the signals that we are giving to foreign investors.
Something that was grandfathered in the treaty is now being, GAR is being, introduced, because GAR says after 17, financial year, April 17, it'll apply. So I'm not sure. According to me, this seems to upset a lot of settled law, including whether TRCs are prima facie recognition. So I think it's significant, but the point is, can the two-judge bench upset a three-judge bench rulings? So all these questions will arise, but we'll have to, await the actual letters and words of the judgment. But I think it's important. I'm it's significant, and I do think it's upsetting some bit of already established law. There has been a great dip in FDI investment into India, and government is trying to encourage. I feel that you are sending wrong signals. You are not going to encourage FDI, which is required for your own country's benefit. That's what you want to encourage. On one hand, you take a decision with the Mauritian government that yes, this will be grandfathered, and then in the court you come and say no, this is overridden by this. So this is somewhat not necessary. Government has to decide. They take one decision, they stick by that decision.
Okay, that's the view, and we'll get you more. Amnish Agarwal is with us, and I hope we've got a better line now. Amnish, go on. You were talking about Restaurant Brands Asia, I think.
Yeah, so Prashant, the main thing is ever since it has got listed, the stake has actually gone down gradually from 56-57% to the current level.
Okay, I think apologies, Amnish, and apologies to our viewers. It's a bad line. We'll try and fix it. Let's just take a quick commercial break here. We're going to come right back with more on the other side. Welcome back. There's about 15 minutes to go for the pre-open session. Hormuz is here with the big movers on Wednesday, and price action plus volumes is what the focus is. Hormuz, take it away.
Morning, Prashant. And one stock that has been hogging the limelight over the last week or months actually has been Vedanta, and that stock ended at a record high on Wednesday, well over 6% higher. It was the biggest single day gain since May of last year, and in fact over the last 26 sessions the stock has gained in 21 of them. So it shows the kind of up move that the stock has had. Wednesday's volumes were the highest since June of 2024, and with well over 4.5 crore shares traded, 20-day average of just 1.5 crore shares, delivery based buying worth over 900 crore taking place in Vedanta on Wednesday. Over 1.4 crore shares were marked for delivery. The 20-day average is just under 67 lakh shares, and over the last 12 months the stock has gone up by almost 55%. The one earnings reaction of the day on Wednesday was Union Bank. The stock went up almost 8% after its results announcement, and as a resultant spike in volumes as well. The biggest single day gain since March of 2023, the fourth straight day of gains. It has gained in 8 out of the 10 trading sessions in 2026 so far. Wednesday's volumes the highest since February of 2024, so almost a 2-year high on the volumes front. Almost 9 crore shares were traded on Wednesday, 20-day average of just over a crore, and out of those 9 crore shares, close to 2.25 crore were marked for delivery compared to a 20-day average of just over 52 lakh shares. And in 2026 so far, Union Bank has emerged as the best performing PSU banking stock so far, gains of close to 17%. And lastly, MCX was one mover on the upside on Wednesday. Third straight day of gains, the stock has moved up almost 15% in these last 3 trading sessions. Wednesday's volumes the highest in 3 months, and in 2026 so far, every single trading session the stock has had more than 10 lakh shares being traded in a single day. Even on Wednesday, 53 lakh shares were traded. The 20-day average is 12.5 lakh. Delivery based buying of 500 crore that took place in the stock. The 21.5 lakh shares were marked for delivery, 20-day average of just under 5 lakh shares, and this too along with Vedanta ended at record highs on Wednesday and has more than doubled in value over the last 12 months.
Thank you very much for that. We still have with us Amnish Agarwal, Director, Institutional Research at PL Capital. Amnish, was trying to get your view on restaurants brand Asia. There is an upcoming board meeting to consider a fundraise, plus the interest by Everstone to sell its 11.5% stake in the company. So they're talking to potential investors, PE players. Your thoughts on restaurants brand Asia?
Yeah. You see, Restaurants Brand Asia has actually gradually seen the reduction in the shareholding of Everstone as well as Restaurant Brand International over the years. Currently, the company is majorly run by the board, but I think as of now, I don't see there is any tiring need for fund infusion in the company, but if there is some fund infusion which happens, plus there is a new PE player or some, you can say, promoter comes in the company, so that could be a big positive for the company. But having said that, a lot depends on the future plans of the company regarding their Indonesia business, because that is one which is bleeding, whereas India business seems to be, I think it is in a very steady state, although it is not profitable, but it seems to be a reasonably good business. So I think the more clarity on, you can say, who the PE player is going to be or some new, you can say, promoter is coming, so that could be actually positive for the company.
All right, Amnish, I wanted to ask you about the cement pack. Stocks like Dalmia Bharat, they saw more than a 20-25% correction from the peak in September. To be fair, the seasonally weak quarter, which was Q2, at that point of time, the pricing was pretty okay. But in Q3, we saw intense pricing on, pressure on pricing, both in October as well as November. However, now most brokerage notes and even the feedback that I've got from various market participants suggest that pricing is improving and the price increase has been absorbed, and demand appears to have come back in a big way, both in December and it's continuing in January. What's your view on the pack, and what do you like from cement?
You see, as you said, the volume growth has actually come back in the third quarter. In third quarter, you can say, particularly post Diwali, and even now, the volume growth seems to be, I would say, decent for the entire sector. So, having said that, I think the pricing pressure has been there. There has been maybe, I think, one round of pricing, and the prices are likely to remain firm. Because the problem with the cement stocks has been that the pricing has not been holding on, and that is why the margins have not been on the favorable side. As the pricing holds on, if they are able to take another round of price increase, then I believe we could see the cement stock doing well, because it is usually not like a very long structural kind of a call. So over the next 2 to 3 months, cement stocks can be in limelight if the pricing action which is being undertaken or which has happened, if they are able to hold it on.
Got that. You know, the Commerce Minister yesterday, and I think the confirmation came from the EU side as well, that with the India-EU FTA, I mean, it's possible that we may see a conclusion to it around the 26th of January. I mean, 10 days from now, 27th of January, when the EU chaps are going to be here in India. Anything comes to mind in that sense? Any sectors directly, indirectly impacted because of this? Amnish?
Prashant, very difficult to give any particular sector which could gain from this. But having said that, if you look at, say, because there is a considerable delay which is happening in the Indo-US trade deal, I think this could provide a lot of breathing space to the entire industry. Now, for example, you look at, say, textiles where India is suffering, or even you can say gems and jewelry and some of the other segments. Indian producers can actually find markets over there. And in some of the critical technologies, whether it is defense, or you can say whether it is defense, semiconductors, renewables and all, I think India can actually access some of these technologies from Europe. So if that deal happens, actually there will be a lot of pressure which will go from India for me trying hurry to go into a deal with US. That is one. And secondly, in terms of technology, definitely the country is going to gain.
Yeah. Got that. Countries are going to again. I mean, textiles perhaps is a case in point, right? It's labor-intensive sector, suffered hugely with the US tariffs, and now, of course, the India-EU at least. I mean, India-US. I think the Commerce Minister is on record saying that, well, there can't be a deadline, and there is no deadline to kind of sort of signing it. But at least on the India-EU. And there are so many other bilateral treaties, of course, which India has kind of sort of signed on, are in the works. Perhaps, a little bit of buff. The big one, of course, is the US, but just by the sheer size of the market. But I think EU is not small either in that sense. Rima?
Amnish, just one more question. Do you think HDFC Bank, the reaction on that post the quarterly update is a bit overdone? Stock is down 7% year to date. And if the numbers deliver, do you think there could be a sharp reversal in stock price? I mean, is that a stock that you're looking at?
The HDFC Bank remains a good stock because the valuations are not expensive. But having said that, the only issue which remains with many of these banking stocks, and HDFC in particular, is that their LDR seems to be very elevated, and that ratio is actually coming down at a very, very low pace. So having said that, I think the NIMs are more or less bottomed out, and I think the things should start recovering. So the kind of reaction which HDFC Bank has seen, I think the downside in the stock seems very limited. And we could actually see there could be some bounce back in the stock. Very difficult for me to give you any percentages. But the risk reward at the front level is definitely favorable.
Risk reward favorable in HDFC Bank. Stock may have, NIMs at least, appear to have bottomed out. Thank you very much, Amnish, for joining us this Friday morning. It's over now to Sudarshan for the brokerage call of the day.
So I have two brokerages calls from the financial space. First one is Morgan Stanley has it on Shriram Finance maintains overall call, increases target price to 1,325 from 925 per share. It says that MUFG deal could provide structural gains in profit. Second, asset growth, even valuation multiples can increase going forward. It believes that risk reward is solid and attractive in coverage over a multi-year time frame, and it sees a decline cost of funds by 100 basis points and loan spread to improve by 60 basis points over FY 27-29, and it forecast AUM CAGR of 18% for FY 26-31 and ROA to sustain above 4%, and forecast EPS CAGR of 23% for FY 26-28 and 17.5% for FY 28-31. Coming to Axis Bank, IFL has written it maintains buy call and has a target price of 1,600 rupees per share. It says company is at an inflection point following negative surprises in both growth and asset quality in last few quarters, and investor concerns of weak growth and sticky OPEX should largely be allayed and provision should decline from here on. Now, stock is trading at 30%, 35% valuation discount versus ICICI Bank and HDFC Bank. And IIFL believes that it should gradually narrow going forward, and it forecasts 25% earnings CAGR over FY 26-28.
Okay, all right. Thank you very much. So for that, so those are individual sort of names up on your screen in terms of brokerage calls. And there is more, by the way. I mean, there's lots of stuff today. We'll take a quick commercial break. We're back, and we'll get you some technical trading ideas with Sudarshan, Mitesh. We also have Bhavin Shah, Samiksha Capital to talk about trends in the IT services space and broader markets as well. Stay tuned.
Welcome back. Well, let's welcome our technical experts with us. We have Mitesh Thakkar as well as Sudeep Shah who join us on the show. Good morning, gentlemen, and thanks a lot for joining in. Mitesh, you go first. Index in a range, GIFT Nifty suggesting a bump up. What's the outlook from here on? Do you think you'd like to buy, into this gap up, or you'd advise just stay away from the index?
Morning. I don't think there is a case for buying, purely because of the fact that I'm not seeing any signs of a sustained uptrend developing over here. So while the index can bounce back after a decline from highs of 26,370, I think till we see the index or Nifty stabilize about 25,900, 950 zones, I think negative structure will remain and a chance of a retest of 25,400 is on the card. So for the time being, not into buying mode. Around 25,900, 950 would maybe explore some shorts with tight stop losses. If they get triggered out, then I think the negative structures will be closed, and then we might look at a retest of 26,200.
Sorry, on the upside, what is it? The 40-day exponential or Mitesh? What's the level?
I've given a broad range, Prashant, which is 25,900 to about 25,950, which is multiple moving averages actually, and a retracement as well.
All right, got that. Sudeep, what about you? Good morning. What would you recommend?
Good morning, Prashant, and good morning, Nigel. Prashant, what I feel is that post this gap up that we are expecting, 25,830, 25,850 would be an important level for me, because if we see the retracement from the highs of 26,365 right to the lows of Monday, lows of 25,473, Nifty has closed at its 23% retracement, closer to 25,680. And the 50% retracement is 25,900, as well as 38% is 25,820, 25,830. So I feel this 38% retracements will be very important, because last 3 occasions Nifty has retraced right from this 25,800, 25,830 mark. So crossing and sustaining about 25,830 would be paramount, and beyond that, then Nifty would scale up to 25,950, 26,030 levels.
What about stocks, Sudeep?
Sorry, yep.
Stocks?
Yeah,
stocks where you recommend a trade?
Yeah, the stocks that that I like today is one is from the PSU Bank, that is the Bank of India. We've seen decent results from Union Bank on Wednesday, and post that the PSU banking stocks had another set of rally, and from here I feel Bank of India is looking very positive compared to other PSU banks. Relative strength is better here. So this can be bought with 149 as a stop loss and 160 as a target on the upside. The second stock that I like is Lupin. Here there's a breakout on a weekly charts. The retest of the important support zone at 2150 has happened thrice. And we feel that the stock is ready to move to 2260, 2280 in the coming few sessions. This can be bought with a stop loss at 2150 on the downside.
Mitesh, your stock calls?
Well, Bank of India coincidentally features on my list as well. So good swing breakout over here. Buy with a stop at 151 or just below it, and a target of 157 to about 158 is what I would look for to begin with, and then eventually maybe even higher levels. Also, Indian Bank is a recommendation today. Keep a stop at 829. Look for targets of roughly around 880. A buy call on Angel One, which had a very strong closing on Wednesday. Here, buy with a stop at 2494 for targets of 2590. And one sell call, that's DV's Lab. So on a mild pullback, say around 6370, which is about 17 points higher from the closing. Sell with a stop at 6401 for targets of around 6290.
Thank you very much for that. The stock of the morning could be Infosys. The ADR was up 10% on Wednesday. It gave up about 3% on Thursday, which means net over the last 2 days, the Infosys ADR is up 7%. And there is an optimism that you can see in the stock price, 5% up in pre-opening. The question is, will it lift the rest of the large cap IT names? But one stock on the mid-cap end that you should focus on is LTTS, that's L&T Technology Services. The reason is the Q3 numbers were a miss. What the company has done is they're recalibrating their business. So they're getting out of exiting some low margin businesses, and that is going to have an impact on the company's top line, which is why the company's top line went down by 2.8% versus estimates of a growth of 1.5%. But there is a pivot towards profitability. So margin expansion was there. It was up nearly 200 basis points sequentially, 14.6%. But because of the decline in the top line, the company's guidance for the full year has also been lowered. From double digit, it now stands at mid-single digits. And analysts say on an organic basis, it could actually suggest a decline in the company's top line. So HSBC points out that the company has good capabilities, but its growth profile versus peers is relatively on the weaker side. So LTTS should be a stock on your radar.
Okay, all right. Yeah, so that is the LTTS story out there. Bhavan Shah is with us. He's founder, CIO, and CEO at Samiksha Capital. Bhavan, good morning. Great to have you with us here. Thanks very much for joining us. And happy 2026. I think this is the first chat on the air in this new year.
Happy 2006 to all of you, yes.
Thank you. I want to just start with IT for a quick bit. If you have any strong views, Bhavan, but you have such a strong view on mid and small caps. That is where you largely operate. So just IT and what's the view from here, Bhavan?
Yeah, I think we are, seeing at least a bit of, stabilizations, quote unquote, slightly positive direction, that we had seen about TCS Infosys results, I think, were, at least that better than perhaps expectations. That weak second half, is turning out to be a slightly better second half for Infosys, for example. And also there is, if you listen to, the industry events, people talking at the industry events, you can expect a lot of sort of pilot projects related to AI, shifting more to actual implementations and so on and so forth. So while there is obviously that deflationary impact on the man hours, so to speak, there could be some opportunities as well. And that blend, whoever is able to take advantage of that better, should see a little bit more growth. Nothing to, write big stories about, but certainly, I think better than what we had seen in FY, what we are going to see at FY26 ended.
Okay, so incrementally slightly better. On Infosys, because it's a part of your portfolio, how much more upside do you see in the stock? Because ultimately the company's top line growth this year will be 3.5%. Next year, even after acceleration, it will still be a top line growth of 6-7%. So, I mean, is there a case for valuation re-rating because the EPS growth is going to be limited? How much more upside in IT stocks?
So, with a bounce that is already happening, and the stock still available at reasonable 4 to 4.5% free cash flow yield. And, if that number is growing at let's call it closer to 7-8%, maybe 8%, if you count in the rupee depreciation, obviously they benefit from that. It's a 10-12% kind of return story still, I would say. I think after a big move that happens around this kind of results, then they don't expect much for a while. But if you're a long-term investor, I think, that kind of return is still possible, which may be better than many other opportunities in the large cap space. I think one famous investor, I think Charlie Munger once said that sometimes you don't have to be brilliant, you just have to be consistent. And I think that's kind of the story of some of these IT services companies.
Okay, so steady compounding story, Infosys, dividend yield of 4%, and plus some EPS growth of 7-8%, and that's good enough to go forward. So incrementally things are turning positive. Anything that you've heard in the IT commentary from the management would suggest that AI is now coming at an inflection point? We all heard about the pilots, the potential, but is it gaining traction enough? Because ultimately, when you look at the AI contribution from an HCL Tech or a TCS, it's still in mid-single digits.
I'm not sure it's so much from the companies themselves, but at industry events, like there was this event in Jaipur by the the Global Summit for TI, and that's where there was a lot of talk about projects going more into implementation phase this year in the calendar 26. So I think that would also come into play as we go further in the year.
Okay. Bhavin, now let's talk about the broader market, right? Mid cap, small caps, right? Are we broadly at a place where are you in a place where you have less money and more ideas? Are we there yet?
I do think so. I think partly because we haven't taken a lot of money off table in last 6 months, so we are somewhat closer to being fully invested. But also I think yes, more names are now in a buy zone for us than they were 6 months back, you can say. And I think we have to see earnings growth basically come through. I think there is a lot of hope around that starting from this quarter itself. So if this earnings season goes well, I think that could play out pretty well.
Bhavin, what are your give us 2 or 3 names if you can. Just as something to kind of ponder over. I mean, not recommendation, just to something which is looking like extremely attractive.
Interglobe Aviation. I mean, the company's market position hasn't changed. I think they're addressing the whole issue, with a front foot. They are doing wet leases so that they continue to serve the markets that the slots they are serving, and obviously they will address other issues. And I think the stock is at a very attractive level in my view, and the opportunity they have. Most important thing is the opportunity they have
is huge. But 2 lakh crore market cap, Bhavin. Well, what else? Give us a few more ideas.
So I mean, I think we also like the wealth management. Some names in the wealth management space. We like Nuvama Wealth. It's a very well balanced and well positioned name in that space with some very unique position. In the capital market space that they enjoy, and I think overall it's a pretty decent growth story available at a very reasonable valuation.
We were doing 3 or 4, so you've done 2, Bhavin. Go on.
Well, I mean, I think one of the recent listings, Nephro Plus is another name that we continue to like. It's they're fairly unique in in that space, dialysis, and I think it's a very capable management, which we can bank on to deliver very healthy growth ahead. So I would like that. So we covered now 2-3 different spaces. So hopefully that suffices.
मैं सोच रहा था एक और पूछता हूँ, but ठीक है, अगली बार. But I think Nephro Plus, that's the name. Nephro Care, right? I mean, so
Nephro Care, yes.
Nephro Care. I mean, I don't think we've really, and fair to assume that whatever we've discussed is part of your portfolio. I mean, it's disclosed in that sense.
Yes.
Yeah, but this is the time to look for stocks which are getting thrown away, right? In the broader gloom and doom, in that sense, Bhavin, right?
That or, just that they haven't performed, sometimes you've seen that companies, even though results were okay, stocks haven't really, discounted that in this market. There have been, some sellers coming in for whatever their individual reasons. So yeah, I think this is a market where opportunities are definitely a lot more than that we have seen before.
Okay, all right. We'll leave it there. Very nice to chat with you, and I hope this is the first of many in this year. Thank you very much, Bhavin. Appreciate it.
Thank you very much. Yeah.
All right, well, 9:10, slightly past 9:10. Mitesh is with us with his 9:10 calls. Mitesh, what do you have?
I'll go to buy on Indian Bank.
Okay, Indian Bank is the buy. Well, we wanted to focus once back on the stock of the day before yesterday, and it was Vedanta clearly. There was a Nuvama buy. Nigel was highlighting it, and I think Kotak is joining the bandwagon. Nigel, take it away.
Well, that's right. Kotak, well, they have come out with a note on Vedanta. They retained the buy rating. They revised their target price to 780 rupees from around 650 earlier. They've gone ahead. They revised the EBITDA estimates for the next 2 years by around 8.7% to around 6.9% because they're basically factoring in higher aluminium as well as silver prices. Kotak says that their commodity price assumptions, they're still 12 to around 30% below spot. But if you factor in spot prices, then Kotak's fair value would actually increase to 965 rupees with a 19% higher EBITDA for FY27 itself. So for the time being, they're factoring in that commodity prices will cool off. But if it stays at current levels, then their estimates move up as well as the target price could move up. They go on to state that they still believe risk reward is attractive, given the strong earnings growth that is expected because of the expansions that they've taken about, the 5% dividend yield, and the manageable parent leverage as well, which otherwise was a bit of an overhang on the stock. The other factors that are working for them, they say that they believe aluminium prices will remain elevated in a deficit market, and the demerger is on track to unlock potential value from aluminium as well as the power divisions. So put everything together, Kotak, they're even more optimistic now on Vedanta's prospects.
All right, Nigel, thanks very much for that. Keep an eye out on that one. That was a big one day before yesterday. Union Bank reported numbers. Stock moved on, what was it, Wednesday, the last session. Gaurav is here with more. Gaurav, take it away.
Well, as for Union Bank, we saw the biggest single-day gain since 2023 for the bank. And at the same time, if you look at delivery data, that also shown a very strong set of numbers. When we look at the reasons, that was actually the good set of number in terms of Q3 results. First is that net interest margins increased, credit cost declined, and as a result, 19 basis point of increase in ROA is what we saw. And after that, now brokerages are also being bullish on the bank. Now, Investec, they have upgraded the target price to 210 rupees versus 195. Their argument is that net interest margins improved because of the decline in cost of deposits. Second is that the credit cost declined. That was because of the lower slippages and higher recoveries. And on the back of all these factors, now they're expecting 3 to 4% increase to their own estimates in terms of profitability for FY27 and FY28. Apart from that, in terms of valuation as well, they have increased their target valuation to 1.1 times price to book on FY27 book, given that they believe that the ROE is going to be on a sustainable level, and that is the reason why they have increased the target price. Remember, if you look at the current valuation also, it trades at 1 time price to book at FY27, so it still gives some upside to the stock, and as a result, we will definitely watch if this momentum sustains in this trading session as well for Union Bank.
All right. Thanks very much, Gaurav, for that. Well, I think we are hitting market open with the first rates coming up on your screen anytime now. And we'll take it from there. What do we have? 25,696 on the Nifty, 83,000, 600, okay, 700. Fast-moving market, fast-changing market rather. So this is not a bad open at all. 75, settling down at about 75 points on the Nifty, 88 points on the Nifty Bank. And you've got the mid-cap index and the small-cap indices, which are also higher right now. Market breadth is not, like a one-way, big, massive advanced decline number, but it's more evenly balanced. Infy is, of course, at one end. Tech Mahindra, Wipro follow. Shriram Finance, that Morgan call that we highlighted. Cipla is at the other end. Again, a call we highlighted with Ekta. HDFC Life, Eternal, etc. are some of the other names. You've got about 25 names which are higher and the rest which are lower at this point in time. 50 on the Nifty at this point. Rima.
The Nifty is holding above 25,700, supported by IT names. So Infosys right on top, 4.5% up move on Infosys. And it's providing a tailwind for Tech Mahindra and Wipro, both of which report numbers later today. Tech Mahindra, Wipro up 2.5% at open. Oil marketing companies on the front foot on the back of the sharp decline seen in Brent crude prices. So BPCL, HPCL up and about. Pull up a Reliance Industries. Reliance Industries is up 0.5% ahead of numbers. But this month, stock is down nearly 6.5%. HDFC Bank, ICICI Bank will also come up for you on your screen slightly on the back foot today. Other notable gainers included Shriram Finance, M&M, Nestle, NTPC. On the way down, Cipla is the big drag. Cipla is down more than 4% as it begins trade. HDFC Life also disappointing. Yash was telling us the expectations were not very high to begin with, but it's a muted set of numbers. Stock is taking a knock. Eternal is down 3.5%. Avenue Supermarts, some consumption retail, retail stocks are weak in trade. You've got a Bharti Airtel, Sun Pharma, BEL also weak in trade. Mildly up, and it's got a lot to do with IT this morning.
Well, that's right, Rima. Billion Brains grow. Well, that stock, in fact, is up 3.5%. Remember, it came out with a set of numbers. The street is a little optimistic on these results. And if you look at Motilal Oswal note, they have gone ahead. They revised the target price to around 190 rupees. So that stock up and about in today's trading session. What else? JTL, last few trading sessions, the stock has been moving on very large volumes. In the first few minutes itself, the stock is already up close to 3%. And volumes are very, very large on that particular name. So big move is what we are seeing. Eternal comes in for profit taking. That's down 2.5%. Nalco as well as come in for profit taking. That as well as down close to around 2%. And even Hindustan Copper actually has come in for some mild profit taking. Let's pull up a couple of other names. Maybe we should get up a Nuvoco on the screen. They came out with a set of numbers more or less in line, but the commentary was quite optimistic with regard to the path ahead. So that one's opened up with a mild gain of close to around 2%. Zen Technologies 400 crore order. The street likes it. Big fund action is what we saw in India Mart, and that's why that stock is up close to around 6%. I think Nalanda was one of the parties out there. So that's why that one is bursting away in today's trading session. Net, Nifty's gains have been trimmed down to around 30 points, but the broader markets, there is some excitement out there, and that's why the mid-cap index is now up close to around 0.4%.
Okay, what do we have, right? I mean, 25,700 on the index at this point in time, and we're about 40-odd points higher to begin the session. Pankaj Murarka is with us, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here on the program. Thanks for joining in. I guess the mood slightly down and out. First up, I guess we're still in the statute of being able to say Happy New Year, not too late. But
wish you a very happy new year, Prashant.
Thank you. Thanks, Pankaj. I guess the moods are down and out, so that's a non-question. But what are you doing? How are you navigating through some of what we going through right now, Pankaj?
Well, let me put the broader context in perspective and then I'll tell you what we're doing. Essentially, I still believe that India is a very steady state economy, meaning just sharing some interesting data points with you. If you look at over the last 15 years, on an annualized calendar basis, Indian markets have given positive returns in 13 out of last 15 years. So, and India's macroeconomic fundamentals have been very stable over the last 10 years. It's been a steady 6.5% growth economy despite the COVID shock that we witnessed. So my meaning the top-down view that drives our thought process when it comes to investing is India continues to remain, despite some external headwinds in terms of trade and geopolitical headwinds that we witness, India continues to remain a very stable economy at 6.5–7% growth. And I think that view underlies our investment process. Obviously, there are pockets of markets where we find value. As investors, we are growth buyers, and we're looking for buying companies where we think valuations are reasonable in the context of the growth that the companies can deliver over the next 2 to 3 years, and just stay invested with that. The underlying growth in India, the economy continues to remain resilient, and the underlying growth continues to remain pretty healthy. We're coming out of a cyclical slowdown in earnings, so we're clearly looking forward to acceleration in earnings going forward into the next year and getting back to double-digit earnings growth for the top 200 companies in India. So yeah, and some of our holdings, meaning we've liked financials for a while and we continue to like that. Apart from that, I think IT is one sector which has not done well last year, but I think we'll see a growth recovery there, and the early commentary from companies is confirming that. So I think this year could be a year for IT stocks.
Okay, all right. Hi, Pankaj. Good morning. Good to see you again. So tech, but what do you like from tech then? How would you play it? The large cap names, though they give you more stability, the growth will be a little bit subdued. Some of these mid cap names could outgrow them, but valuation seem to be a bit of a question mark. If you believe that IT could start recovering, then how do you play it?
Yeah, that's right, Nigel. So I think the approach we are taking is to play a barbell approach where you clearly want to own the large cap names because their valuations are very reasonable. And more importantly, the implied growth that is priced into the large cap names is very low. Meaning, if you look at the top 4 IT companies in India, they're building an implied growth of about 3–4% over the next 10 years or kind of thing. And I think while the industry has gone through a cyclical slowdown, but we certainly see growth being higher than that over the next 2 to 3 years as we see growth recovery and discretionary spends coming back. So clearly, large cap looks attractive from a valuation perspective, and given the fact that we think growth outlook will improve. Having said that, some of the mid cap companies have been growing phenomenally higher. Valuations are rich, but one cannot not own them. So I think the idea is to play a mix of both large and mid cap and create a portfolio out of it.
Yeah, a combination of large and mid cap, I guess, is the way to go. Pankaj, can we talk a few names? Just to give a sense of what you've done lately, just to get an idea.
So at the aggregate portfolio level, Prashant, after a very long time, there are pockets of markets are, meaning just to put in context, I think markets are perfect. Indian markets are perfectly priced at 21 times 1 year forward earnings. Markets are priced to perfection. So clearly, as growth investors, while a significant part of our portfolio is growth oriented, but I find a lot of pockets of value where value is clearly beaten down. I find deep value there. So we have of late in the last few months bought some of those value stocks across state-owned banks, or the power finance companies like the RECs and PFCs, and also some utilities including NTPC. Caveat, we own all of these stocks, so we have ownership across these names. But we find some pockets of markets where we find value, pretty deep value in terms of where these businesses are, how these businesses are priced at this point of time. We continue to like our traditional private sector banks, and of late, all through the meaning we've been buying into consumption. Meaning I believe we are coming out of 2 years of slowdown in consumption. And I believe consumption will continue. We're already witnessing a meaningful recovery in consumption, and I think that recovery will sustain and probably gather momentum. Also, I believe that last year, if we put in context, has been a year of stimulus across fiscal and monetary stimulus. We've seen the government started with the tax cuts in the budget last year and followed up with GST cuts during later part of the year. And in between all of this, RBI has cut rates by 125 basis points, which is a very significant monetary stimulus. I think the government will sustain fiscal stimulus into the economy with upcoming budget because, and I think that probably needed to sustain and probably the growth momentum in the economy. So I see recovery in consumption sustaining from here on. So we've been buying consumption as well. Within the consumption basket, we've been owning both, we're positive on both staples and discretionary after a long time, almost after, I mean, I've been underweight consumption for almost 6 years, right from 2019, because we believe that the growth in these names is slowing down and valuations are very expensive. After a gap of almost 6 or 7 years, I am finding value in consumer names where valuations are very far more reasonable now and pretty much in line with long-term averages and in sync with the growth we expect from these companies. So consumer as a pocket looks pretty interesting to me across both staples and discretionary. Some of the names we own on the staple side are likes of Tata Consumer and Godrej Consumer.
Okay, mixing it up in terms of consumption, owning both some of the discretionary names, and you told us the last few months as well that staples is something that you've gradually started looking into. Let's focus on another sector, defense. You know, with what all is going on globally, defense will be a sector to focus on, not just in India, but all across the globe. However, valuations of some of these stocks had already gone out of whack. The good news is some of them have actually come off the top. At current reckoning, would you look at some of these defense names? Do you own them? And will you look at buying into this dip?
Well, you're absolutely right, Nigel. I think given what's happening, the world is a volatile place and probably will continue to remain so in the foreseeable future. And in that context, obviously, there's a very strong tailwind for defense names globally as well, and an added acceleration in growth of defense companies in India because of the whole focus of Government of India for indigenization. And given the fact that India has some significant challenges on the defense side or on the geopolitical side. You're right, it's slightly tricky how do you deal with these names, because while there's growth tailwind, yet these names are very expensive. The stocks are already pricing in, the next 2 years of growth is already priced in. So to buy some of these companies at a mid-stage of their growth cycle, you essentially are paying far too much out of the future in that context for you to make reasonable returns. Being value investors, it's difficult for us, meaning we have a very small exposure to defense names, and being value investor, it's very difficult for us, someone like us, to buy into these names at this point of time, because you're buying future growth, which is far too out into the future, because the near-term growth of the next 8 quarters is already priced into these names.
Okay, all right. What about your interactions, Pankaj, with your clients? Because, you know, the funds that you all run as well, like most of the funds, the last 1 year actually has been weak, right? I mean, it's been flattish to negative for most fund managers. If you look at it the last 3 to 5 years, then obviously your returns are much better. What is the communication you're having with your investors, telling them this is going to be a better year? Are you all deploying all the money? Are you all waiting by for better opportunities?
I think investors have matured. I must appreciate that in my experience of managing public money for 28 years, where they understand market cycles. We've gone through a cycle where we had strong earnings momentum and very strong returns, probably. And now we're coming out of a phase where we had cyclical slowdown in the economy and moderation in earnings growth. And from there, we're coming back to growth acceleration. So I think investors understand market cycles, and investors do take a medium-term to long-term view in terms of their equity assets. So they are, I must appreciate, they are not perturbed by, short-term returns or short-term market volatility in that sense over the next, over 6 months or 1 year. And more importantly, in case there is significant drawdown, investors have, dry gunpowder with them, where they're looking to chip in more money or put in more money, because they understand the long-term growth story in India and the long-term equity returns. And they want to use those short-term volatility or drawdowns to probably as an opportunity to invest more money. So in that context, I think investors are, taking a medium-term, long-term view, not too perturbed by short-term view. The fact remains that I believe there's a mean reversion that's happening in the market. For the last 4 or 5 years, momentum as a strategy has done pretty well. But a lot of those, pockets of markets which had a lot of momentum are mean reversing, where valuations are reversing to, mean levels. And we're seeing some recovery or some mean movement in market towards recognizing value as well. So I think last year is also a year for us to reposition our portfolio in terms of how we think markets will play out over the next 2 to 3 years, and that's what exactly we have done. So I think investors overlook short-term volatility, and they look at returns more from a 3 to 5 year cycle, and I think that's a very good thing.
That's good. I got that. I know it's helpful. By the way, capital market names, right, are all up and about and how. So Angel, of course, is the number 2 volume-led gainer right now. That's Angel 1. It's up 7%. Grow, of course, again, numbers 4% here. So third largest volume-led gainer. HDFC AMC reported numbers on Wednesday. And the numbers came during the last hour of trade then. Stock went up 4%. It's up another 4% this morning. 361 is up 7%. So that's another wealth player which is looking up. So you got, a bunch of these capital market plays all shining through this morning with tremendous volumes as well for this point in the day. Kernex, I think there was an order 8% on Kernex. There is NetWeb, which is slowly trying to creep back up. So very, very sharp fall on this one. 3.5% here, about 3,300. Federal Bank is up 3% and at about 255 on this one. India Mart, Nigel mentioned earlier, 7.5%. India Mart, by the way, basically was at COVID levels, 2020 levels, is at 2020 levels, even after the 7% kind of a pop. We've got Infosys, which is up about 4%. GTL Industries is another one we've highlighted last couple of days, is up another 4.5%. I think Tuesday was up, Wednesday was up, and today is strong as well. Style Bazar is coming up with a 10% gain. So that is another one which is starting to see some signs of life. So it's not a bad-looking broader screen, Nigel. And although the Nifty is just about 50-odd points.
A couple of accidents, though, are there. If I look at Fed Bank Financial Services, I think it came out with a set of numbers. The stock was down actually 12%. It's pulled back a little bit from the low point of the day. It's still down close to 9%. So that one's seeing some selling. And the other one, I think, is HBL. I'm unsure what's gone on 12%. There. But that as well is down close to 12%. So select stocks, there are some accidents from the broader markets. Though on the whole, you are seeing a relatively better performance and more gainers than losers. But just thought I'd point out a couple of these names. The Federal Bank Financial Services.
I think HBL already reported. I'm not sure if there's something new. We'll check and actually circle back on HBL. That's another one with regard. I mean, fair bit of dependency in various lines of businesses to the government of India. I mean, the Kavach program and other things. I'm not sure if there's any particular news around any of that, but it's a sharp cut at this point in time.
There is actually HBL, if I got this correct, HBL Engineering, that's the one that's down. They put up something on the exchanges yesterday at around 4 p.m. They say that from the CLV Loco Kavach tender of around 6,300 units decided last week, HBL did not get any order because the other bidders' prices were lower. And HBL's intimation to the exchanges on 18th of December was only talking of Kavach Loco business. It did not include Kavach station business. So they put out some clarification, but it seems the street was hopeful of them getting something, which hasn't happened. They're clarifying that they were actually targeting something else. But for the time being, the stock is down.
Typically, in government-led businesses, it's going to be a setback on tenders, etc. That's what I thought. But so we'll actually later perhaps try and get the management on later down in the day and try and speak to them about this. Pankaj, thank you very much for joining us. Good speaking with you. Really appreciate your time and thank you for being here. All right. Well, what we're going to do is markets, of course, about 30-odd points higher. 25,695 is where we're at. We're going to talk about a little bit about oil, right? I mean, and where are oil prices headed from here? Last 2 days, there's a 6% drop. But of course, I mean, before that, counter to expectations, oil prices went headed higher. So that's basically been reversed in the last 2 sessions. Marco Papik is Chief Strategist at BCA Research. We also have MK Surana, former CMD at HPCL. So for our viewers, Marco, of course, believes that oil prices, and maybe I don't know if he's changed his view and we'll ask him, his view has been that oil prices are actually headed higher, counter to market expectations. And I mean, they did head higher. And Mr. Surana, of course, is going to weigh in on how oil marketing companies, standalone refiners, etc., are placed in this environment. Marco, let's start with you at a basic level. Look, I mean, the markets, of course, believing for now that there is no direct action in Iran, so the geopolitics there seemingly calming down. Would you agree with it? Or, and of course, what does it mean for oil in that sense?
Well, I think that, first of all, the setup before the action in Venezuela was quite bearish with a lot of floating storage. available around the world, actually the highest it's been since COVID. So most traders were positioned quite bearish. And then the narrative, as Venezuela was unraveling, was that the United States of America would be able to release more supply. I think that that's overdone. It's not going to happen very quickly. And then the risk was applied to Iran that President Trump would do something similar. He did say yesterday that he would not. He seems to be softening his stance. And there are reports today that he has been talked out of it by many Gulf allies, UAE and Saudi Arabia. My concern, however, this is out of his hands. There's a development in Iran that's not controlled by the US. It has a life of its own. Iran is undergoing very significant protest, and those protests could get out of hand, and eventually they could cause domestic political chaos that's really uncontrollable. So I still think that from a geopolitical perspective, there is upside risk to oil prices over the next month or so.
Upside risk, right? I mean, so that doesn't go away in that sense. Mr. Surana, here, PSU oil investors have been wondering what's going on. I mean, oil prices largely have been in a range. I mean, Brent, for example, between 60, 65 for a while. I think product cracks, etc., have been very strong, and they've been all wondering why are oil marketing companies trading the way they are, or if the standalone refiners, etc., even private companies like Reliance, etc. As someone who's run one of the largest OMCs in the country, what's your perspective, sir? How should investors view this environment?
Good morning, and good morning to Marco as well. So as he rightly said, earlier the oil was bearish, and everybody was assuming that it will somewhere between 55 to 60. After Venezuela, there was not much move because that didn't impact the market much. After the Iran thing, there are two things which are happening. Initial very hard stand which was taken, and yesterday's softening has changed the risk premium which the market is putting, and that's why in last 2 days you have almost 6% drop. There is one more reason that Iran is not as easy as Venezuela, because they've got better military capabilities, they have better air defense system. And second thing is they're more determined regime as well. And therefore, any military intervention from Iran may face with certain repercussions. And one of the things can be the strikes by Iran on the US military bases, which are there in the oil-producing countries. And therefore, what the market is probably factoring in is that if the conflict zone increases, and in that case, there may be disturbance in the oil supply from the West Asia, and that may lead to more war premium. And that is what the thing is. But at the same time, many of the Arab countries and Turkey and many of the oil-producing countries have been canvassing for no attack because they would not like their trade to be disturbed in the West Asia. The Straits of Hormuz is also one of the critical points in this whole thing. And therefore, I think the softening of the stand where the possibility of an immediate attack is, I think, receded. There may be some escalation, which is also seen in terms of yesterday. There are some more sanctions against some of the shipping lines. But I still feel that an immediate attack on Iran is probably receded, the threats of that, or a full-fledged attack is receded. I also believe that US might be thinking of having a quick and decisive action like Venezuela, which is unlikely in case of Iran. And I think that will weigh against an full-fledged attack on Iran. And therefore, I would assume that the market will factor in and the oil prices, while there is a risk, upside risk of if anything happens, but otherwise it will remain below 65 zone. And as far as the Indian companies are concerned, as well as the investors are concerned, the marketing margins are good, the refining margins are good, the volumes have been good, the marketing volumes are good. And therefore, I think the oil companies in India are well placed.
Yeah. Yeah. Marco, you said the protests could get out of hand, right, in Iran. After the revolution in Iran, which is 78, oil prices more than doubled. But we're not in that same kind of situation, right? Because Iran's oil production is about 2 million barrels per day below the pre-revolution level. So it's not as if, I mean, there is a great amount of Iranian oil in the market which is going to likely be curtailed. So just in terms, if that statement what you made, which is that protests may get out of hand, comes true, is there going to be, I mean, with or without direct action from the US, would it have a noticeable impact on prices? What's your sense?
I mean, it could. The decision tree is starting to grow branches, if you know what I mean. There are more and more potential outcomes that we just can't forecast. Iran currently is exhibiting some really worrying signs. For the first time in really since the revolution, we have the Iranian military actually taking pretty decisive actions domestically against the IRGC, at least in the political sense. So the National Security Council now has more seats awarded to the Iranian military rather than to the powerful IRGC, which is linked to the supreme leader. And we're starting to see real sinews of the political system, come under strain, and that could lead to significant disturbances, maybe even something that we would call a civil war. This is a place that, once the regime starts to face real pressure, it's very difficult to forecast the way that goes. So that, yes, even that 2 million barrels could come offline. It could be put in doubt. You could have different fractions within Iran fighting against each other in various other external ways, whether it's taking action against shipping in the Strait of Hormuz, and so on and so on. So I think that we've entered a very dangerous phase. And so I think if you were to net out the geopolitical risks and positives, a change of regime in Venezuela towards a more conciliatory one pales in comparison to the uncertainty emanating out of Iran. I would argue that there's another issue. We started the year off with a very bearish sentiment in the trader community. We also started off the year with assumption that oil would stay low. However, the very macro context that we're enjoying today is a product of political decisions taken in Riyadh almost exclusively. It's the very high level of OPEC production. But one thing that nobody seems to be talking about is that the high level of OPEC production and the quotas that they have set, really kind of flies in the face of some of Saudi domestic priorities. The Vision 2030 is not going to finance itself. Saudi Arabia is facing a current account deficit, and it's having to basically enter the international bond market very aggressively and to tap its foreign currency reserves. So I do think that we're running out of time in terms of these low oil prices. I think at some point, OPEC itself, namely Saudi Arabia, is going to also start thinking about whether these prices are too low for their domestic fiscal priorities.
Yeah, but you got President Trump on the other side, right? Keep oil low. That's one of the top priorities for him. So we'll let us see, who has the upper hand. I mean, how it's going to be managed. Maybe more oil from places like Venezuela. But as you said, that's going to take time. I have more questions, but we're completely out of time here. Mrs. Surana, thank you very much for joining us. Marco, thank you very much for coming back on again. And I think this is a conversation we will keep having as things unfold on the geopolitical front, even though at this point in time, direct action in Iran from the US looks, at least the probability seems to have moved down over the last 2 odd days. Well, we're going to shift focus to, our first corporate on the program, Rima, L&T Technology Services.
Yes, and the stock is down 4.5%. Amit Chadha, MD and CEO of LTTS, is now joining in. Amit, let me begin with the cut in your guidance. You're now forecasting a mid-single-digit top-line revenue growth versus double-digit earlier, and you've spoken about reassessing certain non-core offerings. Can you explain this to us?
So a couple of things as we look at the future. Look, we believe that AI is actually pivoting to EI, engineering intelligence, which is how we would like to be known as going forward. And we see an integration of physical, industrial, and digital AI coming together. So what we did over the last quarter was that we first did our own research. We talked to our clients. We actually hosted them at MIT Labs for a customer event. We spent time with them with our advisory council, and we took them through our offerings for the future. We realized that if you look at mobility offerings, they are bang on. Software-defined vehicles, we continue to work on those. And in fact, happy to share that we've now been able to get up to being top 2 in that space. Also, our offerings in sustainability are bang on. We are able to actually make a lot of progress, close deals, create value for our customers, unlock value for ourselves, and expand on. In the tech space, because it's a very fast evolving space, there were certain areas in certain geographies that we believe were going to get commoditized, were getting commoditized, and we were losing our differentiation because everybody was doing sort of the same thing. So we went back to our board, took their approval, and we have therefore decided to pivot on margins. So margins came in about 200 basis points up, gross margins. All the 3 segments improved in EBITDA margins, and that's early success that you've seen. And as we go forward, we are looking at some of the others as well. By the time we end the year, we want to be fit and ready for our next scale up that starts on April 1st, 2026, going up to March 31st, 2031.
Amit, what was the loss in revenue in Q3 on account of this business recalibration, exiting or deprioritizing certain markets in high tech? And was it entirely in high tech?
It's entirely mostly in high tech. There was a little bit in mobility as well, but largely in high tech, Rima. That's number one. Number two, if you look at it, we will still grow double digit, right? In terms of constant currency, because we are on path and on track. We've had the right wins. We've had the right tailwinds to be able to get to that. We've said that, mid-single digits, so you can do the math and see as to what that number is. But that's broadly what we're looking at as a hit for the current year as we rationalize the portfolio and we look at margin improvement and expansion in an accelerated manner.
Amit, so FY26 guidance, is it double digit or is it mid-single digit?
First of all, we don't give guidance anymore. We only provide a reference. And what we're providing as a reference to you is that if I was to take into account the portfolio that we have decided to drop and would not have dropped it, we would have ended up double digit. But because we have decided to drop it, we will end up mid-single digits.
Okay. So Q3 was impacted on the back of this business recalibration. Will there be a loss in revenue in Q4 too?
No, I don't think so. We'll be fairly at this level as you look at quarter 4. And quarter 4 is to be played out.
Got that. What happens to your earlier aspiration, $2 billion in terms of top line, medium term, mid-16, 16.5% kind of EBIT margins? How does that change and what are the new timelines?
Sure. So number one, our aspiration to get to mid-16% EBIT margin stays. In fact, if you remember, we had talked about that we'll get to it in Q4 or Q4 of FY27 or Q1, Q2 of FY28. I'm now confirming that EBIT margins of 16.5, aspiration to get there by quarter 4 FY27 is where we will be. So it'll be faster than what we had thought about earlier, number one. Number two, with regards to the 2 billion, you will have to give us a little time because we are looking at our 5-year trajectory, organic and inorganic, and we will come back to you and update you on the new number that we're going to look at as we look ahead.
Got that. So now your current margins are 14.5%. The aspiration is to get to mid 16.5% kind of margins by Q4 FY27. What are the levers to expand margins?
Yes. So couple 3 things. Number one is that we can improve offshoring by about 4 to 5%. That window we have. Our utilization currently hovers at about that 83% mark with AI that we have leveraged in the company. I believe we can comfortably improve utilization by another 200 bips. So we've got that play at hand. And third, there are parts of the portfolio that we have executed projects on in quarter 3 that we may potentially not do in quarter 4, but we have growth coming from sustainability, mobility, and the ongoing part of the tech business that should help us to make those bold decisions and take it forward.
Got that. Just one final question, and getting back to this entire business recalibration. What exactly is happening in the tech world You spoke about how parts of the tech business are getting commoditized, and that is driving you to deprioritize part of this business. So what exactly is happening? And if you could explain that in simple terms.
Number one, if I can start by saying we are deprioritizing tech areas in Europe, tech areas in the Indian market. We are not deprioritizing tech areas in the US market. Number two, if I break up the tech market for you, there are investments in data centers that are happening at this stage. Number two, and second, related to that, there is spend in energy. So what does that mean? So you got the hyperscalers spending, you got people like who are the telco infra as well as the computer server people spending. You've got silicon vendors, semicon vendors spending. You've also got parts of the industrial segment, which is sustainability for us, spending because they are building out the data centers and the equipment for that and the racks and others. So there are these. So four of our segments, or two of our segments, which is sustainability and tech, both are seeing an influx of spend coming in the tech because of the build out in AI and data centers. So it's a positive impact for us. So what we've done is, Nima, we've prioritized. So we've taken areas which kind of will become commoditized in the next 9 to 12 months. And we have taken those and we've decided to not work on those in the current, starting the current quarter. And what that means, therefore, is that as we move forward, you will see the margins improve, you will get us fit. So as the spend continues to increase, you will start seeing the growth along with the margins as you move forward.
All right, Amit, considering there is an acquisition which is contributing to the top line this year. Now, based on the reduced guidance, is FY26 organic? Would it be negative?
No, it won't, because like I said, there are areas that we are letting go, areas that we are bringing in, so hard to peel all that. I can tell you that we'll have a couple of 50 million plus accounts. One actually is already a 50 million ARR account for 3 quarters. Others are expanding rapidly. There are some good empanelments that we've got. So it's giving us, look, it happens once in a lifetime. You get this opportunity to be able to shuffle things in and out. Now, it does show up every quarter. That is true. But, we have to be strategic about this as we move forward. And you're seeing an impact of early execution results and margins, and you will see that as you go forward.
Amit, one final question. You will be setting phase 2 of your 5-year Lakshya plan from 1st April 2026, which goes on till March 2031. We'll get to the details as and when you lay it out, maybe in Q4. But could you give us a directional sense what the 5-year aspiration and goal is?
Aspiration is definitely to double, right? Definitely. But can we do more, right? That's the question. Are there tailwinds coming in from AI that we can harness? Are there tailwinds coming in from the data center part that we can harness? We've built 260 plus patents in AI. Could we monetize those? So a lot of those soul-searching questions going on as we speak right now. Early stage execution already on play. We go to the board again in March, get a formal sign-off on the 5-year track. So I guess when we see you in April, we will provide you that clarity as we move forward. But definitely, we would like to continue to grow and grow responsibly and profitably.
Thank you very much for that. For now, LTTS is down 4%. And on the other side of the spectrum is Infosys, which is up 4.5%. Get into a break. On the other side, Vishal Goyal, India Financials Analyst at UBS, will join in to talk about the key expectation from the banking sector in Q3.
Welcome back. This is Corporate Radar, and as we speak, the markets are holding on to its own. The Nifty is up, the Midcap index as well is up. It's been a good first half hour out of trade. Well, it's time for our special segment, though. Quarter se quarter sak. We focus on each sector. Today, Gaurav is going to be telling us what does Q3 FY26 look like for the banking sector. Gaurav, take it away.
Well, yes, if you look at banking sector, we have already got some of the pre-quarterly updates, and let's start with the big picture. At a system level growth that remained uneven. As of December, if you look at the loan book growth, that came at around 12% on a year-on-year basis, while deposit growth was a bit of a laggard at 9.4%. Now, what does this actually tell us? It's clearly reflecting the loan to deposit ratio, which is also known as LDR, is continuing to edge higher. In fact, according to the latest data from RBI, the LDR ratio now stands at 81.74%. It is also at an all-time high level. And we have already seen how sensitive the market is. Because let's take an example of HDFC Bank. Despite reporting 12% loan growth and 11.5% of the deposit growth, the stock corrected as the LDR inched up almost to 99%. We have already seen HDFC Bank actually declining almost by 5%. Now, coming to the pre-quarterly updates that we have seen so far. Across the board, loan growth for most of the bank has continued to outpace deposit growth. In fact, if you look at the PSU banks, they remained the standout performers, with loan growth actually outpacing most of the private sector peers, with 12.5%, more than 12.5% for PSU banks. When you look at the small banks, they emerge as a key growth driver with gold loan. Like we have got players like CSB Bank and Dhanlaxmi Bank, where we saw gold loan actually increasing more than 40%. And the key highlight from the peak quarterly updates, if you look at the sector-wise and the bank size-wise, within the last sector banks, we saw Axis Bank, Kotak Mahindra Bank actually reporting good set of numbers, while IndusInd Bank on the flip side also reported weak set of numbers in terms of loan growth as well as deposits. For mid-sized banks, we saw PSU banks across the board actually remaining above their growth guidance, and at the same time we saw AU Small Finance Bank maintaining its growth performance. On the flip side, again we saw RBL Bank, who reported decent set of numbers, but it was again lower than the street's expectation, and that is where we saw street also hurt the market price for RBL Bank. Now, coming to this quarter, we have already seen two key events. First is that 100 basis point of CRR cut, which is applicable in this quarter itself. And second is the another 25 basis point of repo rate cut. So these were the key events. And on back of that, what brokerages are expecting is that from here on, net interest margin pressure is likely to stabilize in third quarter of FY26. And this will be also supported by deposit repricing, which is typically playing out. And at the same time, LDR expansion, as we saw across the industry, this is playing out. On your screen, if you look at some of the stocks where we will see some of the decline in net interest margins, we have got Axis Bank, PNB, where brokerages expect some kind of decline in the net interest margins. In fact, let's not forget that PNB also cut their net interest margins guidance during the conversation with us. And apart from that, on the upper side, we saw HDFC Bank, ICICI Bank, all of them are expected to report increase in the net interest margins. Apart from that, let's also turn our next to asset quality. Now, lately we have seen credit bureau data, which indicates the improvement in early bucket delinquencies. And as a result, credit cost is likely to improve on a quarter-on-quarter basis, especially for the mid-sized banks like IDFC First Bank, AU Small Finance Bank and RBL Bank, according to some of the brokerages. And these banks will also remain in focus because of the higher credit cost that we have seen in the past. Let's also not forget about Axis Bank, because when we're talking about credit costs, we have already seen slippages were higher because of the technical slippages that they reported for the last 2 quarters. Finally, considering all these factors, if you look at the quarter-on-quarter performance, we are expected to see marginal uptick in the profit growth, barring IndusInd Bank and Bandhan Bank. In fact, if you look at some of the banks like IDFC First Bank and Yes Bank, we may see increase as high as 50% on a year-on-year basis. While on the flip side, we may see big banks like HDFC Bank and Axis Bank actually reporting mid to single digit or high teens number in terms of the growth in terms of profitability. Now, let's not also forget about some of the key stocks to watch out for in this quarter. First is HDFC Bank, because the commentary on LDR is going to be a key thing to watch out for, and also the growth trajectory. Second is RBL Bank, Federal Bank and Yes Bank, because let's not forget we have already seen a recent fund infusion in these banks from strategic investors, and it is really important to see how management see a way ahead for these banks. IndusInd Bank, when you look at the growth, we have already seen growth has been cut down, but the roadmap towards achieving that 1% ROE is a key thing to watch out for. And lastly, let's also not forget about AU Small Finance Bank and Axis Bank. Now remember, Axis Bank actually reported their pre-quarterly numbers for the first time, and they were actually great. And at the same time, AU Small Finance Bank also sustained that growth momentum. So it is really key thing to watch if the management still believes that the growth momentum will remain. So all in all, in terms of growth, we may see some uptick in profitability as well as ROAs, but it is really key thing to see how market sees it and how they value for banks going ahead.
Okay, all right. Thanks a lot for that, Gaurav. Well, let's welcome Vishal Goel, India Financials Analyst, UBS, who joins us on the show. Hi, Vishal. Good morning. Good to see you, Ben. First, a quick word on, the credit growth. A few months ago, it was a little bit weakish. But of late, we have been seeing signs that for the industry itself, credit growth is coming back into shape. What are you factoring in for this year?
Yeah, hi, thanks for having us. Yeah, I think we are expecting acceleration. In fact, we were expecting 12 to 13% growth for the year end for this year. The recent data has some base effect, which is showing 14 plus kind of credit growth. We feel that acceleration credit has happened, and we should see this 12% to 13% range kind of sustaining into the year next as well.
Vishal, LDR of HDFC Bank was a bit of a concern at 99%. And we saw the stock correct because otherwise the numbers were fine, the credit growth, etc. I mean, how did you read the quarterly update? Because numbers are out tomorrow for HDFC Bank.
Yeah, I think, see, again, I'll kind of try to refrain from stock-specific comment. But if I look at the general trend in data, it has, like, most of the banks have seen 3 to 5% kind of sequential growth. And that's a healthy, pickup in the sequential quarterly growth for them. Having said that, some of them are not growing as much. And that's where I think some disappointment, has come in for few names within the sector as well. Now, I think on this issue of LDR for the sector overall also, if you look at in the last 1 year, the pressure of LDR has reduced. At least that's what we feel when we speak to the management, that people don't need to keep reducing LDR, every quarter. So there is some flexibility. But having said that, I think the sector needs deposit growth for it to sustain, any amount of loan growth for next couple of years. And that had been generally missing. And last reported data was, let's say, 9.5 before we just saw the fortnight print, and which has some base effect. But I think we need to see 12 plus kind of sustainable deposit growth for us to be able to see a 12 to 14% loan growth for the system overall.
That point, right? I'm digressing just for a minute, if you will, Vishal. I'm Morning Prashant here. You think the budget will do something to correct that situation, make debt more attractive? You think it's possible? I mean, it's a fundamental issue, as you were saying, right? I mean, deposits, debt is taxed at a much higher rate compared to equity. So, I mean, any correction possible? What's your sense? And will it do it if it so happens? Will it do the job?
Yeah. Hi, Prashant. So, see, I think you've been tracking, I have also been tracking the sector for 20 years. And every year budget, we have had these expectations that there would be something which bridges the gap of, interest on deposits with the other products. That expectation, I think, remains, especially that becomes, I would say, more probable when we think about the weak deposit, environment. So every year, we've been kind of expecting something like this.
Yeah. So no way to tell, but point taken. Vishal, talk to us a little bit about pockets where we will see the strongest overall growth, healthiest growth, and where one will see more weakish growth, relatively speaking, across financials in your coverage universe.
Sure. See, I think a lot of data is already out. So especially in terms of business update. So we know where the loan growth, deposit growth, etc. has landed for the quarter. The question now would be about net interest margins, which again, I think most banks are expected to report some improvement in margin because there was a CRR cut. There was, deposit repricing, which has been happening. And this is the quarter where there should be some relief from the, yield minus deposit cost. So again, overall, we should expect some margin improvement. But sustaining that margin improvement in Q4 would be tricky, given that we have already seen one repo cut. So my view is that guidance on margin, I think, would be kind of critical just for the near term. But as we look out into FY27, you would see that most of these banks would report very healthy earnings growth because the base of FY26 was pretty weak on margin, and the exit loan growth, etc., would also support earnings for next year. So I think maybe once you start looking at FY27 earnings for banks, I think they would start looking better, I would say.
Vishal, can you lay out the valuation picture for us? Yeah, go ahead.
I think valuation also for last couple of years has remained reasonable, right? For the sector, especially for the banking sector. And if I look at the overall financials, yes, we have seen some pockets, let's say in NBFCs re-rated massively, but banks stayed where they are. And even now also, I think banks are below historical averages. Now, the context of historical average also gets challenged because the growth rates have changed now. And therefore whether we should use historical, but that just using as a benchmark. We feel that lack of earnings growth has also caused some of this kind of stagnancy or derating in the overall sector. FY27 generally, as I said, should see some acceleration in earnings and should drive re-rating. And valuations we feel are reasonable for the banking stocks.
Okay. Yeah. No. Absolutely. Anything outside of pure banks and NBFCs, lenders, MFIs? What else should one focus on a risk-reward perspective, given where we are in the cycle, Vishal, according to you?
I think risk-reward is getting better actually in banking. To be fair, NBFCs have run up, and therefore valuation upside seems limited over there. There are some opportunities in life insurance because that's the sector which is seeing margin improvement. More protection is supporting the VNB margins. Capital markets are like on the tear in terms of earnings and all, but they also seem, like the valuation wise, there is no significant delta over there. So I feel banks, MFI is a very small, segment actually. I mean, it's seeing improvement, to be fair, especially for NBFCs, MFI, there is very good improvement in the asset quality. Banks are a little behind on MFI asset quality in general. So yes, there are some improvement over there. But I feel on the whole, given the size of banking, I think that seems very attractive risk reward wise.
Yeah. Vishal, hope you come back once we have the numbers. Thank you very much for joining us. Quick chat today. Appreciate it. We'll take a break. We're back. Manisha will be with us with commodities and, lots happening there. A little bit of retreat across precious metals, silver especially. So we'll ask her what's top of mind for her. Stay tuned.
Welcome back. As always, let's talk commodities. Manisha is now joining in. And Manisha, today you're not watching gold, silver, copper, but it's tin that you're looking at.
Well, yes, when you look at the last couple of days right now, we've seen all-time highs in gold and silver and copper in this week. But tin is outperforming right now. The last time you saw these kind of levels were 3 years ago. And right now we are trading at a record high in this one as well. So $54,400 a ton has been crossed on the higher side for tin. Tin actually has been performing within the space in the last year as well. So when you look at the gains that we have seen in this year and the last, that will tell you the story. Last year, we've seen prices gain up by 46%, which is way higher than what copper did at 42%, but lower than what gold and silver did. In this year as well, till time, this clearly has been an outperformance. 35% of gains is something that none other commodity has given you, nor asset class as well. But tin has given you 35% of returns coming in there. Well, 7 to 8% of that came in the markets overnight as well. There is very strong demand from AI, EVs and data centers as well. Well, let me remind you that tin is used for soldering and for circuit making, and that is where the demand seems to be coming in from. While the LME inventories are quite strong, it is about the potential of future demand and the output concerns in the Myanmar mine, which seem to be adding premium to prices. If you look at the export restrictions that seem to be coming in from Myanmar and also Indonesia have been supportive for prices. Myanmar, for example, accounts for nearly 10 to 12% of global tin demand, global tin supply therein. Also, when you look at the Indonesian markets, well, they export nearly 25 to 30% of global refined tin, and we are looking at concerns in both of these major producers there. It also has to do with a string of strong speculative buying. It is not very liquid as a contract when you see on LME. Shanghai does quite well when it comes to tin, but we have seen open interest and the prices continue to rise, telling you that the speculative money seems to be flowing into this space right here. And then add to the fact that every other metal is doing well, so there is a spillover effect. You also are looking at geopolitics, macro headwinds, all of that supporting tin prices as well.
All right, well, let's talked about, but important one. Thanks very much, Manisha, for that. We'll take a quick commercial break here. On the other side, we get into a discussion with the management of Union Bank of India on the third quarter results and more. Stay tuned, coming up.
Fly Emirates, fly better.
Welcome back. We will put the spotlight on Union Bank of India. The earnings beat expectations. Profits rose 9% year on year, aided by decline in provisions. The NIM grew about the net interest income grew about 1%. Deposits saw a sequential decline. My colleague Ritu spoke with the management on the sustainability of profit run rate and normalization in profits. Listen in.
Let me break up, the profitability part into the three areas. The first one is the, say, business. So actually there was a bulk deposit, which we have shed it off around 40 to 45,000 crores. So that was point number one. Second thing is that our CASA has increased by almost 14,000 odd crores. The third thing was the retail term deposit. Actually, we converted even the bulk deposit to retail to an extent of 40,000 crores. So I think the combination of these, so you will see that there is a good drop in the cost of funds. So that was one part. The second part is even the treasury, it has been contracted by 15,000 crores. So actually we have met the sources of funds and we have deployed it nicely. So this is what I am saying is basically on the part of the liability side. Coming to the asset side, we had IBPC of around 20,000 crores, which is now actually nil right now. So, and if we take from the March, it was almost 35,000 crore. So now the remaining is hardly 3,000 crore. Now, which we have converted to better yielding the long-term portfolio. The third thing was we had an STL of around 10,000 crores, which we have converted to long-term. And the third is the asset quality. The slippage cost you would have seen is 0.09. Slippage ratio is 0.79. It is considered low. The SMA2 figure is around 4285 crores. That is above 5 crores. So keeping in view, I think these three pillars, this has led to the profit growth and it is sustainable.
Profit growth is sustainable, and we'll get to some of those points that you mentioned, sir. But, to begin with on provisions again, what is your estimate of what the ECL impact is going to be? And while RBI has given all banks a 4-year glide path starting April next year, what is your readiness already on that front?
Yeah, we have done the calculation. We have actually the software in place. And almost at regular intervals, we are calculating it. So the gap, keeping in view all other provisions and the total requirement, the gap is coming in the range of 4,500 crores. I think we are very much comfortable on this. And already there is a provision for going for next 5 years, but I think we are very comfortable when we can take a call at appropriate time. So absolutely there is no issue in migrating to the ECL framework.
So you won't be requiring to raise any equity capital anytime soon?
Yeah, see, our board has already approved plan of 6,000 crore, which we have already, briefed earlier.
Yeah.
Now, if you see the 3 quarters profit, it is already in place, which is in the press and media. So if we take March 26, we are at a very good, comfortable range as far as the capital is concerned. And provision, as you have seen, it has come down drastically. So I believe the growth capital we do have, but then we also think of raising money wherever, whether it is through cheap methods of infrastructure bonds or the green bonds or the way in which it is feasible as per the market scenario.
Got that, sir. So, the other positive surprise that came in the quarter was the margin improvement despite RBI's 25 basis point rate cut. But again, you told us you've also decided to shed some high-cost bulk deposits. And of course, the CRR cut also helped margins. What is the steady state NIM target and what lever will you use to expand margins from here on?
See, if we see the 1.25 percentage points repo cut is there in the current financial year. Now, if we take that, if you see from December 24 to December 25, our drop is from 2.91 to 2.76 level, which is hardly anything. And in the last quarter, when we met with the press, there was a question, related to the NIM. So we said we want to defend it. And yes, aspiration is to improve further. Actually, we worked upon the efficiency ratios in this entire quarter. And as I said to you, various measures on the treasury, various measures on the asset and liability side, we could maintain it. So now I feel that still next 2 quarters, we certainly possibility is there for further, but then we would like to defend at this level because we do have opportunity, of some re-rating of the deposits and maybe some shedding of some few more bulk deposit at higher rate. So that is on one hand. Second thing is while maintaining asset quality. we are very sure that we will be in a position. So as per the guidance side, we would like to defend it at what level we are in right now. But same time, aspiration is to make it further better and improved.
Okay, so you'll defend it at current levels while trying to improve it further. But you said you might shed more, high bulk deposits. Your CASA deposits are up sequentially, sure, but the overall deposits have degrown in the quarter for the bank, and they've barely grown 0.5% over the previous year. What are you doing to address your core deposits? I mean, how are you looking to grow them? Because your LDR ratio has jumped quite high to 81% as well. Is that going to be sustainable for future growth, or are you taking steps to bring the LDR ratio down as well?
Okay, see, if you see the regulatory things and being the robustness of the bank, there are 2-3 things. The first is the LDR. We are in a very quite comfortable range, which is below 81 if you take domestically. The second thing is that the LCR and the NSFAR, both are in very comfortable range that we have diverged in our investors presentation. Now coming to your point, like while shedding of the bulk deposit, how we are going to retain our ratio and the robustness in the liquidity position. So I firmly believe if you see the last quarter, the 14,000 plus crores we have brought into CASA, and which is sustainable because we are now focusing into average advances and average CASA and average deposits. The second point is that even the retail we have increased by 9,100 crores. Put together, the 15,000 plus 9,000, around 24,000 crore we have brought in. So we have actually, structured a very good vertical in our bank, which is like an ecosystem banking, which has yielded very good result in the last quarter. So we are confident and we have aspiration to further increase CASA going forward.
So very briefly, since we're running out of time, credit growth at 8% is below some of your peers that are growing at 12 to 14%, even the system. How do you think you could end the year? What kind of credit growth and also the segments that will drive it?
Yeah, see, if we take, the entire year, what you are saying is correct. But if I take two things, the one is the last quarter, there is a very good growth in the RAM sector. If I take the retail, it is around 21.67. And if I take Q to Q, retail is around 3%, MSME is around 6%, and agri, if I take, is around 4%, the total is 4%, which is quite good growth. Now, if I take the corporate book, which you are asking, now when I take the IBPC, which we have shared off around 30,000 crores, and the second is what short-term loans we have converted in long terms, 40,000. Still, we are in double digit. So I think the last quarter is a good clue that we are moving in the right direction. And certainly when our GDP is growing at a good rate, so plus, 2% better, I think we will be in a position to, with the industry standards, and we will be maintaining going forward that run rate on the advances side, both on the RAM as well as corporate credit. We still actually
so overall, what would the credit growth number look like?
Actually, we still have a 24,000 crores of, undisbursed book in corporate credit, which will be taking place in this quarter. Okay. So already that sanction is in place and various documentation, other things are moving forward. So that is why I am saying that putting RAM and corporate credit both together, the double-digit growth certainly you will be observing going forward.
Okay, so the other thing that the street really liked was this improvement you've shown in asset quality and credit costs coming down to just 0.09%. Slippages also just 1,600 odd crores, which was aided by write-offs. How do you expect to end the year again? I mean, are there any emerging pockets of stress you'd want to be cautious on, especially given some of these external uncertainties like the tariff threats for the MSME sector? So where do you think you could end on slippages and your credit cost as well?
See, up till now in the 9 months, our slippage is around 5,800 crores. And it is much lower than, what we thought of initially. Only because that we have made certain changes in our entire system of monitoring. And now we are using even the machine learning and analytics part. And we have feet on the street and we are having a software in that. So using all these machineries, we are in a position to contain, SMA position. Now, there are two things. One, when we talk about asset quality, one is your asset book. Now, asset book, if you can see, my 95% is about triple B and above, and in which 84% is A and above. So I think on the corporate, that is 25 crore and above, I am telling. So I believe that is a very good quality on the asset side. Now, even if we take the slippages, so the SMA2 particularly, so that is again, if you take, is around hardly 4,285 crores, above 5 crores, not SMA2, total SMA. So which is well under control. So we are of the firm view that, going forward, we will be in a position to maintain such asset quality and delinquencies.
Okay, any number you could give us, sir, where you'd end up at?
On which, sorry?
On both the credit cost and the total slippages for the year.
Yeah, I think, the slippages ratio which we have shown in this quarter and the credit cost, we are in the view that we will continue in the same range with hardly variation here and there.
And your recoveries, I think, for the 9 months are more than 3,000 crores. Any further recoveries you're expecting in the fourth quarter? Could you end the year significantly better?
Yeah, actually, we had certain in the pipeline in the December to realize, but it could not come. But you'll be surprised that our biggest the amount which is shown in the recovery is 160 crore something. So not a bigger one has come, but then we could maintain our recovery efforts and we could maintain the recovery figures in last quarter. But we expect the better than the last quarter recovery in this quarter.
Infosys shares surged nearly 5% on the back of its third quarter earnings. The company raises its FY26 constant currency revenue growth guidance to 3.5% from 2 to 3% earlier.
Well, Cipla shares declined close to 3% after the company announces that the company will temporarily pause manufacturing for one of its major drugs.
Angel One zooms 8% after a strong third quarter performance. The company's revenue rises 11%, net profit surges 27%. 361 WAM 2 sees a 6% surge following a strong set of third quarter earnings.
A few movers on the back of order wins. Zen Technologies perks up in trade after winning a 400 crore order from the Ministry of Defence, while Kernax Micro surges after the company bags major coverage orders worth around 2,465 crore rupees.
India Mart Intermesh shares rally up nearly 8% after a large block deal on Wednesday revealed Nalanda India Equity Fund bought about 11 lakh shares of the company.
Hello and welcome to Chartbusters. We're joining you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets, in fact, have come back in style after that one-day holiday that we had. The Nifty up close to around 180 points. Midcap index as well participating. Let's see, Mangalam, if you have got more in store. But tech, that's the index that's bursting away.
It is a good day of trade, Nigel. No two ways about it. You know, we were wondering whether the Nifty holds around the 25,700 mark or not. Lo and behold, it's above that 25,800 mark, closing in on 25,850. Now, the important levels that come in are about 100 points away from here, which is both the 50 and the 20-day moving average. And once we do cross past that, perhaps then there would be some short covering that we have been expecting from the start of this series itself. The important part, not only is the IT index doing well, the Nifty Bank as well is up around 1%, and Reliance too ahead of numbers is fairly well bid. So across the board, all index parameters are supporting the frontline index and the mid-cap index participating too. And amidst all of this, we've got a slew of good earnings coming in from a lot of these, capital market players, be it like the likes of 361 WAM or even someone like an Angel One. Amidst all of this, we have Anand Rathi, the first management, joining us to discuss their third quarter numbers, the outlook going forward. Pradeep Gupta, the chairman and managing director of the company, joins us now. Thanks a lot, Pradeep, for joining in. Season's greetings. There's a slew of, festivals across the country over the last two trading sessions. But, just on your numbers, I wanted to understand a couple of things. If you could give us a sense on, the outlook that you have for the remainder of this year and, more importantly, the start of next year. So FY26 and FY27. If you could give us a sense on the clients that you're willing to add, the number of accounts that you're looking at, and your revenue at large.
Yeah, thank you, Mangalam, and Happy New Year to you and the all team of yours and all the viewers over here. To be really frank with you, if you really look at the number of Anand Stockbroking Limited, for quarter 3, we have already achieved about 248 crore and with a PAT of about 37 crore. So, I mean, if you really see, this is a growth of about 22% on our top line and about 73% on a PAT. But these are the performances which will keep on, increasing and showing proper growth over a period of time. We believe we are bang on target. Our whole motive is to serve those kind of customers who are looking for an investments if they are looking at how they can invest and broaden base their investment products. So we are looking at equity, in more specifically equity in direct equity, cash market side, and then various other products like mutual fund, PMS, AIF, structure products, bonds, and so on and so forth. So we are trying to give them a holistic solution so that they can have a long-term investable portfolio and they can keep constantly working upon it. And that's what we are trying to do. So our motive is, and also on the top of it, what we are trying to do is trying to give and provide margin trading facility to those customers who want to leverage and try to increase their ROI on the investments. So our margin trading facility is something which we are constantly providing to those kind of a customer. So what we have done is we have kept only two kind of a set guidance for ourselves, that how we can probably constantly increase our non-broking business, which is coming largely from distribution and margin trading facility. In distribution, we have already achieved almost 8,370 crore AUM, which we are aspiring by March 26, somewhere around 9,500 to 10,000 crore. That's our first benchmark, which we have set, and we are constantly working towards it. Similarly, if you really look at it, MTF book, we have already achieved about 1,230 crore by way of providing funding to through margin trading facility. And we have set a target that by March, we should be able to reach to somewhere around 1,500 crore. And we believe we are bang on target. Our non-broking book is constantly increasing and expanding by 35 to 40%. So far, broking is concerned, what we are trying to do is broking from cash market and broking from non-cash or a derivative market.
Correct.
There are two buckets, and we are trying to fix this revenue mix over there and trying to see how we are constantly increasing our book.
All right.
In terms of what you have asked about acquisition side, largely our acquisition is dependent on referrals as well as various different activity which we are placing on the ground through our network.
Okay.
And we are constantly working towards this and working constantly increasing and expanding our customer base across the country.
All right. Hi, Mr. Gupta. Good morning. Nigel on this side. Congratulations on your results. We look forward to keep in touch as the year progresses. You gave us a few numbers. The MTF book, you see it go to around 1,500 crores. And the AUM that you're talking about moves around 9,500 to 10,000 crores. Got that. Give us a few more details. The active clients, could you tell us where is that number headed if you have a number in mind? Point number one. Point number two is across verticals, if you could break it up for us, what is your market share? And where do you target this market share moves to?
So thank you, Nigel. I think for your question about market share, we are not really literally bothering on the market share. What we are trying to do, how we can or we keep on expanding our AUM book. And until unless we are not going to increase the AUM book, whether it is coming from existing customer or coming from a new customer, it's not going to help us in any which way. So far, we are focusing on delivery-based business by way of expanding our AUC. And AUC is constantly expanding and increasing, and we believe that is going to increase in forthcoming quarter as well as next year also. Similarly, in terms of AUM, where we are focusing, why we are doing that? Because of a simple reason, we want to create a constant and consistent revenue generation and predictable revenue generation in terms of growth by this company, and we are constantly working towards it. So that's what we are trying to work it out. If you really look at it, our growth is about 21.5% so far has come in terms of AUC book, which we have created so far. And we believe that book is constantly going to grow by 20% year-on-year basis also. That's what we are looking at from an AUC book, which is largely helping us in growing our broking side. And I have already spoken to you about AUM side.
So AUC grows about 25 to 30% every year. Commodities, that's the talk of the town right now. Gold, silver, all of them are at record highs. People call this year to be the year of aluminum and copper, etc. You have been applying, or registering for a commodities derivative broking license. Has that come about for you? And, on the broking, non-broking business itself, if you could give us a mix, how much do you expect coming in from non-broking going forward?
So as on today, if you really look at it, about 55% and 45% ratio is there in terms of broking and non-broking. We are aspiring to reach to 50% level by March 27 with a decent amount of growth in both the segments. And over a period of time, we will see which is the kind of a percentage which really worthy and looking at the revenue growth and sustainable and predictable revenue growth can be achieved. That's what our aim is, and we are constantly working towards it. In terms of commodity, yes, we already have a commodity licenses, and we are addressing the commodity needs of our customers, which is coming and part of our non-broking F&O businesses side itself. our revenue mix between, broking in cash market side and F&O side is 50-50. Within that 50-50, in pure F&O and commodity, both business are included.
All right, Mr. Gupta, as you said, numbers will keep improving from year on. Your net profit is, I think, ballpark 37 crores. If you have to give us a number out there, going by all the efforts you're putting, what would your net profit number look like? Maybe on a quarterly run rate, if you could give us, or maybe if you want to give us for FY 27-28, what should it look like?
So typically for 26, as you know, if you really glance through our 9-month figure, we have already touched about 89 crore kind of a PAT, which we have already achieved. We are constantly looking at that there should be a minimum growth of about 25 to 30% from last year. And our aspiration is that 20 to 25% on top line and about 30 to 35% kind of a bottom line, we should be able to constantly achieve it. So for 26, we believe that we will be able to achieve that. We are bang on target with the current run rate itself. We will be able to probably achieve that, and we will probably surpass that number. And next year again, with the same kind of a growth in PAT level, I think we will be able to achieve that.
So ballpark, you think that you should be headed to what, around 200 crores of net profit in the next fiscal?
Next fiscal, which is by March 27, one should expect somewhere around 180 to 190 crore minimum. But I think, as I said, 30% growth is something which we are surely going to maintain and trying to achieve that.
Got it.
Mr. Gupta, thank you so much for joining in. 9,500 to 10,000 crore AUM by end FY26. 1,500 crore MTF book by FY26. Broking, non-biz broking 50-50 by March 2027. AUC should grow between 25 to 30% and 30% net profit growth for the next couple of years. Wish you good luck, and we will keep track of these numbers and keep quizzing you on them as you report your quarterly numbers as well. Take a short break, come back, get you more on the markets and a lot of stock-specific action on the other side. Stay with us.
Welcome back. Markets at the day's high, 25,850 on the Nifty. Let's see whether or not we can, drive home the advantage and end closer to the upper end of the range. That said, let's shift focus to our special segment where you get a few ideas for profit from Moneycontrol Pro. Sachin Pal of Moneycontrol.com joins us to talk about a stock that he's tracking closely. Sachin, over to you.
The stock is Tamil Nadu Petro Products, which is the only producer of linear alkyl benzene in South India. Well, the company produces linear alkyl benzene, which is a key chemical primarily used in detergents, soaps, as well as industry cleaning purposes. Well, there are two factors currently which makes us constructive on the stock at this point of time. Firstly, the government of India has announced an anti-dumping duty on imports from Iran and Qatar for linear alkyl benzene for the next 5 years. So that really paves the way for structurally higher margins for the company over the medium term. Secondly, it's also undertaking capacity expansion in lab from 120 kilotons per annum to almost 145 kilotons per annum, which should give incremental volume growth going into FY27. Well, the capacity expansion has been funded through a mix of internal accruals as well as debt. Still, the company enjoys a very net cash position on its balance sheet. Also, the values of the company are currently trading at around 7 times FY27 estimated earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
All right, Sachin, while the IT stocks are doing well, the large cap ones, it's the mid cap IT which is surging right now. So you have Birlasoft, which is up 5%, KPIT up higher, Oracle, name it. All these mid cap IT names are doing well. What's not doing well today are the pharmaceutical stocks. The pharmaceutical index is actually the only one which is in the red. In an otherwise booming market, Cipla is the top loser out there. Ekta joins in with more on that. Ekta.
Well, yes, Cipla is in focus. That is because the company has faced some amount of a fresh setback when it comes to one of its top 3 drugs in the US, tumor drug lanreotide. Now, what has taken place is that the company's partner had received US FDA observations for an inspection which has taken place at its Greek plant in November. It was slapped with 9 observations. So the latest is that the manufacturing is temporarily paused of the drug lanreotide to support the remediation. And remember that it is one of Cipla's top 3 drugs in the US, generating around $150 million in terms of sales. The resupply is expected in the first half of FY27. To give you some statistics in terms of Cipla's US business, Cipla has 22% market share in lanreotide in the US. They record around $233 million in terms of US sales in Q2 FY26 versus estimates of around $230 million. And in FY25, they recorded $934 million in terms of total sales in for the US, which was an all-time high, which was supported primarily by drugs such as Revlimid generic, which is the cancer drug, and that is also going to see much more generic competition, as well as drugs such as lanreotide. Now, this is one setback, but Cipla is also facing another setback where Lannett, which is basically Aurobindo's acquisition target, has become the 4th US FDA approved generic company to get approval for this particular respiratory drug, Advair. Now, Cipla had filed for the drug in May 2020 and has still not received approval. They are guiding for a second half FY26 launch, but based on what the street is seeing in terms of the delays, they are a bit cautious. So the street is revising the Advair sales lower by around 23 million versus 39 million in FY28, 29 million versus 44 million in FY27, and similar for FY26. Overall, the street has cut the EPS estimates by 1 to 4% for FY26 to FY28 based on what we are seeing in terms of these two setbacks. And the US sales is now seen to be low single digits to a possible decline because of these current setbacks. Morgan Stanley has an underweight rating. They've cut the target price on Cipla. Nomura has a buy with a target price of 1770, and Nuvama has downgraded the stock to reduce.
Brilliant. Thanks a lot, Ekta, for explaining that to us. Well, a quick programming note before we take a short break. Here's a sneak peek into all the stocks that we'll be addressing on Your Stocks Today. Don't forget to catch the fundamental and technical experts. They'll give their views at 2 p.m. later today, only on CNBC TV 18.
The market's holding fairly well. It is big boy Reliance, which is set to report its third quarter numbers later today. Sonal joins in with the earnings expectations. Sonal.
Well, it's expected to be a strong quarter this time around, but let's talk about the stock move first. The stock, remember, is down around 6% in last 1 month, but in the month of January, it did hit its record high level, came in at around 1,611 rupees a share on 5th of Jan, and the stock trades at 27.2 times FY27 EPS. In terms of the consolidated expectation, revenue is expected to fall by 3% on a quarter-on-quarter basis, but the EBITDA growth will be decent, 5% on a quarter-on-quarter basis, leading to a margin expansion, which is expected to come in at 19.45%. Profits accordingly will see a growth of 6.6% to come in at 19,365 crore rupees. Now let's talk about the segments. It's the oil to chemicals business this time, which will drive growth for the entire company, and this is because of strong GRMs. Singapore GRMs, they are up 97% on a sequential basis. However, weakness in oil and gas segment is expected to continue because of lower volumes and pricing as well. The festive season demand, that is something which will aid growth for the retail segment. And if we talk about the Geo business, that is expected to see a growth of 16% on a YOY basis, 2% sequentially because of higher ARPU and also subscriber growth. Overall, we'll be watching out for some announcements. Clarity on the new energy business, expected to see more capacity coming by on stream, growth in retail store additions, and any pricing action in the telecom business. These are some aspects that we'll be watching out for in the management commentary.
Take that point. Thank you for that, Sonal. A consolidated link. Let's look at Reliance Retail in specific, the value driver, the growth driver of the business. And as Sonal pointed out, it's the festive season that will drive growth out there, along with scale-up of categories and GST cuts. So analysts are expecting anywhere between 10 to 12% revenue and EBITDA growth in this business, which implies that for the first time ever, the retail business could actually have a 1 lakh crore quarterly revenue run rate. And that's something that would be a milestone. 11% growth is what our poll of analysts expects, and a 10% jump in the EBITDA, which implies that the margins would be between that 7.5 to 7.6% mark, which they have been consistent over the last few quarters. What are we looking at here? Growth to be led by the festive season, along with higher penetration of quick commerce, and finally, completed recalibration of store network would impact their, impact their profitability positively. But let's go back to Sonal to get specifics out of the O2C business. Sonal.
Well, this definitely will be the growth driver for Reliance Industries this time. Strong quarter expected in the oil to chemicals business. This is because of the refining segment growth. Now, remember, Singapore GRMs, they jumped in the quarter gone by, up 97% on a quarter-on-quarter basis to come in at $7.50 per barrel. Diesel, ATF, gasoline spreads, all of them were higher, anywhere between 36% to 66%. However, the petchem segment continued to see a decline, 1% this quarter. The decline has slowed down in quarter 3. Overall, Jefferies expects EBITDA to be higher by 15% on a YY basis, 10% on a sequential basis to come in at 16,579 crore rupees. The trend for previous EBITDA numbers will come up for you on the screen, and this quarter is expected to see an increase because of refining. If we talk about the oil and gas business, expected to see some weakness because of 2 reasons: decline in production in KG D6 basin and decline in deep water prices as well. So if we talk about the production to decline 8% on a YY basis, 1% sequentially. Even deep water gas prices have gone down by 4% on a YOY basis, 3% sequentially. And that's why Jefferies expects their EBITDA to decline 14% on a YOY basis, 4% sequentially. There have been pricing issues that we've seen globally and in India as well when it comes to pricing, right? And that's why EBITDA, that trend will come up for you on the screen. And that's been seeing a decline. And this quarter as well, that could continue for Reliance.
Okay, all right. Thanks a lot, Sonal, for that. Well, on that note, though, we'll wrap up on the session of Chartbusters. Stay tuned. The team of Trading Hour comes up next.
Welcome back. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Ritu as well as Hormaz. And what a nice Friday morning the bulls are having. The Nifty, after a very long time, zooming ahead, led higher by all the frontline indices. We have the IT pack, obviously, on the back of strong numbers coming in from Infosys, and had a positive rub-off on all the other large cap and mid cap IT names as well. The Nifty Bank too, doing extremely well, holding up above that 60,000 mark, and the broader markets are doing well too. Amidst all of this, the third largest component, which is Reliance, is holding well in the green ahead of numbers. So the Nifty now moving towards the higher end of the trading range, which is closer to that 26,000 mark. So across the board, good gains coming in. Looks like a good Friday, Ritu.
Well, fingers crossed, Mangalam, it touches that 26,000 mark. But for now, it is hovering near the day's high that we saw, which was at about 25,850, I think, when you and Nigel were talking about it on the previous show. Now hovering just 20 points lower than that. But yes, bulls do seem back in action today after a restful day yesterday. We seem to be making our way to the recovery. Bank Nifty, yes, the all-time high is about 60,400 odd levels. Whether we touch that, that's something we need to see, because the Bank Nifty is performing, outperforming the market today, now up 0.8% at 60,069 as we speak. That, of course, is being helped by some of the heavyweights. Keep in mind, ICICI Bank and HDFC Bank, these will set the tone for the large cap, banking names as far as those are concerned. And they report their third quarter numbers tomorrow. We'll, of course, be here analyzing all of the action. But on the back of that, today we're seeing some excitement in the banking pack as well. The Nifty IT index, which you pointed out, that seems to be one of the top performers today, followed by Realty, the PSU Bank, the Auto Pack, and others. But as always, let's put the spotlight on specific stocks that are buzzing. And Hormaz has walked over to the wall to tell us exactly that.
Well, then the bulls will be feverishly hoping that this Friday fervor does not turn into Friday fever by the time we go into the second half of the trading session. Capital markets are doing well. So as a result, capital market stocks are also doing well. You take a look at Angel One, 361 WAM, HDFC AMC, ICICI Prudential AMC. This is not the stock that I wanted to talk about, but most of these names, earnings reactions came in after market hours on Wednesday and over the weekend as well. You take a look at the volumes as well at which they are trading at. Angel One has seen close to 25 lakh shares traded compared to a 20-day average of just around 2.5 lakh shares. Same is the case with 361 WAM, HDFC AMC, ICICI Prudential AMC. All of them have seen almost close to 20 lakh odd shares that have been traded already compared to a 20-day average, which is anywhere between 1 to 2 lakh shares. The other pocket that has done well today is IT. Of course, you can't not talk about that. Infosys, and the results of Infosys has rubbed off on the rest of the pack as well. Look at Emphasis, look at OFSS, Tech Mahindra reporting earnings after market hours today. And here too, the volumes are now on the healthier side. 80 lakh shares traded on Infosys already, which is almost 6x its 20-day average. Emphasis has had over 3.5 lakh shares traded. OFSS has close to 1 lakh. Tech Mahindra has had 10 lakh shares. All of them significantly above, at least 5 to 6 times higher than their respective 20-day averages. And barring IT, there are some news flow driven names that are doing well as well. It's Zen Technologies, courtesy the order win, and IndiaMart, of course, with Nalanda Fund checking into the stock. They did not have any prior holding in the previous quarter, so it's a new entry here for the fund. The stock up almost 8%, the biggest single day gain that the stock has seen since July of 2023. And take a look at the volumes as well. 28 lakh shares traded on Zentech. Volumes of the 20-day average is less than a lakh. And even for IndiaMart, we've had 6 lakh shares that have been traded. The 20-day average is only 15,000 shares. So unlike a lot of trends from the past, today's gains across the board are coming in with very, very strong volumes.
Take that point, Hormaz. Thanks a lot for that. Meanwhile, a bunch of stocks which are not doing as well are actually the ones that do not benefit from a decline in the commodity prices. They were the ones which were surging once all the commodity prices were rising. So pull up something like a Hindustan Zinc. That's under a wee bit of pressure, down about 2%. Though the underlying strength in the commodity segment would mean that maybe these dips could be buying opportunities. We see that in Nalco as well, down about 2.5%. And the oil plays. Remember when Brent was above that $65 per barrel mark, we had a lot of these upstream companies do well, the likes of ONGC and Oil India. But right now, Oil India is coming in for some selling because Brent prices also have come down to about $63.5 per barrel mark as well. Among the ones that are otherwise doing fairly well, not belonging to the IT or the banking pack are the NBFC stocks. So Shriram Finance, for one, is among the top gainers on the Nifty right now, gaining about 4%. BPCL, as well as the others, also the oil marketing companies, benefiting from the overnight decline that we saw in Brent prices. We take a short break on that note, come back on the other side. We get chatting with the management of Travel Food Services. Varun Kapoor joins us.
You want to talk business? Meet me in the On-Board Lounge.
Well, the market's doing extremely well, and all of last quarter is a travel-heavy quarter. How did that impact some of these travel ancillary companies? We have with us Varun Kapoor, who's the Managing Director, CEO of Travel Food Services. Remember, this is the company that has a lot of the lounges, operates a lot of the lounges and quick service restaurants at most of the airports in the country. Varun joins us in our studio. Thank you so much, Varun, for joining in. It was a busy season for you, I suppose, the third quarter. So that exactly is, what we want to understand first. The travel trends in the third quarter, which is significantly seasonally higher than all the other quarters. Did that play out this time around as well? And the passenger footfall, despite the Indigo disruption, if you could give us a sense on that. Did the Indigo disruption impact business for players like you?
Sure. No, thank you for having me in the studio. Always a pleasure to be across over here. So undoubtedly, travel in India is robustly been strong throughout the year. But always quarter three is the time when you tend to see that to be the busiest. And I think this year as well, obviously we came out of a quarter two, which was a bit slow on travel. Evidently, unfortunately, we had during the summer a bit of disruption, by the war and the effects that happened post the air crash that happened during that time. But quarter three, we actually saw very strongly bounce back. October was a good month of travel. November was superb. I think in most airports you read about record numbers in terms of travel. December, yes, a bit of disruption that happened for a short period, but I think it was quite short, that period of disruption. But in travel, you can see very much. I think Indians are on the move across the board, both domestically, internationally.
So by and large, the travel footfalls, so to say, were they, mid-single digits, double digits, or a little more than that?
We've generally seen, while quarter three, I think the official numbers for December are expected to come out, but I think the trend in quarter three versus a degrowth in quarter two, year on year. Quarter three, you've actually seen kind of expected to see probably a single digit, mid-single digit, low single digit growth is what I think expected. So you're seeing a decent rebound from the effects of quarter two, quite evidently, I think, in every month. So I think, if I remember right, November was about a 6% growth, roughly, from what I can recollect in terms of year-on-year passenger growth. So it was a record month
Could that rebound have been better, Varun, had the Indigo disruptions not happened at the start of December, because there was this prolonged period of flight cancellation?
Surely, I think undoubtedly probably it would have been. So that's why I think it's a temporary piece, and I think the trend is very strong. So I think expect it to be Q4. Again, early days, but I think the indications, obviously travel, the way you
First
see
7-8 days of January have been good, right?
have been decent travel. You can see that. I mean, anecdotally, you always see it at
No, see that. But
airports are busy.
one more thing happened in Q3. The Navi Mumbai airport opened December 25th. I had the opportunity to take a flight from there, but it's not entirely done yet. Obviously, it will take some time for all the stores, all the lounges, everything, to come in place. Do you guys have the contract for the Navi Mumbai airport?
We do operate. So we operated Navi Mumbai airport through a joint venture with Adani Airports. We run the units there. Again, the airport, as expected, will be phase-wise expanding. Part of it has opened here. I think very much the initial feedback has been superb. You've seen across, I think, social media and other places. I think it's the airport Mumbai deserves, and we're very happy to be part of it in our manners.
So what are you expecting in terms of business from there once it stabilizes?
So I think, like I said, early days, started about 30 flights. I think originally roughly about when it started on December 25th. I think closer this month to a little over 40 flights currently trending. I mean, the airport has a 20 million capacity. So today, I think it's roughly maybe about 5,500 to 6,000 passengers a day. Still far away from getting to a 20 million run rate of capacity. Probably will surely be in the next financial year. So for this year, won't be meaningful part of the numbers. But in FY27, one would surely see that towards the back end of the year playing out as being an important airport, no doubt. But I think the offers are, if you must fly there, I must say the brands and all will be tremendous to go. So you have things like a Wagamama opening there. You have some superb concepts there. So
I saw a bunch of them. All of them were going to open soon. What we'll do is take a flight, not literal flight, but the satellite flight, go across to Ritu, who's in our Bangalore studio. She has a couple of questions as well. She herself is a frequent Bombay-Bangalore passenger. Ritu.
Yes, frequent passenger, but not to the Navi Mumbai airport yet. But Varun, FY27-28 is when you start some of the incremental revenue to start coming in from the Mumbai airport. You've given us a hint of what's there, Wagamama, etc. But overall, 50 QSRs, I think, in the last 12 months, and now you have 464 outlets. What kind of addition to these numbers should we pencil in for the coming year as well, if you could give us a sense? And the average revenue per passenger, while the number of passengers you're saying is increasing, the revenue per passenger, how has that been trending?
So yes, when you're flying next, hopefully your choice is Navi Mumbai. It's going to be a superb airport there. Today both the airports in Mumbai have tremendous offers there. But I think if you look at in terms of the outlets, we've seen since September where we had roughly about 464 travel QSR, we had 37 lounges. We've seen a tremendous number of openings since then. We've opened up outlets in Cochin Airport, in Delhi Terminal 2. We've opened up, obviously, our units in Navi Mumbai. That's in a phased manner as well. We've actually opened up outlets in Cochin as well, a recent addition, and Mumbai T2 as well. So a whole slew of airport opening has happened during this period, and actually more coming up as well. So Noida Airport, an airport expected to happen, more units in Mumbai T2, more in Hyderabad. So I think these last 3 months plus the next 3 months, actually a very aggressive slew of airport openings. I think on Christmas Day, we had the opportunity to open in Navi Mumbai. On Jan 1st, we had the opportunity to open in Cochin. Teams are hard at work during the busiest period of the year. And a very evident thing, undoubtedly, in travel, if you see the revenue per passenger, you touched, I think, a very relevant point. What has happened on the revenue per passenger is that the beauty is it actually is been growing in our country ahead of inflation. And why does that happen, right? So there are probably 3 drivers one can look at. One would be the existing units. Right. You actually spend, much more units come in. Second thing, you higher spend per units, better brands coming in. And lastly, in terms of the type of existing units, you drive more promotions, etc.
Take that point, Varun. Thank you so much for joining in just in time for us to also listen to a very important conversation that is currently underway. Let's go across to Lata Venkatesh, who's in conversation with the SEBI chairman, Tuhin Kanta Pandey, on the sidelines of the SEBI's annual conference, Samvad. Listen in.
Fears for this community now is, are we losing the favor of foreign investors? Does that worry you? Whether it is the currency market or the bond market or the rupee market, the fear that FPIs have kind of sidelined us for the past 2 years. Anything that SEBI is doing to just make them feel more welcome?
I think
this is not really an issue of, being welcomed or not welcomed. I think the frameworks, Indian regulations are well in place, and FPI's decisions are contingent on how they look at it, different markets and returns, and also look at earning growth. They also look at currencies. And they also look at geopolitical factors. And they are, in a position to come in and go out as well. Now, if you are really looking at, the FPIs are there to the extent of $900 billion invested into Indian market. And yes, there has been, $18 billion movement over a period, outflows over the period. But it also depends upon cyclical factors. So on regulations, we can only say two things. One is making our markets deeper and more diversified, especially the debt markets, the corporate bond markets, and so that, to some extent, it will be within, not pro-cyclical, but other approach can be taken. The people can shift also from equity to debt, depending upon the situations, depending upon the circumstances. The second issue, of course, is, are there any frictions which we can improve structurally, whether we can improve the market? So one area which we have really looked at it very closely is the registration process. How we can have, registration which is faster, digitizing the whole process, looking at, whether the FPI KYC across SEBI and RBI can be done very quickly. We've introduced the concept of Swagat FIs, bringing in greater amount of certainty in registration period over a period of time, less paperwork, more flexibility. And going forward, I think that particular thing will also expand. Digitizing, digital signatures, even otherwise also allaying certain fears that they had following the, the threshold and other levels which were brought in, and they were also relaxed. So other points, of course, we are looking at very closely is netting. And I think the consultation paper will be out very, very soon on this to allow them to net in some respects so that there is a greater operational efficiency while they operate.
When do you think we may see us getting closer to it? I guess there'll be some conversations with the banking system also on that. So, should we expect it sooner rather than later?
Maybe it is out today.
Oh, excellent. I think that deserves a round of applause. That's a big headline you've given us. I will expect more in the course of the conversation. Actually, what I wanted to ask you was, we are up again, there's an upcoming budget.
Now, there was also, for example, Samara mentioned, the earlier that we are looking at, closing auction session.
Yes.
Very closely. And I should presume that that circular will be out also possibly today.
Ooh, another round of applause. So we are getting two headlines over here from the chairman. So I would ask you
I'm not too sure, but they're very close to issuing it.
I mean, if it's today or tomorrow, but the point is that, Samara had to speak about closing auctions, and SEBI is ready with it, shows an extremely proactive regulator, and many congratulations for that. But, like I said, an unfair question, because we have the upcoming budget. One of the complaints you get from FPIs on our channel is the withholding tax. You've been at North Block, now Kartavya Bhavan. You think there is a case to withdraw it simply because now we have to fight for FPI funds more?
I would not like to comment on, that's not my prerogative indeed, and this is not the forum also to express on this issue close to the budget.
Okay. Okay, fair enough. I take your point that it was your former responsibility, not your current responsibility. But, you know, speaking of FPIs, and just to conclude that conversation, clearly valuations are an issue. I mean, we're running at 22 times when earnings are growing at probably single digit. And therefore, that constantly FPIs are coming and telling us that. One reason which comes from the market is that this highly differential capital gains tax between equity and debt. And this big tidal wave of investors who have come from 2020 to 2025 largely have gone to equity because people are not planning asset allocation depending on their risk appetite. They're not planning asset allocation because of their age. I know retired people now going to, you know, direct index funds, equity funds, simply because the tax is less. So you think that this is now becoming counterproductive. Purely as an academic and someone who has been in Kartavya Bhavan before, do you think this at least merits a debate? This very wide difference between capital gains on equity and fixed income.
Again, I would like to avoid my thoughts on this issue close to the budget. I think you are already, different people have been talking about it, and Finance Ministry will take a view, and it's the Honorable Finance Minister who has to take a view.
Oh, yes,
the end of it.
Okay. Let me put the ball directly in SEBI's arena itself. Can you give us a third headline? You already told us last week NSE IPO announcement may, you know, come very soon, and the settlement issue is something you've taken in your stride. You've taken a call on. Can we hear when the final NOC comes? Since you're in a mood to give headlines.
No, I mean, I've already indicated, so there is no more further information.
No, the NOC comes soon, like this week.
No, I said within this month.
Okay, fair enough. I was hoping you would say within this week. That's why I asked you. Okay, sir, let me now get to the other issue of corporate bonds. The corporate bond market, you know, from time immemorial, from the time I joined journalism, I'm asking questions on when will we have a more vibrant corporate bond market. Anything up your sleeve now?
So first of all, corporate bond market is more vibrant than before. So whether that should be still more vibrant, and I agree, it will be still more vibrant.
I mean, we trade only, you know, we hold to maturity most of the bonds. Trading is less.
That's not correct.
And even issuance, mostly AA or A above, not below.
I'm afraid that's not correct. It's not that completely HTM. There is, bonds are being traded, and there is, you can check the volume. Maybe we would like volume to be higher. Maybe we would like, and I think the whole, you know, our both SEBI and RBI working closely on bond derivatives and bringing in an extra, you know, opportunity to look at it, because secondary trading in bonds is taking place, but it needs to be much, much better. There are certain constraints. So if you really look at the size of the bond market, I indicated, it used to be, you know, about 40% a few years back of the total bank credit to industry and services. It's now climbed to 60%. So the 56 lakh crore are outstanding bonds. Certainly they are, you know, lower than what it is there in China or other places. And we have a constraint that we have not too many still issuers. So number of issuers need to expand. Similarly, there has to be a number of different rated and more than, you know, A-rated and below bonds must also come in to give the proper yield curve. And those efforts are continuing.
Welcome back. Up almost 150 points on the Nifty at 25,815 as we speak. The Sensex also up about 550 points. The Bank Nifty holding strong above the 60,000 mark, now at 60,055. But let's get to some of the specific stocks we're tracking for you today. SmartWorks co-working spaces, that's the one we'll focus on. The company's third quarter margins have expanded with the overall occupancy coming in at 84% during this period. So to discuss the quarter gone by and the way forward as well for the company, let us welcome Nitish Sarda, who is the founder and MD of SmartWorks co-working spaces, joining us now. Nitish, welcome to the show and thanks very much for being here. Let's start with your profit number. I mean, there's been a sharp improvement in profit before taxes. That's a 650% jump. What does that translate into profit after taxes on a normalized calculation? Keeping in mind the index adjustments, etc., that you would have had to make.
So this SmartWorks has posted its strongest quarter till date. If you look at all the financial parameters that SmartWorks has performed at, whether it's our revenue, which has grown to 472 crores, which is a 34% year-on-year jump and an 11% double-digit sequential jump. Our normalized EBITDA, which is what we've been tracking at, has grown from almost 69 crores last quarter to 85 crores, a 22% sequential jump and an 86% jump year on year. Even if you look at our NDS PAT numbers, though we've been profitable for the past few quarters, but because of the NDS impacts, the profitability didn't show. This is the first quarter where even at the NDS level, we've turned profitable and shown a PAT of about 1.2 crores. To start off with. So this quarter has been fantastic. All of this is happening at a high growth stage. If you look at the total footprint that SmartWorks has added, in the last quarter, we've added 2.6 million square foot of space, increasing our total footprint from almost 12.5 million to 15.3 million square foot. So numbers are increasing. Overall revenues are increasing. All profitability parameters are increasing. But all of this is happening at a high growth stage.
All right, take that point. Nitish, we'll ask you to just hold on for a minute because there's breaking news which has come in. Grasim has finally appointed a CEO for Birla Opus Paints. Remember, Rakshit Hargave's exit had, Grasim shareholders a little worried. Rakshit Hargave eventually went to Britannia, but now we know that Sachin Sahai, who was earlier at ITC, served as the Executive Vice President Sales for over 30 years, was pivotal in transforming ITC's move from just tobacco into FMCG as well. He's now been appointed as the CEO of Birla Opus with effect from February 16th. There were murmurs of this happening. Obviously, the company on its part did not, respond to those, but did say that there would be an announcement coming this month itself, and that's where the announcement has come by. It is a positive development that there is continuity of leadership out there, stability, and no real problems at the moment. So Rakshit Hargave, leaving a couple of months ago, the company has announced his replacement. Sachin Sahai from ITC joins in Birla Opus. So we'll obviously, let him settle in post February 16th, get a sense of his strategy for the company. But let's go back to Nitish. Nitish, thank you for waiting by. It's breaking news, but while you have become profitable post Ind AS, as you explained, free cash flow, that continues to be negative. In the second quarter, it was lower, it was negative. In the third quarter, it's negative. The first 9 months as well, it's minus 29 crores. So what does when does one expect free cash flow to be positive?
Mangalam, if you look at our entire cash flow, it's grown from this quarter. We've done an OCF of about 101 crores, which is 1.2 times of our EBITDA. So the cash flow which the company is generating is significantly, from its regular business, has significantly increased. I think it's also the growth that we are spending on. We've grown from 9 million square foot to almost 15.3 million square foot within the last 2 years. This growth is where most of the spending is going towards. Free cash flow accounts for some of the growth elements. Despite growing by 2.5 to 3 million square foot this year, our free cash flows are still only negative of 29 crores, which proves that most of the capex going towards growth is actually generated from the earnings of the company itself. You will see this trajectory also improve like all our other parameters. Our revenue numbers are going up, EBITDA numbers are going up, and continuously you'll see that the company, once the existing centers outputs outgrow the new center requirements, you will see the free cash flow also significantly go higher. But if you look at the operating cash flow of the company, it's been very, very sturdy. It's been growing quarter on quarter, and this quarter we've declared 101 crores of operating cash flows generated by the company.
Nitish, just a clarification on the PAT number you gave us in a line. On a normalized basis, what would profit be? PAT, that is after tax, and should we view the business as sustainably profitable now?
So we've been profitable as a business for almost the last few quarters, but on an NDS impact with all the adjustments of NDS, this is the first quarter where we've been profitable on the NDS PAT numbers. But if you look at how this trajectory has grown, you will see in the last 3 quarters, we've grown from negative 16 crores loss last year to 6 crores in the first quarter, 3 crores, and now we've turned profitable. It is also commensurated with the EBITDA margins that the company is generating. You will see that the EBITDA margins keep going up. So with the base effect and the compounding phase that we are entering into in this quarter of 26, you will see these numbers keep going up on a regular basis, quarter on quarter.
All right, Nitish, thank you so much for joining in. Short but effective conversation. We'll continue our chat as we move along the quarter. Wish you good luck. With that, take a short break, come back on the other side. South Indian Bank, the management joins in to discuss their third quarter numbers. Stay with us.
Welcome back. Continuing with corporate conversation, South Indian Bank is the next management that joins us on the show. The bank's loan book was up 5% sequentially. Asset quality also improved during the quarter. We are being joined by Mr. P.R. Seshadri, the Managing Director and CEO at South Indian Bank. Mr. Seshadri, good morning. Thank you for joining in. Start off with their loan growth as well. It was back to a healthy trend on a sequential basis, is up 5%. Now, what is the kind of growth that you're expecting for the rest of the, at least for the last quarter and the full year? And B, how much of this came from gold loans, and is that trend likely to continue as well?
Thank you very much for having me on the show. Our growth was quite good last quarter, and we think that this will continue into this quarter. And we think that initially we've been indicating that we wanted growth north of 12% year on year, and we continue to stick with that. And we think that we will be north of 12% as we complete this year as well. Gold was a significant contributor to the growth. In addition to gold, we also had growth in MSME and retail. The corporate book was largely flat as far as we were concerned. There was some growth in our transaction banking side, but the nature of the growth was such that the sequential revenue growth, net interest income growth, Q3 over Q2 was 9%. So we are reasonably happy with what has happened during the quarter.
Mr. Seshadri, with the kind of credit growth expectations you have for the year, I just quickly wanted to understand, we've seen a whole bunch of private, banks, NBFCs go ahead, raise strategic capital. Some have even tapped private equity players. Any such plans for South Indian Bank?
Ma'am, we are adequately capitalized at this point in time. Our CRAR is about 17.84%. So at this juncture, we're not really looking at raising capital. We've not had any conversations on that front. We are always open to look at capital options so that we remain adequately capitalized. But there is no material conversation that is taking place at this point.
I see. Mr. Seshadri, your NIMs have shown some, they're flattish actually, 2.86 is where you're at. Just give us a sense of, going ahead, will you be able to defend these kind of levels? Because in this quarter, at least there was support from the CRR cut, despite that repo rate cut from the RBI. But will you have room for further expansion from these levels?
We expanded NIMs by 6 basis points sequentially. And we think that we should be able to defend this NIM as we go forward. We give effect to a repo rate cut on a T+1 basis. So therefore, if repo were to change today, we will give effect to it for our customers tomorrow. So during the last quarter, we've given effect to the 25 basis point change. And unless there is a very significant change in repo rates again, we think that we should be able to keep our margins relatively intact, essentially because of the fact that we do have significant repricing of the deposit base as well. There may be some downward pressure, but we think that we can manage it.
Okay, that is assuming that there are no more rate cuts from RBI. We'll have to see how that plays out. But your asset quality as well. Your credit cost is inched up a bit by 6 basis points from the previous quarter. It's still low. But, from your legacy book as well, do you continue to see slippages? When do you see that normalizing?
Our slippages for the quarter were at 16 basis points. So on an annualized basis, that is 64 basis points. And I think that those are historical lows for us. So the historical book is no longer bleeding the way it used to in the past. Majority of the losses have come from the new book now. And these are levels at which we are relatively comfortable. So the trend line on slippages have been very, very positive, and we are hoping that they will stay in that same direction as we go forward.
All right, we take that point. I just wanted to understand, Mr. Seshadri, the last time you joined us, you did say that you are expecting the MSME book to grow more than 20% in FY26. At the same time, you were looking to reduce your corporate book exposure as well. On those parameters, where do you stand right now? And what's your target, early target if you can, for the next financial year?
So MSME growth for the year so far has been approximately 14% if you include the loan against properties business. We think that we will end stronger than that because Q4 is traditionally the part of the year when businesses borrow the most. Therefore, we think that we do have a shot of getting to 20% on a year-on-year basis. With respect to the restructuring of the balance sheet, corporate has remained flat. If you include corporate and the transaction banking book, it has remained flat at 40%. But there's been very significant growth on the retail and MSME together. So that part of what we are trying to do continues, and we are relatively happy with the progress that we've made so far.
Okay, but, on the MSME book specifically, sir, how much of it is really exposed to, players that have a significant exposure to the US market? And I'm asking that in light of this uncertainty that looms about the tariff deal with the US. So how much of your book is exposed, and to what extent are you making provisions in case the deal is delayed further and any stress emerges?
As of this moment, we're not seeing any stress there. And we do have reasonable exposure to folks who have export to the US because we are based out of Kerala, and Tirupur is just across the border from where we are located, which is a very large market for exports into the United States. Right now, we are not seeing any stress. We are hopeful that deal emerges. We are not even seeing increased utilization levels on our limits thus far. But however, we are trying to ensure that the blow is softened by ensuring that the new advances or the new schemes that the government of India has rolled out in terms of increased capital availability for our customers is implemented, so that in the event there is some stress, they have the means to actually ensure that they continue to survive and thrive as they go forward.
All right, Mr. Seshadri, we leave it at that. Thanks very much for joining us here today, and we look forward to speaking to you again after your fourth quarter numbers. On that note, we're going to have to slip into a short break, but don't go anywhere. We're back with the markets in just a bit.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
India Bonds presents Bond Street.
Hello and welcome to Bond Street. Joining us on the show today is Nishant Kumar. He's Managing Director, Head of Asia Investments, Gann & Co. and Head of Coverage, Asia PIDG as well. Nishant, thank you so much for joining in.
Thank you.
First of all, you operate out of various countries really, and you've been around for a very long time.
Yeah.
What is it and how has the journey been till time?
No, it's been really fantastic. Look, when we were set up back in 2005 and we are funded by 7 of the G12 governments, and the mandate, one of the key mandate given to us was to crowd in private sector investors on capital market to help develop local capital markets in countries which are lower income, lower middle income and fragile and conflict affected states out of Africa, Southeast Asia and the Pacific. So yeah, I mean, I can proudly say that to date we have underwritten more than $1.8 billion of guarantees, which has mobilized roughly $6 to $7 billion of private sector capital into some of the most exciting but also challenging geographies across Africa and Asia. So yeah, all
interesting, exciting journey, would you say?
Indeed, indeed.
Nishant, you also make infrastructure projects safer or more attractive for private investors. How do you do that?
So we have a product which, as I alluded to, called credit guarantee, and that's contractual, on-demand, unconditional, irrevocable guarantee. So the key difference between this and credit insurance is if there is a default by the borrower, no questions asked, we make the investor whole or the lender whole, and then we step into the shoes of the lender. Unlike a credit insurance, which is a conditional product. So you first need to establish loss and wait for several months, and then you get your money back. That's not the case. So we de-risk the investors, the banks, the financial institutions. And that is how we enable those institutions to provide financing on a sustainable long-term basis to sustainable infrastructure transactions.
Yeah. Infrastructure usually is huge projects led by bank and public institutions therein. Where do you get in? How would you make it attractive, easy to invest for retail?
Look, excellent question. And, we take pride in crowding in private sector, not crowding out. So if there is no need for an institution like Gann & Co., we simply do not participate in the transaction. We don't need to do every transaction. Where we see there is a strong additionality angle, which is where our participation would de-risk the project and lower the funding cost or debt financing cost for the borrower. There we would actually get into those transactions and also help bring in those institutional investors who would otherwise not participate in those transactions. So now that works very well with institutional investors. So that should also work very well with retail investors, because at the end of the day, retail investors should also be able to participate in these kind of instruments, which are high credit, but also high impact and provides reasonable rate of return.
You based out of Singapore, you just told me, and you listed out a list of countries which you oversee. So when you look at India, what is the longer term vision for here? And how are you looking at India vis-a-vis various other Asian countries that you're overseeing?
Oh, I'm excited. I mean, not because I come from India, but purely speaking from business sense and where I'm sat there in Singapore, every third finance professional I talk to or interact with in the country or the city state, I tell you, people are talking about India in some capacity or the other, right? There's huge excitement. And the excitement is towards adding new financing, additional financing to help country achieve its net zero ambition, which the Honorable Prime Minister has committed to. So, we, in fact, in November last year, we conducted a debt capital market event in collaboration with the National Stock Exchange, where we committed to deploying at least $300 million of guarantees, which would enable at least $500 to $600 million of debt financing over the next 2 to 2.5 years. So for an institution which has underwritten 1.8 billion guarantees to commit, this is a significant commitment for us in the country. Now, where do I see country vis-a-vis some of the other markets? I don't see it to be vastly different, but at the same time, there are certain gaps, there are certain inefficiencies in the market.
Okay.
So, which is especially on institutional investors, the insurance companies, the pension funds, or debt funds or infrastructure debt funds, providing sustainable longer-term financing to infrastructure asset owners, right? Infrastructure need to be boring. Need to be boring, 15, 20-year financing. That's how, it doesn't need, AI is exciting, not infrastructure. And that's what we help de-risk those projects, and we help make it boring. Let's say that.
All right. So when we talk about infrastructure, and there is various areas within that, you have power, transport, water, climate-related infrastructure, etc. So when it comes to India specifically, what sectors are you more looking at with interest?
So climate, helping develop local debt capital markets, and third is financial inclusion / gender empowerment, which is a strong area of focus for us over next few years in India.
Also, over the years, you've moved on from just about supporting individual products to backing group of projects.
Yes.
Why has that happened? What is your strength therein?
So this is just a natural progression, right? Because, transaction risk is one risk, but then you help not only diversify the risk, but also cross-collateralize the risk. When you do a group of transactions and you club them under one umbrella to help them raise financing. So it is a natural progression for us to achieve that.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome back. The market's mildly off the highs. Nothing worrisome, but definitely noteworthy. So the Nifty is now below the 25,800 mark. The high today was 25,873 thereabouts. Has been led lower by a couple of these consumption names. So pull up, something like an ITC, which is at the low point of trade. Asian Paints is lower as well. And alongside that, we are seeing Maruti Suzuki sell off as well. Partly it could be because the market taking, some sort of supply or facing some resistance at the higher end, which is also visible with the call writing that we've seen at the 25,800 and the 25,850 mark. So those two calls comes up for you. 25,800, about 1.5 crore shares on that one. 25,850, almost 1 crore shares, nearly 2/3 of that added today itself. But Ritu, you're looking at the rupee as well.
Yes, Mangalam, let's not lose sight of the macros as well. The Brent has gone up above 64 to the barrel. Keep an eye on that. But the rupee, yes, it's opened at about 90.3 to the dollar, and it is, depreciated more to 90.6 to the dollar, and that is because of the strength that's coming on the back of the greenback. The hawkish comments coming in from the Fed, strength in the dollar, that's putting some pressure on the rupee. And typically, you'd see RBI stepping in at 90.30 kind of levels, which has not been the case today. So keep an eye on that one for sure. But we have to wrap this edition of Trading Hour. Thank you so much for tuning in. From Hormaz, Mangalam and me, it's a goodbye. The team coming up next will take all the action forward.
Stocks swing up after what was a weak set or tensions in the Middle East that showed signs of easing, and a positive set of earnings lift sentiment. IT and realty are big gainers, while healthcare and capital goods drag.
Infosys reports strong deal wins in Q3 and ups its guidance for the year, raising expectations of IT services growth. IT stocks rally as analysts revise up their Infosys estimates.
Cipla skids after it says it expects to resume supply of top drug Lanreotide only in the first half of fiscal FY27. After its vendor faced a US FDA action, analysts temper expectations as a delayed drug launch also weighs.
Stocks of Angel One, 361 WAM and ICICI Prudential AMC, they climb after they post healthy quarterly numbers, powering other capital market players like recently listed online broker Grow.
Hello, good afternoon. You've tuned into Halftime Report on CNBC TV 18. We're coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me are my colleagues Sonal Bhutra as well as Ekta Batra. Good afternoon, ladies, and a day of a green that we're seeing coming in on the screen.
Oh, yes, but we have come off from the high, so that is something that we need to track very closely. It's a 100-point downtick from the highs of the day. IT continues to do well, but again, there are pockets of the markets which are seeing some pressure, but we do have a lot lined up on the show today, Ekta.
Well, yes, absolutely. But before that, just want to point out that, the other big sector which is in focus in today's trading session is the entire banking space. So on a week-to-date basis, the Nifty Bank is up around 1.4%. The PSU banking index is up around 5% on a week-to-date basis. And that was really fueled by the Union Bank sentiment. With the numbers came out day before yesterday. And what we did see is that now Investec has raised its target price to 210 odd rupees. There is some amount of momentum which is building up in terms of the net interest margins. So I'd watch out for Federal Bank, Central Bank. Both the numbers are today. We also have a whole host of numbers coming out on Saturday, which is tomorrow, from HDFC Bank, ICICI Bank, RBL, UCO, Yes Bank. So I think that would be a very important space to watch in today's trading session as well as on Monday. But let's apprise you of what we have on the show today. We'll put the spotlight on the third quarter results of MV Photovoltaic Power with the management. We'll also speak to Network 18's MD Rahul Joshi on the back of their third quarter earnings. In our special What's Trending segment, we will focus on Cipla, which is under pressure after its Greek supplier, lanreotide drug, has received US FDA observations. We will also discuss the impact of Cipla with our guest today, Vishal Manchanda of Systematics Group.
All right, before we talk about some of these individual names, let's go across to Vivek. He's here to take us through the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. A session where we're actually seeing quite a lot of green on the screen. Cooled off a little bit, but despite that, advanced decline ratio quite healthy. Individual stocks that we are tracking today, well, Infosys, that's the name, taking the entire Nifty IT pack along with it. Q3 strong beat, FY26 guidance hiked, and on the back of that high, over 5.5% for Infi. SW Solar, one name from the RE space, this particular company, a steady set of numbers, Q3, quarter on quarter, good improvement. And along with that, strong guidance coming in as far as the order inflow is concerned for FY26. Over 11,000 crore worth of orders is what they're expecting, over 9.5% higher. ICICI Prudential AMC, a good steady quarter 3, and along with that, the important news is that the MD CEO S. Naren's tenure has been extended, a key overhang on the stock which has been lifted. Zen Technologies, one of the stocks from the broad end of the market, the defense space, order win, stock high by over 7%, good volumes today. And like you mentioned at the start, 361 as well as Angel One, both capital market plays, very good numbers as far as Q3 is concerned. Both of the names doing very well in the session. On the other hand, quite a few laggards as well. LTT, as guidance cut coming in from almost double digit to a mid-single digit. On the back of that, stock low by over 4% today. HPL Engineering, the company has given an update to the exchanges saying that they have lost a few key orders on the back of significant competition in recent tenders. That stock has recovered, but still down over 6.5%. And Cipla, like you mentioned, a couple of key developments regarding important drugs in their portfolio. That stock lower by over 2%. It's been a stark underperformer, especially in the last 2 trading weeks.
Okay, Vivek, thank you so much for giving us those details in terms of the stocks that are moving around in the trading session today. But let's refocus and talk about solar PV module as well as solar cell manufacturer MV Photovoltaic Power. And this is the first management on the show that we have for you all today. The company reported a strong set of numbers in Q3, a strong print that came in. And we have the management joining us. Now we have Suhas Donti, who is the CEO of the company, to discuss one, what are we going to be focusing on? It's going to be the capacity addition and the targets that they have on that front. The second point that we want to discuss is going to be on diversification plans and time to moderate margin expectation. Is that something that we're keeping an eye out on? Is something that we will talk with Suhas. Suhas, good afternoon. Thank you so much for joining in on the show. Let's just start by talking about the numbers. In terms of revenue growth, previously we've spoken about growing at similar rates in Q2. What is it that we are expecting overall for this year and FY26? What would be your growth rate guidance? What would you think that will drive the growth going forward as well? Suhas, I think you're on mute.
Very good afternoon, and thank you so much for having me on the show.
And absolutely, I think this year's performance, this quarter's performance is over 100% growth that we have shown year on year. And I think that is the consistency that we have maintained in the last 9 months. And you can see our order inflow has increased from order book has increased from 6 gigawatt to 9.3 gigawatt and executing about 6.3 gigawatt in the next 12 to 18 months. So that strong order book means about 10,000 crores of revenue of 6.3 gigawatt is usually about 10,000 crores of revenue in the next 18 months. So that is the run rate that we are looking at. And so that is quite strong and healthier than what we have been achieving. So that is the kind
Suhas, does that mean the run rate means you're growing, doubling your revenue YOY? Would that be something that you will continue even going forward, you're saying?
Absolutely. I mean, like what YOY that you see in the first 3 quarters is something also that you should expect in the next quarter as well.
Has, you spoke about how capacity has expanded. Your order book has seen a massive growth from 6 gigawatt to 9.3 gigawatt, right? It is also coming in because of your TopCon cell order wins. Your supply will increase from December 2025. It's a period for 5 years. So, two-part question here. One, for over how many years or months will the revenue recognition come in from these orders? Number two, for the facility, will you be taking some debt because you're debt-free post the IPO? And number three, when you talk about these revenue targets that you have, we're already seeing so much realization downtick in the industry. So do you stick to that guidance? Because will you see realizations go down going forward?
So a couple of things here. I'll just answer one by one. So one on the order book, we are seeing the 4.5 gigawatt of order book that we are seeing for TopCon, which is like, a multi-year order and a strategically taken order. And that is something that's to be executed from December, which has already started execution and going up to 2030. And this particular order is also, it's also important to consider that the execution of last quarter sales is also something that we have further added on, right? So whatever we have executed. So the inflows have been consistently strong, irrespective of, these multi-bagger orders that we have taken. And talking about the expansion plans that we have is a 6 gigawatt of integrated cell and module facility that is coming up. The debt for that is 3,300 crores of debt. But we are looking at about still maintaining our debt to equity or debt to EBITDA ratio of less than one time. So that is that is what we are looking to go as we execute this project, which is going to commission by March 2027. And that's how we're looking at it.
Okay. So Suhas, just wanted to understand what are the realizations that you might be working with? And the reason I ask is that there is, fear of heightened competition which is coming through. So just give us a sense in terms of what the competitive scenario looks like and what are the realizations that you can guide us on.
The realizations in this industry is something that you typically don't look at. What is something that you typically should look at is the EBITDA that is being achieved, the absolute EBITDA specifically. Because the industry as such, like since 2006, like when we started doing manufacturing of this solar PV modules, we were looking about like, $4.5 per watt of cell of the cost of modules. So today we are looking at about 15 to 16 cents of per watt of modules. And in this year, it's about 24 to 25 cents per watt. And that doesn't mean the EBITDA or the margins have fallen in this industry. The margins have been quite stronger, probably stronger. The technology is reducing the realization of these modules, where that is making the solar the cheapest form for electricity, which is making the demand go higher. And that is why the realization is not really a right metrics. But considering the current scenario, I think when the ALMM list 2 is going to be in place from June, the average realizations, what you see as module and cell manufacturers are getting, will be increasing rather than what you will see the decrease.
Okay. You also have 5,500 crores of capex lined up?
That's right. That is for the integrated 6 gigawatt of cell and module capacity, out of which 40% is through equity, and 16% is the debt that I spoke about.
Suhas, you spoke about 3,200 crore of debt, right? So on a 1,400 capex, what is the 3,200 crore of debt taken for?
For the same 5,500 crores of capex, 3,300 crores of the debt and 2,200 crores of the equity portion, which we already started by, where we have already got possession of land and design and planning activities have started. Construction is going to start very soon. So this is the status of that project, and it is to be commissioned by March 2027, taking our capacities of cell to 8.9 gigawatt of TOPCon cells and module capacity to 16.3 gigawatt.
Okay. And Suhas, you said that run rate continue. You had around 2,300 crores revenue in March 2025, end of March 2025. This year seems like you'll close at around more than 4,500 crores. So then next year, what is the run rate that we're expecting in terms of revenue? Any number that you could give them?
I think this year will be slightly more than that. We'll be closing more than that. And next year is something that you can imagine with the order book that we have. It's the order book size is about 10,000 crores that is to be executed in the next 12 to 18 months. So that should give you a fair idea of what is the run rate that we're looking at.
Take that point. Suhas, thank you so much for joining in today. That's the word coming in from MV Photovoltaic. But with that, we'll slip into a short break. But as we do that, the countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact and policy decisions from the Finance Minister. We bring you a power-packed lineup throughout January and on the day of the budget. Helios Capital's Samir Arora for all things market, followed by JP Morgan Sajid Chinoy to discuss the macro signals. We also get you insightful analysis from industry veterans and Dinesh Kanabar and Ashok Wadhwa for the tax rhetoric.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC TV 18. Now moving on to our special segment, What's Trending Today? We put the spotlight on Cipla, which is under pressure on the back of its cancer drug facing rising competition among other factors. Ekta is here to break it down for us and what it means for Cipla as well. Ekta.
Well, yes, the incoming MD and global CEO Achin Gupta might in fact have his task cut out for Cipla's US business. The US, which contributes around 27% of sales and delivered around $934 million in FY25, which were record sales, is now showing signs of pressure in FY26. The business, which generated $459 million in the first half of this year, has faced two setbacks within a fortnight at a time when the blockbuster cancer drug and key earnings driver Revlimid generic faces that expected rising competition to come through. Now, the big concern is Lanreotide, one of Cipla's top 3 US products, where manufacturing has been temporarily paused as partner Pharmathin's plant was slapped with 9 observations from the US FDA. Cipla expects resupply only by the first half of FY27, a risk given its 22% market share in the US. The second hit is rising competition in generic Advair. Lannett, which is Aurobindo's acquisition target, has become the 4th US FDA-approved player, shrinking the opportunity for Cipla, which is awaiting approval for nearly 6 years now. Street estimates now factor in 30 to 50% lower earnings from Advair than earlier projected. As a result, FY26, FY28 EPS estimates have been sliced by 1 to 4%, with the US sales seen as flattish to low single-digit decline amid pricing pressure and unresolved US FDA issues such as the Pithampur warning letter. While upcoming respiratory launches higher Brixon share, which is a cancer drug, and peptide drugs like teduglutide may in fact cushion the impact, expectations are being reset. The stock is trading at around 23 times FY26 and 21 times FY27, is down 5% in a month and flat over a year, reflecting that near-term caution. In fact, to talk more about this, we have Vishal Manchanda joining in. He's a pharma analyst at Systematics Group. Vishal, thank you very much for taking the time out. Well, definitely, it's rough weather that Cipla is facing with its US business. Just give us a sense in terms of, what you would be recommending to your clients, considering that they might see, delayed sales for Lanreotide now.
So I think the correction very much factors in all the bad news that we have been witnessing on the stock lately. And if you look at the US business, it's typically like that. We always kind of see things coming everything coming in favor for companies and then everything moving adverse. So I think Cipla is in those kind of, is facing bad times, and probably the stock price is more or less kind of discounting almost everything in terms of bad news. So I would probably look to add the stock at this price. It's an opportunity. So I think most of the things like Lanreotide, supply disruption, Advair competition getting more intense, and the third one is basically delayed approval, Advair approval not coming through for Cipla. So it was expected in second half, and we are almost 9 months now. So I think sooner or later, most of these things should be in place and earnings should rebound from where it is today. Even from a valuation perspective, if you look at the stock, it's trading at a steep discount to its historical median trailing 12-month P multiple. So I think it's almost the 10-year median P multiple is almost 30, and they are at 21 times FY27. So I see an opportunity here.
Okay. You see an opportunity there, but I just wanted to narrow down in terms of numbers. Say, for example, they did $934 million in terms of the US business in the previous fiscal. Just give us a sense in terms of what you're anticipating in terms of total sales for FY26. For their US business, to give us a sense in terms of, what the numbers could look like.
I think the US sales will be a broad range, but for now, I'm expecting almost, in my current estimates, I'm assuming flattish numbers on a YOY basis. So Revlimid coming off and that getting replaced with Advair, sort of some Abraxane ramp up and teduglutide launch. So this is broadly my maths, but if you like in the last quarter earnings, Cipla had guided to be around a run rate of $1 billion by 4Q FY27. So if all the approvals that they are expecting pan out, then probably we are in for a surprise on the upside.
Okay. Vishal, you said there are certain triggers as well going ahead for Cipla. Ekta also mentioned some of the launches which could cushion the support or cushion the impact of this particular drug, the cancer drug that is. Right. What are the earnings that you're expecting from launches that would come by later? Is that a big trigger going forward?
So if I not going into each drug specifically, but if I look at a range of earnings that Cipla can deliver in FY27, so probably a worst case EPS number where I am at is 58 rupees EPS in FY27 and a best case EPS of about say 75-76 rupees per share. So if I look at numbers on the worst case EPS, they are at 25 times now. And if I look at them on the best case EPS, they are at almost 18 times on FY27.
Okay, Vishal, thank you so much for joining in this afternoon, explaining us, what all this means for Cipla as well as overall. We'll watch out for the pharma pack. Thank you so much for that. But on that note, let's also bring in Saumil Mehta, Head of Alternate Research, Capital Market Strategy at Mirayash at Sher Khan. Saumil, good afternoon. A quick word on Cipla first, right? What are your thoughts coming in here? Overall, in terms of the move that we've seen for the stock, in the last 6 months, it's not done anything. Now, this news flow also comes in. We're seeing a fall in the stock price today. What should we keep an eye out on in terms of levels? Is it good to enter?
Good afternoon to everyone. It's in the downtrend, lower top, lower bottom formation, monthly, weekly, quarterly charts. All the crucial levels have broken on the downside. So it's a falling knife at this point of time. I don't see, I want to avoid the stock at this point of time because I can see that the next level on the downside is 1335 and probably 1300. So these are the two levels which I'm looking for. And I think those levels should be achieved in the very short term. However, in the medium term and in the long-term outlook, I think 1300 levels would be a good level to buy this stock because the long-term are still, still positive. And I'll be expecting very good levels on the upside. But in the very short term, I'll definitely avoid.
Okay. All right. Anything else within the pharmaceutical space that you like at this point, Saumil?
Lupin, definitely a great stock to be in. I think it has broken out of a huge range since 2024, and this range is broken on the upside now. I'll be expecting a target of at least 2700 on Lupin in the medium to long-term outlook, and crucial supports would be around 2060 and 2000, which is very close to 200 daily exponential moving average. So yes, Lupin would be my preferred pick.
Saumil, will come to you in just a bit because Federal Bank's numbers are flashing for you at the bottom of your screen and the stock is up 5%. And as Ekta was pointing out earlier, we'll be watching out for banking results because remember, Union Bank responded very strongly to the numbers. Net profit is largely in line with expectations at 1,041 crore rupees versus a poll of 1,000 crore rupees. The NII is slightly higher, around 100 crore higher than what the poll was suggesting at 2,653 crore rupees. This compares with a poll of around 2,563 crore rupees. The stock in anticipation or generally the reaction that the entire sector is seeing was already higher before the results. So far it has been largely in line with estimates. We'll of course get in the numbers, more internals in terms of gross NPA, net NPA. For now, the net profit is up around 9% on a YOY basis. And of course, we'll get Gaurav in just a bit to decode these numbers deeper for us. For now, it's up 5% and we'll get you the analysis as well.
Yes, absolutely. So as of now, we just have the net NPA, in fact, which is flashing on your screen. So it's maintained at around 0.42% as compared to 0.48%. So no surprises which have come in terms of the gross NPA. We'll try and get you, the net NPA. We'll try and get you the gross NPA. Yes, that's also improved. In fact, it's coming at around 1.72% versus 1.8%. So overall, the numbers are looking good currently for Federal Bank. The devil really lies in terms of the details and what the management will share with us when it comes to net interest margins, what they are seeing in terms of trend, loan growth, as well as the internals in terms of the asset quality. As of now, we have the net profit, which is up around 9% on a year-on-year basis. NII also higher by around 9%. So largely in line with what the street was anticipating, with a gross NPA and net NPA ratio, which has improved prima facie. Do one thing, take a short break. We'll bring you a conversation with Network 18's MD Rahul Joshi on their Q3 results on the other side. Stay tuned.
Welcome back. We are bang in the midst of the earnings season, and one sector which is seeing so much activity in India and globally, of course, is the media space. Let's look at the third quarter performance of India's largest news network, Network 18. Now, there was a 10% decline in industry-wide television news advertising demand. In the face of it, Network 18 has managed to post about a 5% year-on-year revenue growth. in its news business. Let's discuss this and more, the outlook more importantly, with Rahul Joshi, Managing Director of Network 18. Rahul, welcome to the program. Thanks very much for joining us.
Thank you, Prashant. Thank you for having me.
Rahul, relatively speaking, compared to the 10% decline industry-wide, Network 18 has done better, about a 5% growth. I had two questions. There were all these GST cuts, etc., which were supposed to flow in and broadly help consumption and, of course, advertising, which is a derivative of that. Has that happened, not happened? And there is a fair bit of macro uncertainty as we head into 2026. Will the relative outperformance stay if the industry conditions stay tough? Go on.
No, I think, Prashant, good question. I think what the government has been doing over the last 1 year, has really helped media companies. But, the advertising environment continues to be tough. And don't forget that, today we are not only competing with media companies for advertising dollars, we are also competing with a whole host of other players in this space. There are e-commerce companies, there are quick commerce companies. So all of them vying for advertising dollars. Combined with that, the news business, it has had its own headwinds in the last couple of years. So the whole, the attempt at Network 18 has been to, look at ourselves as a content company, not merely as a news company. Of course, news remains a very integral part of our business, but we are looking at beyond content for growth, and that is what has really helped us this quarter, which was another tough quarter, to grow at about 5-6%. Now, if you look at our entire portfolio, we have a solid portfolio. We are leaders in all our businesses: CNBC, Aavas, CNN News 18, digital businesses, whether it is News 18, Moneycontrol, First Post, or even Forbes. But ultimately, pricing power is one way to grow, and the other is to constantly look at alternate avenues of growth, alternate revenue streams. And that is what we've been able to do quite successfully, and we hope to accelerate these efforts in the coming quarters.
Fair enough. Rahul, I mean, and we've spoken about this in the past as well, traditional media companies and them facing kind of sort of movement away of dollars towards some of these new segments, new platforms in that sense, new mediums, as you've put it. So, I mean, to take Network 18's example, 16 billion views, I think, on YouTube, 2.5 odd times the nearest rival. But again, YouTube margins perhaps are a little lower than what you'd describe as linear TV, right? I mean, is there a way to assert this lead in viewership and close the gap in terms of monetization?
No, that's a good question, Prashant. The thing is that we do have the viewership, we do have the views, we do have the reach. But, we are also, some change in algorithms of these media companies, YouTube, etc., can adversely impact our revenues. So we've seen this in the past, in the last quarter, and this has happened in the past as well. So the whole idea is that we do not remain, we are a resilient company. We do not remain dependent on only a couple of, revenue sources, but open up new sources of revenue. So like, for instance, in Moneycontrol, we've gone into subscription in a big way. Moneycontrol Pro was a big success with 1 million paid subscribers. We've launched Super Pro, which is doing exceptionally well for us. And while Pro was priced at 1,000 rupees per annum, Super Pro is priced at 3,000 rupees, right? It's 3 times more, the ARPU. So that has shown good results. I think the way forward would be subscription. Our lending business in the last quarter has done well for Moneycontrol. That's another alternate source of revenue. So, the impact of all this has been seen in this quarter, which has resulted in growth when other companies are really struggling or degrowing. So, going forward, you will see more of this. You will see we will reduce our dependence on news further and look at other content ideas that will generate revenues and other formats that will open up new verticals and new sources of revenue, like Creator 18. If you take Creator 18, the idea is very simple. We are in the business of content creators, and there are many creators today who are doing the same thing that we do. And we have tied up exclusively with 60 creators, and we are working with another few hundred more to bring them into our fold. The idea is that these content creators use our platforms to do relevant stuff, and we use their audiences, younger audience, Gen Z audience, and together grow this pie, and we are able to partake of the share in revenue as well.
Rahul, you know, from an investor point of view, right? I mean, globally, it's true that the news piece of a media business, perhaps multiples have been on the lower side, right? But how would you like investors to view Network 18 with so much which is happening, right? I mean, just how do you think about this platform? If you can give us your thought process, yes.
Sure, Prashant. I think that's the point that I was making. We also do news. You know, we are trying to pivot the company into other content areas which are not necessarily news. And also, please don't forget, the way you and I have understood news over the years is fundamentally changing. You know, news is seen from a different lens by Gen Z, by a new set of audiences that are coming in. You know, they think of explainers also as news. We would think of only breaking news. They would think of explainers. There is this large infotainment segment that is coming up, which is not only attracting advertising, it is also attracting a lot of subscription. So a lot of companies attracting a fair amount of you know, monies in subscription, and that is all competing with us as well. So we have to get into that space as well. So as we diversify our portfolio of content away from news into other areas of infotainment, and also, you know, into other areas like creating tools for investors to be able to trade better, you know, invest more smartly. These are things that were never historically a part of a news organization. So we build these tools. We've got a proprietary research team that has helped us to open this whole subscription window. Lending is a big is becoming a big vertical for Moneycontrol, and that's precisely because we are moving a content company into areas it had never earlier, it never earlier tread into. So these are the things that we are going to continue doing over the next few quarters, and hope that we'll be able to monetize our brands better.
So many industries are undergoing changes, and I guess, I mean, you mentioned the lending business, right? The face of industries and how many industries are being changed, and perhaps Network 18 keeping track. I mean, on the lending side, is the aim finally to become like a full stack financial services provider? Would that be the broader vision, Rahul?
So I wouldn't go as far as that. I would say that, we have in Moneycontrol 50, 60 million, unique visitors coming to us every month. They come to primarily consume content on our platform. I think there is a huge opportunity for us to convert this audience coming in and, serve them many other different things. While I'm talking to you, you are flashing the Network 18, stock score on your screen. I think this is one thing that we have developed over the last few months. Every stock has a score today. It gives you an idea of the potential of that company going forward. Now, there are many tools like this that we have developed, and these are all sooner or later they are all behind a paywall. So we are able to drive revenues using many tools that we've created for traders, for investors to be able to trade better. So I wouldn't say a full stack financial services company. That's not where we are headed, but definitely, a one-stop shop need for everyone for whatever money need that you may have, whether it is, investment of any kind, your spending needs. So we look at Money 360 degree and provide tools for you to be able to save better, spend more wisely, and in the long run, be a smart investor.
Rahul, just one last question, if I may. You've renewed your partnership with CNN with a mandate for sort of digital expansion. If you can give us a sense of what's the thinking, do you plan to compete more aggressively with the BBCs, the Al Jazeeras of the world, and diaspora markets? I mean, what's the thinking?
Yes, I think, Prashant, this company, when it was started, started with some global brands like CNBC, later on added other brands like CNN and Forbes. These are partnerships which were meaningful 25 years ago, but are more meaningful than ever today. Today, the world is an integrated world. Our stock markets are intricately linked to what is happening globally. Tariff issue, whichever big issue today you see in the country has a global linkage. And unless you have a credible global partner, you will never be cutting edge in what you do. CNBC, we have completed more than 25 years of this amazing partnership. CNN, we just completed 20 years. We've renewed this partnership for another 10. I mean, I don't have to tell you that how important global news is today. I mean, geopolitics is dominating the airwaves across the country, and the CNN advantage, the CNN edge, really helps us with that. Forbes, again, is another brand we partner with, and I think we've had a very successful partnership over the last 15 years. So these are our relationships, and this time CNN we've been able to even extend it to digital in a meaningful way. So a whole lot of global content will also be available to on our platforms, news18.com, etc., which will really give credibility to our platform, new content, cutting-edge global development. So yes, absolutely right.
Well, Rahul, so it's all global in that sense. Thank you very much for joining us and running us through, your thinking as we start calendar 2026.
Thank you so much, Prashant. Thank you for having me on the show.
Well, thanks very much. We're going to take a quick commercial break here. Markets off about 100 odd points from the day's high. But the good news is that we are still up 100 on the day. So 25,765 on the Nifty. Take a break. More coming up on the other side.
Welcome back. You're still tuned into Halftime Report. Federal Bank is the stock on our radar. Big surge. Gaurav is joining us to tell us how did the numbers look. 9% higher on the stock now, Gaurav.
Well, as if you look at Federal Bank, it is very fair to say that how the market is taking surprises, even on the upper side or even on the lower side as well. In terms of Federal Bank, they have taken it in a positive way, and the reason being that numbers have been very strong. Let's talk about the numbers. Net interest income that increased almost by 9% on a year-on-year basis, 3% ahead of our estimates. Apart from that, PPOP, which is pre-provisional operating growth, that also came in strong at around 10%. It was also ahead of the estimate, and this was supported by other income. let me remind you that in other income as well, if you look at the fee income where Federal Bank was focusing, they have grown around 18% on a year-on-year basis in fee income itself in this quarter. Apart from that, provisions, they actually declined, and as a result, if you look at profit, that increased almost by 9% on a year-on-year basis. Again, 4% ahead of the street's expectation. When it comes to loan book growth, a fair number is what we are seeing, around 8.6% growth. And even within that, if you look at the portfolio, specifically they were focusing on the medium yielding segment, that they have grown successfully. From the proportion of medium yielding segment has been grown almost by 100 basis points. Apart from that, deposit growth has been strong for Federal Bank. It came in at around almost 12% on a year-on-year basis. As a result, if you look at the stock performance, it is up almost more than 8%. And let's also not forget about the asset quality, because here also we saw some surprise, because gross NPAs, now they decline almost by 11 basis points and net NPAs decline almost by 6 basis points sequentially. So yet again, a good performance in terms of asset quality, growth and net interest margins, because net interest margins increased almost by 12 basis points on a sequential basis. They came in at around 3.18%, which was again another surprise. So all in all, positive surprise across the board, and as a result, stock is up more than 8%.
Gaurav, thanks very much for that. In fact, spiking because we have the slippages which have come through at 435 crores, and that is lower on a sequential as well as on a year-on-year basis. Net interest margins like Union Bank has improved, but like you can see, the slippages, the asset quality is showing a considerable improvement for Federal Bank. That's the reason why you've seen the stock spike up around 9% odd. Good earnings coming through for Union as well as Federal, so maybe the other banks will be important to watch out for, such as Central Bank, which releases its numbers today as well. We'll take a short break, but here's a quick sneak peek into the stocks that we will be addressing on Your Stocks today. Don't forget to catch fundamental and technical experts give their view on these stocks at 2 p.m. only on CNBC TV 18.
Welcome back, and joining us now is Sumit Gupta. He's co-founder at CoinDCX. Sumit, hi, thank you so much for joining in. And we come back after a very, very volatile 2025 with markets anticipating that Clarity Act is round the corner. The Indian budget perhaps can give some support, and the crypto prices in the meanwhile have seen some support come back as well, as various other asset classes perhaps do not seem to be doing well. It's macro markets after all. What is your sense on how would you look back at 2025 and what's your sense in 2026?
Yeah, Manisha, as you know, 2025 was a very volatile year for the sector. And of course, even for CoinDCX, we've learned a lot. We've had some setbacks, but here we are standing very strong. Better than before. We have built a lot of exciting products, which we are going to ship in the Q1. So overall, I'm very excited. And with all of this global movement happening around regulations, the Clarity Act about to get passed in the next couple of months, I think we are going to have a very exciting 2026 as well.
All right. How are you also looking at budget this time around? Because the expectations are we perhaps could be hearing more than just tax rationalization, aligning that we heard in the previous budget. Are you expecting something way more? Are you excited about this budget?
Yeah, I mean, always looking forward to see what the budget holds for the sector. We are hoping that at least some relaxation will come. On the taxation side, there would be some relaxation on the parity between domestic and offshore players. There are a lot of asks that the industry has. So hoping to see more clarity around the sector as well, which has been ignored from last 3-4 years, after the taxation was introduced in year 2022.
Sumit, what's your sense also on the kind of movements that we've seen coming from US? I mean, the first half was very encouraging. We saw the Genius Act go through. Are you anticipating further push from US continuing? As in US, do you think will continue to lead ahead?
Yeah, absolutely. I don't see any slowdown happening on that front. There's active consultation happening with the industry as well. And a lot of the other founders building crypto companies in the US, they continue to tell me that they expect a lot of momentum in 2026, driven by the regulatory clarity, driven by the Trump administration releasing Clarity Act, and a lot of other developments from institutions building new set of financial products. Tokenization is a big theme there. Stablecoin, of course, all of us have seen how it panned out in the last year, and we see more and more adoption happening, in stable coins and crypto in general in 2026, not just in US, but many other countries also.
Sumit, I'm going to push you on what new products can we expect for first quarter, because we do understand, as you said, real world asset tokenization and then stable coin seems to be like the narrative that we heard in last year.
Yeah, I mean, globally, what we are seeing is that real world assets are getting tokenized. The markets are turning 24/7. The financial markets are coming on chain, because this is like disruption of the traditional financial products, and with blockchain, they just make it a lot more transparent, more efficient, way more cheaper, 24/7 running. So a lot of the products that we have seen which were inefficient are now coming up with better structure, and tokenization is playing a big role there. Even on CoinDCX, we are experimenting with a lot of ideas around those lines, and we'll keep our customers posted whenever it gets announced.
All right, we look forward to that. Sumit, thank you as always for joining in. So new products from CoinDCX in the first quarter to keep an eye on. And then, of course, it is about budget, where relaxation in TDS and partly offset between offshore and onshore customers is something that we perhaps, or at least that is on the wish list right now. But thank you so much for your time. And with that, we're going for a short break. When we come back, we'll get you more on markets and stocks.
Welcome back to Halftime Report on CNBC TV 80. The markets have fallen off almost 50-60 points from when we started the show at around 12. So yes, a bit of a fall furthermore in the last 1 hour. We'll keep an eye out on that. But as of now, 25,763 is where the Nifty continues to trade at. Nifty Bank almost trading at 60,027. Keep an eye out on that. But with that, we are absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Stocks swing from the highs of the day after tensions in the Middle East show signs of easing and a positive set of earnings lift sentiments. IT and realty are the big gainers while healthcare and capital goods stocks drag.
Infosys reports strong deal wins in Q3 and ups its guidance for the year, raising expectations of its IT services growth. IT stocks rally as analysts revise up their Infosys estimates.
Cipla skids after it says it expects to resume the supply of its top drug, lanreotide, only in the first half of fiscal 27 after its vendor faced US FDA actions. Analysts temper expectations as a delayed drug launch also weighs.
Stocks of Angel One, 361 WAM and ICICI Prudential AMC climb after they post healthy quarterly numbers, powering up other capital market players like recently listed online broker Grow.
And US President Donald Trump adopts a wait-and-watch position on Iran, saying that he was told that the killings have stopped and there is no plan for further executions. He, however, adds that all options remain on the table. The oil prices extend losses as concerns about supply risks ease. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Patakia, and back with us is Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz. It's great to be back. The markets were doing really well when we started off the day, but coming off their highs as we're speaking, right?
Counting down to some very important earnings. We are mentioning this in the morning as well, right? That there are certain factors that are supportive of the markets to go higher, but then there are certain factors that might keep the index in check as well. The Nifty now possibly off at the lowest point or nearing the lowest point of today's trading range. There was almost a 150-point down move now that you have seen from the highs of the day for the index. So that is one reason that you need to keep an eye out for on the index. The major reasons for caution is because nearly 1/3 of the Nifty is reporting earnings in the next 24 hours. And that 1/3 is just 3 companies. Reliance Industries reports after market hours today. And then tomorrow, we get the 2 banking heavyweights being HDFC Bank and ICICI Bank. The one big reason for the Nifty's fall from the highs is on your screen. Look at Reliance Industries, the chart. 1480 was the intraday high, down to 1460 now. It's given up all of its gains. HDFC Bank is still holding on to some of its gains, still 0.75% higher. And ICICI Bank has moved into the red. ICICI Bank was one reason why the Nifty Bank was remaining or was the outperformer at the start of the year. Now that has slumped to the lows of the day, but the Nifty Bank is still holding on, and that is courtesy of HDFC Bank.
Absolutely. You pointed out those big stocks that are losing steam today, but the IT companies, if you look at them, they're the top gainers on the Nifty. We've got all of those stocks doing well after, a good quarter from Infosys. Infosys, LTI, Mindtree, Emphasis, all of them soaring between 4 and 5% as we speak. We've got those banking names also doing well in trade. We've got Federal Bank, SBI, PNB, all of them seeing strong gains in trade today. OMC is also doing well after oil prices fell. We've got Indian Oil, HPCL, BPCL, all of them doing strong in trade, all of them in the green. On the downside, though, we've got that pharma index, which is in the red. We've got Cipla, Natco Pharma, Sun Pharma, all of them trading lower. And if you bring up that advanced decline ratio, if you look at it, we've got 1,511 stocks declining for 1,394 advancing. But, let's begin the show by focusing on some of those IT earnings. Infosys reported a good set of third-quarter numbers, while L&T Tech Services was a miss. Reema Tendulkar joins us now with all of the earnings fine print.
So it's a tale of two cities when you look at Infosys and LTTS. Infosys has delivered a good Q3 ahead of estimates. FY26 guidance has been raised to 3.5%. And plus, the management sounds upbeat about the financial services vertical. Brokerages have raised estimates, their growth forecasts. CLSA is saying that next year the company will grow at 6.3% versus their earlier projection of 6%. Jefferies has raised EPS estimates, and Jefferies says that the EPS growth for the company is likely to be 7.5%. Analysts we spoke to also pointed out that on top of this EPS growth, it may be 7.5%, but there is a dividend yield that IT companies provide of 3-4%. So if you add the two, then there is a possibility of a 10-12% kind of return, pretty steady, especially when you put it in context of the valuations, which are not prohibitive. The stock trades at 21.5, 22 times forward multiple, and the stock has underperformed in the last 1 year, down close to about 10-12%. LTTS, on the other hand, is getting impacted because of a very conscious decision taken by the management to recalibrate its entire business. So they said that they assessed the full portfolio. They met with the strategic advisory group, all their clients at MIT Labs, and they took stock, and they found that certain parts of their portfolio are getting commoditized. They are low margin business, and therefore the company said that we took a conscious call to exit those low margin businesses, deprioritize certain geographies in the technology vertical in Europe and in India, and pivot towards higher margin. So that's getting reflected in the numbers. Revenues declined 2.8% in Q3. The full year guidance was also brought down to mid-single digits, but margin performance will be stronger. So the company's margins expanded in Q3, and they're talking about an aspiration of 16.5% margins by Q4 FY27.
Reema, thank you for that update there. LTTS being possibly the only IT laggard in today's trading session, still 4.5% lower, while most of the others have received a significant boost from Infosys' numbers. Now, the other one, we were just talking about Reliance Industries. The stock has given up its gains before its results, but Sonal is here with all the key expectations. Sonal.
Well, it's expected to be a strong quarter this time around, but let's talk about the stock move first. The stock, remember, is down around 6% in last 1 month, but in the month of January, it did hit its record high level, came in at around 1,611 rupees a share on 5th of Jan, and the stock trades at 27.2 times FY27 EPS. In terms of the consolidated expectation, revenue is expected to fall by 3% on a quarter-on-quarter basis, but the EBITDA growth will be decent, 5% on a quarter-on-quarter basis, leading to a margin expansion, which is expected to come in at 19.45%. Profits accordingly will see a growth of 6.6% to come in at 19,365 crore rupees. Now let's talk about the segments. It's the oil to chemicals business this time which will drive growth for the entire company, and this is because of strong GRMs. Singapore GRMs, they are up 97% on a sequential basis. However, weakness in oil and gas segment is expected to continue because of lower volumes and pricing as well. The festive season demand, that is something which will aid growth for the retail segment. And if we talk about the Geo business, that is expected to see a growth of 16% on a YOY basis, 2% sequentially because of higher ARPU and also subscriber growth. Overall, we'll be watching out for some announcements. Clarity on the new energy business, expected to see more capacity coming by on stream, growth in retail store additions, and any pricing action in the telecom business. These are some aspects that we'll be watching out for in the management commentary.
All right, Sonal, thank you so much for taking us through those details. So that's the big number to watch out for. And as Hormaz was pointing out, Reliance stock coming off its highs, losing some points there. But if we take a look at the market, we've got the Sensex, Nifty about 0.3% in the green. Also coming off their highs of the day, almost at the low point of the day. We've got the Nifty, Bank Nifty doing slightly better than the key indices. It's about 0.6% in the green. We've got the Midcap index also doing better than the blue chips. If you take a look at some of the sectors that are doing well, we've got that IT pack on top after Infosys numbers came out, and it was a strong set from them. So we've got Infosys, Tech Mahindra, Wipro, LTI Mindtree, all of them doing really well in trade today. We've got those banking names also doing well in trade today. And we've also got a few of those OMC stocks that are doing well on the back of those as Brent prices are falling. So we've got HPCL, BPCL, all of them in the green. And that pharma pack is the only index that is sort of in the red right now amongst the other indices, doing the worst at this point in time. But Hormaz, the markets are coming off their highs.
Yeah, indeed. And we'll keep an eye out on that as the day goes by, because most of the price action generally has been taking place in the second half of the trading session. But to take a look at what are the other stocks that are moving around from what you just highlighted, Ria is here with the hits and misses from a whole host of the third quarter results. Ria.
Well, yes, Thomas, let's start off with the ones that have come out on top first. Starting off with Federal Bank, this one is seeing gains of 9% after seeing a positive surprise across the board in this quarter. NIMs have come in at 3.81%, seeing an increase of around 12 basis points. The asset quality has also improved, with slippages declining, which the street has liked, and hence the uptick in the stock today. ICICI Prudential AMC is the next one, seeing gains of around 7% after a strong quarter. The mutual fund quarterly average AUM has seen an increase of roughly 6% sequentially, which has grown faster than the industry average of 5% growth. Angel One is also up 8% today after an operationally strong quarter and a beat across the board for this company as well. The client funding book has gone up by roughly 11% to 59,000 crores to 5,900 crores on a sequential basis, and the average daily turnover is also up around 22.8% overall for this one. 361 RAM is also up around 5%. The total AUM is at 7.1 lakh crores, seeing an increase of almost 6% on a sequential basis. The recurring revenue has also gone up by roughly 12%, which has reduced cyclicality in the business. HDFC AMC has also seen gains of 3% in trade today. Overall, the company has beaten estimates in this quarter. The quarterly average AUM has seen an increase of around 5% in line with industry growth. Yields have been maintained at 46.5 basis points, and this was also a positive since the street was expecting yields to drop to around 46.2 basis points in this quarter. Anand Rathi's share and security brokers is also up around 9% today after seeing an operationally good quarter. The client funding book has gone up by 14% sequentially on a low base in this quarter. SW Solar is the next one, seeing gains of around 10% in today's trading session. A one-time charge has dented the bottom line for the company, but the company has revised its order inflow guidance for FY26 to over rupees 11,000 crores, which is a growth of 60% on a year-on-year basis. On the flip side, we have HDFC Life down around 2% 2% in trade today. The net premium income has gone up by 5.4% on a year-on-year basis, which was a slight miss versus what the street was expecting. The VNB margin is also down around 202 basis points for this one. And the last stock is Delta Corp, down around 4% in trade today. Net profit has declined roughly 60% this time around to around 14 crores. And the company has cited the fall in profitability to the recent hike in GST for the gaming industry.
All right, Ria, many thanks for taking us through all of those stocks that are buzzing in trade today. But as we slip into a break, the countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact and policy decisions from the Finance Minister. We bring you a power-packed lineup throughout January and on the day of the budget. Helios Capital Samir Arora for all things market, followed by JP Morgan's Sajid Chinoy to discuss the macro signals. We also get you insightful analysis from industry veterans, and Dinesh Kanabar and Ashok Vadva for the tax rhetoric.
Fly Emirates, fly better.
Welcome back. You're still with us on Business Lunch. Moving to some global updates now. Tensions in Iran continue as the protests enter day 19. While the intensity of the protests may have slowed down due to the brutal crackdown by the government, but international pressure on Iran remains. In the latest, the United States has imposed new round of sanctions on the country, targeting senior security officials and several front companies that allegedly launder money in Iran's oil and gas revenue. Meanwhile, the death toll in Iran has crossed 2,500, even as the country continues to face an internet blackout. On the international front, the U.S. said that it stands firmly with the people of Iran. President Donald Trump, as per reports, may be thinking of a diplomatic solution to the crisis a day after announcing that Tehran has stopped killing protesters. Media reports suggest that advisors have told the U.S. president that military strikes are unlikely to topple the regime led by Ayatollah Ali Khamenei.
Now on to the other big global issue. Tensions between the US and its European allies over Greenland continue to escalate. Norway, Sweden, Germany and France have now dispatched small contingent of troops across the territory as a show of force. Now, French President Emmanuel Macron said that a primary team of French soldiers is already in place on the island and more military means will be deployed in the coming days. Responding to the French president's statement, the White House claimed that the presence of NATO troops on the island did not impact President Trump's goal to acquire the island. This deployment comes in response to a White House summit between President Trump and Danish officials, along with Greenlandic leaders, that ended on a tense note on Wednesday.
And before we slip into a break, here's a quick sneak peek into the stocks that we will address on Your Stocks today. Don't forget to catch fundamental and technical experts give their views on these at 2 p.m. today, only on CNBC TV 18.
The cool off from the highs of the day continues for the index as we speak. 25,700 now being under threat is where the Nifty currently stands, only 40 points higher now. At one point when we were almost 200 points higher for the day. ICICI Bank being the principal culprit, and just as we speak the Nifty is almost on the verge of breaking below that 25,700 mark, so a percent lower on ICICI Bank as well. On to some updates from the e-wheeler space. The market share of Ola continues to dip in January while TVS, Bajaj and Ather continue to gain. Sudarshan is here with more on this. Sudarshan.
Remember, January 1, Ola Electric had given a press release saying that it's seeing a business turnaround and courtesy the gain in the market share that company had seen in the month of December 2025. Market share, as per the company, had increased to more than 9% against around 7.5% that it had seen in the month of November. And in the second half of the same month, that is December 2025, as per the company, the market share had increased further to 12%. But now it's back to square one. first half of January 2026 is done. Now we have the market share for all the electric two-wheelers, and instead of improving the market share for Ola Electric has seen a further fall. Now it has fallen to 5.5%. That's likely the lowest ever that company has ever seen. Who has gained the market share? Major three names. TVS continues to gain, followed by Bajaj Auto's Chetak, and next one is Ather. So, as of now in January 2026, TVS market share is increased to nearly 29% from 25.7%. For Bajaj Chetak, market share has increased to nearly 21% from 19.3%. For Ather, which is at number 3 position, its market share has increased to 19.2% from 17.5%. And at the 4th position, it's Hero's Vida. That's market share remains unchanged if you compare from December, and that's around 11%. So, company had said that in the second half of December 2025, it was back to amongst major three electric two-wheelers. But as of January 15, it's back at number 5th position with market share. It's likely at lowest ever of 5.5% for Ola Electric.
All right, Sudarshan, many thanks for those details. Now, the Supreme Court has ruled that Tiger Global's sale of stake worth $1.6 billion in Flipkart to Walmart will be subject to capital gains tax. Let's go across to Ashmit for more details. Ashmit?
Well, a landmark ruling this, giving clarity on a hotly contested subject of taxation, especially for investments coming in via tax havens like Mauritius. The Supreme Court has answered the question that was raised by the Income Tax Department in the affirmative, saying that yes, indeed, there is a case to be made by the Income Tax Department that there are no tax benefits that will flow to Tiger Global as a part of its transactions. Bear in mind that they had sold their stake in Flipkart for as much as $1.6 billion, will now be vulnerable to tax demands being raised by the Income Tax Department. The view that the Apex Court has taken is that there has been a long history of round-tripping of funds via tax havens such as Mauritius, that this is something that the Indian government needs to guard against, that the sovereign right to tax should not be spared, should not be put away, and that this is a right that should be exercised. And to that end, the Supreme Court clarifying that mere having a tax residency certificate issued by a country like Mauritius is no guarantee that there can be no further inquiry by the Income Tax Department. And on that note, the clarity being given now by the Supreme Court that yes, indeed, Tiger Global is not eligible for claiming exemption on that $1.6 billion transaction, is liable to pay tax. Having said that, a long list of many experts say this will open a Pandora's box. Some say that this will then now begin to have implications of all PE, VC, FPI investments prior to 2017, that now the tax department could be emboldened to scrutinize these investments that were made prior to the year 2017. There are also questions being raised about investments coming from other similar tax havens like Cyprus, like Singapore, like Cayman Islands, and all of this, many say, will set the cat among the pigeons. So clearly, a long list of impacts that perhaps could be had as a result of the Supreme Court judgment, but for now, a definite setback coming in for Tiger Global.
Ashmit, thank you for that update. On to some news from the BMC election results. The BJP-Shiv Sena alliance seems to be on its way to capture power in the 227 ward BMC. Santya is joining in with more on this. Santya.
So the counting for much awaited, much anticipated BMC elections along with 28 more civic bodies across Maharashtra is underway, and this is the situation at 12:44 p.m. In Mumbai, in BMC, BJP plus Shinde Sena is leading on around 114 seats. BJP as of now is leading on 89 seats, and Eknath Shinde's Shiv Sena is leading on 25 seats. On the other hand, Thackeray brothers, which means UBT plus Manse, they are leading on 67 seats, Congress on 11 seats, and other candidates, independent and other parties, on 7 candidates. So out of the UBT Shiv Sena alliance, Uddhav Thackeray's Shiv Sena is leading on 58 seats and Manse is leading on 9 seats. If the trends will continue to remain the same, and if it converts into the final numbers, It seems like that finally BJP and Eknath Shinde's Mahayuti will be able to appoint their mayor in BMC. Now, which of these parties will get to do that? That remains to be seen. This is also going to be an interesting day because if the situation remains the same, it will mark the end of Thackeray family's dominance on BMC after 26 years. Let's talk about what happened last time in 2017. Shiv Sena, the undivided Shiv Sena, won 84 seats and BJP won 82 seats. An impressive number for BJP given the dominance of the Thackeray family and the undivided Shiv Sena on BMC at that time. So as the day will proceed, the situation will become more clear. But as of now, clearly, BJP and Eknath Shinde leading in BMC.
So Santya there with the latest on the BMC election. But with that, it is a wrap on this edition of Business Lunch. From Hermaz and me, goodbye and many thanks for watching. Midcap Radar coming up next.
Cool.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Well, we start the show with the markets coming off sharply from the highs of the day. Almost a 170-point cut from the highs. The Nifty is well below the 25,800 mark, which we conquered today back again. So yes, we started well in the green, but those levels seem to have come off from the highs.
Good afternoon, Sonal. You're absolutely right. In fact, the small cap index has slipped into the negative territory. And for a majority of the day, you actually saw most of the markets having a very strong advance decline ratio. But we have a lot lined up on the show, some important conversations as well. So let's start off with the top headlines. Stocks off days high, but continue to remain in the green after tensions in the Middle East show signs of easing, and a positive set of earnings lifts sentiment. IT and realty are the big gainers, while healthcare and capital goods drag.
Angel One zooms 8% after a strong Q3 as the company's revenue rises 11%, while net profit surges 27% during the quarter.
Federal Bank shares rally as much as 9% following a solid set of Q3 earnings. The bank's net interest income grows over 9% during the quarter, while its net interest margin expands to 3.18% versus 3.06%.
And a few movers on the back of order wins. Zentek perks up in trade after winning a 400 crore order from Ministry of Defence, while Kernex Micro surges after the company bags a major Kavach order worth 2,465 crore rupees.
IndiaMart Intermate shares rally up to 9% after a large block deal on Wednesday when Nalanda India Equity Fund bought nearly 11 lakh shares of the company.
Okay, all right. Those are the top headlines. We'll, of course, discuss some of these stocks in greater details. The big talking point, of course, how market has fallen from the highs of the day. We started on the strong foot, but now we saw that big dip and reaching the day's low. But again, there's some buying that has come now. So it continues to be a little choppy as we speak. Small cap index in the red. The advance decline ratio too, suggesting more moves in the declining side than advances. So the Friday mood continues for markets as well. For now, unable to make up their mind.
That's right. So a couple of names or a couple of stocks. Federal Bank after the results up almost 10%. Polycab ahead of its results has once again slipped. So that'll be another stock that will remain in focus. Generally a sharp mover post results. But these names and a whole host of other stocks is what Sudarshan has on his radar. This is our special segment, Midcap Mover. Sudarshan is standing by the wall to take us through all of the midcaps that are moving around in the session.
So in the last few minutes, we have seen that market coming off highs and market breadth turning once again in the favor of decline. So today, as far as the stocks are concerned, I'll start with the Federal Bank. It has announced earnings just a few minutes ago, and it was an all-round beat. Now the question is why the stock has seen such a move. So ahead of the earnings, since January 1, the stock had fallen 8%. And there was an expectation that earnings might come below expectations. And that was the reason the stock was down for the last few trading sessions. But in contrary, company has come out with the earnings, which was beat in NII, operating profit, even net interest margin, loan growth and deposits. Both these have come ahead of the expectation. That's the reason you are seeing a big move. Second name, Angel One. Ahead of its quarterly updates on January 1, for the last 2 to 3 months, the stock was under pressure, and similarly was for 361. But both these companies have come out with the earnings, and those were also beat. As far as Angel One was concerned, it had reversed the losses the day it had announced the quarterly and monthly update for December and quarterly update for Q3 FY26. And because of the healthy updates, since then, the stock has seen a big move, and same was for 361. Now coming to the second set and amongst the top mid-cap losers. On top of that, Hitachi Energy. For the last few trading sessions, this stock has been under pressure. And the reason, if you know, just a few weeks ago, we had reported that government is likely to include Chinese companies in its tender. And if it happens, it's going to impact Hitachi Energy. And also, we are expecting the earnings. So that might be also one of the reasons. Kalyan Jewellers. Remember, quarterly update company had given India business revenue growth was more than 40%. International was around 36%. But since then, stock has seen a down move. And from January 1, the stock is down almost 16 to 17%. Next one is Dixon Technologies. There is an expectation that company is likely to miss the mobile revenue guidance for FY26. And because of that, same day, the company had reported earnings for Q2 FY26. And from that level, the stock is down more than 35%. Lastly, some of the unusual movers. HBL Engineering sharply under pressure because it has lost the Kavach order to Kernex Micro. So Kernex Micro is higher while this stock is under pressure. Landmark Cars has given Q3 updates in which the revenue has increased by 10%. But in Q2 FY26, revenue was up more than 30%, or it was in the range of 30 to 35%. So there was something disappointment came from BYD supply. That was the reason it has reported revenue growth of 10%. And that's the reason this stock is under pressure. ET E2E networks, from the level it has recovered, the same level that it had recovered in the month of August, and Best Agro and SBFC Finance, these two stocks are seeing gains with healthy volumes too.
Okay, all right, Sudarshan, thank you so much for joining in. Let's go across now to Himain Kapadia, Technical Associate from DR Choksi Finserv, for a technical check on the markets. Himain, short on time, so if you can quickly tell us what are the Nifty levels now since we've come up from the highs?
Very good afternoon. Thank you for having me on the show. 25,669, 25,446, 25,212, 25,202. Nothing looks good. Downward bar reversal last week. So a bounce back which hasn't sustained. Not expected to sustain. Maybe something left, but things are not looking good, Sonal. We seem to have made an intermediate peak. Market's not looking good. Weeks is up. Yeah.
Oh, okay. All right. Himain, we have to wrap now. We had more questions, but there's no time left. But thank you so much for tuning in and joining in with your thoughts on the market. So not looking so good from a technical viewpoint. But with that, we'll slip into a short break. We'll get chatting with Himanshu Sinha from Tri-Legal and tax expert Sudhir Kapadia on the Supreme Court judgment on Tiger Global in the Walmart stake sale case. Stay tuned for that. Welcome back. Let's discuss the big story, the update that we got yesterday. The Supreme Court has ruled that Tiger Global's sale of stake worth $1.6 billion in Flipkart to Walmart will be subject to capital gains tax. What does it mean for the broader investment scenario, and what are some of the tax implications from here on? Let's get in Himanshu Sinha from Tri-Legal and tax expert Sudhir Kapadia joining us now. Himanshu and Sudhir, thank you so much for joining in on this conversation. Now, this is something that we've been discussing since yesterday. Sudeep, first up, I want to understand your take on this. What does it mean for the larger investment coming in from these MNCs or PE firms into India? And do you think this means that anti-avoidance principles can be applied by tax authorities even when entities have a valid tax residency certificate? What did you make of this judgment by the Supreme Court?
Yeah, I think as you framed the question correctly, we have to divide into two parts. One is what I would call indirect transfer of shares. So investors who have come in using Mauritius as an intermediary entity. And then you are talking about indirect transfers because you have two layers in the structure. And then we are talking about investors, let's say FPIs, who are directly investing from jurisdictions like Mauritius, Singapore, etc., which are the ones who are also registered with the custodians with SEBI. So these are two separate kind of fact patterns. This case, as we know, belongs to the first category of what is called indirect transfers. The second point, I think, for the benefit of our viewers, we must emphasize that this principle of impermissible arrangements for potentially resulting in tax avoidance, the principle is something which goes back to judicial precedents of the Supreme Court way back in the 1960s. It's not new. This principle was always there that you cannot have only form and no substance and hope to get the benefits of a particular statute. In principle, I'm not commenting on the facts of any case. So it was there from the 60s. More celebrated was the McDowell's case, which came later, much later, 2 decades later. And then, of course, we had a catena of cases, etc. So I think that's the other thing, just for perspective. And the third thing, which is a very important point, is that we had many years of no capital gains tax in our domestic law. The budget 2018 brought long-term capital gains tax back into the statute effective January 1. And the treaty with Mauritius was also amended with effect from April 1, 2017, and very wisely grandfathered investments made prior to that date. So I think these are some important facts. I think the Supreme Court has given the ruling on the facts of that particular case. I think for the government now, it would be very advisable for them to consider giving one clarity. And what is that clarity which is needed? The clarity which is needed is that when you are talking about investments coming from these jurisdictions, which are grandfathered, which are clearly written into the treaty, they are grandfathered, they are protected. As late as 2025, there is a CBDT circular again confirming that grandfathering will protect prior investments regardless of subsequent developments, even at the OECD level, principal purpose test, what is the test for tax avoidance, etc. I think that needs to be reiterated to the field officers and to therefore exhort them not to raise new disputes, not to raise new notices with regard to such grandfather investments. That, if you ask me, is the need of the hour and will give a lot of certainty and clarity to all similar structures of direct investments, particularly by FPIs into the Indian market.
Sudhir, actually, I was going to ask you on this grandfathering clause itself, but you already mentioned there has to be more clarity on that. And this is something that should be reiterated as well. Let's get in Himanshu Sinha from Trilegal as well. Himanshu, first, your thoughts on this ruling. And do you think what do you think would be Tiger Global's legal recourses now? Would it be domestic review or they have to go via international arbitration? Is that available for them?
Yeah. So first of all, I must state that the Tiger Global decision of the Supreme Court is largely unexpected, and it causes a disruptive shift in our tax treaty jurisprudence and infuses a high degree of tax uncertainty and litigation risks, especially in respect of legacy structures of our PE investors and others who have invested in Indian companies prior to 1st of April 2017. That is primarily because the grandfathering commitment given by the government, both by way of statutory recognition as well as administrative pronouncement, has been negated by the Supreme Court in its Tiger Global decision. So I think that is a big disruption which has been caused because it allows the tax authorities to disregard the administrative assurances given by the government and to go behind the so-called structure to look at the commercial substance. So clearly, it marks a big shift in the jurisprudence that we have seen in this country. Of course, this is not the last word, I would say, because the taxpayer will have the remedy of going into a review petition and then into a curative petition, etc. But more importantly, there are other such cases which are in the pipeline in the appeal process. And the taxpayers will have an opportunity to go before the Supreme Court and argue that this matter should be considered afresh by a larger bench of judges. Because mind you, this is a two-judge bench which has decided this case. And if this is a matter of a public importance, it should be examined by a larger bench, given the long history, the checkered way in which the court has approached the interpretation, and the larger issue of tax certainty for foreign investors. So the taxpayers can argue for a larger bench and can have a fresh opportunity of explaining the case before a larger bench and try and get greater certainty from the Supreme Court itself. And besides that, the government itself can also bring about some clarifications, both by way of amendment in the rules as well as assurances given to the foreign investors, so that the uncertainty caused by this decision can be reduced, if not eliminated.
Well, Mr. Sinha as well as Mr. Kapadia, it's a very short conversation that we are able to have with you today. But we assure you, once there are more developments on this particular front, we will get both of you back on the channel to discuss this in greater detail. Especially, we want to understand the impact of future PE investments from this particular route into India. But before we slip into a short break, here's a quick sneak peek into the stocks that we will address on Your Stocks Today. Don't forget to catch fundamental and technical experts give their views at 2 p.m. today only on CNBC TV 18. Welcome back to Midcap Radar, and we put the focus firmly back On equities, this is our special segment, Midcap Spotlight. Winnie joins in with details on IndiaMart Intermesh and why this particular stock is doing so well today.
Hi, good afternoon. So yes, IndiaMart Intermesh today, it's surely holding out a very strong gains, 8% gains there. This is the biggest intra-single-day gain that the stock has seen since July 2023. In the last 3-4 trading sessions, most of it, 3 trading sessions out of the 4, the company has actually seen a positive up move. Do not forget, though, that last 6 months, the stock is down 15% overall. Now, what is the reason today that the stock has started buzzing in trade? We've seen Nalanda India Equity Fund, they bought around 11 lakh shares. This was according to bulk deals that came in yesterday. Now, total transaction value around 230 crores. The seller of this was Small Cap World Inc. Fund. They sold 6 lakh shares. Do not forget, Small Cap World Fund Inc., they held around 1.83% stake as on September 2025. So now, obviously seems like they've sold almost 50% of their stake. So there is still some remaining stake by Small Cap World Fund, which will be held as well. Now, shareholding. Let's look at what's the change over there, right? When you look at it in terms of September 2025, promoters held around 49.17% stake. FII's stake was at around 21.5%, while DII's stake was at around 13%. In terms of overall performance of the company, Q2 was not a great set of numbers. There was a bit of a miss that came in terms of numbers over there. They were facing a lot of issues, especially due to elevated churn that came in the silver tier customers segment. Now, that is something that weighed overall on the net additions and collections in the last few quarters as well. Management has taken a lot of initiatives to start reducing this. So from here on, it's expected that this churn will start seeing some reduction there, and even a minute change in the churn will lead to an improvement in terms of subscriber additions. A lot of analysts also have highlighted there's an improvement in terms of AI-driven engagement, performance marketing, which is leading to better growth. And obviously, subscription addition in Q2 also was decent. So that is still a bright spot there. Overall, these are the triggers that one could see coming in. Management, when they last spoke to us, they said stable margins is something that one could expect going forward as well. And ARPUs, that was seeing a good growth of 6 to 8% in Q2 that is expected to continue going forward. So we are expecting a bit of a positive commentary. The last note we had from HDFC Securities somewhere around in December, they've also maintained their buy rating positive on the stock, target price of 2,800 rupees per share. And they also believe the worst is over in terms for the churns that one was seeing coming in for IndiaMart Intermesh, which was leading to a fall in terms of their overall performance.
Okay, all right. Thank you so much for joining us with that comprehensive take. That is IndiaMart Intermesh. But banking continues to be the sector of the day. We do have Central Bank of India's numbers flashing for you. Federal Bank was the other one, which reported numbers a while back. Strong move on the stock, 9.5% higher. Gaurav is joining us with the fine print. Gaurav.
Well, as Federal Bank came with a strong performance in what it was expected to be a normal and a stable quarter for the bank, and that is the reason why market has taken it in a very positive way. So let me take you through numbers first. Net interest income increased almost by 9%. PPOP, which is pre-provisional operating profit, that increased almost by 10%, and this was supported by the other income. Let's not forget that within other income, fee income has increased almost by 18% on a year-on-year basis. And apart from that, profit increased almost by 9% on a year-on-year basis. All of these numbers were ahead of the street's expectations, almost by 3 to 4%. Other than that, now advances growth, that came in at around 4.5% on a sequential basis, and deposits increased almost by 3% on a sequential basis, and on a year-on-year basis, that increased almost by 12%. So again, a very good set of number here as well, in line with what the street is expecting. What came in as a surprise is the net interest margins. That increased almost by 12 basis points to around 3.18%. Remember, the street was expecting this number to come anywhere around 3.1 to 3.12%. Other than that, the asset quality, that also surprised the street because credit cost, that remains stable. Slippages declined almost to 0.7% versus what it was at 0.94%. And as a result of all these numbers, if you look at gross NPAs, they are at a decade low level of 1.72%, declined by 11 basis points. And even at ROA level, the bank reported ROAs of 1.15%. Remember, the bank was targeting more than 1.4% ROAs by FY28. So it seems that bank is on track to achieve what they had said earlier in the Investors Day. Let's also not forget about the medium yielding segment. There also we saw growth because this segment, which contributed around 43% just a year ago, now contributes 44.4%, again in line with the bank's expectation and the strategy that they had said earlier. So all in all, a very good set of number ahead of the street's expectation, and as a result of a positive surprise, street has taken it in a very positive way. Stock is up more than 9%.
Absolutely right. Gaurav, 9.5% as we speak, higher on Federal Bank, and all-round improvement in the performance is something that has kept the street quite excited. Well, from the broader end of the markets, have a look at Dixon Technologies. This particular stock has seen a bit of a free fall from its recent 52-week high. That particular stock is down significantly, and a whole host of pharma names too under pressure today. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of the markets, we've come off significantly from the day's highest point. And look at the Nifty as of now, 25,680. Around that is where the Nifty is trading at. Even the broader end of the market, that has also given up significant percent in terms of the gains that they were seeing as well. So that is something that we're seeing a bit of a pressure coming in the markets, especially in the last couple of hours. Now, the Nifty Midcap is just holding on to gains of almost 0.2%. So keep an eye out on that. Nifty IT, that's managing to do well. We have Nifty Bank, that's holding on to gains of almost 0.8% in the trading session as well. Now, obviously, in terms of drags that are coming in for the Nifty, which is not doing well, we have something like a Maruti, we have ITC. That's the drags that is coming in there. ICICI Bank, Bharti Airtel. Obviously, we'll keep an eye out on that. A lot of these PSU banks, they reported their numbers. They were buzzing in trade, so keep an eye out on those names as well. But apart from that, we are seeing most of these IT names like Infosys, TechM, managing to hold on to good gains. HCL Tech also. And that's why I look at Nifty IT, right? Like I said, 3% gain is what the Nifty IT is managing to hold on to. Like you can see at the bottom of your screens as well, markets are significantly off the day's highest point. Look at the Nifty Bank down 120 points. Even you saw the Sensex that was down more than 400 points from the day's highest point. But on that note, let's get started with the show. This is a show where we solve all your stock-related queries. And to do just that today, we have our experts joining us, independent market expert Shaina Mukaddam, as well as Vaishali Parekh, Vice President, Technical Research at Prabhudas Leeladhar. Vaishali as well as Shaina, good afternoon, happy Friday, and thank you so much as always for joining in. Let's get started with those queries then for today. We have the first query that's come from Sangeeta, who's writing to us from Mumbai. She's holding 75 shares of Amara Raja and it is at a price of 1,007 rupees per share. So they're making a loss on this one. Other than that, 60 shares of NCC, price is 162 rupees per share, and wants to know the outlook on both the stocks. What should they do? Hold, sell, average? Both the names. Shaina, good afternoon. Let me start with you.
Good afternoon, Vinny. Good afternoon, Vaishali, and all the viewers. See, in terms of Amar Raja, I would believe that it is better to book half the profits or whatever losses, because the investor is making quite a bit of loss on Amar Raja. I would say book half the loss and keep the rest half and review it a couple of months down the line. I'm saying to keep half because the valuations after this huge correction have become quite reasonable. If you look at it in terms of the price to turnover is just about 1 time, and in terms of EV by EBITDA, it's 9 times. So it's not expensive after this huge correction. The issue is why I'm saying to book half is because they've got this huge capex that is lined up in FY27. They've already started making that investment about 1,200 crores in their lithium battery plant. But a major chunk of it will come over the next couple of years. So I think that is a risk. Also, the US market, while small, is an additional risk for Amar Raja. So I would say book half out. Now, in terms of NCC, there also the stock has corrected a lot from the buyer's price. But at these levels, I would say that they have got huge order book position. The first half was not that exciting for them, but I believe second half should be better. They've got huge projects on hand. And if you look at it in terms of order book, they've got something like 72,000 crores, which is almost 3.5 times their current turnover. So there I would say hold and wait for a rebound to review whether to hold or to book profits or loss or whatever.
Okay, hold and then review it later. But for Amara Raja, you can book half your losses. At least that is what Shaina is saying. On the technicals, Vaishali, good afternoon. Amara Raja and NCC, what's your view? Is it similar?
Hi, very good afternoon, Vinny, Shaina, and all the viewers. So, Amara Raja, well, we have seen massive erosion. What I can see right now, even on a weekly chart, it's just holding on to the 200 period. So I think there is quite a likelihood of this stock bouncing back. So if now that he's held on for so long and already going through a loss, I think keep a stop loss of 860 because that is the level of the 200 period for the weekly chart. So if that level breaks, then I would say exit. Otherwise, wait for this to bounce. At least 940, 950 would be the level if this stock bounces back. So that would be the level to exit partially.
Okay. Keeping an eye out on
And
those.
one that you're
NCC?
asking me is NCC.
Yeah.
So NCC also is looking pretty weak right now, and we are seeing that it's broken all the moving averages. So I don't think it makes any sense to hold the stock for now.
Okay, doesn't make sense to hold the stock for now. That's a view for NCC on the technical front. Let's move on then to the next query. We have Dushyant Patel, who is writing to us from Surat. He's holding 100 shares of PB Fintech, and this is at a price of 1,688, making some bit of a loss in this one. Wants to know the short-term view for the stock. Fundamentally, for the short term, how is PB Fintech looking, Shaina?
I think it looks a bit difficult, for the stock to give you any meaningful, fundamentally any meaningful rebound in the shorter term, because there are a lot of policy changes that have been brought about recently, which is including on the commissions that are to be paid, and the impact that it could likely have on PB fintech. We really will have to wait and see what is the impact. And also, if you look at it, even in the last 6 months, 1 year, there have been a lot of policy changes by the regulator. So we have to really wait and watch. While I don't think, if the long-term investor will have any major problem, because it is the largest in terms of digital in this market space. But I would say shorter term looks a bit dicey.
Okay, short term looks a bit dicey for PB Fintech. Long term, no problem, but short term, yes, a bit dicey. On the charts and technicals, Vaishali, they bought it at 1,688. Short term, is there any sort of a bounce that we could expect? Any indication on that front?
The stock has fallen right from 1940 levels to one way towards 1600. So today's candle looks a bit optimistic. So I would say keep today's low as stop loss, and I think wait for it to bounce because it's in deep oversold. So having said that, I would say that continue holding for now, and the stop loss should be 1615. And once you see this stock, if it survives and it goes higher, I think there could be all the chance of a bounce back going towards 1750 or so. So this would be absolutely a short-term view.
Okay, that's the short-term view there from Shaina on PB Fintech. Next query for today, ladies. This has come from Sushil, who's writing to us from Chennai. He's holding 2,700 shares of IREDA, and that is IREDA, that is at a price of 54 rupees per share, as well as RVNL. He's holding 800 shares of RVNL. Price is 75 rupees per share. So they're making a profit on RVNL, and a long-term investor asking if he should hold the shares for another 5 to 10 years. A long-term view on both these stocks, Shaina.
Yeah, I think at least for now he should hold it because you have the budget round the corner. And both these stocks could benefit. I would believe the government will come up with some policies to benefit both of them. See, IRDA also in terms of order book, they've got a huge order book. So it is just the execution that has been an issue, which I hope over the next coming of quarters, especially with interest rates, their cost of funds coming down, they could be able to give a better performance. They've already been doing that. First quarter was bad. Second and third quarter has been good. The numbers were out. So I would hope that the rest, the fourth quarter and coming quarters will be better. So hold currently. And as far as RVNL goes, there also the same issue, the first half has not been that good. The numbers are still not reported. So it has been flat if you look at the revenue. And the profits have, been lower. Now, second half, if their management has to meet the guidance that they had set out of doing 22,000 crores in terms of revenue for the year, then the second half should be much better. So I would say, plus being, railways should get some good impetus in this current budget. So I would say hold both.
Okay, hold both. And yes. And Vaishali, your view on the technicals for both these names? They are long-term investors, so they don't mind holding it.
Well, so I first start with, I do agree it's a budget-friendly stock, both these stocks, IREDA as well as RVNL. So, but for this stock, let's talk about IREDA. If it has to have a meaningful positive view, then I think it is technically making, it's in the process of making higher bottom. So for this, it's very important that it holds on to the 130 levels, which is a strong support. And if that is so, then we can see a good bounce coming towards 155. That is a good resistance level. For long-term perspective, it is very essential that the stock sustains above 155 to see further growth in this. So this is how I would look at IREDA. And talking about RVNL, well, similar pattern. RVNL 2 right now at 334 levels, still holding on to the higher bottom category. So I would say 320 would act as a support. And for the near term, I would first look at 370 to 390 levels. About 390 and 400 levels, it can be reviewed again for a long-term perspective.
Okay, we'll keep an eye out on those levels over there for both the stocks. But on that note, we're going to sip into a very short break. But as we sip into the break, we have this update that is there for you all. The countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact and policy decisions from the finance minister. We bring you a power-packed lineup throughout January and on the day of the budget as well. Helios Capital Sameer Arora for all things market, followed by JP Morgan Sajid Chinoy to discuss the macro signals. We also get you insightful analysis from industry veterans and Dinesh Kanabar as well as Ashok Wadhwan for the tax rhetoric. Welcome back to your stocks on CNBC TV 18. We still have with us our experts for today, Shaina Mukaddam as well as Vaishali Parekh. So we will watch out for the markets as well, because right now the Nifty is just up 18 points, significantly off, almost near the day's close point is what the Nifty is trading at. You have some comments that have come in from Federal Bank as well. So keep an eye out on that one. Good numbers is keeping the stock abuzz in the trading session. Let's keep it going then with the stock related queries. Balakrishna Hegde is writing to us from Udupi, and he's holding 300 shares of Wipro. This is at a price of 323 rupees per share. And another IT name, that's Infosys, 11 shares of that at a price of 3,230 rupees per share. Wants to know whether he should continue to hold or sell both these names. Your view on this one, Shaina?
Well, I wouldn't say now is the right time to sell, simply because the whole sector is actually coming back in favor. There is some buying in terms of stock, but otherwise, in terms of performance, Wipro's numbers will come today post market. So we do not expect anything much coming from there. More or less flat type of revenues. A bit margin should be under pressure, but at the same time, I would believe valuations are not very expensive. It's just about 20 times, which is much cheaper than the other large cap IT stocks. So I would say hold now and hold for a bounce to exit. Of course, numbers are there today, so you can't really give a specific expectation of what we can get at the day end. But I would say hold for now. Emphasis, I would prefer actually, though he's making a loss on this. But if you get a deep correction, I would say hold as of now. If you get a deep correction, add. Because here, while valuations are more expensive on a PE basis, about 30 times. And it's a mid-cap IT. But at the same time, I believe the investments that they're making in AI, I think that will hold them good in terms of getting deal wins going forward. Already, if you saw in the first half, they've done already about 1.4 billion deal wins. So I think it's a buy at major dips, like maybe 10-15% dip. It would be a good buy to average.
Okay, that's a view there on Wipro and emphasis on the fundamentals, on the technicals, both these names. Vaishali, what's your view?
Start with actually full IT index is showing signs of improvement. And today also, as we saw, most of the IT stocks were showing good strength. So now talking about Wipro, purely on technical terms, this too is on an upward trajectory. So for now, I would say that 250 acts as a very good support. And well, let's see what happens post results. I would say it's a range of 250 to 275. So that would be the range that one should be looking at. Either ways, if you see a decisive breakout, I think more preferably it would be a breakout, then it would carry further more strength. So Wipro, that would be the view. And as far as emphasis is concerned, that too is already having a good, strong bullish candle today. And we've seen a good consolidation at these levels. So I would say 2,750 acts as a good support. And we look at a resistance of 2,975. So this is the range for emphasis. I think this too should go for a breakout, and above these levels, one can look for 3,100. So I think overall the view for now is buy at every decline.
Okay, that's the view on emphasis, buy at every decline there on the technicals and even fundamentally also. If there was a correction, China did indicate that maybe you could look at emphasis. Next query for today, Siva Reddy is writing to us from Andhra Pradesh. He's holding 215 shares of Reliance Industries at 1,239 rupees per share. Wants to know if he should average, add more, sell the shares, and or maybe look at something like an SBI and ITC if they look to sell the shares. We have the numbers also for Reliance Industries today. Shaina, your view?
If he's got extra money, he can, invest in SBI, ITC hotels, but not by selling Reliance. The numbers are today. I think numbers should be quite decent. The OTC business is likely to support a good profit, I would believe, in terms of that vertical. Basically, you have Singapore GRMs, which is good. Now, of course, Geo, we are likely to see that the merger happen in the next 1 odd year, which will be a good positive value unlock. So, and of course, ARPUs are likely to be higher. So this is definitely not a time to get out of Reliance. And of course, the retail vertical is also doing very well. Look at the size that it has got in this it's in this short period of time. So I would say continue to hold Reliance, hold it for the long term.
Okay, continue to hold Reliance for the long term. Vaishali, your view, Reliance Industries, should they book profit, add more, or sell? When they book the profit, then look at SBI and ITC hotels?
Let's not be in a hurry. Let's wait. Let's see what happens post the results. Because anyways, it's seen decent corrective move. So if it has to see some furthermore profit booking, then I think 1400, 1380 is a good level to start adding. So I would say let's wait for the outcome and then take a call.
Okay, let's wait for the outcome and then take a call there right now. That's for Reliance Industries. Next query, we have Sriram, who's writing to us from Chennai, holding 100 shares of Advanced Enzymes. And this is at a price of 339 rupees per share. He wants to know if this is the right time to average. The stock is at 277. Shaina, your view on Advanced Enzymes, and is it a good stock to add more right now?
In fact, I would say that it is better to exit, switch from Advanced Enzymes. See, last 5 years, the stock has done nothing, either in terms of stock price, in terms of revenue, in terms of profits. It's been very stagnant. I don't see how it's going to change too much in the next maybe couple of quarters, 1 year. It has got good enzymes. It's got quite a big product portfolio of enzymes. It has got a lot of, markets it sells internationally, even US. But I think there is going to have a problem. So I would say exit.
Okay, you would say exit from Advanced Enzymes. And on the technicals, Advanced Enzymes, averaging is an option, or you would also say exit, Vaishali?
Because it's overall a very big trend, and even the longer term, even the monthly chart I'm looking at is showing signs of weakness. So I would say definitely exit and get into a better stock.
And get into a better stock. That's the word on the fundamentals and the technicals. Next query then for today, we have Ria Mehta, who's writing to us from Mumbai. She wants to know the target price of Hindustan Copper, Ashok Leyland and Asian Paints next 3 to 6 months. So Vaishali, I'm going to take this to you since she's specifically asking for targets that one could expect on these stocks in the next 3 to 6 months.
Definitely. So as we have seen that overall full metal sector has done very well, and especially talking about Hindustan Copper, very, very strong uptrend. And I think in spite of all the choppiness, though stock being in the overbought zone, the stock still holds strength. So I would say continue holding this stock with a stop loss of 520. And the next target, because it's quite likely we may see a breakout in this can go towards 620, 630 levels to start with. So this is how I would be looking at Hindustan Copper. As far as Ashok Leyland is also concerned, I think this stock is still holding very well. It's only consolidating. So I would say 178 should be taken as a support or and continue holding, because below 178, it would damage the trend. So and look for a target of 210 to 220. So it's very strong trend, and hold with these levels.
Okay, strong trend there. Holds with these levels over there. Let's move on then to the next query. Monica is writing to us from Noida, holding 300 shares of Aeroflex Industries. This is at a price of 191 rupees per share. Short-term view on the stock and the outlook. Shaina, your view on this one?
Well, I would say it's better to switch, maybe short term, medium term. Basically, they have got a huge exposure to the US market also. And I would say that its valuations also it's not that much in favor of Aeroflex. So I would say it is a switch.
Switch maybe to the sector capital side and industrial side sector?
Well, I would say that, there are other sectors that are doing better. So rather than, engineering, which actually could see some impact of imports from China, and I would say it's some other sector, not capital goods.
Okay, some other sector. And Vaishali, just a quick word, what would you suggest here? Stay or exit?
I would say continue holding for some time. Keep stop loss of 170, because it is once again at a very crucial support level of 170. So maybe we can see a good bounce and then exit at around 190, 195. That would be a better level. And otherwise, if 170 levels break, it calls for further weakness. So then you have to exit.
Okay. keep an eye out on those levels over there. But China as well as Vaishali, thank you so much for joining us, as always, helping solve all those viewers' stock-related queries. And viewers, you can keep sending us your queries. You have the phone number that's flashing at the screen for you all as well, on the top of the screens. Email ID is there as well. So do send us your queries and we will solve them Monday, Wednesdays and Fridays only on Your Stock. But with that, we'll wind down this edition of Your Stock. Thank you so much for tuning in. Up next, your closing bell to take you through the last hour of trade.
Lines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
So a percent higher on the Taiwanese index. The Shanghai Composite trading 0.3% higher.
Nifty still exactly at the 20 weekly moving average, which is what we've been putting on for the last several days now. So this is not a bad open at all. 75, settling down at about 70-75 points in the Nifty.
I believe we are coming out of 2 years of slowdown in consumption.
EBIT margins of 16.5, aspiration to get there by quarter 4 FY27.
We are expected to see marginal uptick in the profit growth, barring IndusInd Bank and Bandhan Bank.
This is the third largest component, which is Reliance, is holding well in the green ahead of numbers.
Consultation paper will be out very, very soon on this to allow them to net in some respects.
We are looking at
beyond content for growth, and that is what has really helped us this quarter.
The Nifty is well below the 25,800 mark, which we conquered today, back again.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me is Prashant as well as Mangalam. For the markets, we're trading in the green, but we're a distance away from the highs that we saw earlier today. The Nifty has come off. We're up only around 40 points. In the first half of trade, it appeared we were gunning away towards the 25,900 odd mark, but we have given it up from the top. Tech is the index that's been strong all through the trading session. Infosys, 29% of the Nifty IT index is on account of Infosys. If Infosys does well, then that's doing bulk of the heavy lifting, still holding with gains of close to around 5%. But it's a very big earnings day for the next couple of days. So you have Infosys that's reacting today, and there'll be pre-positioning on Reliance Industries, HDFC Bank, ICICI Bank, and throw in there Tech Mahindra as well as Wipro. So action-packed earnings day. Hey, gentlemen, what's up?
Hi, Mangalam, hi, Nigel, hi. And, not being able to hold on to pop, right? I mean, at one point, almost 200-point gain and just 20 points is show for it as we wind down and wrap up the week. Kind of in line, I mean, it's disappointing on the day, but I think it's in line also with what we've seen for the rest of the day, rest of the week, I mean, with the holiday thrown in between. Just not being able to hold on to higher levels and getting sold into once again. So 25,690, lots to talk about here over the next 60 minutes. Mangalam, hi.
Take that point. Today we had all the reason for the market to actually break out, try and attempt to break out at least, because the Nifty Bank was doing well, the Nifty IT index was doing well ahead of numbers, Reliance was holding on as well. But turns out that we are, in this broader range of 25,550 to closer to 26,000 as we move towards that 25,900 mark. Today's high also just about 25 points away from there. What's interesting is that, we are seeing some decline in the pharmaceutical names, yes, but that doesn't account for a big weight on the index. But the FMCG names, they're coming in for some selling as well. So pull up something like an ITC, that's lower. The pharmaceutical index is at the low point of trade right now. And even the auto names, something like a Maruti or an Eicher Motors, etc., they have been fairly well sold. ITC has been, lower through the course of day, and right now currently at the low point, as is the auto index. So good time to tell you what's lined up on the show right now. The market trims gains. The Nifty slumps below that 25,700 mark. The pharma pack feeling the heat. Cipla among the top drags on the Nifty. On the flip side, it's an earnings-led fillip for a lot of the banks today. The likes of Federal Bank extends gains following that strong earnings report, nearly 8.5% on that stock. And coming up in just a bit, we'll talk about the other high-flying packs of IT, Infosys, L&T Tech Services, both of them robust set of numbers, a detailed fine print of those numbers as well coming on Closing Bell. It's going to be an earnings-heavy weekend. The likes of Reliance, ICICI Bank, HDFC Bank, Tech Mahindra, Wipro, all of them set to report their results today, tomorrow, over the next couple of days. What should the expectations from these performances be? All of that coming to you on Closing Bell over the next 1 hour or so. But the big question, how should you position yourself in the last hour of trade? Mitesh Thakkar, as always, joins in. Mitesh, good afternoon. We've not been able to build on to the gains or the good, start that we had. We've sold off from there.
Well, that's right. I think very clearly, as I said in the morning as well, this is a market which is not showing signs of any kind of directional bias. So it's just chopping around. One day it's down, one day it's up. But on the upside, till we get past levels of 25,950 broadly, I think give it take a few points. I think till then, I think the structure will not turn positive, and therefore you will remain in a choppy kind of an environment with chance of and a strong possibility and a chance of testing 25,400. So that's the kind of view on the index. Therefore, not much happening on the index for the timing for me on the charts. Yeah.
Okay. All right. Mitesh, I wanted to particularly ask you about the tech index, the biggest underperformer of 2025. Any kind of good news is being well received. And that's why even in today's wibbly-wobbly trading session, you have Infosys that's doing bulk of the heavy lifting. 29% of the Nifty Tech Index is on account of Infosys itself, and that's holding its own. How are the charts looking both for Infosys and the Tech Index, if you have a view?
So I think, Nigel, very clearly, the Tech Index, is showing some signs of revival. And my sense is that if you look at the recent historical charts, we've seen the Tech Index, the Nifty IT Index, that is, peak out around this 39, 300, 500 zones. First, it happened in the June of 25. Then again, I think, in December 25. I think once we get past these levels, and there are certainly chances of that, I think the tech index could head towards 40,300, and in a good case, 42,000 as well. So the structure is positive. I would still believe that slowly the tech stocks will kind of reverse their underperformance, come into the long side.
All right, we'll come to you on shortly for the picks, etc. But in the meanwhile, just address Federal Bank. Big move is what we saw post the company reported its numbers, and now we're getting some commentary from the press release and the management commentary as well. Gaurav joins in with more on that one. Gaurav, Federal Bank, the street really like these numbers.
Well, yes, it seems that street actually appreciates any positive surprise that we saw in the stock price, and that is what happened in Federal Bank today. Because if you look at the numbers, street is expecting a stable quarter, but bank reported very strong quarter this time. And the reason being that if you look at net interest income, that increased almost by 9%, PPOP increased almost by 10%, and this was supported by the other income. And within other income as well, if you look at the fee income element, that increased almost by 18% on a year-on-year basis. It was above the street's expectation. As a result, coming to profit, that also increased almost by 9%, and that number may look in a single digit, but it was 4% ahead of what the street is expecting. Apart from that, net interest margin, that was a big surprise. We saw 12 basis point of increase in net interest margins. Now it stands at 3.18%, and even in terms of asset quality, the bank did not disappoint at all. In fact, gross NPAs declined almost by 11 basis point. Same was seen in slippages as well. Slippages came down to 0.7% versus what it was at 0.9% level. When it comes to advances, we saw 4.5% increase on a sequential basis. It was more or less in line with the street's expectation, and same happened in deposits as well. 12% growth on a year-on-year basis, in line with the street's expectation. But given that there was surprise in net interest margins and asset quality, street has taken it in a very positive way. Apart from that, let's also not forget about the ROAs. Now they have increased to 1.15%, and remember, by FY28, management was expecting ROAs to reach 1.4%. So it seems that they're actually heading towards that 1.4% mark, and it can happen anytime soon. Lastly, let's also not forget about the medium yielding segments. Management was very clear that medium yielding segment should contribute higher, and that is what we saw in this quarter as well, which was the medium yielding segment, which was 43% of the overall loan book. Now it stands more than 44%. So that is also something that they are improving. So all in all, very good set of number. They are also delivering what they had mentioned earlier, and as a result, that is something that we saw in a stock price as well today.
All right, Gaurav, thanks a lot for that. Let's go back to Mitesh. I think his picks are left. Mitesh, your picks for this hour, and also a call on Federal Bank.
No, Federal Bank I'll avoid because we have some positions, so I'll avoid commenting on that. But on the stock side, HCL Tech is a buy with a stop at 1677.75 for targets of 1730, 35. And Asian Paints, it's a structure which has slightly grown negative in the last few days. So I'm just waiting for a breakdown. The trigger will be if the stock starts trading below 2740 or about 14, 15 points away from there. So if it breaks 2740, go short with a stop at 2770 for targets of 2680.
All right, take that point. Just as we speak, though, the tech pack continues to do well. Tech Mahindra up around 5.5% right now, up at the high point of trade. AU Small Finance Bank as well, doing fairly well, up around 5% for that counter too. But speaking about banks, let's hear out the word coming in from the management of the PSU lender, Union Bank, on what they expect with respect to the net interest margins going forward. Listen in.
So we said we want to defend it, and yes, aspiration is to improve further. Actually, we worked upon the efficiency ratios in this entire quarter. These measures on the asset and liability side, we could maintain it. So now I feel that still next 2 quarters, we certainly possibility is there for further, but then we would like to defend at this level because we do have opportunity, of some re-rating of the deposits and maybe some shedding of some few more bulk deposit at higher rate.
Okay, all right. Well, let's go across to Gurmeet Chadha, Managing Partner and CIO at Complete Circle, who joins us on the show. Hi, Gurmeet. Good afternoon. Good to see a couple of earnings surprises at least. Federal Bank did well. Union Bank actually did bounce up and trade a couple of trading sessions ago. What's your preference from the pack?
So, Nigel, we discussed Federal since Mr. Manian took over. So there was a leadership change, and I think what they are also doing is delivering on what the roadmap was. So pretty strong set of numbers. I think the NIMs expanded, asset quality was better. As a result, everything grew. So if you see the core POP, CASA improved, and everything got reflected. And I think with the cost of funds further likely to come down, I think there is some more room for interest rates to fall. I think the bank has really re-rated from about 1.1 book value when he was sub 200, and now trying to catch up with some other private banking players. So I think very steady set of numbers. Also, the environment has been very supportive with a lot of FDI coming in, whether it's been Federal, RBL, some of the leading NBFCs. So we remain overweight financials. I also think some of the large private banks are due. We have almost 25% of Nifty earnings between today and tomorrow with Reliance, HDFC, ICICI. I think that could decide the next charter for financials, but we're pretty overweight. And I think even the capital marketplace, I think if NSE, NOC comes in time, I think there'll be some bit of a boost there as well.
I take that point, Gurmeet. Also, the greetings for Lodi to you and your family, as well as all your colleagues. Just wanted to understand if you have a fresh view on IT after Infosys numbers, because extremely under-owned, a lot of people are worried about how things will pan out for them, but things are good at a price, right?
Yeah, absolutely. I think the numbers were better than what I think it's completely under-owned. There's not much expectation with IT, and I think HCL initially and then Infy surprise. So what happens is when you are under-owned or let's say net short at a technical level, even a small positive surprise can be a boost, which is what happened with Infy. And in fact, I found HCL numbers better. And I think there's one area which probably will need more analysis is their software business. It contributes 11% to the revenue, but almost 22% to EBITDA. And that's how the overall blended margin goes up, and that business looks very good. So it's much more diversified than just clubbing the entire large cap IT with US exposure. I also think the earnings of Coforge, especially what they have done with a very ambitious acquisition, Persistent, and some of the better mid-cap names would be essential. But any positive surprise in earnings can lead to a bit of a tactical bounce. So some part of the portfolio can be on contra and under-owned plays like materials, chemicals, bit of IT, where you have valuation comfort and good earning visibility.
Absolutely. And I think we'll see, you mentioned a bunch of acquisitions. I think we'll see more this year because, TCS, by the way, made a very large acquisition. It's a $700 million acquisition late December. There's, Coforge, as you said, and maybe a lot more coming. Basically, trying to bridge the gap with AI-led firms, and but of course, I mean, none of them come cheap. The TCS one, a very large one. They paid some 5 times sales. With Coforge, for example, some question marks at the margin as well. But I think more and more firms, I guess, on the M&A path, as they realize that they need some of these technologies, if not in-house, buy them to fill these, so-called white spaces in that sense. Let's stay with IT, right? And I guess let's round up numbers from Infosys and L&T Technologies. Rima is here with just a quick fine print view. Rima, over to you.
So it's a tale of two cities when you look at Infosys and LTTS. Infosys has delivered a good Q3 ahead of estimates. FY26 guidance has been raised to 3.5%. And plus, the management sounds upbeat about the financial services vertical. Brokerages have raised estimates, their growth forecasts. CLSA is saying that next year the company will grow at 6.3% versus their earlier projection of 6%. Jefferies has raised EPS estimates, and Jefferies says that the EPS growth for the company is likely to be 7.5%. Analysts we spoke to also pointed out that on top of this EPS growth, it may be 7.5%, but there is a dividend yield that IT companies provide of 3-4%. So if you add the two, then there is a possibility of a 10-12% kind of return, pretty steady, especially when you put it in context of the valuations, which are not prohibitive. The stock trades at 21.5, 22 times forward multiple, and the stock has underperformed in the last 1 year, down close to about 10-12%. LTTS, on the other hand, is getting impacted because of a very conscious decision taken by the management to recalibrate its entire business. So they said that they assessed the full portfolio. They met with the strategic Advisory Group, all their clients at MIT Labs, and they took stock and they found that certain parts of their portfolio are getting commoditized. They are low margin business, and therefore the company said that we took a conscious call to exit those low margin businesses, deprioritize certain geographies in the technology vertical in Europe and in India, and pivot towards higher margin. So that's getting reflected in the numbers. Revenues declined 2.8% in Q3. The full year guidance was also brought down to mid-single digits, but margin performance will be stronger. So the company's margins expanded in Q3, and they're talking about an aspiration of 16.5% margins by Q4 FY27.
Rima, thank you very much for that. That's IT for you. By the way, another name which is selling off sharply is Hitachi. Hitachi is the number 2 volume-led loser on the NSE. It's down another 4 1/3%. The high last month, the high in December was 23,000. Stocks at about 16,000 now. Any thoughts on this space, Gurmeet?
One thing, Prashant, not really specific to Hitachi, but in general on capital goods and EPC plays is that I think there is a sense that the budget would be more with the fiscal constraint, more on the consumption side and more on ease and operational easing and reforms and bit of a tweaking in customs and maybe STT if or LTCG at some point of time. And there could be a slight moderation in the overall capex spend. And obviously it's a function of what numbers and all we do. So you got to wait and watch. So you could see a bit of a pivot towards more consumer names and more material names, and maybe within EPC or infra, maybe some of the power transmission name, because that's where the big bottleneck is. And in terms of transmission, I think the private transmission capex is hardly 8-9%. The government would like to boost that. That's a big bottleneck. So that you have to be a little watchful of. So there could be a small bit of a softening or rotation leading up to budget, maybe from capital goods and more EPC plays towards some of the consumer and other names.
You mentioned STT and LTCG, etc., with a wry smile. Gurmeet, any serious expectations? Or no?
No, I think I think somewhere this kind of supply pressure is very difficult to absorb, Prashant. So just see the kind of redemptions we have had, and I think some point of time we may consider either on STT in terms of reducing the cost of transaction, or maybe having a slightly different view to long-term patient capital. So a lot of the endowment funds or pension funds globally are not taxed the way we have started doing after 2018 when we increased LTCG. So I'm not speculating. I'm saying something could be relooked at. And also, I think if you see there's a just flash on reaching out to some of the FPIs in terms of netting of cash transactions was to be done. So I think a little bit needs to be done to attract patient capital. We are a growth-hungry nation, and I think if something goes there, it can quickly reverse the sentiment.
Something that's growing right now, it's a lot of these value retail players. Look at Bazar style retail. It's up 19% with decent volumes as well. Remember, the company reports its numbers sometime next week, 20th if I'm not mistaken. And at the same time, they're also looking at fundraise. The volumes today are what? 40 times average of what we've seen on the stock usually. So about 1.5 crore shares traded on Bazar style retail already. Gurmeet, V-Mart, V2, Bazar style, or you would look at something like Trent or D-Mart, the good old D-Mart?
So, we are a little more towards the new age consumption names. I think many dips we've added return on. We are looking at some of the more premium consumption plays. I think even the consumer durables space has seen sharp correction. Let's say, for example, LG, after a stellar listing, has been very soft. And I think last quarter should be better, and the business is less cyclical compared to the Voltas or the Blue Stars of the world, because they have a portfolio across OLEDs and refrigerators and washing machine, and the premium portfolio does well. So we are more inclined towards that than pure retail names. Trend, obviously, I think is a bit of a de-rating going on with now growth being more at 15-18%, so still expensive. So we are more positioned there, and anything to do with more premium consumption and new age is something we are more positioned in.
LG that we're talking about here?
Yes, LG Electronics we've added in the recent correction we've added. I think that's a more structural play on consumption picking up, GST benefit playing out.
Right.
And as I said, their premium portfolio is inching up. Their market share, whether it is OLEDs or the double door refrigerator or high-end products, is almost 40-50% in most places.
And when you say new age, you mean any of these current listings? The likes of Meesho, there's Lenskart, there's so many.
Yeah, so we have Eternal in the portfolio. We have a bit of Paytm there. We added Grow around 140 odd levels. We are looking at Meesho at probably slightly more better price point if we get lucky.
All right, take that point. Always a pleasure speaking with you, Gurmeet. Thank you so much. Have a good weekend. We'll speak to you post all the big earnings, 25% of the earnings that you're talking about on the Nifty. Take a short break, come back. On the other side, the Alpha Manager of the Day, Vaibhav Sanghvi of Ask Hedge Solutions joins in.
$20 points higher. I mean, I should say only 20 points higher because it was 200 earlier. 25,690 is where we are at. We are, of course, getting into the last 40 minutes of trade. Vaibhav Sanghvi is CEO, Ask Hedge Solutions. Vaibhav, good to have you with us here. Thanks for joining in. I was asking about these power equipment companies. Actually, Hitachi's down sharply, but look at GE Vernova, another 6% lower. CG's lost, I think, from 800, 900 levels, stocks down to 550. Very sharp falls across the board. Gurmeet was with us and he was saying that maybe one reason is the budget's expected to focus more on boosting consumption away from capital goods, etc. But I think there is this Chinese equipment players being allowed for government tenders, etc., which is also a factor. Any thoughts on at what price do some of these become a little more attractive? CG especially, right? I mean, CG's building out other businesses. I mean, this is just one business, the transformer business. They got a railway business. They're, of course, doing the OSAT business, which is a new one, but one of the few companies which has got central government subsidy. What's your sense, Vaibhav?
I think, first of all, thank you for having me. But, from a sectoral standpoint, which you rightly pointed out, I think, from our perspective, the trigger point has been, from the market buzz about the Chinese equipment makers being allowed to kind of participate here. So that has kind of spooked off, especially on the industry perspective. Not that the order books are, not good, or probably the profitability matrix is not good. I think everything of that is in pretty much good order. In our view, which is slightly different from the street of what it is kind of showing, our view is basically data center is going to be an extremely big opportunity, and anything to do with the data center, including the equipment or probably power companies and the grid to kind of supply that. I think it's going to have incremental kind of capex coming about. So it's not only about the government putting in that money, but about the private companies who are going to spend a lot in this whole segment as well. So we do like this space. Unfortunately, in the last fortnight, I think it's kind of got marred by the whole buzz about these Chinese equipment. But that buzz has to be clearly seen with the context that there were supply shortage of certain equipments, from an overall grid perspective, and that is what that is what came from Chinese guys as well.
Right, Vaibhav, at the start of this year, we spoke to a bunch of market makers, intellectuals, and all those who 90%. You were in the camp that you believe that the market over the next 3 years can actually give you more than 50%. What drives this optimism, and what sectors would drive this growth?
See, I think the way to look at it is basically that from an overall perspective, last 1.5 to 2 years, we have compressed in terms of the PE. Second, from an FPI ownership in India, we are almost a 15-year low. Thirdly, it is also largely driven by the overall AI shift towards China, Korea, and Taiwan. Our view is basically that in the last 1.5 hours, where we've seen the earnings pretty subdued, in fact, earnings downgrades kind of happening. I think that kind of stabilizes, and we look up from here onwards in terms of the earnings. Lastly, the GDP growth, which again, we'd seen some very dull period in the last year. I think it's been on the recovery trend, at least for the last 2 to 3 quarters. To be very honest, the earnings kind of lag the GDP growth, and I would continue to wish for more nominal growth coming into the play. But as things stand, our view is that we are at a cheaper valuation, the earnings growth stabilizing. For the next 2 years, we are looking at about 14 to 15% earnings growth. So in all likelihood, I think we should be following the earnings growth trajectory, which is nothing new, but just the historical perspective where markets continue to follow the earnings growth. And in our view, it is more of an earnings growth story with slight amount of PE re-rating, which makes me optimistic for the next 3 years.
Vaibhav, forget about the upside. What about the downside from here? In the last few days, this call of, barking up the wrong tree, we're getting too optimistic. FI holding last year, 14-year low. This year, it's a 15-year low. That's the kind of selling that we have seen. Earnings growth pick up, yes, that is the hope. Nominal GDP, yes, hopefully it goes to double digits. All that is known. But that call for maybe seeing a swifter correction, the broader market staying in pain, and maybe headline index corrects as well. What are the odds? Sometimes when these voices get a little louder, it's not such a bad thing. And from there, sometimes the market does reverse. So if you put out downside on the index itself, what do you think? How low can we go from here?
See, I think, Nigel, to look from your perspective, I think you're right in terms of saying that the FPI has been the pain point, from an Indian market standpoint. And it's not only about last 6 months or probably since the Trump kind of announced the tariffs. It is actually, if you look at it, it is happening right from 2022 onwards, wherein the Fed has started to increase the rates. Now, looking at a broader perspective, when the rates should have come or had come down, the logical conclusion would have been that emerging markets should have witnessed some inflow, which we didn't see. And the point is basically, because of that AI trade, it shift seen that shift of flow, probably from India or not allocating towards India and going to China, Taiwan, and Korea. And that also got coupled with your earnings dullness, growth dullness, and which is why, or cumulatively, we didn't see any action from the APIs. Having said that, whether this can continue for a few more months, of course it can continue. We do not know the timing of it. But all in all, we can see that the variables surrounding it are actually getting in place one by one till the time that somebody would not be able to ignore a good growth story. So my guess is, and that's why we say 3 years and not probably 3 to 6 months.
So you think that we're closer to the end of the painful period? Would that be fair?
Yeah, provided if the earnings kind of not start deteriorating, honestly, because if earnings start deteriorating, then markets will follow that.
Hopefully, we get those mid-teens growth, at least that 12 to around 15%. Then the markets at least will be at least steady, if not move up. You were talking about value a couple of times during this conversation. 2026. What is that one sector that you're very, very bullish on? You mentioned data centers as well. You want to drill it down a little bit. That one theme that will actually play out.
So, Nigel, again, I think not only one theme, but few themes. One, of course, data centers and anything relating to data centers. Maybe it's cooling equipment, or maybe it is power and utilities. I think that's a segment to watch out for. In addition to that, I think banks on an overall basis, after mediocre growth in terms of the earnings, pressure in net interest margins, I think things are stabilizing with credit growth looking up as well. So, of course, that will also get influenced by the amount of FPI flow which comes into it. But that is something which, from a fundamental perspective, we are liking it. In addition to that, CDMO players are the guys we still are kind of very keen on. So overall, apart from the consumption, which we have been seeing for some time, these are the sectors looking good for 2026. Is
there anything that you don't like? Something that you believe has maybe either run its course or perhaps has no future triggers in terms of the growth expectations?
See, if I see from a sectoral perspective, pharma is coming under a slight amount of pain, and purely because of the generic players who has a sizable exposure to a drug which is Revlimid. So my sense is basically, I think you will see pressure on those numbers continuing through this year. Pharma has been a good sector, in the last 2 to 3 years. I think this is a time to get pulled off. In addition to that, I still don't understand the overall, rally from a base metal perspective in a light that, the global growth is not very encouraging. Now, we'll see where it kind of ends, but when it ends, I think that can be a little ugly as well. So I'm not preempting it. We'll wait for those kind of corrections to take place to see what we can take in terms of a view which is constructive on the negative side.
Look at the currency go, boy, 90.84, and it is under pressure. And how?
That's what
once again, so it's just going one way, right? I mean, actually, if you keep if you put this chart and put the Nifty chart, it'll be exactly the opposite. I mean, this kept going higher, the dollar rupee across, and the Nifty, of course, sinking on the other side. So that is that. We'll maybe try and get a voice in from the Forex side in a little bit from now. Thank you very much for joining us, Vaibhav. Appreciate your time here. There you go. I think that's pretty much, it does the job, right? I mean, tells you what has happened today. Let's talk about what the FNO positioning is changing and how is it looking now. At an extreme, especially FI shorts, etc. Nigel, take it away.
Well, that's right. The FI shorts are extreme levels, but the PCR has got some distance to go because in the last 10 days or so, we saw it going down to around 0.62, and from there we saw a bounce. Last time I checked, it was at around 0.76, so it has some room to go on the downside, though the call writing is getting rather aggressive. And that's clearly evident in today's trading session because, as you all mentioned, yes, the Nifty is up. But take a look at the 25,800 call. You've got the direction right, but the premium, in fact, is down by close to around 6% or thereabouts, telling you writers are at play out here. While the 25,900 call as well, there's a bit of mixed activity out there as well. So though you're getting the direction right, you're not making any money if you're buying those calls. So the writers, well, they are at play out here. The level that you're looking at, recent low, ballpark around 25,450. That's the level you don't want to break on the downside, because otherwise you're calling for the 200 MA, which is closer to around the 25,000 odd mark. On the upside, 26,000 mark. That's going to be a very, very firm resistance. 20 DMA, 50 DMA out there. Options data as well suggesting that, out there at the bears, they'll come in to fight and protect that 26,000 odd mark. Individual stocks are in focus. Yes Bank. That stock is coming for a bit of a short covering bounce today. So the banking index itself is doing well. And some of these smaller banks, whether you look at Yes Bank, whether you look at PNB Bank, both of them are seeing a bit of a short covering bounce in trade today. And from the broader markets, the metal index actually has come in for some selling, but it appears more it's unwinding of long positions. Case in point being Nalco. That's seeing some unwinding of positions. The stock is down 2%. You have open interest as well down. In terms of stocks that are seeing buying, Federal Bank stands out. Fresh buying being seen on that particular counter. So the day has been, a bit of a sluggish one. Though the Nifty is up close to around 40-50 points, you are seeing the call writers are at play, telling you that belief is still not there that we can go ahead and conquer the resistance levels. So the 500-point range is maintained despite the Nifty Bank firing away all cylinders. Back to you.
Take that point, Nigel. Thanks a lot for that. Sometime during midday when the Nifty was closer to that 25,870 mark, the put-call ratio had moved to almost 1.2. And from there, it's retreated back against to 0.76 right now. And as Prashant pointed out, the rupee at the day's low along with the market. We'll take a short break, come back on the other side. We'll tell you what the dealing rooms are saying in our special Day Street Chatter segment. Also, get you the tomorrow trades.
Welcome back. You're tuned into Closing Bell. The rupee at the low point of the day and the Nifty as well has come off the highs. Gives you a sense in terms of sentiment right now. Good time though to find out what's going on in D Street Chatter. Nimesh joins in to tell us. Nimesh, what's the buzz in the dealing rooms? The bulls must be getting frustrated. Yeah? Even on a day like this when you thought you were going to be flying away, come off the top and plenty of pain in the broader markets.
Well, absolutely. Nigel, so market off day is high, but there is still a lot of momentum. So IT has done well today. Bank continues to outperform. So IT index is up 3% thanks to the Infosys numbers, and that's actually led to a bit of a short covering bounce in the other IT NIMs as well. And on top of it, we have Wipro and Tech Mahindra numbers. So again, that's something to track. I guess earnings is a big thing to watch out for. We are seeing a big reactions to at least decent sort of earnings. So Federal Bank is a classic example today, up 9-10%. On Wednesday, we saw a big reaction to Union Bank after the numbers. So clearly, because all the prices have corrected so much, a bit of good news, and the market is rewarding as well. So that's something to track going forward. I guess for Monday, the Nifty will be in focus largely because of the big earnings from the large caps. So Reliance, ICICI Bank, and HDFC Bank all gets reported over the weekend. So if all the three support the bulls, you might see a big rally on Monday. So that's something to watch out for. Technically, 850 is a level to watch in the upside. That's been acting as a big resistance as well. So need to see on Monday if that gets taken out. Then you might see a further short covering rally. But I guess while a bit of profit booking in broader markets, I guess a bit of a Friday factor as well. But there is clearly momentum in banks as well as in technology names today.
All right, Nimesh, technology names is where some buying is. Apart from that, any individual stocks which could be in focus?
Well, so the first stock on my list is AB Capital. That's been buzzing off late. In fact, if you look at the recent shareholding pattern, some of the domestic mutual funds have added as well in the last couple of quarters into AB Capital. And now there is a very strong buzz that post earnings, you might see a corporate development as well, a potential fundraising in one of the subsidiary business. That's the buzz as well as far as AB Capital is concerned. That's the first name. Pine Labs is the other stock in focus. Off late, we've seen a bit of momentum back. I understand some large HNS have bought as well. The volumes also picked up, and again, there is some sort of sense that maybe momentum is back in Pine Labs. So that's buzzing off late. The third name is Federal Bank. You spoke about the earnings, and it's been a big quarter in terms of very strong earnings. But apart from that, I understand leading family office has been accumulating Federal Bank off late. So there is delivery base happening in that particular stock in the last many weeks. And the last name is Sun Pharma. Again, within the pharma name, this has been under pressure of late. I highlighted a few days back as well. There is a very strong indication that maybe the company is going for a very large acquisition overseas. And that's the reason why the street is a bit nervous in Sun Pharma of late.
Okay, a bunch of these large acquisitions in the pharma space, right? I mean, at least that's what I think we've been indicating towards. Sun perhaps a bit under pressure. Thank you very much, Nimish, for that. Well, I just get you the trades as we go into Saturday and Sunday. Mitesh is here. Mitesh, what's the recommendation?
I think Infosys has spent the entire day with strength, and now near the day's high. I think VTST with a stop at 1677 can be taken with a target of around 1710 on the upside. And Kotak Bank is slightly closing with weakness, so we'll take STBT here with a stop at about 421.5 for targets of 412.
Okay. All right. So those are some specific short-term sort of trades. Now, we are, of course, awaiting numbers from Reliance and the banks, etc. But there is the other big result, which is also trickling in, which is the BMC closely watched Mumbai Municipal Poll results. Sante has got the latest with all the leads, trends, etc., which have come in. Sante, what does it look like?
So now it's clear that BJP and Eknath Shinde's Shiv Sena have emerged victorious in these BMC elections and will be able to appoint their mayor to Asia's richest civic body. BJP has clearly stolen the show here. BJP has not only cut Thackeray brothers to size, but they have also outperformed their own ally Eknath Shinde's Shiv Sena. Now talking about these elections, BMC elections were held after 9 years and after a delay of 4 years. In 2017 also, BJP performed very well. In 2017, when the last BMC elections were held, at that time, Shiv Sena, the undivided one, Shiv Sena won 84 seats and BJP won 82 seats. An impressive number for BJP given the dominance the Thackeray family and the undivided Shiv Sena had over BMC at that time. But now things have clearly changed, and based on the numbers so far, BJP and Shiv Sena, especially BJP, have emerged victorious and will be able to appoint the mayor to BMC.
All right, so the leads are now clear. It is BJP and Eknath Shinde-led Shiv Sena which would be appointing the mayor of the Mumbai Municipal Corporation. Let's go across to Sudeep Bandyopadhyay, who is the market expert who joins in now. Sudeep, BMC elections, do you think there would be any sort of rub-off on Mumbai-based real estate players? That's something, that everyone wants to speak about. And the other part would be any of these Mumbai-based infra companies? Do you think there could be any fresh tenders awarded, etc.? Is there a play there?
Not too much, Mangalam. I think, effectively, the government had been running BMC for the last few years, and a lot of activity as far as tendering has already happened. I'm sure the momentum will continue, and that's good news as far as these companies are concerned, both real estate as well as the infra companies. I think the development pace will be maintained, probably even get accelerated. So I think it's good news for these companies, but I'm not seeing anything significantly incremental happening as far as these companies' fortunes are concerned.
Okay.
Nigel, what we're going to do is just take a quick look at the rupee, and we'll come back and get more opinion as far as individual stocks, etc., are concerned. I think Lata is with us. Okay, she should be with us in just a bit. I mean, it's a big one. I think there's some recovery in the rupee, right? 90.84, 90.76 now. So
it's interesting is that Ritu this morning had told us that when the rupee moved from 90 all the way up to 90.34, 90.44, she said between that period, there was no any help coming in or support coming in from the RBI as well. And from there as well, the rupee's only worsened. And, it's closing in on that 90.8. Just that big positive tick that happened from 90.84 to around 90.76. We don't know whether it's some big bank support which is coming or not, because, that would have meant a much stronger pullback. But that's not happened. The intervention hasn't happened yet.
And Lata's been working the phones and speaking with dealers, etc. And she'll be able to tell us if, this is the RBI supplying some dollars. We'll go to her in a bit. Well, Reliance will report numbers later today. And let's get a quick snapshot view in terms of what the expectations are looking like here. Sonal is joining us now. Sonal, over to you.
Well, it's expected to be a strong quarter this time around, but let's talk about the stock move first. The stock, remember, is down around 6% in last 1 month, but in the month of January, it did hit its record high level, came in at around 1,611 rupees a share on 5th of Jan, and the stock trades at 27.2 times FY27 EPS. In terms of the consolidated expectation, revenue is expected to fall by 3% on a quarter-on-quarter basis, but the EBITDA growth will be decent, 5% on a quarter-on-quarter basis, leading to a margin expansion, which is expected to come in at 19.45%. Profits accordingly will see a growth of 6.6% to come in at 19,365 crore rupees. Now let's talk about the segments. It's the oil to chemicals business this time which will drive growth for the entire company, and this is because of strong GRMs. Singapore GRMs, they are up 97% on a sequential basis. However, weakness in oil and gas segment is expected to continue because of lower volumes and pricing as well. The festive season demand, that is something which will aid growth for the retail segment. And if we talk about the Geo business, that is expected to see a growth of 16% on a YOY basis, 2% sequentially because of higher ARPU and also subscriber growth. Overall, we'll be watching out for some announcements. Clarity on the new energy business, expected to see more capacity coming by on stream, growth in retail store additions, and any pricing action in the telecom business. These are some aspects that we'll be watching out for in the management commentary.
Okay, all right. That's Reliance for you. Polycab numbers are coming at the bottom of the screen. 7636 is the revenue. It's, about 1,000 odd crores higher than what the CNBC TV poll suggested. And I think EBITDA, though, is largely in line. 970 crores compared to about 980 crores, which was the expectation. 620 crores is the net profit. And this compares to 644, which was the poll. I think we'll have Upasana join us in just a bit with more details on this one, margins, etc. As we
Sense that the margins will be lower than the polls, largely because the revenue is higher and the EBITDA is largely in line. And the factor that could play out is input prices. We've been talking about how copper prices have seen a big surge, etc. So maybe a large part of the revenue growth would be value-led as against volume-led. And we'll get more clarity on those numbers, which is what explains why the stocks also lower post its numbers. Not that it's gone great guns either in the recent past, but it's lower post numbers despite a revenue beat, because that may largely be a value beat, not a volume beat. And the EBITDA in line with expectations implies that there is margin compression. And at the same time, okay, there you have it. Margins at 12.7% versus a street expectation of 14.5%. And there is disappointment on the net profit as well. 620 crores as against street expectations of 644 crores. But
these cable and wire companies, Mangalam, I think, as we've spoken with many of them, right? The copper price thing, it'll show up in the revenue.
Yeah.
But will it hurt I don't think that is the reason for the margin because it's passed through. It's completely passed through, straight up.
That impacts volumes.
Volumes is the problem, but here I wonder why that is the case. But maybe Polycab, of course, is not just cable and wire. They've got the
FMEG business is in the green. That's in the green. I had a look at that itself, and it's improved actually the FMEG business. So the miss has not come because of that. But there's another smaller part of their business, which is the EPC business. So it's a small part of their business. There is some margin pressure out there. And obviously on the core business as well, the big top line growth, the profitability has not kept up out there. So FMEG continues to remain in the green. I think the last time the management had told us that as well. Broke even in the September quarter. They said it will stay in the green. That's what's happened out here. On a year-on-year basis, FMEG delivers a profit versus the loss. But I think the other verticals, there is some kind of margin pressure out there. So the top line growth is good, but the margin compression is something that the street will be a little bit disappointed on. We'll have to get the trajectory going ahead.
Absolutely. We'll have our a research team also join us in a bit with more. The rupee's fall and then slight recovery, right? What's at play? Lata is joining us with some intel. Lata, over to you.
A rather bad day for the rupee. It's fallen by about 0.6%. Which is unusual. I mean, over 0.5% fall is certainly not usual. And what's unusual is that other currencies have not fallen. It's basically, once again, the worst performing currency. The immediate trigger could be the December trade data. Not that it was as bad as the September or the October data, but it's still showing the pressure. You know, November trade deficits have fallen by 7% in December compared to November, which means the pressure is beginning to tell. Who is to say that things don't get worse? Electronics and services exports, normally good numbers, they're good, but they're not outstanding, not enough to beat the blues. Then that is the current account, but look at the capital account. We've been continuing to see capital outflows by FPIs, and the market suspects that today is going to be yet another 500 million kind of sale. Every day is about $500 million in the past few days. And today, to counter it, the usual RBI dollar supplies have been lacking. Is the general market chatter? We don't know. Anecdotally, that's what dealers tell us. So just for the record, the all-time low is 91.07 rupees per dollar, hit on December 17th, and the all-time closing low was hit the day before, December 16th, at 91.03. Still a distance away from that, but looks very much like in sight.
Looks like that, Lata. Just moments ago when we were looking at the rupee, it had come a little off the lows of trade at around 90.72 thereabouts, but that decline has, or rather that appreciation has been sold into back around that 90.8 to the dollar for the frontline index. Meanwhile, the cut on Polycab deepens a little more. It's down about 3.5%. When the numbers hit the screen, it was about 1.5% lower. We'll take a short break. In fact, there you have it. It's a vertical decline that we've seen on Polycab. Take a short break, come back, more market talk lined up on the other side. All right. We do have the Nifty just holding around the 25,700 mark, and the Midcap's actually given up all its gains. The story of the day can be looked at in the advanced decline, right? For most part of today's trading session, we had more number of stocks advancing than declining. Sometime in the middle, those lines did intersect, and now as we speak, around 1,700 stocks in the red for about 1,200 in the green. But big numbers coming in over the weekend. Gaurav joins in. He has ICICI Bank. What's the street expecting this time around?
Yes, if you look at ICICI Bank, street is expecting around 11% growth in terms of loans and around 8.5% growth in terms of deposits. Now, I'll tell you the numbers, why they expect this. 3.5% on a sequential basis is something that the street is expecting, but we may see a positive surprise here. And the reason being that if you look at a system level growth, it has already been at around 5% in this quarter itself. And that is the reason why, given that ICICI Bank has a tendency to outperform the market, we may see some outperformance here as well. Apart from that, net interest income, PPOP, we may see a stable growth here. Profit is likely to increase just by 5% on a year-on-year basis, and the reason being that this quarter is specifically higher, expected to be higher in terms of slippages because of the agri loans that they provide. Because Q1 and Q3 is usually seasonally higher, and that is the reason why credit cost is likely to increase. But at the same time, street is also expecting net interest margins to expand almost by 3 to 4 basis points, and the reason being that first is CRR rate cuts, and second is the deposit mobilization and the deposit repricing that is happening throughout the industry. Other than that, a key thing to watch out for is the commentary on the clarity of MD and CEO, Mr. Sandeep Bakshe, because remember, his term ends in October 2026, and any clarity on that is a key thing to watch out for. And other than that, commentary on growth and margin is also something that street will be watching out for. But all in all, in terms of number, stable set of numbers with no negative surprise is what we're expecting from ICICI Bank this time.
Gaurav, thanks very much for that. That's ICICI. What about HDFC, Gaurav?
Well, for HDFC, we have already seen advances and deposits growth, but we also witnessed that the market was not happy with the LDR ratio, which crossed that 99% mark because management wanted to bring that LDR ratio below 90%. So now, when it comes to numbers, they're expecting around 7% growth in terms of net interest income and profit. When it comes to PPOP, which is pre-provisional operating profit, we may see this number going as high as 9%, and the reason being that we may see some support coming up from the other income segment. Apart from that, net interest margins, here also the street is expecting 6 basis point of increase, and again the same reasons, CRR cut and the deposit repricing that is happening across the industry. And credit cost, we are likely to see a stable credit cost in HDFC Bank, but once again, agri slippages and any commentary in terms of agri loans is something that we will be watching out for. Again, in HDFC Bank as well, beyond numbers, the commentary is going to be a key thing to watch out for. And the reason being that, as I mentioned earlier, LDR ratio, which has crossed 99% mark, how management sees this LDR ratio coming down, because street is very concerned about the growth going ahead. And apart from that, the loan book outlook and the net interest margins outlook is something that we will be watching out for from comments. But all in all, in terms of numbers, once again, a good set of number is what we're expecting from HDFC Bank in this quarter.
All right, Gaurav, thank you very much for that. That's ICICI and HDFC Bank, both in focus. By the way, the rupee is collapsed again. 90.76 or so when we were talking to Lata. It's back at about 90.86, I think the last I saw. 86.50. Yeah, there you go.
No intervention.
Sharp recovery, and then it's basically turned around just like that. 35 points is what you have as far as the Nifty is concerned. Sudeep, we just had the Polycap numbers, and we were talking about the Hitachis and the GE Vernova and the CG Powers of the world. One factor that just struck me is, of course, copper. Copper is critical to all these companies, right? There's all this China talk and this budget and what will happen, but you think there's a bit of a worry that margins perhaps will be under pressure across? I mean, actually, it'll be interesting to get a list of companies where copper is a significant part of the raw material list. These three, I'm assuming, transformers, any company, I guess copper will be. Your thoughts?
Well, Prashant, you're absolutely right. I think the way the copper prices have been going up will definitely put pressure on a whole lot of sectors. Some of these you just named. I'm also worried about the overall, the metal scenario, because while we are enjoying the bull run in the metals and metal-related stocks are doing very well, and if you have investments there, you are kind of making money. But the fact remains that even look at tin. I think after a long time, there is a rally in tin, and that again is a critical component in many industries. And we normally don't track these metals so much. So definitely we have to be very, very careful. While all the analysis we didn't factor in that earlier, But now I think time is coming where we have to factor in, this kind of shocking rise in metal prices and a whole lot of them. Look at what's happening to aluminium, and I think it's expected to remain where it is. Of course, we have seen it getting played out in silver. I'm not talking about precious metals. I'm talking about silver, which has a use in industry as well. So industrial use of metals, while it has been increasing, the metal prices have been sharply moving up, and it's definitely a matter of worry. I'll be definitely worried about the consumer durable industry, which uses quite a lot of them. And we were expecting good times for consumer durables. So I think this is one worry. EV also needs to be careful about, because a lot of these are used for EVs.
Right, take that point, Sudeep. Thanks a lot for that. As we speak, Lemon Tree, that's moved to the low point of trade. There was a note this morning that came in which suggested that maybe, this demerger exercise does not unlock a lot of value, largely because the resultant players, one of them will have holding company discount for Fleur. So as a result of which that stock's lower. We are seeing some declines from the highs on even Bazar style retail. When we spoke about it, it was up 18-19%, now holding with gains of just about 7%. Landmark is the other one, which is down 8%. But all in all, let's start wrapping. It was one of those days where the markets started off fairly well. At midpoint was closer to that 25,900 mark. Thereafter saw a sharp sell-off from the highs, led lower by a couple of these consumption names. And we also saw the pharmaceutical index not do particularly well. Reliance itself going into numbers with a bit of a cut from the highs. What led the day today was the IT index. Infosys, top of the pops, up around 6% higher. We have Tech Mahindra up around 5% as well. LTI Mindtree up 4.5%. The IT index at large did extremely well. Midcap IT even better. The earnings of the day definitely on the way up. We had Federal Bank up nearly 10%. Good performance from a couple of these capital market plays as well, the likes of Angel One, etc. But on the way down, again, like IT was doing extremely well. L&T Tech Services, the street did not like those numbers. The stock down about 8%. And towards the end, we got Polycab's numbers. Those stocks, along with Polycab, all the other cable stocks also saw a bit of a sell-off. Polycab ended about 4% lower.
Okay, well, that's the end of the day and end of the trading week as well. 36 odd points higher for the week, nothing. Nil in terms of change Friday to Friday, at least as far as the Nifty is concerned. But for the broader market, Nifty Bank up 1.4, small cap index about a quarter, the mid cap index up a quarter, and the small cap index up a little bit as well. So, I guess going through every day was painful, but when you look back, metals, PSU banks, capital market plays, some of these indices were up between 4 and 5%. So that's the week which has been which went by. It's a wrap on the session, a closing bell. Thank you very much for staying with us. Editors Roundtable will pick up on the action. Mihir Vora is our guest in the program. We'll of course discuss some of the trends, top trends this week, and what we can make out from them for the coming week. Stay tuned.
The Sensex and Nifty end the week flat, but the broader market outperforms. The Nifty Bank gains 1.5%. PSU banks, metal stocks gained the most this week. Over the next 30 minutes, we will decode the action on Dalal Street. We'll put the spotlight on the IT numbers, decode the rally in metals, and a lot more. Hello and welcome to Editors Roundtable. I am Reema. With me are Nimesh and Nigel, and joining us here in the newsroom, Mihir Vora, CIO, Trust Mutual Funds. Hi guys, earnings season is here. What are your thoughts about the week that went by?
It's been a tough to 25, right? The start of 26 was tough. 25 was very bad for sure. 26 start was very tough. But yeah, I think some bit of momentum is back because some of the numbers are good. So I guess because market is so oversold, even a small bit of good news is something which the market is rewarding. Look at what happened to Federal Bank this Friday, Union Bank on Wednesday, a small beat and you saw 7%, 8% rally. IT, everything is up this week. So I guess that's going to be the big thing. A bit of surprise on the positive side, and markets may react big time because we've seen a lot of correction in the broader market names in the last 1 year.
Yeah, that's right. I think now the call is how far away from the bottom are we, because that pessimism talk is getting louder, and sometimes it's not such a bad thing, right? Because otherwise everyone says buy the dip and all. But off late people are sounding a little bit more nervous. So hopefully, we're closer to the bottom than we thought. So,
and we have a FI short position as well, which is a cushion for the market.
But the problem is the way they're selling in the cash market. That is not stopping. That's just not stopping.
And it's very surprising, for the last many days to have 92% FI's net short position, and they're like fearless. They don't fear for anything. I mean, I don't know what they can see and we can't. Made any thoughts on overall markets and the fact that FIs have been so net short, and they're so confident about continuing to be net short?
Yeah, I think, first of all, the currency is also not helping, frankly speaking, and that also adds to the lack of interest as well as confidence. And see, if you just step back and see what happened in 25 is that India got left behind.
Yeah.
Right? So I'm talking about not only the absolute underperformance of India versus other emerging markets, but we had no theme like AI.
Yeah.
Right? So you had Korea, Taiwan, Japan, China catching up to the US and doing even better than the US because of the AI hardware and software theme, which India did not have. Hopefully, with the AI hype tapering down, our normal 6-7% growth should carry us through. I think the trade deal is a big deal, and that should be one of the most significant triggers for the FI sentiment.
Yeah, and this lack of clarity about the US tariffs, whether it's going to be rolled back, whether it stays, does Trump's powers get more powerful? I think the lack of clarity also, because the Supreme Court has still not ruled on it, also makes it difficult to take a clear direction on the Indian markets, considering our sensitivity to it. But on this AI, look at TSMC's numbers, right? There is so far no evidence that the AI juggernaut is slowing down. So India's best case was that AI hedge. If AI goes down south or the optimism moderates a bit, and then India will do well. But at least as of now, from the earnings, global earnings, there is nothing.
Absolutely. Only thing is, stock price do tend to lead the actual outcome.
Yeah.
So to sustain these valuations in the AI stocks, you'll need positive surprises. So even if you meet the high growth requirements, they may not be enough. So let's hope India finds its right place this year.
All right, let's talk about IT, because IT did well, especially in Friday's trade. So the one-year returns remain deeply negative. Stocks are down more than about 10%. But on Friday, we saw a decent bounce on the back of Infosys numbers. Now, the question is, do the numbers that we've had from TCS, HCL Tech, Infosys suggest that things are turning around marginally at the corner? Not a sharp acceleration, but just some improvement. If you look at the Q3 numbers, revenue growth beat estimates across for all three large cap IT companies. The expectations were very modest. For Infosys, it was no growth, a flat performance. The company delivered 0.6. For TCS, expectations were for a 0.5% growth. The company delivered 0.8. So there was a minor beat on very low expectation. And then the guidance upgrade. Not just Infosys, which upgraded the guidance, even HCL Tech services guidance was upgraded marginally at the upper end. That also reinforces the narrative that maybe things at the margin are improving, and it's providing some sort of a confidence. On the subject of AI, what we did see in the Q3 numbers is that AI revenues are growing fast. For HCL and TCS, the revenues went up by nearly 20% on a quarter-on-quarter basis, but it's coming in on a very small base. For HCL Tech, the revenue contribution of advanced AI is about 4%. For TCS, it stands at 6%. But the key worry about AI cannibalizing the traditional application maintenance revenues hasn't gone away. Because if you take a look at the deal wins are very strong. Infosys in particular, more than $4 billion of deal wins, 57% of it is net new. Yet this is a company which is going to grow 3.5% this year. So growth rates are going to be in low single digits. And next year, even though it will be better than this year, the street estimates for growth are about 5 to 8%. Valuations appear to be fairly fair. Infosys is trading about 22 times, slightly at a premium to TCS. TCS has been a bit of a laggard compared to the rest in the large cap space. So execution seems to be improving. The guidance is stabilizing. AI is gaining traction. Mihir, do you think the sector is past its worst and we are seeing a slow reset? Interest may come back towards Indian IT?
I think we need to take it stock by stock. Our bias has been towards the higher growth IT services companies within the services pack, which have been typically the mid-cap stock picks. The large caps are still stuck in that single-digit growth trajectory, and if they keep on doing the same thing, not change the business model, I don't see that changing, whether it's with AI or because of AI or without AI. The fact remains that even without AI, they were in a single-digit growth phase. So they really need to do something different apart from buybacks to really get back to the higher growth trajectory. So structurally, if you were to tell me for a 3 or 5 year view, I am underweight on large cap IT stocks. I'll be more stock specific in terms of the mid cap and small.
But these mid cap growth IT companies like a Persistent, Coforge, do you own both of them in your portfolio?
Yes, we do own some of them. Yes.
But is there valuation comfort? Because they've been bid up.
See, market always looks at the hunger for growth. And I don't see the large cap ITs demonstrating that hunger for growth. And when you see that the promoters or the management are motivated enough, you will get that premium. And in some of the cases, they have demonstrated over at least 8 to 24 quarters that kind of growth.
You know, Mir, one of the IT companies which you own in your fund and which has shown growth by inorganic way, they've done a very large acquisition. You like those kind of companies where their hunger for growth, they go for large acquisitions beyond the reach and you feel that they will reward the shareholders?
I would not give a premium for acquisitions. Sure. We do need to see organic growth too. But as long as the company has some risk appetite and it supplements the overall strategy of the company, I will be fine. But I'm not really a big fan of acquisitions for the sake of top line.
Okay, all right. Let's focus on the other theme then, Mihir. That's had a super 2025 and it's not stopping. Metals. They're brilliant. I will pull up a chart of some of those price moves in the last year. And they've started this year itself with big gains. And we're not even a month into, into the year. And you pull up the most volatile ones, silver and platinum, they are up close to 18 to 25% in the matter of 20 days.
Couple of weeks, yeah.
That's the kind of moves that we've seen. So the metal melt up continues. And there is a lot of factors at play, right? The geopolitical risk, so you're seeing precious metals go up. On the industrial metal side, you're seeing that there's a shortage in terms of supply and the demand is as strong. And the cost curve of some of these metals actually has moved up. That in turn is supporting pricing. And that's why the utilization levels, in fact, are moving up. And with regard to precious metal, the Chinese central bank, they continue to buy gold, I think, for the 14th straight month out there. On silver, there is a restriction in China with regard to physical export. So that as well is holding them in good strength. So this melt up, it's a little bit tricky, but for the time being, the music is playing, so people are dancing. Valuation-wise, though, it's quite interesting because metals, we look at momentum and not really with valuations. Absolutely. But Hindustan Copper, 550 rupees odd. Last year's EPS was around 4 rupees. Things go well, say they do 10 rupees, they do 12 rupees. Still, it's trading at around 50 times odd for a miner. So we'll have to see what they come up with. But for the time being, the street is very, very excited about it. Hindustan Zinc, that's the only way to play silver. And the Q4 actually will be good because Q3 they hedged a lot of their supply at around $35 to $40. So the real benefit will come in Q4. But for the time being, the stock is trading at around 12 times its EBITDA. So it's not cheap at all, but there's only one way of playing it out there. And finally, the aluminium plays. In December, in the first week, we had put out this piece with regard to aluminium. We said it could probably look up because demand is growing. And China's at around 45 million tons of capacity that is capped. And they're already at 44 million tons. So we always worry China will produce more. Here they didn't have too much of supply to come on stream. And those stocks, in fact, Nalco, Hindalco, Vedanta is the cheapest with good reason because you don't know what the promoter entity does next. But it has a demerger in the works. And that actually has been a big outperformer. Net, the metal melt up has continued. But how do you play it, Mir? In the past, you'll have played it tactfully. As of now, it appears non-ferrous is getting the benefit over ferrous. Is that what your preference as well? Is that, or are you all playing it by some other means? Maybe pipes, maybe some of those ancillary stocks as well to steel or to aluminium?
Sure. So structurally, our investment philosophy is not really in favor of commodities per se, because we're looking at long-term compounding and all that. But tactically, there's a very strong move, as you said, and with good structural reasons. In aluminium, I'd just like to add that it's a bit of an energy story also, because aluminium requires a lot of energy, and the way energy costs are going up in the US because of AI. So actually, maybe it's a part derivative of the AI boom also.
Indeed.
Similarly, copper also is a derivative of AI, because you need so much power and power generation, distribution. Even the data centers themselves require so much cabling and all that. So that's also fueling the AI. So some of this demand is linked to EV, AI, and renewables. So that's what's creating this.
And there's a fight for power, and that's why, in fact, the cost curve is moving
exactly.
up as
well. So the way we are playing it is directly through some of the names in zinc, copper, and aluminium. We don't have too much exposure to steel, because I don't think steel is that kind of a structural story. But interestingly, indirectly, we are playing it through exchanges as well as some of the gold financing companies. So we probably are the highest overweight in some of the gold financing companies and the exchanges.
Can you give
give
us a thesis with regard to that gold finances, because it appears it's in a very lovely spot, right? Gold prices are moving up and the cost of borrowing is going down. So though valuations of some of them are at the upper end, but that tailwind could actually drive them even more from here.
Yeah, the good thing about gold financing companies is as the price of gold goes up, the addressable market itself goes up, the loan to value goes down. So they can actually lend more to the same customer also. So that also creates a tailwind. So when the music stops, obviously that will stop. But as of now, since we are talking about a structural story in gold, silver, etc., that seems to be a good play. And second is the exchanges, because as the excitement around precious metals is building, you are seeing exponential growth in volumes in some of these.
And gold finances is the one that has done very well, or the one that has a new promoter?
Both. We have some experience both.
But you remember, right, we were talking with CSB Bank, and they said that because gold prices have gone up so much, their LTV is sub 60%. So even if gold prices correct by 5%, 10%, there will still be, there is enough cushion, there is enough buffer on the way down.
Absolutely. And one more sub-component I missed out, which is the jewelry.
Okay.
But
you pay for the big ones, the giant?
We're staying to the big ones. We're
staying with the
larger
not the challengers, not the regional
Because the top line anyway, again, automatically goes up. Though volume growth may not be there. But so far, given the business updates, etc., that have come through, seems to be a strong
for trust.
T for trust. All right.
We spoke about which has done well. Now some of the pain points. And I want to ask one about, the second half of last year saw a bit of PE compression in many of the sectors in stocks. The classic example was EMS. All the stocks are down 30-40%. And even then, they're quoting at 40, 50, 60 times. Are you playing the EMS sim in some form? And after the correction, anything is done attractive for you?
So we do have some exposure, but much lesser than before.
Okay.
And you're right about the PE compression. The lesson is that in many of these cases, when the expectations are running sky high, meeting expectations may not be good enough. You'll have to continuously get earning upgrades, which stopped in some of the stocks, and that's what's creating the PE derating. I don't think the structural story has stopped. The government is serious about building the EMS space, and valuations for some of them have come down, partly because of some disappointment and partly because they are actually embarking on high capex initiatives in semiconductors, etc., in some of the cases, which may have a longer gestation period. So the capital light model is in some of the cases turning into capital heavy model, which probably makes it a longer term story. The immediate compounding may not come through, and that's also what the market is looking at. But having said that, beyond a certain point, below a certain point, these stocks will become very attractive.
And since we spoke about metals moving up, just to close the loop, some of these companies, like the cables and wires companies, we had Polycab that came out with a set of numbers, top line beautiful, but margins under pressure. Some of these guys could get hit, right? And they're not cheap by any stretch of imagination.
Absolutely.
So do you think some of these companies, like cables and wires namely, the growth is there, you have more competition that will come in later today, and some of these stocks are not cheap. Would you look to buy into some of these dips, or would you stay away?
See, some of these stocks have actually, if you look at the last 4-5 years, not given those kind of great returns. So some derating has already happened. And your question on margins getting impacted by higher input prices of metals, etc. We looked at the last 10-15 years, and we didn't find very strong correlation between, say, copper, aluminum prices and margins of these companies. Give or take a few quarters, they are able to pass it on.
And this is across sectors, or you're referring particularly to cables and wires?
The cables company.
Cables and wires.
So beyond us, with a lead or lag, they are able to pass on the the cost increases. So I don't think that should be a concern. We should be more, focusing on the actual organic demand growth in this sector.
And is AI inflation a concern for any sector, not for cables and wires, but any other sector which could get hurt? Right? Yeah. So many other autos get impacted. So
because of
AI, sorry, not AI inflation, commodity inflation. Commodity inflation.
Yeah, again, we looked at auto numbers also actually, and again, there also we didn't find a very strong correlation between commodity prices over the longer term and auto margins.
Okay, so no sector per se we should worry about commodity inflation.
In the short term, like in tech, you cover tech so well. In tech, people say rupee depreciation will help the margin.
It's never structured.
It's never structured.
Got that. All right, Amir, stay on. We'll continue to decode the week on Dalal Street. For now, short break. We'll come back.
Welcome back. You're tuned in to Editors Roundtable. Well, we're still in conversation with Mir Vora. Mir, I want to ask you about a couple of these sectors that people were very gung-ho till not so long ago. Namely, the infra space, where people are fearing that, capex will slow down, and that's where the stocks will get hammered. Even frontline names, PNC Infra, you have NCC, they have corrected. I think they're half of what they were in the recent peak itself. So, would you believe that some of these stocks have gone through a decent correction? They have a good order book, and their execution has been fairly good in the past, that you'll give it a second look. So, your take on the infra space, because of this looming worry that capex spend will actually slow down from here on, and this budget will actually be more for the consumption space. Your take?
So, I think segment by segment, if you look at it, roads has seen a slowdown in ordering. So some of the names that you mentioned are actually road heavy, so to say. And if you see, the maximum derating has happened in the road heavy, companies. So that's for sure an indication that spending is slowed down, and probably that should continue because we've actually done a lot in the last 10 years as far as roads are concerned. My guess is the government will continue now to focus on the power T&D, the ports sector as well as the defense sector, where I think the immediate requirement is far more. Power T&D, especially since we've been putting up so much of renewable capacity, now we realize that we don't have enough muscle in the T&D space. Yeah. So that's a kind of a non-negotiable, so to say. So that space might see more a better priority compared to the roads sector, etc. So I do see some realignment of priorities there.
So you won't go in as of now. There could be some kind of pain. All right.
A word on the broader markets. Last 12 months have been pretty tough for the broader market names. While the index looks flat to positive, there's so much of pain in the broader market and mid-cap and small-cap stocks. Having said that, your fund in the last 1 year has relatively done better. What has changed? What has worked for you, and how have you avoided the big mistakes or the big accidents in the last 1 year?
So we've kind of stuck to stock picking, and we've not really been hugging the benchmark, whether it's the small-cap benchmark or the multi-cap benchmark. And we've basically maintained the core philosophy of growth at reasonable valuations. And for example, our portfolio weighted average growth rate, EPS growth rate for the next couple of years is in excess of 30-35%. And while the PE is also 30 plus, the PEG ratio tends to work out. So as long as you stick to stock picking, and the good thing about small caps is that while there are only 100 large caps and 150 mid caps, you have almost 600 to 800 small caps to choose from. Yeah. So you can always kick the tires.
No, I can see your top holdings in the small cap fund. As you rightly pointed out, there are some stock picking activities which have done well for you, like Kirloskar Oil, or Grow, or for that matter V2 Retail. But the one thing that which is clearly visible is the small private banks. You've got some of this bunch of those small private banks in your portfolio. What's the rationale there? Is just a top-down approach, or you think there is an individual story in all those small banks?
So broadly speaking, I would say the small private banks, at least the ones we have benefited from MSME growth. So lending in MSME has been encouraged, and they have the niche in the MSME space, and gold financing again, directly or indirectly. So those are the segments which have been growing faster, and the government has also been encouraging. And while the larger banks have also been lending in that space, as a proportion of their assets, since they are too large, it doesn't show up. But it shows up relatively much better in the mid-cap private sector banks.
Also, the last 1 year, the big theme was the FDI capital into the financial space. Couple of names that you own saw very large transactions. RBL Bank, for that matter, Federal as well.
Exactly.
Is that the theme that you're very bullish on? That there will be a lot of FDI capital which will be chasing the financial names?
So my guess is that as long as there is capital which chases growth, it will be in the mid and small caps.
Sure.
Right. So people are coming to India for growth, and whether it's this sector or any other sector, the growth potential on a lower base can only be in the mid and small cap space. So we are lucky that we didn't know that strategic acquisitions will happen. But as long as they show growth, I'm sure somebody will find it attractive.
So fresh money allocation now, Mihir, where would you put it?
Fresh money, I would say that within the overall space, financials is the one where there is maximum value for money.
Large caps or mid cap PSUs?
Both, I'd say, because the sector has underperformed for quite some time now. So while in the last couple of months they have started picking up, but if you look at the last 2 to 3 years, there is enough headroom as far as valuation and growth equation is concerned in the private sector banks and the financial and the public sector banks also. I think financials in general also should start catching up a bit more, because even capital markets saw a good drawdown in the last 12 months. So whether it's brokerage houses or AMCs and all, AMCs of course some of them are at higher levels, but capital market linked plays like, for example, brokerages did see a lot of derating. Wealth management firms also saw some kind of derating. Those should also start catching up.
The other one sector which has seen a bit of a derating last year was real estate. The index is down 15-16% in the last 1 year. The stocks are down 30, 40, 50%, be it large caps or be it mid caps. It was a perfect tailwind year for them. Interest rate cut, everybody was getting money. Most of the real estate stocks, companies raised money as well, and still the stocks are underperformed. What's the view now? Time to buy into real estate names?
I think so, but back of the mind, my guess is that a lot of it is linked to stock market returns also. Sure. Because most of the real estate companies that we see, the listed ones, the large ones, are not in the affordable housing space. They are in the large ticket space, 2 crore, 1 crore, 5 crore, 10 crore ticket sizes. And willy-nilly, directly, indirectly, there is a wealth effect play out there. So my guess is if the stock market picks up, you should see real estate also picking up. And now, as you said, stock prices have corrected also much more than the rest of the market.
Just one final word, we were discussing it in the break, right? There are so many mid-cap, small-cap companies where you are seeing good growth. Like, for an example, SmartWorks came out with numbers. The top-line growth is at 34%. And there are others, just giving this as an example. But the stocks are correcting. I mean, what explains that? If we're so indexed to earnings and the earnings are showing up, why are these stocks under pressure? Not for 1 quarter, but for a while now.
And yeah, you're right. We've seen that not in one stock, but so many stocks. I'm asking the same question. But my guess is that as long as the broad market remains weak, and in some of the cases, there is also fear of further selling by either the existing PE holders or promoters. So whenever there's a lock-in expiring or expectation of PE exits, stocks are just not performing because markets are not willing to give that leeway for them. So I think in some of the cases that's also the reason.
Okay,
thank you. In some of the cases, this year will be a year for mid and small cap.
Sorry?
You think this will be a year of mid and small cap?
I would think so, yes. Yeah. But as I said, the key is the trade deal. We need to get the trade deal through.
All right, all conversations always start and end with the trade deal. Thank you very much, Mihir, for joining us here in the newsroom. Well, that brings us to an end in this edition of Editors Roundtable. Thank you very much for watching. Stay tuned to CNBC TV 18 for more news and updates.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The rupee hits a one-month low after a sharp fall in late trade. Higher trade deficit, strengthening dollar and uncertainty over the U.S. trade deal weigh on sentiment. Dealers say the RBI is not supplying dollars adequately. The Sensex and the Nifty snap a two-day losing streak but end a volatile week flat. Bank stocks and mid-caps outperform. Reliance Industries set to report a steady Q3. Weakness in oil and gas segments likely to be offset by strong growth in O2C, telecom and retail. Profits likely to rise over 6% even as revenues are seen declining by 3%. SEBI releases a consultation paper on permitting netting, a framework that would allow FPIs to square off trades within the same day instead of settling each transaction individually. SEBI Chief Tuin Kantapande told CNBC how operational efficiency for market participants. The government is likely to increase FDI limit for defense companies with existing licenses from 49% to 74% under the automatic route. Sources say the Department for Industry and Trade Promotion is likely to liberalize the FDI regime. Days after the U.S. captured Nicolás Maduro, Venezuela's opposition leader Maria Mercado presents her Nobel Peace Prize medal to President Trump at the White House. A Nobel laureate cannot. President Trump pulls back from plans to attack Iran after a warning from Gulf states Turkey and Israel. Economic Times reports that India is likely to exit from Iran's Chabahar port, but no official word from the government yet. A World Economic Forum survey among chief economists raises the red flag on public debt across emerging economies. Outlook for global growth remains weak despite marginal improvement. Nearly 60% of those polled expect modest to significant job losses due to artificial intelligence over the next 10 years. From Mumbai to Nagpur, BJP-led Mahayuti sweeps the Maharashtra civic elections. Mumbai is likely to get its first ever BJP mayor after the party emerges as the single largest. Uddhav Thackeray faction outperforms Shiv Sena's Shinde faction in Mumbai. The Pawar faction faces humiliating defeat in Pune and neighbouring civic bodies. Well, let's go straight to the top story this evening. The rupee has hit its lowest level in a month after a sharp decline that we saw in late trade. Now, the rupee has been the worst performing currency today after December trade data showed a decline in exports and trade deficit widened to cross $25 billion. A strengthening U.S. dollar and uncertainty over the U.S. trade deal also weighing on sentiment. Dealers also say the RBI is not supplying dollars adequately. Lata's here with more on the weakness that we are seeing in the rupee. Lata, what is weighing on sentiment? But more importantly, what seems to be the thinking within the RBI?
Yes, it was a rather bad day for the rupee. It was the worst performing currency among Asian and among EM currencies in general, falling about 0.6%, about 55-60 pies versus the dollar. The bearish sentiment was initially triggered by the December trade data that came yesterday. It did show that the deficit has slightly widened by about $500 million. It was $24.5 billion in November. It went up to $25 billion goods trade deficit for the month of December. And the important point was the tariffs are now showing. The exports to the US have fallen by 7% from November levels. So it's starting to bite. That's also ruined sentiment a bit. Even electronics and services were good, but not outstanding. So the fear in the market is there about how big would the current account deficit be. But the bigger problem is capital flows. Foreign funds have been big sellers in January. There has been no let-up, and that appears to have been the case today also. They're selling equities, buying dollars and remitting. Normally, you have the Reserve Bank supplying dollars as a counterweight. Dealers say it appears the Reserve Bank has not supplied much today and has allowed the rupee to take its own direction. All told, this doesn't look like it's stopping anytime soon. The initial number that everyone is looking at in the market is 91.03, which is the all-time closing low reached on December 16, and 91.07 per dollar, which was hit on December 17.
Well, Lata, many thanks for joining us. A new low there for the rupee. From the currency market to the equity market, the Sensex and the Nifty snapped their two-day losing streak but ended off their intraday highs. Nearly 30 Nifty stocks closing in the red. The Nifty Bank, though, outperformed. Nifty Bank was up by about 500 points. Flat close for both the Sensex and the Nifty today. Today, we saw some key bank earnings like Federal Bank, etc. That stock was in focus. And of course, we do have bank earnings tomorrow as well. But let's bring up the picture for the week. The Sensex and the Nifty have ended flat while the broader markets outperformed. That's the picture for the week, just about in the red and just about in the green for the Nifty and the Midcap index closing slightly higher. Capital market, PSU banks and metal stocks were the biggest gainers for the week. Now on to the energy market, where oil prices rose as market participants weighed concerns about supply risks. However, receding chances of a US strike on Iran has limited gains. Prices are on track for a fourth straight week of gains. That's the latest as far as oil is concerned. And metal prices fell globally on the back of reports of China's crackdown on high-frequency trading. Beijing's move follows intense activity in mainland futures that fueled global price rise. Chinese regulators have ordered bosses to remove servers operated by high-frequency traders from their data centers. Prices of precious metals also fell. Gold and silver prices also declined on hopes that geopolitical tensions have softened. A stronger dollar index also weighing on prices. Market regulator SEBI has released a consultation paper on netting today. The framework allows foreign portfolio investors to offset buy and sell trades within the same day instead of settling each transaction individually. Now, speaking with Lata at SEBI's annual conference, the SEBI chief Tuhin Kantapande said the proposed framework will allow operational efficiency for market participants, especially FPIs.
Other points, of course, we are looking at very closely is netting. And I think the consultation paper will be out very, very soon on this to allow them to net in some respects so that there is a greater operational efficiency while they operate.
Well, that is the SEBI chief, and that proposal has been made public today. The big global story: Venezuelan opposition leader Maria Corina Machado presented her 2025 Nobel Peace Prize medal to President Trump at the White House, as was widely expected. Now, Trump has praised Machado and said that the medal was presented to him for the work he's done. However, the Nobel Prize Committee has clarified that the medal can change hands or owners, but the title itself cannot be transferred. Now, this comes nearly 15 days after the U.S. military captured Venezuelan President Maduro. Take a look.
I presented the President of the United States the medal of the Nobel Peace Prize.
Venezuelan opposition leader Maria Corina Machado said she presented U.S. President Donald Trump with her Nobel Peace Prize during a meeting at the White House on Thursday. Machado spoke after finishing separate meetings with Trump and U.S. senators, where she was met by a large crowd of media and supporters.
Very well.
Earlier, she said her meeting with Trump went very well. Machado, who fled Venezuela in December, is competing for Trump's ear with members of Venezuela's government and seeking to ensure she has a role in governing the nation going forward. She was banned from running in Venezuela's 2024 presidential election by a top court that was stacked with allies of longtime leader Nicolas Maduro. While he claimed victory, outside observers widely believed Edmundo Gonzalez, an opposition figure backed by Machado, won more votes by a substantial margin. But as their meeting was taking place, White House Press Secretary Caroline Leavitt said Trump stood by his assessment that she did not have the support needed to lead the country in the short term.
And at this moment in time, his opinion on that matter has not changed.
Trump has on several occasions praised Delcy Rodriguez, Maduro's second in command, who became Venezuela's president after the U.S. captured Maduro in a snatch-and-grab operation this month. Leavitt said that, so far, Rodriguez has been cooperating.
Venezuela and Ms. Rodriguez have also confirmed that they will be releasing political prisoners from Venezuela. There were 5 Americans who were recently released this week as well. So the president likes what he's seeing and will expect that cooperation to continue.
While the current government has freed dozens of political prisoners in recent days, outside groups and advocates have said the scale of the releases has been exaggerated by Caracas. Separately in Venezuela, Rodriguez spoke in an annual presidential address to lawmakers. She said she would propose reforms to her country's oil industry as investors in the U.S. push for easier access to it.
And President Trump has threatened to deploy troops in Minnesota to quell protests against immigration enforcement authorities. Trump warned he would invoke the Insurrection Act to send in the military if officials fail to quell protests. Demonstrations, which began after ICE agents shot a woman dead, intensified after authorities shot a second person yesterday. European nations, including France and Germany, have sent their troops to Greenland. This is an attempt to boost the Arctic island security. The military deployment came after Denmark and Greenland's foreign ministers met U.S. Vice President J.D. Vance last week. Following the meeting, Danish foreign minister had said that there was a fundamental disagreement between the two sides, also criticized Trump's bid to acquire Greenland. The United Nations Security Council held an emergency meeting over deadly protests in Iran. Iran's deputy UN envoy told the council that the country does not seek confrontation, but would respond to any U.S. aggression. He also accused Washington of fueling unrest. U.S. Representative Mike Waltz said that President Trump was a man of action who had made it clear that every option remained open to stop Iran from killing protesters. The White House has said that Iran has halted the execution of 800 demonstrators. Speaking to the press, White House Press Secretary Caroline Leavitt said President Trump warned Tehran of grave consequences if the killing of demonstrators continued. Meanwhile, Economic Times reports that India is likely to exit the Chabahar project. This comes after President Trump had announced Iran's trade partners will have to face a 25% additional tariff. There is no official word from the government so far. The government is likely to hike FDI limit for defence companies with existing licences under the automatic route. Sources have said that the Department for Industry and Trade Promotion is likely to liberalise the FDI regime. Parikshit is standing by with more. Parikshit, what does this mean for the defence sector?
Well, this coincides with the government planning to announce the biggest possible capex and manufacturing push for the defence sector in the union budget. The Defence Ministry has already sought a 20% increase in capex because this year will be all about self-reliance in defence technologies for the future, such as early warning systems and combat drones as well. Now, what the government has done is this. They have now tried to bring parity between new and existing licenses in the defence sector. Earlier, some months ago, the government had liberalised FDI for companies seeking new licenses for manufacturing. And those companies were allowed to get FDI in the range of 74%. It was 49% earlier as the cap. That was increased to 74% for new licenses only. Now, in order to bring parity, companies which already have existing licenses and have investments, they will be able to increase investments from a 49% cap to a 74% cap as well. Now, this is a proposal which is under consideration by the DPIIT, which comes under the Ministry of Commerce, but it is squarely backed by the Ministry of Defence, is what we hear. The Defence Ministry had asked for this after getting suggestions from various quarters. They believe that this is going to increase India's prowess in defence manufacturing for the future and also help increase exports from here as well.
All right, Parikshit, many thanks for joining us. So further liberalisation there for the defence sector on the cards. A World Economic Forum survey among chief economists raises the red flag on public debt across emerging economies. Outlook for global growth remains weak despite marginal improvement. Nearly 60% of those polled expect modest to significant job losses due to artificial intelligence over the next 10 years. The survey was released just days before the annual summit kicks off in Davos. Ritu's here with the key takeaways. Ritu.
First up, on the global economic outlook, 53% of the economists now expect weaker growth in 2026. Now, that's still cautious, but it is a clear improvement from September when 72% were expecting a deterioration. So more of them now see stability and nearly 1 in 5 expect stronger growth as well. Bottom line is pessimism has eased, but confidence is still quite fragile. Now on to markets, where the biggest fault line is the Magnificent Seven dominating returns. They now make up 35% of the total index market cap, which is up from 20% in 2022, with valuations in the top 10% of historical ranges. On outlook, though, the economists are quite split on US AI stocks. 52% expect declines, but 40% still see an upside. But the sentiment is far more positive on China's AI stocks, with 68% expecting gains. Gold remains a key hedge. 46% expect further upside. Crypto sentiment is sharply negative, 62% expecting declines, and the US dollar, where more than half expect some weakness. Next up is the risks, where global public debt has hit $102 trillion in 2024, and it is projected to approach 100% of global GDP by 2029, and that is emerging as the biggest risk. The stress is far higher in emerging markets, where debt and currency crisis dominate. For advanced economies, sovereign debt risks top the chart, followed by the likelihood of a corporate debt crisis. Now, government spending priorities are also moving fast. The clear winners are defense, digital infrastructure and energy, which is driven by AI power demand. But what is getting crowded out in turn is education, it's climate, transport, and even research and innovation budgets are quite flat. So clearly, geopolitics and AI are now dictating spending choices. And finally, artificial intelligence, the defining force of the cycle. When asked how significant the direct impact of AI-linked investments is going to be on growth in the next 2 years, economists see the most significant impact on the US and China, lesser so on Europe and South Asia. As for the impact of AI on jobs, in the next 2 years, job losses are expected to be modest but not massive. But in the next decade, job disruption there on account of AI is expected to deepen.
All right, Ritu, many thanks for joining us. And of course, we'll bring you all the action from the World Economic Forum right here on CNBC TV 18 starting Sunday. The United States and Taiwan have reached a trade agreement to build chips and semiconductor factories in the U.S. As per the agreement, Taiwanese chip companies will invest at least $250 billion in the U.S. In return, the Trump administration will lower the reciprocal tariffs on Taiwan to 15%, down from 20%. The U.S. government will also commit to zero reciprocal tariffs on generic pharmaceuticals, aircraft components, and some natural resources. So that's the latest in the US-Taiwan bilateral deal. Canadian Prime Minister Mark Carney met Chinese President Xi Jinping, where both leaders announced a new strategic partnership. Carney's visit to China is the first by a Canadian Prime Minister in nearly a decade. Both leaders discussed clean energy, expanding trade in agriculture and food. Canada will also import 49,000 Chinese electric vehicles from China under preferential tariff rates.
Canada can thrive in a new system, but to do so, we must be ambitious. We must work at speed and scale to find new partners, to diversify our trade and attract unprecedented levels of investment in our country. And we must be pragmatic. That means we have to understand the differences between Canada and other countries, and then focus our efforts to work together where we're aligned. And it's with this approach that Canada is forging a new strategic partnership with China.
While Canada and China forging a new strategic partnership. Now, a trade deal between India and the European Union is inching closer. Top EU officials will travel to India for the 16th EU-India summit, which is scheduled for the 27th of January. Sources tell CNBC TV 18 there is a big possibility that both sides will sign a deal, and that trade deal is reasonably balanced. Well, we will end to a break, but up next, Wipro misses estimates in Q3, but Tech Mahindra delivers. That and more when we return. Well, the BJP-led Mahayuti has swept the municipal corporation elections across Maharashtra. Let's first focus on Mumbai, which in all likelihood will get its first BJP mayor. The Mahayuti is heading towards a massive victory and will control Asia's richest civic body. The BJP, which has historically fought the BMC polls in alliance with the undivided Shiv Sena, has emerged as the single largest party. This time, the BMC polls were also a battle for the Shiv Sena legacy after the bitter split in 2022. The Uddhav Thackeray faction of the Shiv Sena has outperformed Eknath Shinde's party, this despite the latter retaining the name and the symbol of the undivided Shiv Sena. Shinde, however, maintained his sway in Thane's home bastion. A moment of truth for the Pawar faction as well. The party headed by Sharad Pawar and Ajit Pawar's NCP suffered humiliating defeats in Pune and neighbouring civic bodies. The BJP retained the Pune corporation by a huge margin. Away from the results in what comes as a unique feat, 3 members of the Matre family in Thane emerged victorious. But there's more to that. All of them had contested the elections on tickets of rival parties. On that note, let's go across to Santya Gura, who reports on the BJP's impressive BMC performance. Santya.
A big day for BJP in Mumbai as BJP has emerged victorious in these BMC elections held after 9 years. BJP has clearly stolen the show. Right now we are in Mumbai's Nariman Point area, and this is how this is BJP office in Mumbai, and this is how it's looking like right now. As you can see, the celebrations have started. So BJP and Shiv Sena contested these elections together. BJP as of now is leading on 90 plus seats, and the alliance will be able to appoint its mayor. But talking about Eknath Shinde, his performance is pretty low. As far as the alliance is concerned, it is emerging victorious, and definitely a big day for BJP, especially its Mumbai unit.
Santya, many thanks for joining us. That is the latest there on the BMC elections. Back to earnings. Wipro has reported a mixed Q3 with margins beating estimates. Revenue slightly short. Wipro's growth guidance also appears weaker. On the other hand, Tech Mahindra has exceeded expectations. The new labour code impacting profits of both companies by more than 550 crore rupees. In fact, India's top 5 IT companies have seen nearly 5,000 crore rupees shaved from their profits in Q3 due to the labour code. Rima is here with more on Wipro and Tech Mahindra's earnings. Rima.
Thanks so much for that. So let me start with Wipro. As you rightly pointed out, it's a good beat on the company's margins, but the Q4 guidance, that's the Jan to March quarter, is a bit disappointing. The company's top-line growth came in at 1.4%. EBIT margins have expanded to 17.6% versus 16.5%. So one reason for that is in Q2, the company had taken a hit of 50 basis points on its margins on account of a client bankruptcy. So that is not there. And plus, you've got the Rupee tailwind. So margins have done well at 17.6%. But what will disappoint the street is the Q4 guidance, because the company had made a large acquisition, Harman DTS, which, according to analysts, could contribute up to 200 basis points in Q4. Yet the company is only guiding for 0 to 2% in terms of its Q4 guidance. So that is a bit disappointing. Deal wins for the company, particularly large deal wins, are also a tad bit disappointing. In current quarter, it's at less than $900 million versus $2.8 billion in Q3. Tech Mahindra, on the other hand, has delivered a pretty good beat on revenues, margins, and deal wins have come in at a 4-year high. The company's revenues have gone up by 1.7%. This is in a seasonally weak quarter. EBIT margins have expanded from a low of 4.7% in Q2 of FY24 to 13.1%. And even in Q3, margins have expanded by 100 basis points, coming in ahead of consensus expectation. This is the 9th consecutive quarter of a margin expansion for Tech Mahindra. Remember, the aspiration is to get to 15% margins. This was what was laid out by Mohit Joshi when he took charge. That comes to an end towards the end of FY27, Q4 FY27. So 15% is the goal. They're now at 13.1%. The company says the deal wins on an LTM basis. LTM is last 12 months, are also the highest that they've achieved in the last 5 years. And in Q3, deal wins have crossed $1 billion. Back to you.
All right, Rima, many thanks for joining us. Those are the tech earnings for you. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Don't go anywhere. We're back in a minute with more.
Thank you very much, SEBI and NISM, for giving me this opportunity. It's to the credit of both these institutions and the exchanges and the mutual fund community that, as chairman of SEBI has repeatedly said, in the last 5 years, the unique investor community has gone up from 3.8 crore to over 14 crore. That's a seminal achievement. So let me start over there, the expansion in this community. One of the big fears for this community now is, are we losing the favor of foreign investors? Does that worry you? I mean, whether it is the currency market or the bond market or the rupee market, the fear that FPIs have kind of sidelined us for the past 2 years. Anything that SEBI is doing to just make them feel more welcome?
I think this is not really an issue of, being welcomed or not welcomed. I think the frameworks, Indian regulations are well in place, and FPI's decisions are contingent on how they look at it, different markets and returns, and also look at earning growth. They also look at currencies. And they also look at geopolitical factors. And they are, in a position to come in and go out as well. Now, if you are really looking at, the FPIs are there to the extent of $900 billion invested into Indian market. And yes, there has been, $18 billion movement over a period, outflows over the period. But it also depends upon cyclical factors. So on regulations, we can only say two things. One is making our markets deeper and more diversified, especially the debt markets, the corporate bond markets, and so that, to some extent, it will be within, not pro-cyclical, but other approach can be taken. The people can shift also from equity to debt, depending upon the situations, depending upon the circumstances. The second issue, of course, is, are there any frictions which we can improve structurally, whether we can improve the market? So one area which we have really looked at it very closely is the registration process. How we can have, registration which is faster, digitizing the whole process, looking at, whether the FPI KYC across SEBI and RBI can be done very quickly. We've introduced the concept of Swagat FIs, bringing in greater amount of certainty in registration period over a period of time, less paperwork, more flexibility. And going forward, I think that particular thing will also expand. Digitizing, digital signatures, even otherwise also allaying certain fears that they had following the, the threshold and other levels which were brought in, and they were also relaxed. So other points, of course, we are looking at very closely is netting. And I think the consultation paper will be out very, very soon on this to allow them to net in some respects so that there is a greater operational efficiency while they operate.
When do you think we may see us getting closer to it? I guess there'll be some conversations with the banking system also on that. So, should we expect it sooner rather than later?
Maybe it is out today.
Oh, excellent. I think that deserves a round of applause. That's a big headline you've given us. I will expect more in the course of the conversation. Actually, what I wanted to ask you was, we are up again, there's an upcoming budget.
Now, there was also, for example, Samara mentioned, the earlier that we are looking at, closing auction session.
Yes.
Very closely. And I should presume that That circular will be out also, possibly today.
Ooh,
or
another round of applause. So we are getting two headlines over here from the chairman. So I would ask you
I'm not too sure, but they're very close to issuing it.
I mean, if it's today or tomorrow, but the point is that, Samara had to speak about closing auctions and SEBI is ready with it, shows an extremely proactive regulator, and many congratulations for that. But, like I said, an unfair question, because we have the upcoming budget. One of the complaints you get from FPIs on our channel is the withholding tax. You've been at North Block, now Kartavya Bhavan. You think there is a case to withdraw it simply because now we have to fight for FPI funds more?
I would not like to comment on, that's not my prerogative indeed, and this is not the forum also to express on this issue close to the budget.
Okay, fair enough. I take your point that it was your former responsibility, not your current responsibility. But, speaking of FPIs, and just to conclude that conversation, clearly valuations are an issue. I mean, we're running at 22 times when earnings are growing at probably single digit. And therefore, that constantly FPIs are coming and telling us that. One reason which comes from the market is that this highly differential capital gains tax between equity and debt, and this big tidal wave of investors who have come from 2020 to 2025 largely have gone to equity because people are not planning asset allocation depending on their risk appetite. They're not planning asset allocation because of their age. I know retired people now going to, direct index funds, equity funds, simply because the tax is less. So you think that this is now becoming counterproductive? Purely as an academic and someone who has been in Kartavya Bhavan before, do you think this at least merits a debate? This very wide difference between capital gains on equity and fixed income.
Again, I would like to avoid my thoughts on this issue close to the budget. I think you are already, different people have been talking about it, and Finance Ministry will take a view, and it's the Honorable Finance Minister who has to take a view.
Oh, yes,
the end of it.
Okay. Let me put the ball directly in SEBI's arena itself. Can you give us a third headline? You already told us last week NSE IPO announcement may, come very soon, and the settlement issue is something you've taken in your stride. You've taken a call on. Can we hear when the final NOC comes? Since you're in a mood to give headlines.
No, I mean, I've already indicated, so there is no more further information.
No, the NOC comes soon, like this week.
No, I said within this month.
Okay, fair enough. I was hoping you would say within this week. That's why I asked you. Okay, sir, let me now get to the other issue of corporate bonds. The corporate bond market, from time immemorial, from the time I joined journalism, I'm asking questions on when will we have a more vibrant corporate bond market. Anything up your sleeve now?
So first of all, corporate bond market is more vibrant than before. So whether that should be still more vibrant, and I agree, it will be still more vibrant.
I mean, we trade only, we hold to maturity most of the bonds. Trading is less.
That's not correct.
And even issuance, mostly AA or A above, not below.
I'm afraid that's not correct. It's not that completely HTM. There is, bonds are being traded, and you can check the volume. Maybe we would like volume to be higher. Maybe we would like, and I think the whole, our both SEBI and RBI working closely on bond derivatives and bringing in an extra, opportunity to look at it, because secondary trading in bonds is taking place, but it needs to be much, much better. There are certain constraints. So if you really look at the size of the bond market, I indicated, it used to be, about 40% a few years back of the total bank credit to industry and services. It's now climbed to 60%. So the 56 lakh crore are outstanding bonds. Certainly they are, lower than what it is there in China or other places. And we have a constraint that we have not too many still issuers. So number of issuers need to expand. Similarly, there has to be a number of different rated and more than, A-rated and below bonds must also come in to give the proper yield curve. And those efforts are continuing. Third important issue is that even if we say that the retail participation in bonds, that we have facilitated by bringing down the threshold from 1 lakh rupees to 10,000. And online bond platform providers are providing liquidity and availability to the retail investors. But of course, we need to do far more. So in terms of education and awareness regarding corporate bonds at the retail level, certainly it is largely missing. And therefore, we need to have something like you had that mutual fund Sahi hai, something like a campaign to go around and also make people educative about what it entails to invest in bonds, because you need not always say that the bonds you have to hold till maturity. You can also dispose it. The question is whether the secondary market will offer that purchase and sale. We did give liquidity window facility saying that you can give a put options, but so far not much movement has taken place, not many issuers have come forward. Still the market is OTC market. We have also provided the platforms. We have an RFP platform at the primary stage and the RFQ platform at the secondary stage. And many steps have been taken to improve transparency in the market. Secondary market trading has improved, but far from what is desired. And I believe that bond derivatives will be another way of also creating further liquidity and depth in this market.
SEBI has done a lot, but every now and then there are issuances. I don't want to name names. There were 2 companies where disclosures were even pulled up by the courts for not making disclosures, at the right time. Now, of course, on other things like entities and fin influencers, you have Parva, as you said. What are you looking at in terms of improving disclosures, higher penalties, or, as you point out, institutions like Parva?
I think one normal thing we should not be really, accusing SEBI of is the lack of disclosures. No. I think this institution, SEBI as an institution, if you look at it over a lot of period of time, has given every possibility, every system for the disclosures. And we constantly say that this is a disclosure-based regime. Even for that matter, when valuations, it's clearly, we don't look at the valuations because you have to let the markets work. Our job is not to become the market, but let the markets work, where there are buyers and sellers and the expertise and, the traders and the speculators and the arbitrators. So we have to really be very clear that disclosures, wherever possible, we make. And so therefore, we make disclosures, we make compulsory disclosures wherever for primary purpose in terms of IPOs and FPOs. There are disclosures for corporate governance, all kinds of disclosures. The companies need to disclose. So an LODR has been amended to facilitate such disclosures. Materiality of disclosures have been there. So I think on disclosures, SEBI's record is not of a recent origin, but of a very longish origins. And therefore, this market has actually developed.
No,
now,
I agree with you.
Sometimes, of course, there was an issue of excessive nature of, the very lengthy disclosures. And now the people are wanting, how quickly we can grasp it. And we have heard their voice. For example, in case of IPOs, we said, and I think very soon we will be notifying it, but the board has approved it, that we will have a draft abridged prospectus whenever the IPOs are issued. And there will be a QR code. People can access it in all these advertisements. So the draft abridged prospectus also we will define very clearly all the factors which are needed to be disclosed for very quick glance by the media as well as by the investors.
So to be fair,
we want more active participation of investors in terms of their understanding of what it contains. But we have to also educate always investors, and so is your duty to educate them, is to not to have always a herd mentality, to really look at their exposure, do a bit of their research. Today, there are opportunities available of a very high order in order to really find information and find all kinds of information. So therefore, before they take investment decisions, they should be clear where they're investing.
No, I like the backhand shot, lobbing it back to the media. We are using agentics to, derive main points from, IPO disclosures and other large disclosures. Maybe a more educated agentic from SEBI will be more helpful in that direction. But let me come to the other issue you raised in your speech as well. SEBI has been excellent in ensuring that capital market does its main job, allow companies to raise capital. And the latest strides in including REITs as to be defined as equity goes a very, is a very large step. And then now, of course, InvITs also. Can you inform us as to what are the other steps in the direction if you have to think of a second round of improvement of capital raising from the market? Anything on your mind?
We have a whole range of measures, and we have different kinds of markets, and we have different types of risks which are associated with the market. We want to really make it available as a very diversified market with diversified regulations keeping with the view the diverse needs and the diverse risk profile of the investors. And we should not have always a one-size-fits-all. For example, the investor protection, the investors themselves are of a different types. What it means for an institutional investors may be different from a retail investors. What it will mean for an accredited investor will be different from an ordinary investor who is, so therefore we have to look at, in derivatives, we have to look at it, well, who is really, who knows the market. So there is an investor education. We have also to see that wherever, what markets the investors will be more comfortable with. And there could be a light touch regulation for those areas where we feel the risk is well understood by the investors. Like, for example, AIFs. And therefore, we have an AIF accredited investor scheme only. And we are going to liberalize the way the accreditation is granted, because that itself will speed up the process of such investors to come and quickly come to the market. And there will be other markets where we will be more intensive in regulations, because there is so much of retail money is involved.
I'm aware that we are running out of time. A final question, these new batch of investors that have come, especially the later ones, and it's almost a flood now in the last 4-5 years. They are coming at a time when valuations don't seem to be working in their favor at all. Does it worry you? Do you want to warn investors about valuations and earnings growth? Does it make you cautious?
My views on valuations are well known, because I've answered these questions at various forums. Valuation is in fact the most difficult question ever encountered by human beings, and they have never got the real story. How about it? Valuation can be quantitative. The methodology can be quantitative, but it is still subjective.
Yes.
Because if the valuations is based on the future, what you look at the future means there is no such theory to say this is the way it is going to be future. Future is about beliefs, and different people believe it differently. And that is why you have bulls and the bears, and they keep fighting in the stock markets in order to determine what's going on. And so therefore, how is it that, such a people with fantastic degrees, they take wrong decisions?
That's true. No, I agree with you.
I am reminded of the seminal work of Mr. Daniel Kahneman, and someone was asking me, some young man was asking me this question. No, I think the lady, and she's teaching, and I told her that please teach your students what Daniel Kahneman told about the prospect theory, about the way people's minds work. People's minds do not work in the way we thought that they will be most efficient, even if they are well educated.
Yes.
And so therefore panic selling takes place when they should be patient. And we are talking of patient capital. We should the power of compounding, in which the people should stay and not really try to do that. And many of the frequent day traders and others, they've realized to their horror that what they wanted that to make a big money, they haven't. But there are others who are advising, who have built up very big portfolios, how the proper investing has, and choosing the right investing and staying on has helped them. Nobody can advise. People are different advisors. People have to take their advice. Nobody can say, I am the advisor and my advice is the best one. And the least of all that of SEBI chairman, who is not allowed to invest anyway.
I think a SEBI chairman who is reading Daniel Kahneman's Thinking Fast and Slow and expounding on that gives me the assurance that we are in very safe hands. The capital markets are in very safe hands. Thank you very much, Mr. Pandey, for giving us so many headlines and for continuing to be a very able steward of the capital markets. Thanks a lot.
Thank you.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, the foreign investor community is in shock after the Supreme Court ruled that Tiger Global's $1.6 billion stake sale in Flipkart to Walmart is now taxable in India. The apex court held that Tiger Global cannot claim capital gains tax exemption under the India-Mauritius Tax Treaty. Remember, Tiger Global exited Flipkart in 2018, selling its stake to Walmart. Now, the investment was routed through a Mauritius-based entity, and the fund had claimed tax exemption under this treaty. However, the court ruled that the transaction structure amounted to treaty shopping and that tax avoidance. It said that the treaty benefits cannot be granted merely on the basis of a tax residency certificate. The court also noted that the India-Mauritius Tax Treaty was amended in 2016 to ensure that only genuine entities with real commercial substance can avail of these benefits. The ruling can and will have far-reaching implications for foreign investors, including private equity funds, venture capitalists who routed investments into India through Mauritius. Now, experts warn that this verdict may prompt the tax department to scrutinize similar transactions, potentially setting the stage for more litigation. All of this comes at a time when the startup funding has already slowed down. So what options does Tiger Global now have, and what does this ruling mean for the broader investor community? To help us unpack this judgment and the implications with this, is with us Sachin Jolly, Senior Advocate of the Delhi High Court, and Sandeep Junjunwala, Partner at Nangya Global. Gentlemen, thank you so much for joining us. Mr. Jolly, let me come to you first. For very long, for the last 20-odd years, there's been this understanding that there is some degree of protection under the India-Mauritius Tax Treaty. So whether that's the government circular of 2001, whether that's repeated judgments coming in from the Supreme Court, whether it's the amended DTAA, which had grandfathered, which had protected pre-2017 investments, can the investor community now afford for the Supreme Court to do a U-turn, to backtrack on a long-standing position which has given clarity to investors on how to go about investing in India?
Ashmit, I must honestly say that this judgment creates a lot of uncertainty. It is, you talked about grandfathering and the amendments to the treaty in 2016, which protected past investments. Even the GAR provisions which were brought in protected investments prior to 2017. This judgment seems to say that if the effects or the tax consequences of the investments come about after April 2017, the amendments to the treaty, GAR, all can be invoked to, bring to naught the years of certainty which has prevailed on the Mauritius route, and which was also sought to be protected through the amendments of the treaty in 2016 and the amendments to the Act of 2017. I'm quite aghast that on one hand, the judgment records that the finance minister, while bringing in GAR or the general anti-avoidance rule, as well as other amendments, clarified that this will not affect past investments. But then the tax department goes and argues something to the contrary, and the Supreme Court accepts that. I'm actually at loss of words to even explain this to any investor on how does our tax administration and how do our courts function. It's quite amazing.
So a lot of questions that need unpacking. Let's try to go through that one by one. Mr. Junjunwala, let me come to you. In terms of understanding what the implications are, firstly, tell us, is the tax department now emboldened? Can they now scrutinize all pre-2017 investments into India via Mauritius, whether that's PE, venture capital, FPI? Are they all vulnerable to taxman's scrutiny?
Yeah, so Ashmit, in short, yes, but I think it's also equally important for us to understand that if we look at the case of Tiger Global itself, there has been a lot of development in the international tax world, say between 2012 and 2018. So 2012 and 18, because the entire arrangement that we're talking about of Tiger Global making investments in Flipkart through their Mauritius structure was set up in sometime in 2011-12. And between then and 2018, I think there has been a change in the world order. A lot of developments in the international tax world. Say, for instance, we had GAR coming in. We had a lot of action plans being implemented on BEPS, etc. Now, what we are seeing now is the court clearly saying that this is not about disregarding the tax treaties, but maybe looking at it from a more deeper lens of commercial substance as well as the intention. So therefore, I would rather believe that while the GAR as a tool to probably expand and scrutinize the structures may probably increase, it's equally important for the investors to relook at their structures more from a substance as well as from an intent perspective. And if I think these two dual substance as well as intent is cleared, I don't think GAR is going to be a problem for them, but it all depends on the facts.
It all depends on the facts. Mr. Jolly, let me come to you. Again, the same question that pre-2017 investors who've been looking at the India opportunity have been pumping in money via Mauritius. If they've made that investment pre-2017, is there cause for concern for them? And not just Mauritius, what if I've invested in India via a Singapore, via a Cyprus or a Cayman Islands? Am I vulnerable? Do I have reason for worry?
Well, absolutely, yes, Ashmit. I have a lot of reasons to worry. And I'll tell you two very far-reaching implications of this judgment. One is that, even if I invested prior to 1/4/2017, which was the cutoff date, the judgment seems to say that, in fact, in one passage, it says, since the negotiations for sales started after 2017, which is in May 2018, therefore, we can look at even the structure which was created prior to 2017. So, then what is grandfathered? Nothing is grandfathered according to this judgment. So everybody and anybody who made investments prior to 1/4/2017 is today in jeopardy. Secondly, and more fundamentally, it seems to suggest that the indirect transfer which happened in this case, where is a Mauritius company selling the shares of a Singapore company, is not at all protected by the Mauritius Treaty. It says that the investments must directly be held by the Mauritius entity in the Indian company. If they are held through a structure, then there is no exemption available. So that to my mind is quite baffling, because whether I am selling as a Mauritian investor, whether I am selling shares of an Indian company or whether I am selling shares of a Singapore company, I am only selling shares. Article 13(4) of the India-Mauritius Treaty protects transfer of shares. So therefore, really this artificial distinction which the revenue drew and which the court accepted is mind-boggling, and it's going to have large implications, not just for this taxpayer, but I think everybody around.
That, in fact, has been a criticism that many experts have put across, that there was this understanding between India and Mauritius on grandfathering pre-27, on protecting, on shielding pre-2017 investments. Mr. Jhunjhunwala, let me come to you on that. That the question many are raising, like Mr. Jolly, is that, look, the treaty itself said that pre-2017 investments will be protected. For the Supreme Court to now walk back on that agreement between two individual countries, does that then lead to more confusion, more uncertainty in the minds of investors?
Absolutely. There was an absolute immunity given on the 2017 grandfathering. It was never subject to GAR, no conditions attached. Now, with this, where they are even talking about the structure itself to be an impermissible tax arrangement, they're not even talking about giving a treaty benefit to a income which is coming out of an investment, but they are trying to overall say that this structure itself is impermissible, and therefore the provisions of GAR should apply, is in some sense, going back from what was, probably agreed at the time of giving this absolute immunity from grandfathering way back in 2017.
Sure. Again, laboring on that same point, Mr. Jolly, let me come to you. One aspect that, in fact, the judgment dwells on is that the sovereign power to levy tax needs to be retained. It should not be frittered away. It should be protected, especially in times of geopolitical uncertainty. That's the message that the court is sending. But speaking of the sovereign, these were two sovereign countries that negotiated and agreed upon this deal. But the Supreme Court is asking the taxman to go back on something that was agreed between two governments.
Ashmit, I'll tell you, this is a bogey which is being played by the tax administration for long. And let me address this because this is an absolute, I hate to say, for better words, it's a rubbish argument for the reason that the Act of Income Tax Act was promulgated by the Parliament. Circular number 789 was issued by the CBDT, which is an instrument of the state of India. The treaty was negotiated by the executive. Now, who's undermining whose sovereignty? Are you saying the treaty undermines the sovereignty, the circular undermines the sovereignty, or the Act of Parliament undermines the sovereignty? In each of the cases, the blame lies with the government. How is the taxpayer being blamed for this so-called lack of certainty or sovereignty? I mean, it's mind-boggling. Today, India goes and negotiates its tax treaty with Mauritius, UK, US, and says, you tax X amount, I tax Y amount. I have given up that sovereignty by choice. Now, how can then you go to a court and say, look, this, if you don't let me tax it, my sovereignty is lost, but you've given up that right. You shouldn't have negotiated that treaty. So, I mean, for lack of better words, I think this is all rubbish. It's a false bogey. This whole tax nationalism needs to go. I mean, otherwise, no money will come into India.
Sure. Let me come across to you, Mr. Jhunjhunwala. Today, on January 16th, we celebrate the 10th anniversary of India's Startup India mission. At the time when there is a funding winter, when we look at the startup community, how much concern will this cause in the mind of PE, venture capital investors who are looking at the India opportunity? Will they now perhaps start recalculating, recomputing their ROIs and then be circumspect in whether or not they want to be a part of this India story?
Yeah, so Ashmit, I think we are actually looking at a lot of exits as well in 2016 based on some of the pipeline available on the public domain. So I think this definitely is going to create a lot of unrest among the non-resident investor community because the old playbook is completely dismantled by the ruling, and therefore in some sense wherever investors would have set their structures and forgotten that, okay, they may probably look at, the capital gains implications only at the time of exit without even probably looking at the substance and the intention requirements in the interim period. I think that's going to create a lot of unrest among the non-resident community now who are probably looking at an exit in the near future, because this ruling in some sense creates a precedence that some of their structures itself could be questioned from a GAR perspective. So having said that, I think one of the points that is also to be looked at is, tax harmonization. We are living in a coordinated world where probably India needs capital, foreign capital in the race to the top. Now, definitely tax sovereignty in itself could mean that there's an international isolation. So when we are talking about tax sovereignty, there's an equal and critical importance that needs to be given to the concept of tax harmonization. We kept talking about US levying tariffs, which was unilateral. I mean, if we keep talking about tax sovereignty in isolation, the entire world trade is going to collapse. So this definitely is going to create a lot of unrest amongst the foreign investors.
Sure. We're running out of time, Mr. Jolly. I'll come to you for one quick comment. What does the way forward look like? We've seen the Vodafone judgment, which was given by a 3-judge bench. This Tiger Global judgment has been given by a 2-judge bench. How do we look at it? Is there a need for a larger bench? Is that a case that the lawyers of Tiger Global now need to make to ask for a larger bench, clarity from a larger bench?
Well, Tiger Global was being led by 2 stalwarts. I think they'll decide whether to approach a larger bench. But according to me, I think, Ashmit, I'll tell you something. If you see the question of law which the Supreme Court formulates, in para 11.1, and what it answers, according to me, it could not and it does not overrule Vodafone. Secondly, it does not and could not overrule Azadi Bachao. Therefore, according to me, both those judgments still stand. If I were to argue, I would say this judgment turns on its own facts and the question that was proposed before the Supreme Court. There are certain observations, yes, which are directly and inherently contradictory with the findings in Azadi Bachao as well as Vodafone. And if I were to argue, I would say that those judgments still stand good and I'm still protected. And this judgment in Tiger Global is an outlier. In jurisprudence, in legal jurisprudence, a two-judge bench does not and cannot overrule another two-judge bench of Supreme Court or a three-judge bench. And therefore, as I would look at it, Tiger is an outlier and should be treated as such. It is not the law of the land for all times to come.
These are the very points, the very questions that we'll all be deliberating, squabbling, and perhaps debating as the days and the weeks progress from here. But clearly, a substantial, a landmark ruling coming in from the Apex Court. Whether or not it gives clarity or whether it causes more uncertainty, of course, is up for debate. I'd like to thank both of our panelists for joining us, sharing their time and perspective. With that, it's time now for heading into a very short break. But on the other side, India and the EU are expected to ink a trade deal during the visit of top EU officials to India. Details when we come back. Welcome back to News Center. Now, India and the EU are expected to ink a trade deal during the visit of European Commission President Ursula von der Leyen and other top EU officials to India. Now, sources tell CNBC TV 18 that there is every possibility of securing a good deal by January 27th. Abhimanyu Sharma is joining us now with more details. Abhimanyu.
Possibility of yet another big free trade agreement between India and a large economy seems bright. By the end of this month, India's largest trading partner, European Union, is already in talks with India for a free trade agreement. 20 out of 24 chapters have already been finalized. India's Commerce and Industry Minister Piyush Goyal has indicated that India has signed 7 FTAs since 2014, and the India-EU FTA would be the mother of all FTAs which have been signed till now. As far as talks between both the sides are concerned, they are continuing on a day-to-day basis in the virtual mode, and they are currently in the last and most arduous phase of negotiations. While sensitive agricultural issues are off the table due to sensitivities on both the sides, several other sectors would be opened up on a mutual basis for both Indian as well as European exporters, which are going to provide huge opportunities for a growth in trade. Commerce and Industry Minister Piyush Goyal also indicated that not a single EU state amongst the 27 members has opposed the FTA with India, and at different points of time, all member states in the past few months through several channels have supported an increase in overall trade partnership with India. It remains to be seen how early the FTA is going to be concluded and signed, even as India's leadership is slated to meet EU's leadership later this month in New Delhi. And before that, both the sides are trying to conclude talks and to ensure that there is a mutually beneficial deal on the table.
Well, now to the latest on the Sanjay Kapoor inheritance battle. Priya Kapoor has moved the Supreme Court seeking records related to the divorce between Sanjay Kapoor and Karisma Kapoor. She's seeking certified copies of the divorce settlement proceedings, which concluded in 2016. In her plea, Kapoor states that the details of the divorce terms are critical to ascertaining the entitlement of Karisma Kapoor and her children. The plea comes amidst an inheritance dispute initiated by Karisma Kapoor's children, which is currently pending before the Delhi High Court. And with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
AU Bank back in 2008, March of 2008. They put in 20 crores at a valuation of about 50 odd crores at that point.
30 crores. Sir, इतने महंगा देते नहीं थे यार.
अच्छा, तो ठीक है. So and then they stayed invested. They put in more money. I think in 2010.
10.
There was, and then of course, I mean, in a phased way, they sold their stake.
Yeah.
The final exit value, market cap, when they sold was about 5,000 crores. So it's been 100 bagger AU Bank for Motilal Oswal private equity.
Yeah.
I know Ramdev is coming.
Yeah.
Now Ramdev is the second thing, right? So Motilal Oswal as a firm still owns about 77 odd lakh shares.
70 lakh shares.
Yeah, 77, 78 lakh shares. And there, he's not made 100x. He's only made 33x in the last 11 years, and he's complaining.
No, I'm not complaining. I just wanted to keep the record straight. I have not made 100x.
Well, I think he will. And congratulations, you've got the universal license. So I think the 100x is coming, Ramdevji.
Yeah, sure.
What we aim to...
So, I think, because you are covering the story, but, just 2 minutes on it.
Please.
So, when I came in Mumbai in 2007, and I was looking for a private equity or a private capital, and, I was being supported by HDFC Bank. But then I met Ramdevji, I think 2007, September onwards, right? And Vishal and, of course, Ramdevji. Ramdevji se baad mein mila tha, Vishal se pehle mila. And from there today, it's good now 20 years, more or less 19, 20 years, right? And still when Ramdevji speak to me about the company, the future, the growth, the India story, you must be hearing so much. I think it always inspires me, For me, it's not the way Ramdevji would have earned money or would have created wealth. I think his company, his Sangat, which has inspired me so much that if people ask me that who inspires you to build company or to build institution, I think one man, which is Ramdevji. So thank you so much, Ramdevji, for doing me all these things for over the years.
He inspires us all. I mean, I have to say.
He is pure. He is so natural that sometimes, you are in such a difficult, positioning mindset. But once you meet Ramdevji, it looks like, why you are so much depressed, Just go and play the inning.
Yeah. What we aim to do here is try and ask Ramdevji how he built his conviction. And I mean, the motto of Motilal Oswal is buy right, sit tight. And I think you've done both with AU Bank. So what can we learn from the journey, and how to, as investors, how do you kind of find these kind of tremendous wealth creating ideas? And of course, we'll ask Sanjay how he did it. So I'm actually just here to facilitate the conversation. It's a conversation aimed, we thought of it as a conversation between Ramdevji and Sanjay. Let me just kick this off. Sanjay, let me ask you this. When did the idea come? I mean, what was the genesis? Because your family was not in the business, right? I mean, you're a first-time entrepreneur in that sense.
Yeah. So Prashant, I'm a product of 90s, I done my chartered accountancy in 95, and that time era was very different, and the only silver lining was that India was opening up. There were some sectors which were given the private license, and at that time only the HDFC Bank of the world came in picture, right? And being a chartered accountant, I figured out that I don't want to do any normal practice and all those things. But Jaipur, was never inspiring you or pushing you to do something great, Somehow, I would have done around 10 odd businesses, in those days. Right from export to even a truck company and whatever, right? But finally, I figured out that my own knowledge or my own comfort is more around the building the businesses around what is your finance or maybe investment banking and all those things. So I started with my own HNI help, and subsequently, got with HDFC Bank, the famous partnership, which I always say that, I'm a product of HDFC Bank partnership, and they inspired me a lot. When I started meeting their leadership and, figuring out that their knowledge and my knowledge is same. So, the ability to think big.
That was in 2003.
2008, right?
Yeah.
And I met everybody except Aditya Puri Saab till 2008, and with Paresh and everybody. And those people really inspired me that whatever they have as a character, as a personality, as a risk manager, product manager, distribution franchise, I also have, but I'm not getting a platform, right? And where I met Ramdev ji, and the team, of course, the first is Vishal Tulsian, and from there onwards, and when they started believing in me, because it's not about putting 10 crore in your company, it's about believing and supporting you, and I was coming from nowhere, At that time, 2008, it was one product, one state, one lender. That was the company, right? That was not an NBFC. I think when Ramdevji put the money, then we became NBFC. And then, now you know the story. So I think one thing led to another, kept the patients always in mind to really, be around that. So all those things. So
and Ramdevji, I think always used to say the next HDFC Bank. HDFC Bank was a big winner for him back in the day. And he always used to say the next HDFC Bank. And I think he found that in you. Ramdevji, tell us a little bit about your first impressions and what really got you excited about AU and Sanjay.
Yeah, so we had set up this first, private equity firm, private equity company, and we had about 400-500 crores to invest to 10-12 companies. So one of the thought process for me was value migration from public sector to private sector. So I said, and that time HDFC Bank had already become somewhat. So we said, I told Vishal, why don't we look at some budding private sector lending companies, so get me few small ones, because we were giving 30-40 crores, so we couldn't have got big one. So we're looking for this thing, but profitable. Okay, so in 1 week's time, they bring in front of me Sanjay. Okay, now Sanjay, I said, I think they're making about 2 or 3 crores profit. Yeah. 2 crores, yeah. So I said, so how much, what exactly you do? So they said they're onward lender of HDFC. So we had great respect for HDFC. So he said they have got 200 crore line from them. Yeah. I said, we'll check with them whether you actually got 200 crores or not. Yes. If Aditya Puri has given 200 crores, we'll definitely give you 20 crores. That was a total due diligence.
I think it was not me, he got the comfort. The comfort was Aditya Puri.
No, if somebody has, how do you check whether this guy is good or not?
Yeah.
So he's a chartered accountant, good looking, very energetic, very nice, everything. But whether he has the business sense or not, if Aditya Puri is given 200 crores, 20 crores, hum pakka denge. And the deal got done.
That was line of credit. I mean,
so it was a partnership model, right? And where the first loss basis.
Right.
Outstanding was around 400 crores.
Right.
Yeah. So
no, but Ramdev, there would have been other companies where HDFC Bank would have had kind of these kind of arrangements.
But we had only this proposal in front of us. Don't forget, he's a chartered accountant. Yes. He's a good, robust chartered accountant from Jaipur. So, I mean, we liked him. We liked the whole idea that he has been already successful and he's profitable. See, for me, it was very important that he was profitable. Yeah. And then I think the one led to other, we negotiated.
But let me, so, in 2012-13, I still remember, and you were in different mood that time. And he called me up and said, Sanjay, yaar, banking license mil jaye na, to main tere ko leke dunga. So he actually quoted me that you should run a bank. And at that time, there was no license, even a guidelines or whatever, And when I got the license in 2015, I called up, sir, sir, aapki ichha puri ho rahi hai. So I don't know how, he has some linkage with me. I don't know what, Prashant, honestly, that he has some view on us and he can actually read our future. If you go back and see his video on us in 2009, when we celebrated this investment, what he has said at that time in Jaipur, and many people now when they see the video, they say, how come Ramdev ji knows you so well that, I think he quoted that, in 2009, that one of the asset class, one of the asset which will grow in Jaipur, in next 15 years would be AU, So I think, I don't know how, from where, you always have some comment on us, whether it's koi Hanuman ji ka kuch hai aap pe ya...
See, it is the tailwind of the private sector banking because value migration was done and they are competent guys. They were actually conducting so well. So I was very clear that there will be many more HDFCs will be born. And a lot of guys that tried to be next HDFC. And nobody kind of made it. In fact, the most successful possible bank right from ground up is going to be AU. And I had been... So See, one of the things he said, I will never give unsecured loan in India. That was one of the promise of yours.
Yes.
You know, so they're never proud. See, a lot of companies, banks, they suffered because of this unsecured loan, the MFI part of their own book. So fortunately, they were not heavily into this right from beginning. So they had a very good risk management. And when I visited their office in 2008, I found their office to be run tighter than my office. And I was always proud of my office. So I said, ye bande to bahut sahi hain.
Tighter means?
Tighter means you could see, you know, at 11 o'clock, people are silently sitting. You just feel, you know, whether
It's a well-run operation.
Well-run operations or not, or it's a loose, aisa kuch nahi. It was a small operation, and yet it was very professional, very disciplined. I mean, those are things you judge, because I'm visiting companies from 1985. So I have seen hundreds of companies, badly run, very well run, world class. I've seen all of them. I mean, like I've seen Infosys from 95 onwards. I mean, how, so those things help you understand whether there is something better than special, because you're just talking about 50-60 crore worth of company. Total market cap to be about 70 crores.
Right.
So, so these other things, when you look at a company, what is the option value you are paying for all this? You're getting a terrific entrepreneur, terrific future. The runway is very large, because this country is going to have 14 to 15% credit growth compounded for next 100 years. In that, you are starting with literally nothing, you know, I mean, some 100, 200 crores. So runway is massive. Size of opportunity is very large. Business is reasonably good. It's not like Nestle or Lever, but 18, 20%, 16, 18%. So it's a damn good. But you can deploy a lot of capital. You can deploy 5 lakh crores, 10 lakh crores. But there needs to be a discipline. So most important thing is, how do you handle capital? How do you, when lend, how do you get it back? It is not an easy trade. I cannot do it what he can do. Because when we invest in equities, we know it can go to zero. And we allow it to go to zero, and many times it goes to zero. But this guy, they cannot afford to do that. When they lend, they want everything back. थोड़ा सा पठानी कार्यक्रम भी हो. So
इतना खराब भी नहीं है सर.
नहीं इतना खराब भी नहीं, but you know, being good lender needs to be very tough. Even if you see Aditya Puri, he's not a very soft guy. He's a, you know, you got to be strong. Even physically, you got to be strong, and he was. So we said, let's take a bet on.
Elections are not a problem. Sanjay, but has Ramdevji been a capital provider, or he has been a, he's provided guidance, mentorship? It's more of a partnership. I mean, how do you?
No. I don't think that Ramdevji, provided me the capital. Honestly, it was more of Vishal's fund and all those things. I think Ramdevji always, inspired me a lot. In terms of his approach towards life, his approach towards building the institution, his approach to think, bigger, larger, beyond today. All that came because I never educated from the business school, right? I'm a chartered accountant only from Jaipur. So how come you can relate that in 50 years, you can be a largest bank or maybe a top 3 banks of the country?
So he
right?
gave you, Ramdevji ne aapko sapne दिखाए और आपके कुछ targets थे?
No, Prashant ji, it was not about dreaming. It's about...
No, in terms of what is possible.
I think he's very natural, honestly, right? Like what he was saying in the earlier discussion that, be optimistic, there will be many noises, but you don't want to be noises, be on your job, I think his maybe could have given me 5 ideas, but those ideas actually built it, Sure. Now it's my duty to not to have 50 ideas from him, right? He will give you 5 ideas and build yourself another 45. So I think for me, he's the first guru to me in terms of not building as a bank, right? Building as an institution, building as a personality, character, Sure. governance. I still remember that because I'm Jaipur ke chartered accountant the, in 90s chartered accountant would do a lot of things which is not correct in my opinion. But in 2010 he told me that, Sanjay, don't waste your time on taxations. Don't waste your time on the tax people. It's a waste of your time. Just pay your tax. Pay 1 rupee more so that they are not coming to your office, right? And we are now 17, 18 years, Actually, I don't even waste a minute on my tax status, So I think these were the things where he was pushing me to be focused on business, good governance, building the team, think big, think beyond you, And that is why, Prashant, and with the full blessing of Ramdevji that, in my last 9 years, our balance sheet has now gone 10 times, in spite of so many challenges, right from, the COVID or the bank crisis, NBFC crisis, the interest rate high, how the last 9 years would have been, right? But we just kept on our resilience, focus, execution, right? And we are now, the largest SFB, the only one we got, the universal. And now from here in next 15 years, me and Ramdevji were chatting the other day that even if you grow by 20% year on year, we would be touching what today the ICCI is, So what we have done in last, 20 years in the partnership, we have created the belief that we can do it.
I mean, I remember the IPO when it came at 10,000 odd crore valuation, and it was an expensive issue.
5 times, price to book.
5 and
Got listed at 6.5, 7 book.
Yeah.
10,000, and now of course market cap is 75,000 crores, and now you've given us it can be an ICICI. I mean,
it has to be bigger than them, honestly.
Yeah.
Because let's be honest here, right? HDFC Bank never had an advantage of AI. I think they never had an advantage of their own. They didn't have any role model, right? I have this HDFC Bank in my front, right?
Right.
I have more technology. I have more ambitious people with me. I have more bigger economy, right? So my aim cannot be only HDFC Bank, to be honest. In my next 25 years, it can be bigger than that also. I think the challenge is not opportunity. The challenge is how mentally you are solid enough to take that scale. Or to be remain in that corridor that you will get right. So I think my belief is that in next 15-20 years, I know that I'll not be there, but this institution will become big, and all people be really proud of what we have created in last 20-30 years. So
that's a round of applause for Sanjay. I think that's a phenomenally well put. Story and of course ambition.
And you were talking about AI, sir? Yeah. Because some subjects maybe not be going deep, but at bank level, Prashant, I am seeing that because for the scale, HDFC would have done much hard work. Now hard work can be replaced by AI. You will need people, right? But you can't put energy. You can't put them that they have to do everyday hard work to build our next SEC bank, right? In my opinion, we will create on a 50% effort bigger bank than HDFC Bank in next 25 years because of the tech support.
Which is now available, which
yes,
was not there back then.
Yes, you can't even imagine what kind of AI is doing in that sense of making the life easy. The language has become, no matter what, As of now, if I want to build a South franchise, I need to understand 4 languages. Now I don't have to understand any language because AI is talking to the customer, right? So where that capability was 25 years back.
Yeah.
So when I'm deep in Tamil Nadu, I have a support of AI-led communication, right? So I think these small things are really helping me as a CEO to think bigger, scalable, and that too in control.
Yeah.
It is not that, when we are building up, there are many gaps will come in, right? So I think in my opinion, the technology will actually fast forward the entire scale building mindset.
I think Manish makes that point often that maybe in terms of adopters, the biggest will be financials and banks.
Yeah.
Because you have the data, you have the...
Yeah, I have one question, Sanjay.
Yeah.
What the regulator is doing is that whatever is the founder bankers, like Ms. Kotak, and so they are being, at certain period of time, they are being superannuated and they want the team to be in place to take it forward, the journey.
Correct.
Okay. So is AU, since it is a first generation entrepreneur and founder, do you have, well before you are being asked to step down, do you have a better team than you, ready to take over?
So, sir, I think if you ask me, banks are public platform, and I completely in sync with the regulator's view that beyond a point, a promoter or a CEO should not continue because it can create a risk. It's not about Sanjay Agrawal or maybe any other name. It's about the system in place. So, and then this my duty, or any CEO duty to create a second line succession because in the end, it's not about 15 years. Maybe after 30 years also, when I get retired, somebody has to take care of that, right? So I think that is completely in focus. And regulator also pushes us to create 2 EDs or deputy CEOs, deputy managing director, in order to really build this, the sustainability around leadership, And Ramdevji, for me, being a first generation entrepreneur, I strongly believe that, it's not about you, it's not about me to build a business. It's about how better I can visualize that, how it will run beyond me, And banks are meant not only for 30, 40, 100 years, I have seen a bank for 400 years, So why can't we create an institution which can last, even, when I come back in this earth, maybe, I just joined AU Bank as an employee, right? So I think that's the whole idea, to build a institution which can last for not for only centuries, for many decades, not for decades, many centuries, So
Ramji, for viewers,
it's there, sir. So in short, it's there, and we work on an everyday basis.
Yeah, Ramji, for an investor who's watching, right? What is the takeaway? How do you spot an AU? Not everyone has the access that you have, or the team that you have. What are the 2 or 3, especially in financials? Because it's a space littered with accidents, and as you yourself said, the most important thing is return of capital. That is that you can't go wrong there. So, what would you tell viewers who are watching?
So now, actually, opportunity is not only among the lenders, but now the much bigger opportunity is opened up in the non-lenders. That is the capital market, whether it is AMC, whether it is wealth management. They're just about to start it. So. Fortunately, they are not lending type. Here you have you need a platform where there is no capital adequacy so far, and with 10,000 with 1,000 crore capital, you can manage maybe 10 lakh crores or 20 lakh crores. So what is required is to create a competent team and competent distribution to manage assets, because the wealth generation in the country. Just to give you some numbers, in last 20 years, the total savings is about $12-13 trillion in India. If you add up all 20 years. Next 20 years will be, hold your breath, it will be more like $50 trillion. Just the savings. Mark to market on top will be another. So we're talking about $100 trillion flowing in here. We don't need anybody's money now. There is enough money from the domestic savings coming into the capital market. Now that capital needs to be managed by wealth managers, asset managers, intermediaries, all sorts of things. Now, can we find one emerging platform, whether it is a wealth management, whether it is asset management, and hundreds of them will come. But can you find a Sanjay Agarwal in that vehicle and maybe seed, So
you don't have to look for a Sanjay Agarwal in a bank. You can look for...
No, bank to I'm already invested.
Bank to hai.
Yeah.
So,
now he will set up insurance, AMC, wealth management, everything he's going to do it.
Yeah.
And that will come free of cost to us. Yeah.
But Prashant, my own understanding, sir, is this, that last 5-7 years, and the credit goes to all you people that you put so much money into the new, energy. But nowadays people are really want to build a business which can actually create a value. So they are not looking, they're creating a value from balance sheet than a P&L, right? So you will find many entrepreneurs, but, somehow you have to train them. Somehow you have to, make them understand that it is not a 1 year, 2 year, 5 year story. You want to really create a wealth, it has to be at least 20 years, have patience, have better governance, better transparency, honesty. And you have to de-link yourself with the company, What generally people make mistake that, they want to own everything, and then they just mess up, right? So, but I think there's a lot more opportunity, more people than what at our time, in my opinion. So, but you have to train them, right?
One thing I want to say, we have to find people who have done first round of success. The whole entrepreneurship or success story of any entrepreneur, any in the world, it is success built on success. It's a series of success. It's not one. Now, AU Bank has come this far and they just got the actual universal license. So that is one of the reward for success. Now, how they use that universal license to go to the next stage. So it is a continuous build-up. So that's what I have seen in my 30 years of entrepreneurship, that success builds success. It's not that right from day one, you know what is going to be your future. Nobody knows.
Yeah. Ramdev sir, in Jaipur, when you invested in 2008, Prashant, we were the only NBFC.
Yeah.
Now, the North NBFC Adda is Jaipur. You'll have 200 NBFC. And the ripple effect is that every NBFC is paying tax.
Yeah.
I think the success is only not limited to you. This entire society, even government benefits from the whole success of any entrepreneur because it inspires so many people, right?
Yeah.
So I think the only point I want to ask Ramdev ji, and then I'm struggling with that, if India want to get a scale, which we are talking about, how we are educating people in terms of building businesses, and building the resilience, building the mindset, I found that Indian education system don't give us a business school, like where we really want to understand the entrepreneurship, building the business, understanding the business.
Programs like this.
Yeah. Program like this? Yeah.
No.
But do you think like American system of building?
No. Best. See, entrepreneurs are kind of the guys who want to work for themselves. That is what is the real trade. Like you and we both decided to work for ourselves.
Correct.
Whether we are going to become big or not, that is a different thing.
Correct.
So fundamentally, do you want to work for somebody or do you want to work for yourself?
Correct.
Once that determination is there, then that school is your own kind of a country, your own place where you want to do it. I think
I was thinking to propose you, let's start a business school.
I don't think
that's an idea.
Business school. In fact, business school, you go to business school, they are looking for, they will not attend your lecture if it is not going to give them credit.
Correct.
They want only placements, nothing else.
Okay.
So entrepreneurs are not born in business school. In fact, it is born more in Chartered Accounting Institute.
I think this is such a lovely conversation and we could go on, but I think Ramdevji has a further appointment, so he's got a hard stop as well. Thanks both of you for being here. Sanjay,
My pleasure to be with Ramdevji.
What a wonderful entrepreneurship journey. And I think you've given us targets bigger than HDFC Bank in the next 20-25 years. And why not, right? Absolutely.
I'm giving target to my team.
Yeah. And Ramdevji, thank you so much for being a guiding light to AU and, of course, all of us. And thank you for being here. Really appreciate it. Thank you.
Thank you.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The rupee hits a one-month low after a sharp fall in late trade. Higher trade deficits, strengthening dollar and uncertainty over the U.S. trade deal weigh on sentiment. Dealers say the RBI is not supplying dollars adequately. The Sensex and the Nifty snap a two-day losing streak but end a volatile week flat. Bank stocks and mid-caps outperform. Reliance Industries is set to report a steady Q3. Weakness in oil and gas segments likely to be offset by strong growth in O2C, telecom and retail. Profits likely to rise over 6% even as revenues are seen declining by 3%. SEBI releases a consultation paper on permitting netting, a framework that would allow FPIs to square off trades within the same day instead of settling each transaction individually. SEBI Chief Tuin Kanta Pandey told CNBC TV 18 in a proposed framework will allow operational efficiency for market participants. The government is likely to increase FDI limit for defense companies with existing licenses from 49% to 74% under the automatic route. Sources say the Department for Industry and Trade Promotion is likely to liberalize the FDI regime. Days after the U.S. captured Nicolás Maduro, Venezuela's opposition leader Maria Mercado presents her Nobel Peace Prize medal to President Trump at the White House. Trump calls it a wonderful gesture of mutual respect. Nobel organizers say a medal can change owners, but the title of a Nobel laureate cannot. President Trump pulls back from plans to attack Iran after a warning from Gulf states Turkey and Israel. Economic Times reports that India is likely to exit from Iran's Chabahar port, but no official word from the government yet. A World Economic Forum survey among chief economists raises the red flag on public debt across emerging economies. Outlook for global growth remains weak despite marginal improvement. Nearly 60% of those polled expect modest to significant job losses due to artificial intelligence over the next 10 years. From Mumbai to Nagpur, BJP-led Mahayuti sweeps the Maharashtra civic elections. Mumbai is likely to get its first ever BJP mayor after the party emerges as the single largest. Uddhav Thackeray faction outperforms Shiv Sena's Shinde faction in Mumbai. The Pawar faction faces humiliating defeat in Pune and neighbouring civic bodies. Well, let's go straight to the top story this evening. The rupee has hit its lowest level in a month after a sharp decline that we saw in late trade. Now, the rupee has been the worst performing currency today after December trade data showed a decline in exports and trade deficit widened to cross $25 billion. A strengthening US dollar and uncertainty over the US trade deal also weighing on sentiment. Dealers also say the RBI is not supplying dollars adequately. Lata's here with more on the weakness that we are seeing in the rupee. Lata, what is weighing on sentiment? But more importantly, what seems to be the thinking within the RBI?
Yes, it was a rather bad day for the rupee. It was the worst performing currency among Asian and among EM currencies in general, falling about 0.6%, about 55-60 pies versus the dollar. The bearish sentiment was initially triggered by the December trade data that came yesterday. It did show that the deficit has slightly widened by about $500 million. It was $24.5 billion in November. It went up to $25 billion goods trade deficit for the month of December. And the important point was the tariffs are now showing. The exports to the US have fallen by 7% from November levels. So it's starting to bite. That's also ruined sentiment a bit. Even electronics and services were good, but not outstanding. So the fear in the market is there about how big would the current account deficit be. But the bigger problem is capital flows. Foreign funds have been big sellers in January. There has been no let-up, and that appears to have been the case today also. They're selling equities, buying dollars and remitting. Normally, you have the Reserve Bank supplying dollars as a counterweight. Dealers say it appears the Reserve Bank has not supplied much today and has allowed the rupee to take its own direction. All told, this doesn't look like it's stopping anytime soon. The initial number that everyone is looking at in the market is 91.03, which is the all-time closing low reached on December 16, and 91.07 per dollar, which was hit on December 17.
Well, Lata, many thanks for joining us. A new low there for the rupee. From the currency market to the equity market, the Sensex and the Nifty snapped their two-day losing streak but ended off their intraday highs. Nearly 30 Nifty stocks closing in the red. The Nifty Bank, though, outperformed. Nifty Bank was up by about 500 points. Flat close for both the Sensex and the Nifty today. Today we saw some key bank earnings like Federal Bank, etc. That stock was in focus, and of course we do have bank earnings tomorrow as well. But let's bring up the picture for the week. The Sensex and the Nifty have ended flat while the broader markets outperformed. That's the picture for the week, just about in the red and just about in the green for the Nifty and the Midcap index closing slightly higher. Capital market, PSU banks and metal stocks were the biggest gainers for the week. Now on to the energy market, where oil prices rose as market participants weighed concerns about supply risks. However, receding chances of a US strike on Iran has limited gains. Prices are on track for a fourth straight week of gains. That's the latest as far as oil is concerned. And metal prices fell globally on the back of reports of China's crackdown on high-frequency trading. Beijing's move follows intense activity in mainland futures that fueled global price rise. Chinese regulators have ordered bosses to remove servers operated by high-frequency traders from their data centers. Prices of precious metals also fell. Gold and silver prices also declined on hopes that geopolitical tensions have softened. A stronger dollar index also weighing on prices. Market regulator SEBI has released a consultation paper on netting today. The framework allows foreign portfolio investors to offset buy and sell trades within the same day instead of settling each transaction individually. Now, speaking with Lata at SEBI's annual conference, the SEBI chief Tuhin Kantapande said the proposed framework will allow operational efficiency for market participants, especially FPIs.
Other points, of course, we are looking at very closely is netting. And I think the consultation paper will be out very, very soon on this to allow them to net in some respects so that there is a greater operational efficiency while they operate.
Well, that is the SEBI chief, and that proposal has been made public today. The big global story: Venezuelan opposition leader Maria Corina Machado presented her 2025 Nobel Peace Prize medal to President Trump at the White House, as was widely expected. Now, Trump has praised Machado and said that the medal was presented to him for the work he's done. However, the Nobel Prize Committee has clarified that the medal can change hands or owners, but the title itself cannot be transferred. Now, this comes nearly 15 days after the U.S. military captured Venezuelan President Maduro. Take a look.
I presented the President of the United States the medal of the Nobel Peace Prize.
Venezuelan opposition leader Maria Corina Machado said she presented U.S. President Donald Trump with her Nobel Peace Prize during a meeting at the White House on Thursday. Machado spoke after finishing separate meetings with Trump and U.S. senators, where she was met by a large crowd of media and supporters. Earlier, she said her meeting with Trump went very well. Machado, who fled Venezuela in December, is competing for Trump's ear with members of Venezuela's government and seeking to ensure she has a role in governing the nation going forward. She was banned from running in Venezuela's 2024 presidential election by a top court that was stacked with allies of longtime leader Nicolas Maduro. While he claimed victory, outside observers widely believed Edmundo Gonzalez, an opposition figure backed by Machado, won more votes by a substantial margin. But as their meeting was taking place, White House Press Secretary Caroline Leavitt said Trump stood by his assessment that she did not have the support needed to lead the country in the short term.
And at this moment in time, his opinion on that matter has not changed.
Trump has on several occasions praised Delcy Rodriguez, Maduro's second-in-command, who became Venezuela's president after the U.S. captured Maduro in a snatch-and-grab operation this month. Leavitt said that, so far, Rodriguez has been cooperating.
Venezuela and Ms. Rodriguez have also confirmed that they will be releasing political prisoners from Venezuela. There were 5 Americans who were recently released this week as well. So the president likes what he's seeing and will expect that cooperation to continue.
While the current government has freed dozens of political prisoners in recent days, outside groups and advocates have said the scale of the releases has been exaggerated by Caracas. Separately in Venezuela, Rodriguez spoke in an annual presidential address to lawmakers. She said she would propose reforms to her country's oil industry as investors in the U.S. push for easier access to it.
And President Trump has threatened to deploy troops in Minnesota to quell protests against immigration enforcement authorities. Trump warned he would invoke the Insurrection Act to send in the military if officials fail to quell protests. Demonstrations, which began after ICE agents shot a woman dead, intensified after authorities shot a second person yesterday. European nations, including France and Germany, have sent their troops to Greenland. This is an attempt to boost the Arctic island security. The military deployment came after Denmark and Greenland's foreign ministers met U.S. Vice President J.D. Vance last week. Following the meeting, Danish foreign minister had said that there was a fundamental disagreement between the two sides, also criticized Trump's bid to acquire Greenland. The United Nations Security Council held an emergency meeting over deadly protests in Iran. Iran's deputy UN envoy told the council that the country does not seek confrontation, but would respond to any U.S. aggression. He also accused Washington of fueling unrest. U.S. Representative Mike Waltz said that President Trump was a man of action who had made it clear that every option remained open to stop Iran from killing protesters. The White House has said that Iran has halted the execution of 800 demonstrators. Speaking to the press, White House Press Secretary Caroline Leavitt said President Trump warned Tehran of grave consequences if the killing of demonstrators continued. Meanwhile, Economic Times reports that India is likely to exit the Chabahar project. This comes after President Trump had announced Iran's trade partners will have to face a 25% additional tariff. There is no official word from the government so far. The government is likely to hike FDI limit for defence companies with existing licences under the automatic route. Sources have said that the Department for Industry and Trade Promotion is likely to liberalise the FDI regime. Parikshit is standing by with more. Parikshit, what does this mean for the defence sector?
Well, this coincides with the government planning to announce the biggest possible capex and manufacturing push for the defence sector in the union budget. The Defence Ministry has already sought a 20% increase in capex because this year will be all about self-reliance in defence technologies for the future, such as early warning systems and combat drones as well. Now, what the government has done is this. They have now tried to bring parity between new and existing licenses in the defence sector. Earlier, some months ago, the government had liberalised FDI for companies seeking new licenses for manufacturing. And those companies were allowed to get FDI in the range of 74%. It was 49% earlier as the cap. That was increased to 74% for new licenses only. Now, in order to bring parity, companies which already have existing licenses have investments, they will be able to increase investments from a 49% cap to a 74% cap as well. Now, this is a proposal which is under consideration by the DPIIT, which comes under the Ministry of Commerce, but it is squarely backed by the Ministry of Defence, is what we hear. The Defence Ministry had asked for this after getting suggestions from various quarters. They believe that this is going to increase India's prowess in defence manufacturing for the future and also help increase exports from here as well.
All right, Parikshit, many thanks for joining us. So further liberalisation there for the defence sector on the cards. A World Economic Forum survey among chief economists raises the red flag on public debt across emerging economies. Outlook for global growth remains weak despite marginal improvement. Nearly 60% of those polled expect modest to significant job losses due to artificial intelligence over the next 10 years. The survey was released just days before the annual summit kicks off in Davos. Ritu's here with the key takeaways. Ritu.
First up, on the global economic outlook, 53% of the economists now expect weaker growth in 2026. Now, that's still cautious, but it is a clear improvement from September when 72% were expecting a deterioration. So more of them now see stability and nearly 1 in 5 expect stronger growth as well. Bottom line is pessimism has eased, but confidence is still quite fragile. Now on to markets, where the biggest fault line is the Magnificent Seven dominating returns. They now make up 35% of the total index market cap, which is up from 20% in 2022, with valuations in the top 10% of historical ranges. On outlook, though, the economists are quite split on US AI stocks. 52% expect declines, but 40% still see an upside. But the sentiment is far more positive on China's AI stocks, with 68% expecting gains. Gold remains a key hedge. 46% expect further upside. Crypto sentiment is sharply negative, 62% expecting declines. And the US dollar where more than half expect some weakness. Next up is the risks, where global public debt has hit $102 trillion in 2024, and it is projected to approach 100% of global GDP by 2029, and that is emerging as the biggest risk. The stress is far higher in emerging markets, where debt and currency crisis dominate. For advanced economies, sovereign debt risks top the chart, followed by the likelihood of a corporate debt crisis. Now, government spending priorities are also moving fast. The clear winners are defense, digital infrastructure and energy, which is driven by AI power demand. But what is getting crowded out in turn is education, it's climate, transport, and even research and innovation budgets are quite flat. So clearly, geopolitics and AI are now dictating spending choices. And finally, artificial intelligence, the defining force of the cycle. When asked how significant the direct impact of AI-linked investments is going to be on growth in the next 2 years, economists see the most significant impact on the US and China, lesser so on Europe and South Asia. As for the impact of AI on jobs, in the next 2 years, job losses are expected to be modest but not massive. But in the next decade, job disruption there on account of AI is expected to deepen.
All right, Ritu, many thanks for joining us. And of course, we'll bring you all the action from the World Economic Forum right here on CNBC TV 18 starting Sunday. The United States and Taiwan have reached a trade agreement to build chips and semiconductor factories in the U.S. As per the agreement, Taiwanese chip companies will invest at least $250 billion in the U.S. In return, the Trump administration will lower the reciprocal tariffs on Taiwan to 15%, down from 20%. The U.S. government will also commit to zero reciprocal tariffs on generic pharmaceuticals, aircraft components, and some natural resources. So that's the latest in the US-Taiwan bilateral deal. Canadian Prime Minister Mark Carney met Chinese President Xi Jinping, where both leaders announced a new strategic partnership. Carney's visit to China is the first by a Canadian Prime Minister in nearly a decade. Both leaders discussed clean energy, expanding trade in agriculture and food. Canada will also import 49,000 Chinese electric vehicles from China under preferential tariff rates.
Canada can thrive in a new system, but to do so, we must be ambitious. We must work at speed and scale to find new partners, to diversify our trade and attract unprecedented levels of investment in our country. And we must be pragmatic. That means we have to understand the differences between Canada and other countries, and then focus our efforts to work together where we're aligned. And it's with this approach that Canada is forging a new strategic partnership with China.
Well, Canada and China forging a new strategic partnership. Now, a trade deal between India and the European Union is inching closer. Top EU officials will travel to India for the 16th EU-India summit, which is scheduled for the 27th of January. Sources tell CNBC TV 18 there is a big possibility that both sides will sign a deal, and that trade deal is reasonably balanced. Well, we will end to a break, but up next, Wipro misses estimates in Q3, but Tech Mahindra delivers. That and more when we return. Well, the BJP-led Mahayuti has swept the municipal corporation elections across Maharashtra. Let's first focus on Mumbai, which in all likelihood will get its first BJP mayor. The Mahayuti is heading towards a massive victory and will control Asia's richest civic body. The BJP, which has historically fought the BMC polls in alliance with the undivided Shiv Sena, has emerged as the single largest party. This time, the BMC polls were also a battle for the Shiv Sena legacy after the bitter split in 2022. The Uddhav Thackeray faction of the Shiv Sena has outperformed Eknath Shinde's party. This despite the latter retaining the name and the symbol of the undivided Shiv Sena. Shinde, however, maintained his sway in Thane, his home bastion. A moment of truth for the Pawar faction as well. The party headed by Sharad Pawar and Ajit Pawar's NCP suffered humiliating defeats in Pune and neighbouring civic bodies. The BJP retained the Pune corporation by a huge margin. Away from the results in what comes as a unique feat, 3 members of the Matre family in Thane emerged victorious. But there's more to that. All of them had contested the elections on tickets of rival parties. On that note, let's go across to Santya Guru, who reports on the BJP's impressive BMC performance. Santya.
A big day for BJP in Mumbai as BJP has emerged victorious in these BMC elections held after 9 years. BJP has clearly stolen the show. Right now we are in Mumbai's Nariman Point area, and this is how this is BJP office in Mumbai, and this is how it's looking like right now. As you can see, the celebrations have started. So BJP and Shiv Sena contested these elections together. BJP as of now is leading on 90 plus seats, and the alliance will be able to appoint its mayor. But talking about Eknath Shinde, his performance is pretty low. As far as the alliance is concerned, it is emerging victorious, and definitely a big day for BJP, especially its Mumbai unit.
Santya, many thanks for joining us. That is the latest there on the BMC elections. Back to earnings. Wipro has reported a mixed Q3 with margins beating estimates. Revenue slightly short. Wipro's growth guidance also appears weaker. On the other hand, Tech Mahindra has exceeded expectations. The new labour code impacting profits of both companies by more than 550 crore rupees. In fact, India's top 5 IT companies have seen nearly 5,000 crore rupees shaved from their profits in Q3 due to the labour code. Rima is here with more on Wipro and Tech Mahindra's earnings. Rima.
Thanks so much for that. So let me start with Wipro. As you rightly pointed out, it's a good beat on the company's margins, but the Q4 guidance, that's the Jan to March quarter, is a bit disappointing. The company's top-line growth came in at 1.4%. EBIT margins have expanded to 17.6% versus 16.5%. So one reason for that is in Q2, the company had taken a hit of 50 basis points on its margins on account of a client bankruptcy. So that is not there. And plus, you've got the rupee tailwind. So margins have done well at 17.6%. But what will disappoint the street is the Q4 guidance, because the company had made a large acquisition, Harman DTS, which, according to analysts, could contribute up to 200 basis points in Q4. Yet the company is only guiding for 0 to 2% in terms of its Q4 guidance. So that is a bit disappointing. Deal wins for the company, particularly large deal wins, are also a tad bit disappointing. In current quarter, it's at less than $900 million versus $2.8 billion in Q3. Tech Mahindra, on the other hand, has delivered a pretty good beat on revenues, margins, and deal wins have come in at a 4-year high. The company's revenues have gone up by 1.7%. This is in a seasonally weak quarter. EBIT margins have expanded from a low of 4.7% in Q2 of FY24 to 13.1%. And even in Q3, margins have expanded by 100 basis points, coming in ahead of consensus expectation. This is the 9th consecutive quarter of a margin expansion for Tech Mahindra. Remember, the aspiration is to get to 15% margins. This was what was laid out by Mohit Joshi when he took charge. That comes to an end towards the end of FY27, Q4 FY27. So 15% is the goal. They're now at 13.1%. The company says the deal wins on an LTM basis. LTM is last 12 months, are also the highest that they've achieved in the last 5 years. And in Q3, deal wins have crossed $1 billion. Back to you.
All right, Rima, many thanks for joining us. Those are the tech earnings for you. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Don't go anywhere. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Anand Rathi and with me as always is Shruti Mishra. But Shruti, today India's startup landscape has reached a historic milestone as the nation celebrates 10 years of the Startup India initiative, with official data revealing that over 50 new startups are now being recognized across the country every single day.
Absolutely, Arundhati. And as Startup India turns 10, we celebrate the stories that shaped India's entrepreneurial journey with CNBC TV18's Young Turks, the OG startup storytelling platform at the helm of it for the last 23 years. And that's not all. Over the last 6 years, you've been getting your daily dose of all the startup action right here on Startup Street. So let's get on with the show. These are the top headlines from the startup space.
Quick home services startup Pink has shut down its operations, with its 3 co-founders joining rival Snabit in senior roles. Snabit also plans to hire more than 20 former Pink employees as it scales its Bengaluru operations.
Used car platform Cars24 said it aims to go for a public listing in the next 6 to 12 months as the company sees rising revenue growth in the first half of FY26. In a post on X, co-founder and CEO Vikram Chopra said the firm is on track to earn over 750 crore rupees in adjusted net revenue in the second half of FY26, recording about 35% year-on-year growth.
EdTech unicorn Unacademy plans to exit its offline business by converting company-operated centers into franchise partnerships in an internal email. Group CEO Gaurav Munjal told employees that the franchise model would allow the startup to employ an asset-light, capital-efficient business.
Prime Minister Modi celebrated Startup India movement marking its 10th anniversary. On National Startup Day, Prime Minister Modi congratulated all the stakeholders associated with India's startup industry, adding the ecosystem that started with 4 startups in 2014 has grown to over 125 active unicorns. He added countries leading the AI race will have an advantage.
Artificial intelligence startup Anthropic has appointed former Microsoft executive Irina Chase as its managing director for India. Chose served as managing director for Microsoft's India business, a role she held for 2 years before leaving the company in December 2025.
Well, those are the headlines we've been tracking for you this evening. The top story today: the Supreme Court has delivered a landmark verdict in the Tiger Global Flipkart case, ruling that capital gains from the Walmart deal are taxable in India, potentially exposing Tiger Global to a tax bill of over 14,500 crore rupees. The ruling calls the Mauritius route treaty shopping and strongly backs India's right to tax income arising here. So what does this mean for global investors, venture capital exits, and India's promise of tax certainty? Joining me now to discuss this further are Siddharth Pai, founding partner 314 Capital, Mitesh Shah, co-founder Inflection Point Ventures, and Ajay Rotti, the founder and CEO of Tax Compass. Gentlemen, welcome to Startup Street. Siddharth, let me quickly start with you. This is being seen as a big win for tax authorities, but from a VC lens, does this ruling risk denting India's attractiveness as a long-term capital destination, or will this just mean deal structures will have to be tweaked? Siddharth, I think you're on mute. If you could unmute yourself.
The attractiveness of the Indian startup ecosystem is not actually contingent on taxation. I think it's contingent on the fact that we're a large growing economy for that matter, growing one of the fastest growing economies of our scale in the entire world, with a large consuming population, high level of disposable income, and a very talented pool that ends up actually existing. While tax plays an important role in the internal calculation that ends up actually underpinning investment decisions, it's not the maker or breaker to end up deciding to invest in a jurisdiction or not. I think what the biggest thing of this is going to be, the takeaways from this are going to be, number one, for all the VCs and private equity funds who end up investing through Mauritius, the hygiene checks they have to do in terms of making sure there's actual substance in Mauritius, as opposed to Mauritius being just a mere conduit for that matter, is going to end up heightening. I think that's number one. Number two, also for that matter, for any of the investors who look at trying to optimize for tax, need to end up actually getting rid of that notion and end up actually working much harder to start generating higher market returns. And I think last year's IPO boom, the startup IPO boom, has shown that India can end up delivering eye-watering returns for all sorts of investors without having to resort to this sort of tax calculations also for that matter. I think number three, what's going to be most important is that the uncertainty around this entire Mauritius route has gone away. I think the Mauritius route, for all effects and purposes, is dead. and people are going to start coming to India directly as opposed to intermediate polling jurisdiction.
All right, let me go across to Mitesh now. Mitesh, do you agree with what Siddharth said? And at the angel and early stage level, are you already seeing nervousness among foreign investors, or is this being viewed as a Tiger-specific large fund issue? Do you expect more investors to now prefer direct India entities despite higher taxes simply to avoid future litigation risk?
Well, the potential for India doesn't deter at all with this. I think we are a great nation when it comes to startup growth and will continue to remain so. Taxation is a byproduct. When you make gain, you pay tax. As simple as that. And I think the Apex Court has just put that in a ruling where it amply clarifies that substance over form. So I think people will welcome this judgment. Yes, there might be some reopening of previous assessments and all.
Yes.
But at the same time, I think this will not deter any investors to not look at India purely because of the tax.
Okay.
It might open GIFT City as a big destination over in India. So I think overall, in terms of having a proper base, having an effective place of management and having substance of management in the jurisdiction where they are operating from, that's going to define the future course of
All right.
for foreign investors.
Okay, understood. Let me get in Ajay. Ajay, the court has said that merely having a tax residency certificate is not enough. How big is this shift? There is also discussion around investments made before April 2017 and treaty renegotiations. Is the grandfathering protection now weaker than what investors had assumed?
So, on the first bit, how big is this shift? I think this is a shift which had started a while ago. A decision like this 15 years ago would have been catastrophic because businesses were not prepared for this. And I'm saying this as a tax consultant. I have always advocated what Siddharth and Mitesh just said, which is tax has to be a byproduct or you can't get the tail to wag the dog. The tax has to be a consequence of a commercial activity. And therefore, tax being a driver is history. I don't think we can take any decisions, including choice of jurisdiction based on tax alone or even tax as the main factor. That is now, if there were any doubts left, the Supreme Court ruling seals that forever. I think the industry has been moving towards that. So therefore, this decision is not going to come as much as a shock as we sort of would expect. The only negative, the way I see it, is because this could unsettle some of the investors with respect to how India has been looking at tax laws. And, we had a circular which says that a TRC is enough. And therefore, certainty, which has been a big issue for us on tax litigation and tax position and how tax administration views past transaction, that will still prop up. But overall, at a principal level, I don't think the Supreme Court decision is going to change how businesses look at structures.
All right, Ajay, so could this reasoning now be applied to investors using the Singapore Treaty or other jurisdictions? How wide is the legal ripple effect?
So it is quite wide, Shruti, because, tax residency certificate or a certificate of residency, as some of the countries call it, is the basic document to establish that you are a resident of a particular country. And therefore, that entitles you to a treaty. So it could be Singapore, it could be Netherlands, it could be Cyprus, it could be any of the treaties for that matter.
Okay.
The primary basis of which applying a particular treaty is the TRC. Therefore, if the tax office is not going to treat that as a conclusive evidence, then the impact could be across treaties, across transactions, not just capital gains.
Okay. Siddharth, coming back to you, do you see this verdict reopening old deals and creating uncertainty around exits that were considered settled? Would you say Mauritius or Singapore holding companies would become a thing of the past?
Oh, 100%. I think given the fact that GAR, the general anti-avoidance rules, have actually been applied to this as of now, everyone believed that your older investments were grandfathered and actually immune from GAR. I think everyone's now awoken to the fact that GAR ke aage jeet hai, and they have to end up actually pleading their cases now in the courts with regard to the application of GAR, which places the onus on the investor to show that they did actually have substance in Mauritius or Singapore, for that matter itself. I think for all the exits, and Ajay can actually correct me if I'm wrong, but all the exits from financial year 1920 onwards, there is a strong chance that the tax department can end up actually opening up all of them as of now, reopening assessments, and end up actually applying the lens and the razor they've gotten from this Tiger judgment against all those cases. So it is important to be well aware of that and to end up guarding against it as well.
All right, final two questions. One, Mitesh, for you, if you could quickly answer that. Founders watching this might worry about fewer global funds or tougher exit renegotiations. Does this change how founders should think about choosing investors or structuring offshore holding companies?
Well, I don't see any reason for founders to worry. One, global interest in India will continue given the value that we produce. Second, there are ample of Indian funds as well, which can look at great founders. But I think in terms of overall understanding of founders, very, very important for them to understand the VCs with their effective management as well.
Okay.
Just having a Singapore or Mauritian present will not kind of justify now. You need to look beyond the paper and look into the substance of the management.
All right, Ajay, final words. What would your immediate advice for funds and startups be? What should they change today? And, if you're a global investor looking at India today, what's the single biggest change you must make in how you structure, invest, or exit?
I think the most important thing is if you're choosing a particular jurisdiction, then you better have a commercial rationale and a commercial decision. Let business drive tax and not the other way around. That would be the single biggest, input for structures, not just holding structures, but for even your transaction and operational structure. Let business drive tax. Therefore, if for business reason you needed to be in Singapore, then that's good enough, and therefore you'll be able to justify it. But if you want to open a holding company in Singapore, Cyprus, wherever, only because there's a tax benefit available, then you are in trouble.
All right. On that note, I'll have to wrap up our conversation. But gentlemen, Siddharth, thank you so much for your time and for joining us on Startup Street. Of course, Mitesh and Ajay, again, thank you so much for your time.
Thank you.
Thanks for that. Thank you.
India's energy transition story is attracting serious capital. Transition VC has closed its debut fund at 700 crore rupees, nearly double of its original target as investors bet big on India's future of energy. The fund is backing engineering-led startups across electrification, storage, industrial decarbonization and alternate fuels at a stage where conviction is scarce but impact can be massive. So what's driving investor confidence? Where's the capital going? And how big can this platform become? I'm joined now by Rayan Shingati, the co-founder of Transition VC. Rayan, thank you so much for taking time out and being here with us on Startup Street. Fund 1 closed at nearly double the original target, right? So what sort of changed during the fundraising journey, and what did LP see in your thesis that gave them the confidence to back this particular theme in such a big way, and how big is this opportunity?
So we've, thanks to LPs, of course, and thank you for having us. So we've successfully closed a 700 crore fund, oversubscribed from our initial target of 400 crores. I think this strong response shows the growth in conviction that India's energy transition is no longer optional. It's not about just climate change. It's about India's energy security and long-term energy independence, especially in today's volatile geopolitical environment, right? We see this as a massive $250 billion plus opportunity in India by 2030. And we are backing startups that are making real decarbonization difference while making real money. So, yeah.
Sure. Yeah, and within this broad energy transition theme, right, there's electrification, storage, alternate fuels, industrial decarbonization. Where are you sort of leaning in most aggressively today, and which areas do you believe are still sort of underappreciated?
So we invest in energy solutions that make existing solutions faster, cheaper, better, and not just science projects. So the real opportunity that we see is in industrial decarbonization, data centers, smart meters, electric mobility value chain, advanced manufacturing and green manufacturing solutions, and also long duration energy storage and power electronics, semiconductors as well. And these are exactly what we've backed from our Fund 1 so far. We also see a massive opportunity in the whole hydrogen economy coming up. And this, we believe, would be very important for India's goal to be eventually energy independent.
Sure. And how much of this Fund 1 is sort of reserved for follow-ons? And how actively do you plan to double down on breakout companies as they move from early traction to large-scale execution? Take us through the deployment plan at this point. You've already invested in a couple of companies, so take us through that plan.
So we've invested almost 60% of our capital. We've identified about 17 startups, and we believe we will invest the remaining by end of this year. So we invest something known as catalytic capital, which we believe is a major gap in the market. This is where after the product is developed, but before product market fit is established. This is a major gap today that we are filling in with our capital. We invest anywhere between 1 to 3.5 million over the life of the startups. In some cases, we invest couple million, and then we reserve another 1.5, 2 million to help them achieve product market fit at scale. We measure success very clearly, and for us, it is helping startups hit almost 100 crores of revenue, turn towards EBITDA positive within 24 months of our investments, which is slightly unconventional in VC investments because we believe in positive unit economics and not growth driven by cash burn. So with that belief, we invest a lot in hardware technology solutions, which again is quite ignored by most VCs, unlike software-driven solutions.
Sure, and you've already
That's exactly
seen...
where we massive.
Yeah, and you've already seen acquisition interest across the portfolio, right? So how are you sort of thinking about exits, strategic M&A versus IPO pathways in India's evolving energy and manufacturing landscape?
Absolutely, and those are tough calls, right? So we've seen over 6 acquisition offers, and they're tempting because there are multiples of where we invested at. But we believe in our founders because they want to build something larger than themselves. Indian public markets has rewarded engineering companies very, very handsomely, which is why we believe providing the right resources, which is not just capital, but also deep domain expertise, which comes from our LPs to help them open up our networks, convert relationships to purchase orders, and really hit that 400 to 1,000 crores of revenue in 5 to 8 years of our investment period and drive them towards IPO. It would be good to see almost more than half of our companies move towards IPO eligibility. That doesn't mean that they'll all go IPO within our investment horizon. Some of them would be pre-IPOs or secondary exits, but about 30 to 50% of our portfolios could also be M&As, and that's purely driven by high gross margins and VC scalable businesses that our founders have built.
Sure, and with Fund 1 closing at 700 crore rupees, Fund 2 is already seeing early commitments, right? How are you sort of thinking about AUM growth over the next few years, and what does right-size scale mean for a sector as capital-intensive as energy transition?
This is something we've heavily debated internally, and it's a good problem to have in early commitment for Fund 2 as well. Even though we have not started raising capital, we want to start raising capital before the end of this year, after we've completely deployed. We believe it should be at least a 1350 crores or a $150 million fund. And we've built a solid thesis around it. And we believe that's exactly what India needs for the next 3 years of energy transition growth. And we would be here with the capital to provide it.
All right, you will be there with the capital to provide it. All right, Rayan, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best going forward on this journey.
Thank you. I appreciate it.
On that note, it is time for us to head into a short break. But coming up next, AI services firm Ivar bags $4.6 million in a seed round led by Soren Investments with participation from Bessemer Venture Partners. We put the firm's founder on the hot seat to find out more. Stay tuned.
Well, on the hot seat today, we have AI services firm Ava that has raised $4.6 million in a seed round that was led by Soren Investments with participation from Bessemer Venture Partners. Operating as an end-to-end AI studio, Ava spans strategy consulting, custom AI solution development, and managed AI operations, and it claims to have scaled to more than 80 customers in under a year. The startup says this new funding is going to be used to expand their presence across the India, US, and the Middle East, while also continuing to invest in the AI accelerators, senior talent, and global delivery capabilities. For more on this, joining me now is Kaushik Rajendran, the co-founder and CEO at Ava. Kaushik, thank you so much for your time here on Startup Street, and congratulations on that $4.6 million fundraise. Start by telling us where exactly are you going to deploy this capital, how much into talent, how much into accelerators, and how much into global expansion?
Thank you, Ritu, for covering Ivor. And see, this funding is going to unlock four things, right? First is geographical expansion. We are scaling across India, the US, Middle East, and this will help us to strengthen our India market, at the same time expand in US and Middle East meaningfully. We also have plans to scale in Singapore and Australia in later part of the year. Second, deepening our AI talent pool. We are hiring senior engineers and also delivery experts. And then thirdly, it's going to help us improve our accelerators that we have currently. When I say accelerators, these are AI solutions that can readily be deployed in customers with very minimal customization.
All right. So far, you've scaled to more than 80 customers in less than a year. What does that translate to in revenue today for you? And what kind of run rate are you exiting this financial year and say the coming year with?
Absolutely. Basically, we were able to scale fast because of three reasons, right? One is strong validation because of our initial customer traction and collaborative GTM with cloud players like AWS being their strong partners, and some of the competencies we have learned like generative AI competency. Now, these credibility opens door for us, right? And second are accelerators. We are a service-first company, but also we have accelerators, and we also operate at studio model. Now, what customer would see is an immediate traction in weeks, not like quarters or month, which would be a typical use case when you're working with an SI from traditional setup, right? And these are the factors that are helping us fuel scale fast. And number two is we are operate at a product level margins, and also like we deliver at a much accelerated pace. So blend of all of this is scaling fast.
I was reading that you talk about delivering projects in weeks instead of months for companies. What does that do to unit economics? Do you get higher margins per engineer or just faster revenue velocity?
It's both. This helps us to basically cut short instead of using like a traditional setup of 20-30 people team with like over a year-long project to like 6 to 8 weeks kind of a delivery with a very lean team augmented by AI. So this basically helps us reduce the cost for the customers and also like improve velocity of how we deliver.
Okay, you told us at the start you have expansion planned across the US, India, and the Middle East. Which geography out of these is expected to drive the bulk of your revenue growth over the next 12 to 18 months? And which of these is the fastest growing for you?
See, interestingly, all three geos that we want to land and scale, which is India, we are already scaling quite well. And then in the US, a bulk of lots happening in the US market. So naturally, we would be investing into the US market. And third, we are also seeing significant traction and announcements in the Middle East as well, like a lot of infrastructure and also sovereign cloud being built on Middle East, where there is a need for a company like us to build solution and last mile application. Same is the case with the US being bulk of whatever AI wave is happening. So we are going to invest a lot more in the US as well.
Well, Kaushik, finally, how capital efficient is the model? I mean, with this round, how much of a runway do you get? And also, secondly, when do you expect Ava to reduce or rather reach cash flow break even?
See, Ritu, we are already good when it comes to operating expense and everything, right? So we raise money to basically scale fast, because as a founder of this company, our fear is to basically opportunity loss, because a lot of very interesting things are happening across the globe, where this capital is going to fuel our scale across different geo and also deepen our relationship with our existing engagement, not necessarily to sustain what we're doing. So this is going to help, like I mentioned initially, to hire fast and scale meaningfully across all these regions. Because see, our vision is to help a lot of enterprises to move from isolated pilots to become operating system of enterprise workflows, right? With measurable outcome. So this capital is going to fuel that.
All right, Kaushik, we'll leave it at that. Thank you very much for joining us here today. It's been a pleasure speaking with you.
Thank you, Ritu. Bye-bye.
Okay, and on that note, we're going to wrap up this edition of Startup Street. From all of us here, goodbye. Thank you for watching. Stay with us. More news and updates will continue after this break.
Typically, a 60-year-old going into retirement was thinking about how do I give back to my children or leave more for my children. It was never about how do I take care of myself.
Having done this for 15 years, I'm now starting to see this demography wanting to spend. The pie has increased. I think the wealth that India has seen and the wealth that the current 60-year-olds hold, they're not having to make that trade-off.
As we look at this longevity debate, Taran, I want to understand how you're viewing it.
I think it's almost too short-sighted to think that you can, twist and play with the fundamentals of how life is going to work. We want to make the years that you are alive physically as joyful, as healthy, and as happy as possible. Forget even for a minute the 350 million people over 60. You take 1% of that. Who is going to care for them? My nickname growing up was Granny. So I think I always...
Why were you called Granny?
I was always older than my actual age. I think I behaved older. I thought like an older person. And then I got into the senior care business. So it's clearly proved everybody right that I am inherently a lot, I think, older.
Old soul.
An old soul.
India is aging faster than it is prepared for. According to reports, 11% of India's population today is 60 plus, and by 2050, this number is projected to be double to almost 21%, which means that 1 in 5 Indians will be a senior citizen. Longer life expectancy, smaller families, dual income households mean more seniors are living alone. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Joining me on the program today is somebody who has been on Young Turks and is trying to address the problem of what we do for senior care. We put the spotlight today on Antara Senior Care, company that's reimagining senior care, not as a charity or custodial living, but as a structured, scalable business opportunity built around dignity, wellness, and continuity of care. Tara, it's wonderful to have you back on Young Turks, and thanks very much for joining us here on Reloaded.
Thank you. So happy to be back.
So 15 years now, Tara, of doing this, but I want to understand from you, as you look back, this was a space that had a whole bunch of societal sort of stigma attached to it. Nobody wanted to even talk about the possibility of setting up senior care homes because the idea of sending your loved ones to a senior care home, courtesy Bollywood and all of that, was just traumatic. But has that changed, and how much has that changed in the last 15 years?
It's absolutely changed. I remember walking into a room for the first 2 or 3 years of starting Antara and always having to push the conversation and having exactly that reaction, saying, oh, you're making an old age home. I don't want to live in an old age home, or I don't want to send my parents there. And I feel when we started Antara, we were very clear that this is going to be more than just senior living or retirement living. We wanted to be a brand that people thought of as they got older or had loved ones who were getting older. And so when COVID hit, and at that time we had the one Antara Dehradun residential community, and we had launched our second vertical care homes. I think that changed the game and the narrative for us. People started believing in wellness a lot more. They understood that as they get older, they need an ecosystem to support them. And so when I walk into a room now, especially actually the last, I would say 2 years, investors, organizations, corporates, and even people looking at starting new businesses have been talking about this space as a whole. So it's very exciting.
So it took the pandemic for people to understand the use case for a business like yours.
I think it did. And also by then, I suspect that because we had done things the way we had done things and people had something to engage with as a concept or a product or a service, it changed their mindset as to what the concept could actually be. And it took that much time for us to prove ourselves. And then for other players also to start seeing, hey, this could possibly be a benchmark for the narrative to change.
But let's talk about the business case of this now. And, Max Holding is the listed entity. Antara is a part of that. As you look at your expansion plans, as you look at building this out pan-India, if that is in fact the aspiration, what do you think it's going to take for you to be able to do that?
So Antara is 3 different business verticals. And I want to create that distinction because each one will have different opportunities and challenges. So the first with which we started was what we call senior living, retirement communities. Dehradun was the first. We then launched a project in Noida, which is fully sold out. And then we did a partnership with Max Estates for Gurgaon. And so in that ecosystem, now I feel what it's going to take is just us being aggressive and finding opportunities to grow. And the pathway to that is 1.5 million square feet a year of commitment, which will over the next 8 to 10 years give us 8 to 10 communities. I think there's a huge opportunity there. And so really it's just about us being aggressive and saying who can we partner with, because we as Antara will not go buy land and do all of that. We want to partner with people who have the land, who have the expertise of construction, but we will bring the expertise of design, sales, and of course, eventual operations. The second vertical is what we call care homes. That's sort of the sort of colloquial way to explain it is assisted living, short-term and long-term. There, I think there are going to be 3 things that are going to push us. We have 500 beds as of the next 2 weeks between Bangalore, Chennai, NCR. A is going to be finding infrastructure that allows us to retrofit and move quickly. And that has been a challenge, and I think will continue to be because we know compliant infrastructure in India is a challenge. 2 is insurance, which has also started to get unlocked. For insurance players to potentially think of assisted living as a focus product or even combine it with a healthcare product is going to be the big unlock there. And 3 is actually going to be just awareness, which again, we're starting to see shift because it is category building as well. Age Easy, which is our newest baby on the block, D2C platform for products to really help people with conditions that are chronic and age related. I think that's been the most quick to market and the most exciting. And I think the challenge there is just to keep our metrics of ROAS, of margins, and hold those very, very tight so that we can play the long game there.
So let's unpack each one of these. And let's start with the first, which are these residential communities, courtesy Antara Living that you're creating. Now, typically, who are the people who can afford to be at an Antara Living facility? I mean, how much does it cost? And when you talk about building out an ecosystem of partners because you don't want to buy the land, you don't want to get into actual construction, you essentially are managing the property for somebody, who would typically be interested in partnering with you? What have you seen so far?
Yeah. So I think who is buying is, we actually have 2 variations of the product. When we launched Antara Dehradun, it was almost product first. We had a dream. I had a dream, a vision. And that was what it cost. And we tried to find the market that would buy it. After that, I said, look, I think to make this a scalable business, I have to think customer first. I have to think what are they willing to pay and what are they willing to pay for. And that's how Noida came about. So 2 very different price points. The thing that stays sacred amongst all of our communities will be our deep mission to impact quality of life. So our services don't change, but I would say the per square foot cost between Dehradun and Noida and then
is very different.
Is different. So example, today, Antara Dehradun is reselling at 26,000 rupees a square foot. We launched also back then at 100% more expensive than the next real estate comparison. Our monthly charges are 3 times of that. And so that was the big pushback there, and it took us therefore longer to sell. But today, I mean, when I think about the resale value, I'm shocked myself. Noida launched in 2021 at about 9,500 rupees. It's now reselling at 15 to 16,000 rupees. So there's still a 10,000 rupee per square foot price difference there. And we just launched Gurgaon Estate 360 and 361 at 21,000 rupees. So who is buying are therefore people who can afford a ticket size of 2 to 7-8 crores, depending on the size of the apartment they want, and who are willing to pay a monthly charge more than a regular condo because we pack in a lot more services. And that can vary from about 30 to 80,000 rupees a month, again, depending on the size of the apartment. So that's who is buying. And in terms of the partnerships that we want to create, when we finished Dehradun and looked for partners, it was a big struggle because why would anybody partner with a concept that was so nascent? They could command velocity as well as per square foot rates of traditional real estate. But as the market has changed and people believe in what we do, they realize that we can command a premium. So we actually sell 15% more per square foot in terms of a sales price than anything that's next to us. So now those are the partners who say, we want to diversify our portfolio. We believe in the senior care spaces being high demand. And we want to work with an organization like Max and Antara that has high governance and high standards. So far that partnership has been with Max Estates. Yeah. Haven't had to go too far and they will continue to be our partners in NCR. And we are therefore looking for partners in the top 5 markets that we believe, which are, Chandigarh, Bangalore, Chennai, Hyderabad, and perhaps even Goa.
2 to 7 crores is the elite market. Yeah. I mean, it's what you could call premium or what you could call luxury. Is there space then to do anything for the mass market to make this product more affordable?
100%. I actually believe if we are 350 million people over 60 by 2050, there is a market at every price point. The reason we haven't entered that market yet is because we know this market better and we want to play to the strength right now. So in our scale up the next 3 to 5 years, we want to continue to play in this price point.
So what have been some of the big learnings, of the last 15 years in terms of customer behavior, in terms of customer expectation, also in terms of customer fulfillment? Because, so far the Indian marketing community or the Indian sort of entrepreneurial community has been servicing the demographic dividend because that is what we have been accustomed to believe. That
number has come in this time around higher at 18,645 crore rupees, which is higher both on a quarter-on-quarter and on a YOY basis. Remember, it was expected to be a strong quarter for Reliance Industries led by their oil to chemicals business, and the retail business was also expected to do well because of the festive demand. Jio would see some improvement because of high subscriber growth and some tariff hikes as well. So all in all, expected to be a strong number, and that is something that we can see in the performance as well. In fact, the EBITDA this time around, that number will come up for you on the screen, has come at 46,018 crore rupees, and this number is at a 7-quarter high. So that's the kind of performance that we've seen with Reliance this time. The profits are higher on a quarter-on-quarter basis as well. Now, do remember, you will see quarter-1 profit to be way higher. That is because of the stake sale. But other than that, on a consolidated basis, the numbers look very strong. But retail, Mangalam.
Yeah, the retail business is doing extremely well this time around. 97,912 crores is what the company's quarterly revenue is. This compares with 90,351 crores, which implies that the retail business has risen by high single digits, a little over 8%. And that's pretty much par for course, given the fact that, the festive season this time around was spread over 2 quarters as against just 1 quarter same time last year. And also the company has demerged their consumer products business. So that has been taken into account for the base as well. So if you look at, just a relative performance for their retail business, a high single-digit growth in this environment at a time when the GST-related price rationalization has happened as well is definitely a positive. Retail EBITDA too has seen a jump from 6840 crores all the way up to 16915 crores, telling you that the margins of the retail business over 7% have been steady as she goes. So the retail business continues to do well for Reliance. High single-digit revenue growth, the EBITDA margins stable, the EBITDA stable as compared to last year as well. And this despite an unfavorable base where festive season last year was concentrated in the third quarter as against this year where it was spread across quarter 2 and quarter 3. And the performance that we saw despite the demerger of Reliance's consumer products business. So all these factors taken into account, good thumbs up for the retail business too.
And that's the case for auto chemicals business as well. Now, do remember Singapore GRMs, they were up 100% on a sequential basis, and that shows in the numbers as well this time, right? The O2C business EBITDA has come in higher at 16,507 crore rupees. Even if you look at that number and compare it with the previous EBITDAs, that too again is at a 7-quarter high. So both consolidated EBITDA and O2C EBITDA has come in higher. O2C margins also have come in at a 7-quarter high, 10.2%, which compares with 9.4% on a quarter-on-quarter basis. And if we look at it on a YOY basis as well, that number is higher. Yes, oil and gas business did see some decline, but do remember deep water prices, the gas prices, they have been lower. And that is something that you're seeing in the margins as well for oil and gas business. Their margins have declined to 83.3% versus 87.4% on a YOY basis. In fact, we do have Sunny Agrawal joining in from SBI Securities with a quick take on Reliance's earnings this time. Sunny, what did you make of the numbers? O2C looks like a beat, so does retail, and overall EBITDA has come in at a 7-quarter high as well.
Yeah, good evening, everyone. I think broadly numbers seems to be very strong. To be very honest, I have not gone through the press release. If you can just repeat the numbers for retail and telecom business, it will be really helpful.
So we're still awaiting details on the telecom business, Sunny, but for retail, what we have right now is a revenue growth of 8.5%, 97,912 crores on the retail top line. The retail EBIT is, EBITDA rather, is 6,915 crores. This compares with a number of 6,840 crores. So it's stayed stable year on year. A marginal increase of 1% is what we've seen. Margins for the retail business have been 7.1%. This compares with 7.6%. Over the last, I think, 7 or 8 quarters, you know, the retail business margins have been hovering between 7 and 7.8% odd itself. So no real problems out there. The retail revenue up 8.5%. Sonal, you want to fill him in on the O2C and other numbers?
Yes, Sunny, so oil to chemicals business has been very strong as well. The revenues have come in at 1.62 lakh crore rupees. If you look at the EBITDA number as well, 16,507 crore rupees, that number is at a multi-quarter high, 7-quarter high to be precise. O2C EBITDA margins have come in at 10.2% versus 9.4% on a sequential basis. And if we talk about the oil and gas business, that is where we've seen some weakness, which was quite expected actually because of the macros that we have seen with deep water gas pricing, which is lower by around 3 and 4% on a quarter-on-quarter and on a YOY basis. Margins there as well have come in at 83.3%. And we do have the oil and gas EBITDA, which has come in at 4857 crore rupees. So some weakness in oil and gas, but strong showing by retail and O2C segments this time. Sunny, over to you.
Yeah, definitely. I think, again, in line with expectations, so upstream business was supposed to be slightly drag on overall performance because of weaker crude oil realization. However, as expected, because of a very strong GRM, which we have witnessed even in the case of MRPL, so seems that business has contributed very well in terms of growth for this quarter. Retail, only one concern which I feel after reporting a 2 quarter of very strong double-digit top-line growth, seems this quarter we are again back to a single-digit top-line growth. But again, the margin expansion is something which had definitely aided in EBITDA growth as such. Overall, seems a kind of mixed bag kind of number, however, in line with our expectation.
Sunny, the question is, the stock has been underperforming, at least since the start of the year. Reliance Industries share price is down nearly about 7-8%. Is there enough in the numbers for the stock to reverse its underperformance? How do you expect the stock to move in the near term?
I think, again, all the negatives are already in the price, and we continue to remain constructive on the business, predominantly led by likely unlocking due to the IPO of its retail and digital business. So that can lead to a re-rating on the retail side. another important aspect is ahead of IPO, we may see a kind of increase in telecom tariff. So that should again aid in a better margin for the telecom business. So overall, if you look at the sum of the part, we believe the retail and telecom business together should constitute closer to 1,200 rupees per share value. And oil and gas business, which include both upstream as well as downstream business, should constitute kind of 500 rupees per share value. And if you ascribe total other, if you ascribe value to other businesses, which includes the investment in a new energy business, we believe that's closer to 250 rupees. So we believe the fair value of the business, if somebody can hold the stock in a portfolio from 12 to 18 months perspective, is closer to 1950 rupees. Yeah. So again, 19. I believe. Yeah,
yes, Sunny, that is what, yes, 1950, that's your target on Reliance Industries, and right now it's trading at 1457. The stock did hit a record high of around 1611 on 5th of January, and it has retraced from those levels. Sunny, you spoke about the new energy business as well, and you have ascribed a value of 250 rupees a share on that one. Some of the capacities are expected to come in this year itself. What kind of contribution are you expecting from that business? Is there a trigger which could be seen in financials in FY27 itself?
I don't think so. So just to correct, 250 rupees is not the entire value for new energy business. That includes other investments also. So what we believe is that new energy business should start contributing beginning FY28 or 29 meaningfully, not immediately from FY27 or 28. So maybe slightly away, maybe right now we are valuing the business based on the investment. So 2x price to book is something which we are ascribing to the new energy business.
And what's the multiple that you're ascribing for the retail business here? You've given us a SOTP valuation, but if you could give us, the assumptions on which you've ascribed that value?
So again, on the retail side, we have ascribed the value in terms of EV/EBITDA multiple 28 times Mangalam, in line with other retail major which are trading in the market in terms of share.
All right, 28 times the EB to EBITDA on the retail business. And when you say that you're looking forward to some sort of value unlocking coming by in both the telecom and the retail businesses, what's the nature of that value unlocking that you are expecting in your model? Because if it was supposed to be, a situation where the current listed entity is a holding company, then at some point there would be a holding company discount as well, right? So how do you account for that?
Yeah, so when we ascribe the 600 rupees value per share for this, 1200 rupees value per share for this entire retail business, we have ascribed a 20% holding company discount also. So I am telling this value including a holding company discount.
Got that.
Okay. Sunny, also wanted your take on the oil and gas business because, the production coming in from there is huge. It's almost 30% of the consumption that the country does, right? Deep water gas prices have been lower. Do you expect some recovery come by in the gas space overall, gas pricing, gas production? Is this a space which you think could start contributing very soon again, or there'll be some time before we see that?
Again, I think overall environment seems to be slightly benign for entire oil and gas industry. So as the crude oil prices continue to hover closer to $60-65, and even globally, if you look at the gas prices, they are continuing to remain under pressure. I think it will take some time for upstream business to start contributing meaningfully. I wanted to keep in mind that as we speak, closer to 50% of EBIT is coming from consumer-facing business, whether it is retail or telecom. And as we move ahead, I think the growth driver will continue to remain the consumer-facing business. And over the period of next 2-3 years, you should see the contribution of oil and gas, including upstream as well as the downstream business contribution should reduce going forward. So I think ultimately the growth kicker is the consumption as a segment, and that is something which Street will looking forward to.
One thing that the Street would have been looking forward to is some of the internals that have come in from the numbers. So the press release is out. Sunny, I'm just reading some of the parts which are relevant to the retail business here. They said that the business delivered a steady performance of 8.1% growth. Importantly, I'm looking at their store additions, and they've added about 4.6% jump in the stores from 19,102. Now the total store area is around 19,979. With the area which has increased by just 1% from 77.5 million square feet to about 78.1 million square feet, which means that the revenue per square foot has actually increased for Reliance Retail, and that's as against all the other players, including the likes of Trent, etc., where the revenue per square foot has come down. That explains the operational resilience for Reliance Retail. They've added 431 new stores. The registered customer base increased to about 378 million. And if you look at the grocery business here as well, key categories, dairy, frozen bakery grew about 23%, staples grew by 19%, packaged foods grew by 15%. We also saw a 40% growth in namkeen, 32% growth in chocolates, etc., given the festive season. Jio Mart did extremely well. And, the other parts of the business, including the likes of Reliance Jewelry, which grew about 13%, AGO Lux grew by about 41%, and consumer business as well did extremely well. All of this is not taking into account the Reliance consumer business, which was demerged this quarter. The quote that has come in from Isha Ambani, she says that it is a steady quarterly performance by prioritizing trend-focused assortments, seamless omni-channel experiences. They believe that the business will continue to do well going forward. Any other details that you have, Sona?
Go ahead. On Jio, we don't have the revenue or the margin performance, but what we do have are the internals. Subscribers have crossed 515 million subscribers, which means on a quarter-on-quarter basis, it's an addition of 8.9 million subscribers year-on-year, about 33 million subscribers. Now, 515 million subscribers in Q3 is higher than estimates. The street was working with 6-7 million subscriber addition. Sequentially, the company's done 8.9 million. So that is a positive. ARPUs have come in at 213.7, 213 rupees 70 paise. That's a modest increase of 1.1% on a quarter-on-quarter basis, 5.1% on a year-on-year basis. But this has come in line with expectation. In the absence of a large tariff increase, the increase in ARPUs for the company has been very, very modest. Every quarter it's been going up by 1%, 1.5%. It's basically happening by migrating from 4G to 5G, moving from the Jio phone users to 5G, premiumization. So that's been driving the ARPU increase. But till we get a big bang tariff increase of 10, 12, 15%, we will not see that step jump in the company's ARPUs. But for Jio, in a nutshell, subscriber numbers better than estimates. ARPUs have come in line with estimates.
Okay, all right. It has largely been in line. Retail has done well. Jio, as Rima just explained what the numbers look like. For oil to chemicals business, as I pointed out, it has been very, very strong. The company additionally has also expanded their fuel retail operations. It is up in terms of their network or the stores or the outlets. It's up 14% on a YOY basis. And overall volume growth for petrol has been 20.8% in terms of sales and 24.7% in terms of diesel. So this is a segment we don't talk about much, but this has also been driving growth for the oil to chemicals business overall. If you talk about their cracks, the company says cracks have been very strong across the board, be it diesel cracks, be it petrol cracks, or the ETF cracks as well. They're up anywhere between 38 to 90%. So Sunny, come in on this, because we are seeing a lot of changes, a lot happening geopolitically, right? Be it Venezuela, be it what's happening in Iran. Do you think that is something which could put pressure on cracks going forward? Or do you think refining margins will continue to be strong?
I think, again, as you rightly pointed out, because of this geopolitical tension, there can be some disruption in terms of the cracks which are likely to be enjoyed by all these refining businesses. But again, let's hope that, this is all temporary in nature, and going forward again, once this trade uncertainty reduces, maybe FY27 is a year, maybe second half, where we may see again normalcy returning back to the spreads in them into O2C businesses. So I think maybe short-term drag is likely because of this ongoing geopolitical tension. Maybe, but in the longer term, I think business should return to normal for this oil and gas.
So you think Q4 could be volatile, but these elevated margins that we saw towards the end of Q3, they could normalize a bit. Is that what you're saying?
Yes.
Okay. All right. This is about the O2C business. The retail business has done really well, and Mangnam just highlighted how there has been strong store expansion, and this is something that we saw in their retail outlet as well. The ARPU growth has been strong. The subscriber growth has been strong too. So we'll just get in some more reaction. But before that, Mangnam, anything to add on the retail side?
Well, one of the most exciting consumer prospects for Reliance Retail this time around has been Shein. right, when they brought over Shreen, and they were expecting the value fashion part of the business to do extremely well. And they've given some color on that. It's seen 6.5 million app downloads or app installs, which is fairly positive. AGO Rush has reached about 420 pin codes. And at the same time, if you look at the Reliance Quick Commerce verdict as well, that's been extremely strong. So JioMart, which is their quick commerce business, has actually seen an exit daily orders of 1.6 million users, or 1.6 million orders per day, and recorded 53% growth quarter on quarter and over 360% growth. Obviously, this is on a favorable base, year-on-year growth. So Reliance is now making its full-blown foray into quick commerce as well by increasing the dark stores that they have. So JioMart has shown a 360% growth year-on-year, as against the industry, which is growing at over 80 to 100% every every quarter, year-on-year. 360% growth on Reliance's base. Obviously, they are scaling up their quick commerce business, so everyone will watch out for this one as well. Shein and quick commerce doing well.
Indeed, Piyush Pandey, research analyst, Centrum Broking Limited, is now joining in. Piyush, unfortunately, don't have the revenue, EBITDA, profits number to share for Jio Infocom, but we have the subscriber numbers, 515.3 million in terms of subscribers, while the ARPU, the average revenue per user, has inched up by 1% to 213.7. How does this compare with your estimates?
Broadly, I would say numbers are in line with estimates. So increase in ARPU were definitely close to 1% sequentially, and this is primarily to do with higher FW addition. Their customer addition has been on the higher side, so roughly they have added close to 9 million customers. But I think the concern has been muted this ARPU growth, and we expect that companies will be taking some tariff hike by the end of this quarter, or maybe in 1 or 2 quarters. So that remains a key concern for Jio, like how they want to drive the ARPU growth.
But the ARPU growth will come in only when there is a large tariff increase, right?
Yeah. So see, Bharti Airtel has been more successful in driving ARPU increase quarter on quarter. But for Jio, I think except tariff increase, that increase has been very, very muted. If you see for last several quarters, so this quarter again, just 1% increase in ARPU. However, the increase in number of customer base has been on a much higher side, like we've been sustaining over the last few quarters.
Okay. All right. Take that point. Let's get in Gurmeet Chadha into the conversation as well. Gurmeet, thank you so much for joining in. So just taking you through Reliance's numbers this time, Auto Chemicals business has seen a strong growth. If we look at the overall numbers for Reliance Industries, EBITDA consolidated basis has come in at a 7-quarter high of 46,018 crore rupees, margins at 17.4%, profits at 18,645 crore rupees. The retail business has seen a growth of 8.5% on a YY basis, which is led by the festive season, the demerger of Reliance Consumer Products and GST rate rationalization, and average revenue per user is up 5.1% on a YY basis, and it's a strong 7-quarter high growth, 7-quarter high EBITDA for even Auto Chemicals business. What's your take? Do you think this is something which would reverse the underperformance that Reliance stock has seen over the last couple of days?
I think the numbers are pretty steady and largely in line. I think I would have probably I'd be happier in case the ARPU would have been slightly better. So obviously their user base has grown at almost 51.5 crores now. So what the street would want to see is how much can they bridge the gap on ARPU with Airtel, considering that Jio also has a listing sometime this year. They are targeting H1. So I think that could be one big trigger of value unlocking. I think the numbers are largely in line, and probably the retail margins are slightly lower. From the first cut, whatever little I've seen, there's a minor drop there, and OTC is better because of Singapore GRMs, and that was expected. So I think largely in line, and I think the big trigger for the stock more from a larger move would be the Jio IPO unlocking and a slightly better growth in ARPU.
You're saying that, Gurmeet, the investors would want to see Jio's ARPUs closer to Bharti Airtel